Yes, people, happy afternoon. Happy afternoon. Are we on talking terms? I say hello, you say hello. Or I say hi, you say oi. Where are we? Fine, comfortable now. Okay. All right. Thank you all for joining with us. Maybe I'll try to reduce the volume a little bit. Is it echoing for you as well? Okay. All right. Yes, people. So welcome to the first session of what is this now? FM. Pakka. But they told me do advanced accounting. I came prepared for advanced accounting part. They suddenly they tell you do FM. Now I don't know anything about FM. So let's do advanced accounting only. Yeah, you do whatever you want, it's okay. Anyway, we're not going to understand both. What difference will it make? Correct? No. Okay, people. Yes, so welcome to the first session of CA Inter Financial Management ka Marathon. So since we have some time, I'm planning to do this for about 3 days. Okay. By the way, I am called CA Sandesh. So in case just you're watching me for the first time, I'm called Sandesh. My Mata Shri and Pita Shri named me Sandesh. The CA degree I got in 2012. So about 14 years back. All right. Since about 10 years plus, I would say I'm in the teaching field for the time being. I specialize in advanced accounting, and at Inter, fortunately or unfortunately, I handle FM modes. Okay. So now we have all gathered for FM marathon. So it's going to be a 3 days marathon, and I think some of you requested that it will be better to have an afternoon session. I think initially it was planned for a morning, but apparently you wanted to attend some class and come down. So we'll stick to the afternoon schedule itself. Schedule is very simple. 2:30 starting time. Ending time, don't ask. Mystery for me also, mystery for you. When it ends, it ends. Both of us we will know. Okay, now. So we'll have a certain targets in mind, certain topics ka target in mind. We will finish that whatever time it takes. It takes 8:30, 7:30, doesn't matter, or 9 o'clock also for that time. Fine. The moment that particular topic is done, then we all say tata bye bye for the day. That's a simple schedule. Okay, people. All right. So normally before we start the class, normally when we watch the videos, many students ask, sir, how to buy the books. So currently the FM marathon I'll be doing with the help of this chart book. You see this? Yes, I follow for all my subjects. I have a handwritten chart book, so which I will follow, and chart books look somewhat like this. I've added some extra comments as well for class reference purpose. So in case you want to buy these chart book, all right, you can do so from our website. Quickly, I'll just show so that we can avoid a few comments. Now go to our website in the Google. If you do learn.arivupro.com, if you punch in, it will take you to the website. There's another website, online.arivupro as well. So both can be used. That's okay. So I'm showing you the online or learn.arivupro.com here. Log into our website, go into the CA. Obviously, you are in CA only. Select CA Intermediate and select online classes. Sir, online classes here refers to the recorded classes. In case you want to buy a recorded classes, all the products which is available pops in over here. All right, we have various validity option. Whatever seems good for you, if at all you want to purchase, you can do so. That's with respect to our classes. Similarly, if you want to buy the chart books, which I'm using here for our marathon, you can go select the same thing, select CA Intermediate, under that select books. So you will get, just scroll down, whatever subject you want to buy the books for. Suppose you want to buy the book for financial management, select financial management. We have two kinds of book. One is our study book, which the faculties use for conducting the normal classes. And other one is chart or revision book, which I'm using it for marathon over here. So this way you can punch in your or given the right name, address, phone number, not your neighbor, so not your girlfriend, so your name, your address, your number you give, and books will be delivered to your place. Okay, Saru. So that is about sir, marketing, sir. Yeah, little we should know, sir. Yeah, fine. So that is about the books and the classes, sir. Anything else you have before we start the session? Yeah, can CA students watch these classes? Bindas watch much. Anyway, FM is anyway common. FM, accounts, costing, income tax. These are all what, sir. Doesn't matter whether you take CA, AC, CS or anything. Everything will be common. Maybe in CA, the syllabus will be little more voluminous. Maybe compared in CS, it will be little less. But still, it will be helpful. You can go ahead and watch. Not a problem at all. Okay. Kannada marathon law is the real law. This is going to be English marathon. Okay. All right. How about others? Can we dive into the subject? How is the Joe show? Very less so. Should be, you had food, no sapad, you had no proper sapad, no. Yeah, how is the Josh show? Better. Online probably they'll tell after 10 seconds. Relay, no. Yeah. Great, fair enough. Sir, before I dive into the session, I'm going to start the session with a small kutti story. Would you be okay with that? Small chinna kutti story. Sollama. Okay, ma. And full Tamil varadappa overload manage பண்றேன். ஓகேவா? அட்ஜஸ்ட் பண்ணுவீங்களா? ஓகே. இது போதுமா? ஓகே. Sure. Okay, listen. So you that story Tamil or we are there outside. No, story is going to be English. Don't worry. Sir, one fine day, a person, CA student, CA intermediate student, he felt like I'm breathing because of the tree. Because to be alive we need air. And air God does not give. In the earth, the God that gives air is the tree. So, with full gratitude, one day, same like yours, wonderful CA interest student, he took a bucket full of water. Bucket full of water, okay? And unfortunately, he didn't observe in that water, no sir, when he collected the water, there were some small rocks also. There were some small bits of rocks also already in the bucket. He did not observe. He took full bucket of water, started carrying that water, and he emptied the whole bucket and poured the water into the tree. He poured the water to the tree. Now the question is that in that bucket, only water was there or rocks was also there? Small rocks were also there. Now, will tree take in both water and rocks or only tree? The tree will only take in will the rocks get into the roots of the tree or only water? Only water. So the tree, sir, will have has a wonderful filtration system. Through that, it will take in only water. The rocks will be there on the surface. You can pour buckets and buckets of rocks. Will that rock get into the tree? No. It will only take in what? Water. Now, why am I saying you this? Same like the way tree has a filtration system, even you should have a filtration system in your life. Now it's exam season, right? Many of us will get our doubts in our mind. We'll compare. My friend has already finished 2 revisions. So I have not even finished the syllabus. So, right? All that negative thoughts will come. I am dumb. Time is less. So is it possible for me to finish, etc., etc. These sort of 101 negative thoughts will come into your mind. This is the peak season to get all those doubts. Now in your mind, you should have filtration system to cut off all those negative thoughts. It is not the time for you to worry about the negative thoughts. It is only time for you to do what, sir? Think positive, be positive, and achieve only what? Positive. Think that I'm already cleared the CA intermediate examination. Okay. In your mind, you already become CA intermediate qualified. One formality called exam. No, ICAI is asking you to come to one place, sit for 3 hours and write some autograph. They're asking you to put for how many hours? 3 years. This you'll have to do it for 6 to 7 days, and they will give you a degree called CA intermediate. Fair enough. Always think positive from now onwards till your examination day. Do not let even a single negative thought come into picture. The moment it comes, brush it off. All right. Think that what and all I can do after my CA intermediate exam is over. All right. What will happen after I clear chartered accountant? All right. Once I become that. So always it's time. Remember, it's not what has passed that matters. From now onwards till the examination time, what you do is what matters. Many people with just 25-30 days also have cracked both the groups of CA intermediate. You must have heard some tweets from our central council member. He tweeted that within 1 month I cleared both the groups of my CA final. But ideally, that will put a lot of pressure because you have to study a lot. But that's not ideal scenario to be. But I'm saying it is also possible. So don't have any self-doubt that time is less, syllabus is vast, can I do it and all that. Of course you can do it. Are we not sitting here? You believe that I'm a CA? You do not believe only much. They're not even responding. You believe that I'm a CA? That means if a dumb guy like me can do it, smartest Gen Z like you will do it like this. Nothing else. Yes, no. But so much reels, so much things you're used to it. After all, on book content you can't memorize and put it in exam, sir. Aram, so you will be able to clear. Not a big deal at all. Okay, sir. Having that positive thought in mind, can we start this positive topic? Yeah, give me once again. How is the Josh? How is the Josh? No. All right, people. So without further delay, so let's get. They're giving Pushpa dialogue and all that. Anyway, what Pushpa yesterday? Yesterday it released. When it released? 5th it released. Anyone watched? No, you are busy in CA intro. For your CA intro only is Pushpa. Yeah, I know. Bigger movie is going on in your life. So why do you want to worry about Pushpa? Correct, no? Makes sense. All right. Great. Yes, people. So without further delay, so let's get started with our topic. The first topic is today's target. I'll tell you before I start the class. 3 topics. Today we'll be covering 3 topics. Cost of capital, capital structure, leverages. These are the 3 topics which we'll be covering today. Okay. The first topic now we'll be beginning with is what, sir? Cost of capital. And one more, maybe before I dive into the session, I'll tell you, sir, one of the prerequisites for this, watching this marathon, sir, ideally you should have prepared the syllabus once. You should have studied FM topic once. Alright, because what we are doing right now here is the revision part of things. Alright, I may not have, normally my regular class, I do it for around 120, 125 hours. We do like, especially the topics, if you see, for working capital management and all, we do 50 problems. Right? For cost of capital, we have done like most of 30 problems. Now, we will not have time to do all 30 problems right now in marathon. Alright, I'll cover all the concepts, 100% of the concepts I shall cover. Problems, we will pick a little bit, considering the time into mind. Okay? So, ideal scenario is once you should have already prepared. Just in case you tell me, sir, I have not even opened my book. Now I'm watching your marathon, can I clear the examination? Sir, that is not the ideal scenario, that's what I would say. But I try my level best to cover all the concepts and probably little exam oriented questions. Fine, keeping the time constraint in mind, we'll cover as much as possible. I try my best to give the best shot possible from my end. Okay, Saru? Alright, sir. And the pace also at which I speak generally, usually face-to-face class, I speak a little slower. Here the pace will be little faster. Is this okay? Are we able to comprehend what I'm saying here? No issues, no? Okay, start. What is the topic name of? Cost of capital. Sir, cost of capital. Name itself is saying cost of capital. Sir, to run a business, you need money. That money only we call it here as capital. Sir, FM ka word capital and accounts ka word capital is not same. In accounts, when we say capital, we mean equity share capital and preference share capital. But in FM terminology, capital means money required. Capital means money. You can raise the money through equity shares, preference shares, or through loan or debentures. That loan debentures we call it as debt. You can raise the money from whatever source. All that is called as what, sir? Capital. Now that capital ka cost we are trying to find out here. Because I need 1 crore rupees. Will anybody give me at free of cost? I went to bank and told I need 1 crore. Give me macha. They will give up. I will give you, but you need to pay interest and EMI. That means that itself becomes what, sir? Cost. That means this topic is very simple, no, sir. If I go to bank, I need 1 crore loan. Bank will tell, let's say interest rate is 10%. Interest rate is 10%. That means that 10% only is a cost, no? 10% itself is a cost. So why should we compute cost once again, sir? Interest rate itself is a cost. Why to calculate once again? Interest rate, no, sir, is what you are paying actually to the banker. That is not really your cost. There are other factors also. What is that, sir? Check here. Sir, when you pay interest, when I pay, I'm the company, when I pay interest for me is income or expense? Expense. Due to my expense, what will happen to my profit? Profit will reduce. If profit reduces, what happens to my tax that I pay to the government? That will also reduce. That means due to interest, my tax liability is getting reduced. That means due to this particular expense called interest, I am getting one benefit. What benefit? Tax benefit. So honestly, touch your heart and tell, is the cost really 10%? No. I might be paying 10%, but I'm also getting some tax benefit. That is the reason in this topic, we'll have to calculate the cost of each source of capital. Fair enough, people? Right. Now, and first thing is, when we say cost here, no, sir, cost here refers not to the what amount you are paying to the providers of finance. Cost here refers to the expectation of the providers of finance. Suppose I take a bank loan, bank will expect some return, no? That for them, for a banker, what it is? Return. For me, it is what? Cost. The return expected by the providers of finance is what we call it as cost. There are various ways to calculate that. We will see. One by one, we will dive in. Alright. So first, here in this topic, there are 6 components. If I have to broadly say, 6 concepts are there which we need to keep in mind. One, we will have to find out the cost of equity shares. Cost of equity shares. Then we need to find out cost of retained earnings. Then we have to find out cost of preference shares. Then we have to find out the cost of debt. Debt means a loan taken and debentures issue. That loan debentures put together, we call it as what, sir? Debt. Because you can raise the money from any of these sources, correct? No? So we'll have to find the cost of these instruments. After you find these 4, you have to find something called overall cost of capital, denoted by the symbol AO. Then there is one more called MCC, as in marginal cost of capital. If 6 components, if you do, means this topic could dumber over. Okay, now one by one we will dive into it. I'm sure most of you have already know the formulas and all. Quickly we'll be revising the things. Can we start to? Alright, first we will go for long-term debt. Long-term debt. And moreover here, sir, what does the word capital I told here means? Capital here means equity share capital or all source of finance. All source of finance means not short-term, only long-term source of finance. Here in this topic, we are finding only the cost of long-term source of finance only. And what are those sources? These are the 4 sources of long-term finance. What are those again? Equity shares, preference shares, debt, and retained earnings. More about the one by one we will talk about. Now we will go into the debt aspect of things. Debt here means what, sir? Debentures as well as bank loan. But it should be short term in nature or long term? Long term. So now we are trying to find out long term debt cost. First aspect. Pace is okay? I can maintain this now, everybody? Okay. Online also? Good, no? Okay. Now, sir, the moment they ask you to find out long term debt cost, the first thing you need to do is find out whether it is a redeemable debt or irredeemable debt. That's the first thing you need to do before you do the cost. Redeemable or irredeemable. Zoom ada. Is okay, da? Okay. You have to find whether it is redeemable or irredeemable. Redeemable means at some point of time you need to repay, meaning it will have a term. Suppose I take a 10-year bank loan. That means I have to repay this loan within 10 years. That is an example of what? Redeemable debt. Suppose company issued debentures. Is debenture a debt? Yes. Term not given. That means it will go on forever. Till the time company is there, this debenture also will be there. Such a debenture or such a debt, we call it as what? Irredeemable. First find out this. So how to find out? Based on this called N. N means life. If life is given to you in the problem, that means it is a redeemable debt. If N is missing, means then it becomes irredeemable debt. That's how to identify. Yes, people? Okay, simple formula. If you have to find out the cost of irredeemable debt, all of you know this formula, let's revise. Cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. I for interest into 1 minus tax rate. T here stands for tax rate, NP here stands for net proceeds. Okay. Or if you want it in a simple way to remember, cost is simply given by one number in the numerator, one number in the denominator. Numerator mein what you are paying, no, put that number. Whatever company is paying, put that in the numerator. Whatever company is receiving, put that in the denominator. So that means if I have to tell in short form, it will be what's it? Payment divided by receipt. Now you think on debentures, what will company pay? Interest. That is receiving or paying? Paying. So put that in the numerator. Interest. Okay, Ji? But just now we learned interest is an expense. Due to that expense, you get one benefit called what? Tax benefit. Right? That means your tax that you're paying to the government will reduce. Hence, to capture the tax benefit, you do 1 minus tax. That means we don't want interest, we want after tax interest. To get after tax component, no, we always do 1 minus tax rate. I've explained the formula of all this detail in regular class. Now we don't have so much time. I'll just quickly tell up and move on. Okay, sir? So it is what, sir? Interest into 1 minus tax rate divided by net proceeds. Now, in your mind, what is the formula? Numerator mein what it should be? Payment. Denominator mein receipt. When company issues debentures, they will pay or they will receive. Hence, that only we calling it as what, sir? Net proceeds. Comfortable? This is okay. I here stands for what? Interest amount. Now net proceeds. Sir, what should we take as net proceeds? Sir, for that there is a small pointers you need to keep in mind. First thing you need to check is whether these are a new debt or a existing debt. Whether it's a new instrument or existing instrument. If it's a new debt means new loan or new debentures, then the first priority will always be given to issue price, IP. If it's a new debt, first priority always to issue price. Because when you're newly issuing the instrument, company will issue it at some price. That we are calling it as what, sir? Issue price. First priority to IP. In case IP is missing in the problem, in case IP is not given, you'll go for next priority item, which is the market value. If market value is also missing means face value. Alright, this is the order you will use for what instrument? For a new debt. First priority IP, next priority to MP, last priority to face value. Comfortable? This is what, sir? New debt. Suppose if it is existing debt, then existing debt means you are issuing it now or many years back only you have issued. Many years back only you have issued. You are finding the cost many years back or today. You are finding the cost of this instrument many years back or today. Now you tell me IP is relevant or irrelevant? Because IP is old data. Because you issued this instrument now or many years back. Many years back. So cut off IP. So what is the order? For an existing debt, the first priority is market value. Last priority is face value. If market value is missing, then you will take the face. Comfortable? Doesn't matter what you take, one component should be compulsorily reduced called flotation cost. Doesn't matter what number you pick, whether you take IP, MP or face value, doesn't matter. You always have to reduce what, sir? Flotation cost. From this, if you reduce flotation cost, the number you going to get only is what we call it as net proceeds. Comfortable? So what the hell is this flotation cost, sir? Name itself is saying flotation cost. To issue the instrument, you will have to incur some cost. Now company, if they want to issue debentures, means they may take the help of an underwriter. A broker. Will broker do the activity free of cost or he will charge some commission? All that issue expense. Remember in your accounts may you have learned issue expense, share issue expenses and all. That issue expenses we call it as what, sir? Flotation cost. It will be given to you in the problem. So that portion you'll have to reduce. After you reduce flotation cost, the final number becomes your net proceeds. Any doubt here? That's all is the formula. Again, what is the formula? Let's try to remember everything in the class itself. If it is a redeemable debt, if it's rather irredeemable debt, then cost of debt is given with the formula. Don't look at the screen. Try to remember like that only. Interest into 1 minus tax rate divided by net proceeds. Alright? I for interest, T for tax rate. NP ka first priority what? If it's a new debt, first priority to IP. Next priority, market value. Next priority, face value. If it's a new debt, or rather if it's an existing debt, then first priority to market value. Last priority to, doesn't matter what you pick, flotation cost has to be always reduced. This is for what? Irredeemable. However, if it's a redeemable debt, now you think redeemable debt means same formula. What again? Simple number is what? Payment divided by receipt. Now think, what and all will the company pay for redeemable debt? One is interest. Can we take interest or after tax interest? So what should be the first component of your formula? Interest into 1 minus tax rate. Yes, sir. Now think, when you are redeeming, company will have to pay some money. Let us say the face value of the debenture was 100. The face value of the debenture was 100. Should it be redeemed at 100 only or it could be more? Redemption price could be more than 100 or less than 100. Suppose company paid 110. Company paid 110. That means is the cost really 10%? Suppose it's a 10% debentures means is the cost 10% or company paying extra? Extra, what extra? Instead of 100, company is paying redemption price of 110. How much extra? 10. How did you get that? 110 minus 100. Now express that in formula for me. What is this 110? RVs. Redemption value minus what? At the time of issuing, company will receive what? Net proceeds. That means what? RV minus MP gives you this number. Correct? Now let's say the term of the debenture is 10 years. How much extra company is paying? 10 rupees, or maybe for towards simplicity, I'll take this as 5 years. The term is how many? 5 years. This 10 rupees extra company will pay every year or only once? Once. Correct? No. That means we want to know this 10 rupees is a cost for 1 year or 5 years? 5 years. On an average, how much is the cost every year? How did you get that? Divided by 5. That means tell me the formula. Tell me how did you get from here to here? You took 110 minus 100 divided by 5. Express in words for me. What is that? RV minus NP. What is that? N. No. N divided by N. That is your formula. Understood? So this gives you what, sir? Payment. This gives you what? Payment. Now divided by what? Receipt. 1 minute. In the numerator, you took normal number or average number? This is normal number or average number? Average. Mathematically, if numerator if you're taking average, denominator also you should take average. Hence, we don't take in this formula. They may have as net proceeds, but since in this formula we capture average, here also we have to take average. How do you find out average between RV and NP? How do you find average of something? Add and divide by 2. So tell me the denominator ka formula RV plus NP divided by 2. That's all. This is okay now. Easy to remember. Simple funda is again payment divided by receipt. Tell me the formula once again for redeemable debt. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Awesome. Keep up the same Josh. I'll also try to keep up the same Josh. Okay, sir. This is your formula for redeemable debt. Done, G. Sir, online also. Now this, sir, this method we call it as approximation method. This method what we are using, we call it as a approximation method. There is another method to find out the cost of debt. That we call it as IRR method, or also known as yield to maturity approach. IRR method or yield to maturity approach. Okay, all of you have calculated IRR? FM class is over, no? Everyone come? IRR, you remember? IRR is basically what, sir? Rate will be given or you have to assume? Two rates you have to assume and get a particular IRR. Yes, no? So calculate IRR, that IRR only becomes your cost of debt. Okay, to simple funda, if I have to tell here, let's say we have a debentures which were issued for 3 years. A company has issued debentures for 3 years. Now simple. IRR means what, sir? Basically, IRR is a rate at which present value of cash inflow will be equal to present value of cash out. At what rate present value of cash coming in and present value of cash going out, these two will be same, no? At what rate they become same, that rate we call it as IRR, and that IRR only becomes your cost of debt over here. Easy. Yes, that means all we have to find out is what, sir? What is the cash inflow and what is the cash outflow? Alright. Now IRR is what, sir? Full form is what? Those of you have done? Internal rate of return. Now, if company issues debentures, for them it is return or cost. If I'm the company, if I'm issuing debentures, for me it is return or it's cost. Cost. For whom it is return? The other party, which is the investor. Yes, no? So inflow and outflow, you have to put a sign, no? If it's inflow, we show it as positive number. Outflow, we show it as negative number. This IRR is what, sir? Internal rate of return. For company, it is return or investor? Investor. So you put this positive negative sign not from company's viewpoint but from investor's viewpoint. Now what our ICAI material does. In fact, if you change the sign also, it will not create a big deal, but better to sync up with our mother body. That is ICAI ka solution. Comfortable? Alright. Now think, sir. Company has issued debentures. We have to think from whose perspective now? Company or investor? Because sign is from whose perspective? Investor. Now, if company is issuing debenture means investor has to pay the money. So that means at year 0, what will come? Investor will have an inflow or outflow. Because to get the interest on debentures, first we need to invest the money. So at year 0, investor will have an outflow. That outflow will be nothing but your net proceeds. For company, it's a proceeds. For investor, it is an investment. So at year 0, you put in what's our net proceeds. Any problem? And calculation of net proceeds you already have done. What is that again? First priority IP, then MP, then face value minus flotation cost. That drama is still the same. This NP you'll put it as positive number or negative number? Negative. Why negative? Because from an investor perspective it is an outflow. Now if an investor has purchased debentures, what and all he will get? Interest. No. We should take interest or after tax interest. So every year we should consider I, not I in fact, I minus 1 minus tax rate. That you put it into your year column. Last year, sir, this is irredeemable or redeemable? Redeemable. Redeemable means life will be infinite or finite? Finite. Here, how much is the life for? 3 years. That means investor will get interest for all the 3 years. At the end of third year, what will investor get? He will also get his money back. That's the reason I've written here. P for your what, sir? Principal. Or you can also write it as RB. RB as in redemption. So last year, you have to take interest into 1 minus tax rate plus RB. Done, sir. This is the cash flow. Any problem? Now this, sir, to find out IRR, we assume some random rate. It could be 8%, 10%, whatever. Assume a rate. Now all this investor will get today or in the future. Now this interest into 1 minus tax rate, investor will get now or end of first year? End of first year. This investor will get at the end of second year. This investor will get at the end of third year. That means all these are present value or future value? Future. But we need the cost future way or now? No. Hence what, sir? What it's currently there on future value platform. No, get it to what platform? Present value platform. In FMA, how do you get something in present value platform? Take future value and multiply it by the discount factor. And how do you get the discount factor? 1 divided by 1 plus I whole power n. Assume any rate. It's okay. 5, 8, whatever percentage. Simple for sake of format, I've assumed 10%. So this is your future cash flow and multiply by the discount factor. You will get present value of cash flows. Now, if this 10% itself is IRR, means NPV should become 0 because IRR is a rate. What, sir? Present value of cash inflow and present value of cash outflow should be same. Right? If it is same, means this is an outflow and this is an inflow. When you sum it up, this should give a number or it should give you 0. So if the rate that you have assumed, if it is a correct IRR, then the final number you're going to get when you total up, no, this should be what, sir? 0. If generally IRR, no, your the Vastu will not be that good. The answer will be 10.80, 11.55. Will anybody assume 10.52? No, they will assume what? One whole number. But usually IRR and all will be given in decimals. So you will not get a perfect answer. NPV, you will get some number. But if the rate that you have assumed by chance is correct, then what should be this total, sir? This total should become 0. So first to take one rate. If you are not getting 0, take one more rate. Alright, maybe ideally I would suggest the difference between two rates. So let it be at least 4 to 5%. Meaning first rate if you are taking 10, next then let the next rate be 15 or 14 or whatever. Again test the same cash flow you take, multiply now with the new discount factor. What is the new discount factor? 15%. Again find out the present value. Now you will get a number. If 15% is your IRR, means NPV should become what, sir? 0. Unfortunately, it will not. That means this also. Suppose you calculated here, you got 100. You calculated here, you got minus 20. Assume. That means IRR is lying somewhere between what? 10 to 15%. Now take this and plug it into IRR formula. Everybody remembers IRR formula? Yeah, what is IRR formula? How do you get IRR formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So plug all these numbers. So basically NPV means also what, people? NPV means what? Name itself is saying net present value. We have only inflow here or outflow. These are what, sir? These are inflow. These are what? Outflow. So when you sum this inflow and outflow, you will get a number. No? That summed up number we call it as what? Net present value. Like in accounts, we say net assets. Net asset means what? Asset minus liability. Net present value means present value of cash inflow minus present value of cash outflow. Sum it up. Alright. So just take this number and plug it into the formula. Okay. Now low rate. What is the low rate in this? My example where one have taken 10, another one have taken 15. What is the lower rate among this? 10. So this will come in here. Lower rate becomes your 10 plus NPV at lower rate. Whatever I assume 10 NPV at lower rate to be, or I've brought the number to be 100 divided by NPV at lower rate, which is 100 minus NPV at higher rate, which is 20. Alright, into higher rate minus lower rate. Higher rate is 15, lower rate is 10. So 15 minus 10 you will get what? IRR ka value. That IRR only becomes your cost of debt. So these are the two ways through which you can ascertain what's the cost of debt. Any doubt? Paka? So which method to use in exams? Question will specify whether you have to use IRR or whether you have to use approximation method. Question will mention. So if it is not mentioned, I would always suggest which one. See, IRR and all, you have to do a lot of drama, but approximation method will give you the answer in one liner as a formula. I would always recommend you to use approximation method or formula method in case question does not mention. Okay, they will usually mention. So one of the two is good enough. Any doubt, anybody till here? Paka guru, everybody understanding? Move on to the next. This is about the long-term debt. Once this is over, quickly we'll revise once more time all the concepts and then we will dive into some questions. Fine. Now, next is cost of convertible debentures. Cost of convertible debentures. Convertible debentures means you will repay. Let's say you have issued the debentures for a term of 10 years. N is how much? 10 years. At the end of 10th year, will company pay cash to the debenture holders? No. That debentures will be converted into what? Equity shares. Comfortable, people? Now this we call it as convertible debentures. In convertible debentures, now one extra drama will come into picture of RV. RV means what? Redemption value. Now, no sir, usually in these cases, company will give an option to the debenture holders, either to take cash or to take equity shares. At the end of 10th year, company usually gives an option to the debenture holder, either they can select the cash option or they can go for equity option. Tell me, if option is given to you, what will you choose? Pakka or higher? Higher. So, redemption value in these cases, no, redemption value is, first you have to find out redemption value of cash value and redemption at share value. You will take the lower one or higher one? Higher. So, the higher of the above two will become what, sir? Redemption value. After you find the redemption value, find out cost of debt using approximation method or IRR method. That is your choice. Yes, people. That's it about convertible debentures. We'll also go through one question on convertible debentures quickly. I'm spending so much time on the formula because once you understand this, question to revise will not take more than 5 to 10 minutes. We can revise that quickly, but this is important, okay? And I'm asking you to remember the formula inside the class itself. I'm sure regular students will not have this issue, but I don't know how many of you are newly seeing me, our approach and all. So I'm just keeping that open mind and explaining a little further here. Hope it's not boring. Everyone is okay? Yes, sir. All right. This is about debt ka full drama. Online also everybody okay, na sir? I'll get the response a little later. I'll move on. Okay. So first portion we have done. Cost of what, sir? Long-term debt. Next, we have 6 components. Next component we are looking at is cost of preferentials. Simple drama. Same drama. In formula method, what you will put in numerator? Payment. Denominator mein receipt. Now, which is the instrument? Preference shares. For a preference share, so tell me, what is the payment for company? On debentures, company used to pay interest. On preference shares, what will the company pay? Dividend. That means the numerator will be what, sir? Preference and dividend. On interest, you did 1 minus tax rate. Why? Because you got a tax benefit. On a debenture, will you get tax benefit? No, sir. Because the order is what? You remember the order. First, you will take what, sir? EBIT. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. From this, if you reduce tax, what are you going to get? Earnings after tax. Now, you will deduct preference dividend. Yes or no? People, I mean, tax is already paid. After paying the tax, the company will pay preference dividend to the preference shareholders. Due to preference dividend, will there be any impact on tax or no impact? No impact, because tax is already paid. So on preference dividend, or for that matter equity dividend, will company get tax benefit or no tax benefit? No tax benefit. So 1 minus tax rate is required or not required? Cut it off. Construct your formula. The moment you have preference shares, same drama. First you have to check whether these are redeemable preference shares or irredeemable. Redeemable or irredeemable. If it is irredeemable, what is the formula? Tell me, sir. Preference dividend into 1 minus tax rate or no? Cut. Preference dividend is your numerator. Divided by what? Net proceeds. You can keep this in net proceeds. Yes, sir. And how do you calculate net proceeds? Same drama. If it's a new debt or new preference shares, means first priority IP. IP missing, market value. Market value missing, last priority to face value. If it's existing preference shares, first priority market value, last priority face value. Same drama. Okay, Saru. This is for what? Irredeemable preference shares. What if it is redeemable? How to find out whether it is redeemable or irredeemable? Based on something called N. N is not actually total life. N is the remaining life. Whatever life is remaining. Okay, if N is given, then you take it as redeemable. Otherwise, you will take it as irredeemable. So for redeemable preference shares, tell me the formula. What is it? Preference dividend. 1 minus tax rate you cut off. Plus what? RV minus NP divided by M. Whole thing divided by RV plus NP divided by 2. Same as debenture ka formula. Yes, sir. So both these methods are known as what, sir? Approximation method. Is this only method or we have IRR also? Even IRR also can be used. Is IRR ka drama different or same? Same. Give me a quick walkthrough. What do you need for IRR? You need cash inflow and you need cash outflow. This inflow and outflow are sign. Positive outflow you will show it as negative. Inflow you will show it as positive. The sign you will put from company perspective or investor perspective. Investor. Why? IRR is internal rate of return. For whom it's a return? For company or investor? Investor. Now think, sir. For what will be the outflow for an investor? Net proceeds. Net, because he has to invest. For a net investor, net proceeds becomes outflow. Then inflow will be what? Every year ka preference dividend. And at the end of the instrument, he will get the redemption value. That becomes your inflow again. Plug in the same number, assume two rates, and accordingly find out what's the IRR through formula lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. And one good thing about FM is majority of the topics are driven by formula. Whether you know logic of formula or not, it becomes irrelevant. If you remember the formula, full marks is swaha. Otherwise, full marks go in. Okay, now that is one good advantage. That's the reason we say both FM is very scoring also, but at the same time, FM can freak you out also. Know the formula, full marks. So otherwise, full toss only. Correct? No? So be aware of that. Anyways, so this is done. Next is the cost of equity shares. Third instrument. So equity shares, no, crazy people. Equity shareholders are crazy people because their expectation is never ending. It will keep changing. If market condition is good, no, they will say, I need more return. If market condition is very bad, now some war is going on, let's assume. Equity shareholders will say, give me 2% also, I will accept. Daivame, please, okay, enough. Don't give me negative return, even 2% is sufficient. Suppose if it is a boom period, then they will say, I need 100% return. Same expectation or changing? Hence, we have multiple methods through which you can find out cost of equity shares. Because the expectation of equity shareholders are very dynamic, it keeps changing. So first approach is very simple, dividend price approach. Dividend price approach. Name itself is saying dividend price approach. Same funda, numerator is what, sir? Payment. Divided by what? Receipt. Now, dividend price approach. So what is the formula do you think it will tell? Dividend divided by current market price. That current market price we call it as P naught. P naught in FM terminology means what, sir? Current market price. P here stands for dividend per share. P naught here stands for current market price. So dividend divided by price will give you what's the cost of equity. This is as per dividend price approach. One of the assumptions of dividend price approach is it assumes that the dividend which the company pays every year, no, it will not change. It is constant. Meaning every year dividend payable is same number. That is your dividend price approach ka funda. Next is earnings price approach. Same formula. Earnings price approach. Tell me on the same lines construct. Earnings divided by price. We don't take total earnings here because the numerator you are taking total price or price of one share. One share. Hence in the numerator don't take total earnings, take earnings per share. So earnings price approach ka formula is EPS divided by NPS. NPS or current market price or also denoted by the symbol P naught. Okay, sir. EPS divided by NPS will become your earnings price approach ka formula. Now this method assumes that EPS will remain constant. Practically it may not work out. All these are for the sake of marks. Okay, sir. All right. Next is our Golden Jika growth model. Our Golden Jika. Sir, CA final classes will happen in Chennai. Next time we will plan much. Even our attempt is passed. May attempt we will plan one. Definitely. Thank you for logging in onto CA inter classes and inquiring about CA final. We will try. Okay, for the time being, we will move on with CA intermediate. We'll plan. We'll put a notification on that sometime maybe in February or March. Thank you. All right, all the best. Now, next is the Gordon's growth model or Gordon's model. We say. Now, sir, excuse me. Now, Gordon's assumption was, sir, every year dividend will be now here. First approach assumes what? Dividend is constant. Practically, you think can dividend be constant? If I teach like this only full 5 hours, what will you do? Sleep. You need some movement, yes or no? Same way, even shareholders also want movement. What movement? Money movement. So, hence, dividend, Gordon sir is saying that cannot be constant. Dividend will keep on growing. So, hence, Gordon-Sarka formula was what, sir? Anybody remembers what is Gordon-Sarka formula? It's given by what? Cost of equity is given by D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by the growth rate. Revision not has happened. Okay, or maybe it is done. No, you have attended all FM class. My class only. Wow. Okay, fine, no issues. It's of course, sir. I mean, it's been probably a long time since you've attended class. It's natural human tendency that few things we would have forgotten. So not a big deal. All right. So now, so one formula you can express is D naught into 1 plus growth rate divided by P naught minus F as in flotation cost, whole thing added by the growth rate. Now, sir, D naught means current dividend. The dividend which is already paid, we call it as a D. Current dividend denoted by the symbol D. Now, last year or currently, let's say I've already paid 10 rupees dividend. Will shareholders expect this year same 10 rupees dividend or they want to increase? Let's say growth rate is 5%. Growth rate is 5%. That means this year, this is what, sir, denoted by symbol what? Dividend already paid, we call it as a D naught. Now will they expect same 10 rupees or more? How much more? 10 plus 5%. Yes, that means that will be 10.5. Correct now. This expected dividend, we call it as what, sir? D1. You can calculate like this or through a formula. D1 directly you can do 10 plus 5%, or you can do take D naught. D1 is equal to D naught into 1 plus growth rate. Calculate like this. How much is D naught? Growth rate is 5%. Do calculate this. How much are you getting? 10.5. So this formula is just trying to capture that. So if they give you directly D1 in the problem, take that and write the formula. Otherwise, if they give you D naught, use this particular formula. Divided by P naught. P naught means what, sir? Current market price. Minus what, sir? Flotation cost. That we already know, right? Because we need a net proceeds. Now, this and will this is what, sir? This is what? Expected dividend for next year. After that, it will be same or it will keep on growing. Dividend will keep on growing. How many years? Infinity. Hence, Gordon sir said add of growth rate to capture that infinity element. Hence, our formula is what, sir? D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by the growth rate. We add growth rate at the end to capture the infinity element of the growth there. Fine, people. Now, how to find out this growth rate, sir? Sir, first of all, how to know whether to use Gordon method? Sir, the moment if they give you growth rate, in the problem, if you see the word growth rate, you have to use Gordon sir's formula only, no escape. Fine. In fact, this is popular in examination. Other things are not that relevant. Okay, usually cost of equity, they will ask you to calculate using Gordon sir's formula only. Yes, people. Now, there are multiple ways to calculate growth rate. In our regular class, we have used trial and error as a favorite. There is one trial and error method. Those of you who don't know, once probably I'll take you through problem, I'll tell you. One is trial and error method. Another one, sometimes in our question, future value table will be given. Using that, we can find out growth rate. The more popular option is they will give you B and they will give you R. B as in retention ratio, R as in rate of return. G is equal to B multiplied by R. I have proved this in my regular class by this equation. In fact, all the equations have proved it. Okay. Now I don't have time to prove it. I'll quickly run through the formulas. Because on the examination day, they will not ask you prove this formula. They will ask you to calculate. So at this point of time, examination, we don't want logic. We want magic in terms of our memory. Yes, sir. So B is given by the formula, G is given by the formula, B multiplied by R. B as in retention ratio, R as in rate of return. So there are multiple ways. We will calculate all of this in couple of problems. Yes, people. So that's the way to approach Gordon sir's formula. Next, this and all I've written how to do it. Leave that for the time being. There is another model to find out cost of equity called CAPM model, Capital Asset Pricing Model. So here, using this model, you can find out cost of equity. So cost of equity is denoted by the symbol KE. Okay. So if you want cost of debt, that is denoted by the symbol KD. Cost of preference shares is denoted by the symbol KP. Cost of equity shares denoted by the symbol KE. Cost of retained earnings denoted by the symbol KR. Overall cost of capital, every component ka cost of capital is denoted by the symbol K. So we have covered KD, KP, and slowly we are looking at cost of equity also. Yes. You can find out cost of equity through another model called CAPM, Capital Asset Pricing Model. In Capital Asset Pricing Model, cost of equity is given by the formula RF plus beta into RM minus RF. RF stands for risk-free rate of return plus beta into RM minus RF. RM stands for your market rate of return. RF stands for risk-free rate of return. Sometimes in the problem, RM and RF, they will not give separately. Directly, they will say risk premium. Okay. So if RM minus RF, if you do know, the value you get is what we refer to as risk premium. Some problems में RM and RF will be separately given, so you can plug in. Some problem में directly doing RM minus RF, they give you risk premium. Take that and accordingly do it. Okay, so this capital asset pricing model is nothing but it's trying to compare the relationship between equity shares and market. Now let's say if you invest in government bonds, the government bonds gives a return of 7%. If you invest in government bond, RBI, central government, state government, whatever, you get how much return? 7%. Now we have to take risk to earn 7% or easy? Easy. So the return that you get from government instruments, no, sir, we call it as RF, as in risk-free rate of return, which is 7%. Now let's say you did not invest in government bonds. You invested in one company ka equity shares. Let's say Infosys ka equity shares you purchased. Why? You want 7% or you want more? You want more. So cost of equity here will be, what is the formula again? RF plus beta into RM minus RF. How much is RF? 7. Either you can take full number or you can take decimals. It's okay. If you take full number, answer also will be in percentage. If you take, instead of 7%, if you take 0.07, then final answer also will be in decimal. And then you'll have to convert it into percentage. That's okay. Plus, this is what's a beta. Beta, they will give it to you in the problem. Let's say beta is 2. I'll tell you what is this. RM means what's a market rate of return. For equity shares, the market is Sensex or Nifty. You invest now. Market, you've heard about Sensex and all those, BSC, Sensex, Bombay Stock Exchange, National Stock Exchange and all you've heard. Let's say National Stock Exchange gives a return of 15%. Every year on average, Nifty gives how much return? 15% assumption. Alright. Now, how much is government bond giving? 7%. That means market, is it giving extra return? Yes, comparative to government bond, how much extra return market is giving? 8%. Yes. This is 8% extra return of the company or a market? Market. You invested in the market or you invested in Infosys company? Infosys company. Now, Infosys company has a beta of 2. Beta of 2, what it means is, beta measures the relationship between market and company. It measures the relationship between market and company. Meaning, if market increases by 1%, means this company ka beta is how much? 2. That means Infosys ka share price will increase twice. That means 2% increase. That is what beta denotes. If market reduces by 5%, tell me what will happen to Infosys ka share? Double. Because beta is what? 2. That means you have to do 5% into 2. How much is this? 10%. Market increased or decreased? Decreased. If market reduces by 5%, the share will reduce by 10%. That is the beta ka significance. Basically, it establishes the relationship between what to what? The market and the company. Hence this. Comfortable, sir? By plugging in this number, you will get some number. That only becomes your cost of equity as per capital asset pricing model. Okay, people. Done. This is about CAPM. Next. You want, can I do one or two more small concepts and then dive into the question? Would you be okay with that? So that we'll have all the questions in one shot. After this chapter is over, I'll give you a break. That's okay, no? We can stick around normal here, no? No issues, I think. Yes? Alright. Sir, then we have another method called online no have choice. Online you can take break whenever you want, macha. Yeah? Anyway, you have videos available. After this, we will also post the videos in YouTube also. So it will be available there also. So not a big deal. Next, there is another method called realized yield approach, which only we learned it as what, sir? IRR method. Now here also there is a small catch. And personally for me, I would, for 1 or 2 attempts, I would place this as little important. Why? I have not seen in the last 4 or 5 attempts question coming from this. Okay. Normally institute ka trend is there. Something which has not come since many attempts. Suddenly they'll put it off in your attempt. Who knows? You are lucky fellows. You may get it. So that's the reason. No, this you can work out using 2 methods or 2 ways. I'll explain this. Immediately we'll take both the questions. Okay. So I feel this might be my gut feel. I could be horribly wrong also. I don't know. Alright. Whatever I'm discussing here. Sometimes whatever question we have discussed has come. Sometimes it has not come also. I am not setting the paper. I don't. I'm just making an intelligent guess. Okay, so don't just rely on this and say, oh yeah, that fellow, I relied on him, whatever question he told didn't come only, my life also go in the marathon session. Remember, I can't do all the questions. I can only do what's a 4 or 5 question at best. Alright, because that's all is the time availability. Okay, great. Now, realized yield approach is nothing but what, sir? Online people, when you post the doubts, it comes to me a little later. No issues. If something is pending, and me again you ask it, we'll again answer that. Is that okay? Because I'll not be able to see that initially. Current dividend means D not par. Current dividend means D0. Expected dividend means D1. Okay. All right, now low key. That's your name, right? Low key. LOWKEY. Okay, fair enough. Realized yield approach. Now, in realized yield approach, no, sir, that is nothing but your IRR, but you can work out the problem in multiple ways. First, sir, whenever they give you this, whenever they say calculate realized yield, no, first check if year-wise return is given to you in the problem. Year-wise return, have they given? Is it possible for you to calculate that? If the answer to that is yes, we will use this particular formula. If it is not possible for you to calculate that, then you use normal IRR method. Normal IRR, everybody is comfortable. Okay, so either you will solve like this little fancy, or you will go for IRR method. Let's do a thing. Let's quickly look at the IRR method first, then through one problem, then we'll come back. Okay, 1 minute. I'll take you through one question. This is study material questions only. Some are picked from RTPs, MTP. Some are picked from study material questions. Check this. Mr. Mehra has purchased the shares of Alpha Limited for rupees 1,000 rupees. Great. He has received the dividend for a period of how many years? 5 years. At the rate of what? 10%. Sir, how much did he invest? 1,000. How much return dividend he has received? 10%, which is how much? 100. So dividend is calculated on face value, no sir? Have they given face value? No. That means I'll assume that this 1,000 rupees itself is what? Investment amount as well as face value. So how much is every year dividend to? 100 rupees. Correct, people? Next, at the end of 5th year, he sold the shares of Alpha for how much value? 1128. Compute the cost of equity as per realized yield approach. Now, how many years did he hold this investment? 5 years. All the 5 years ka dividend and price given or missing? All the 5 years ka dividend you can know. It's same. How much is that every year? 100. That is there. Price, is it given? Because see, if you want to calculate, what did I say in the chart? You should be able to calculate the year-wise return. To calculate the year-wise return, you want dividend payment also, or you want the price also. Both should be available. In this problem, is it available? Dividend is available. Is price for all the 5 years available? If price for all the 5 years, if it is not available, we will go for normal IRR method. Tell me, how do you do normal IRR method? Year 0, then year 1 to how many years here? Year 1 to year 5. So you will put the signs from company perspective or investor perspective? Investor. And the data starts from what? Year 0. Year 0 in FM means no. Year 0 in FM means no. Now, if investor wants to buy the shares today, how much he has to pay? Because here IP is given up? No. Is MP given? No. That means what is this 1,000? Becomes your face value. Alright, because you can assume face value itself as IP into the problem. Yes, people, I've taken you through the solution. I've solved it because I don't have time to waste time. So all these are my regular class notes. I brought it in here. Quickly, we'll run by. Okay, sir. Now, year 0, what will the investor invest? How much he'll invest? 1,000 rupees. Now, 1,000 rupees cash coming in or going out? So that means this should be positive or negative? Negative. I mean, and how many years he will get the dividend? 5 years. Is the dividend changing or same? Sir, if it is same, that means we have to calculate all the 5 years ka present value separately, or can we do shortcut method? Shortcut method means we are using PVIF or PVAF. Sir, PVIF means what? Present value interest factor. Each year ka cash flow, if you take and find out the present value of that cash flow, we say we are using PVIF. Suppose many cash flows, if you are combining, and if you use a discount factor, that we call it as PVAF. Like here, one normal way to calculate this is what's the year 0, 1, 2, how many years is this? 1, 2, 3, 4, 5. Cash flow column mein 1,000 you'll write negative. First year mein how much dividend? 100. Like this 100, 100, 100 you can calculate for each year separately. That's one option. And all these are what? Future present value or future value? This one or this 100 rupees investor will receive when? At the end of first year. This 100 rupees investor will receive at the end of second year. We want future value or present value? How do you get present value? Discount factor. In IRR, mein discount factor will be given, or we have to assume? Here I have assumed the discount factor how much? 10%. So take your calculator, tell me for year 0 what is the discount factor, sir? For year 0 the discount factor is always 1. Because this 1,000 rupees is on future value platform or present value? Present value. So it's already on present value platform. Hence for year 0 discount factor is always 1. Now first year ka at 10%, how do you get discount factor? How do you get, first of all, what is the formula to calculate discount factor? 1 divided by 1 plus I whole power n. So I here is what I have assumed. 10%. So you do 1 divided by 1.1. So first year ka discount factor will be 0.9090. Then go on pressing equals to button. 0.8264, 0.7513, then 0.6804, 6830, then 0.6209. Correct? Like this, you can calculate each year ka discount factor separately. But mathematically, if you check, these numbers are different or same? Same. I mean, should we have to calculate it 5 times or can we combine? If you are using each year ka discount factor, we say we are using what, sir? PVIF. Each year ka separately, if you calculate, we say we are using PVIF. Now, should we have to use this or combine? Combine. Add all this, how much are you getting? Adding all this, how much are you getting? 3.7. Yes, no. That directly we say we are using PVIF. Like that's your shortcut. How to find out PVIF? 1 divided by 1.1 you do. How many years data we need? 5 years. Press equals to button in your calculator 5 times and then there will be a GT button. Grand total button. Press GT button. You can also use M plus option also. I don't know how you have learned it, but GT is simpler. 1 divided by 1.1 you do. Press equals to button 5 times and then press GT button. Grand total button. You will get 3.79. Comfortable, Asaru? Everyone getting it? So that's how you get 3.7. Either you can use M plus button also, that is okay. Everyone is comfortable with PVA calculations? So you can calculate like this also separately, but you can use a shortcut method. Shortcut method is PVA. Now that's it. Or 5th year, what did the investor do? 5th year, the investor sold off the shares. Sir, if he sells the share means it is an outflow or inflow? Inflow. When did he sell the share? Now or 5th year? So year 5th May, you will show 1128, negative or positive first. Now this 1128 will come every year or only once? Sir, cash flows which comes every year, for that you can use a PVAF. Same cash flows which come every year, for that you can use shortcut method which is PVAF. But a cash flow which comes only once, for that you have to compulsorily use what? PVIF only. Meaning do 1 divided by 1.1 and press equals to button how many times? 5 times. 5th year ka discount factor if you find it will be 0.6209. So this is your outflow. These are your present value of cash inflow. If 10% is IRR means the final NPV should become 0. Is it 0? No. That means is 10% the right rate or no? That means we'll have to assume one more discount rate. Here I've assumed it to be 14%. You can make it as 13, 15, whatever. Now at 14% I'm testing the same thing and I got my NPV how much, sir? Negative. That means is 14% my IRR? No. If 14% is IRR means the number should have been 0. But I got negative. That means can I say IRR is lying somewhere between 10 to 14? Somewhere between 10 and 14 IRR lies. Now take this number and plug it into your formula. What is formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. Now I have assumed 10 and 14, which is a lower rate? 10%. 10% in full form becomes 0.1. You can take decimals or percentage, doesn't matter. Plus NPV at 10% is how much, sir? 79.37 divided by NPV at lower rate, which is 79.37 minus NPV at higher rate. Higher rate ka NPV is already negative. Negative of negative will become what? Positive. So here we need to add these two. Whole thing multiplied by what? Higher rate, which is 14% minus lower rate, which is 10%. Multiply and you will get the answer to be how much, sir? 12.1. That IRR itself becomes your cost of equity. Any doubt in this question, anybody? Quickly running through the questions. Okay, Saru. Can I move forward? So this is one approach. Yeah, 3 decimals is good. I look different. Thank you. All right. It keeps changing in which way. So 3 decimals is fine part. You can take 3. If you're comfortable, you can take 4. That's okay. Now, this is what, sir? IRR method. Why did we use this IRR method? Because year-wise price was given or missing? Missing. Now we will go through one more question, same, with a slightly different approach where year-wise price will be given to you in the question. If every year, in here, no, they gave the price only for 5th year. Did they give it for all 5 years? No. Here, now they will give you price for all the 5 years. In this case, how to find out cost of equity using a realized price approach. Okay, I don't know whether you have done this question or not. Many people don't do this question because it's not come recently in the past. Okay, this attempt we have covered this. Okay, but anyways, now if you want to do that, first I'll tell you the formula for this. If year-wise return, if it is given to you in the question, then first you need to find out first year ka return given by P1 plus D1 divided by P0. Or rather D1 plus P1 divided by P0. Second year return is given by D2 plus P2 divided by P1. Third year return is given by D3 plus P3 divided by P2. You're getting the order? So what will be the fourth year ka return? Tell me. D4 plus P4 divided by P3. Correct. So you will use this option when year-wise price and dividend is available to you in the question. Yes, sir, people. Sir, why only 4? I'll tell you in this problem. It doesn't go only till 4, but this is a problem-specific adjustment I've written over here. Now, you got this. Then we'll have to plug this number into one formula that I'll tell you. But first, let's go through this particular question. Check here. Compute the cost of equity using following data using what approach? Realized yield approach. The moment it is realized yield approach, what should come to your mind? IRR. But will you use normal IRR or there is another formula? Another formula that we call it as geometric mean. GM. Geometric mean. It is possible for you to calculate geometric mean only if they give you year-wise dividend and year-wise price. Check. They gave how many years ka data? 5 years ka data, and they gave you dividend only for 1 year or all 5 years? All 5 years. They also gave the price of the share, but they gave price of the share at the end of the year or beginning of the year? Beginning of the year. So this is what, sir? Year 1 ka beginning. Year 1 ka beginning. Sir, year 1 beginning. No, in FM, no, sir. When you put year column, you write 1, 2, 3 and all like this, no? Suppose I write in year column 1, 2, 3, 4. This 1 stands for what? Year beginning or year ending? When you write 1 in any year column in FM, it means year 1 ka ending. When you write 2, it means year 2 ka ending. This means year 3 ka ending. This means year 4 ka ending. Yes, people. But how do you capture year 1 ka beginning? How do you capture year 1 ka beginning? Year 1 beginning only we call it as year 0. Year 1 beginning we call it as year 0. This is how we capture. Yes, people. Now check. They gave price of the share at beginning, and this is first year beginning. First year beginning means this is what? P1 or P0. This is price at year 1 ka beginning. That only we call it as P0. This is price at year 2 beginning. Year 1 ka ending price only becomes year 2 ka beginning price. Just like in accounts we say, no, year 1 ka closing balance will become year 2 ka opening balance. So year 2 ka beginning price only is nothing but year 1 ending ka closing price. So this is what? P1. Similarly, this is P2, this is P3, and this is P4. Comfortable? Now you tell me how many years price is actually given to you? 4. That's the reason if you just check our chart book, I wrote only for how many years? 4 years. How much ever data they give, that much only you can capture. It's not necessarily it has to be 4, but in this problem they have given data only up till 4. Hence my formula stops at 4. If they give you 6 years ka price, that means you have to calculate 4 times or 6 times. 6 times like this. Oh, understandable, everybody? But usually in these sort of problem, they will not modify, they will give the same. Now let's calculate this. Everyone pay attention. I have solved it, so no need to just adjust. Check. So first year ka return, I'll bring this maybe a little closer. 1 second. First year return, how do you calculate? Tell me, sir. Think from investor perspective. What is the return for investor? Dividend. No? And if he sells the share, he will get money. I mean, it's 2 return for the investor. One is what, sir? Dividend and price. Well, investor, if you're calculating first year return, he will sell it year beginning or usually year ending? Year ending. So that means construct the formula for me. D1, because he will get first year dividend, he's selling the share at year ending, if at all he wants to. So it will be first year dividend he will receive. First year dividend he will receive now or at the end of first year? End of first year means D0 or D1? D1. So first formula is what? D1 plus P1. That is the price, correct? Did he bought it at P1 or P0? He purchased it at year beginning only. That means this is what, sir? Tell me the formula again. It is nothing but first year return is given by D1 plus P1 divided by P. Comfortable? Here, how many years data they have given? 4 years. 4 years do the same drama. For second year, what? The second year return is denoted by the symbol 1 plus Y2. ICAI is giving fancy wordings, that's it. Second year return is denoted by the symbol 1 plus Y2. Third year return denoted by the symbol 1 plus Y3. Fourth year ka 1 plus Y4. Tell me second year return, how do you calculate? Second year dividend, which is D2 plus the second year ka price, which is P2 divided by P1. Okay, that is your second year ka return. Now third year ka return, D3 plus the P3 divided by P0. Perfect. Fourth year ka return, D4 plus the P4 divided by P3. Calculate all this, you will get a number. Till here, everybody, you good? I'll not go into calculations. I'm telling you how to revise this. Yes, people? No. Stop. Have they told end of 4th year or 5th year he sold off the shares? Check the data. Have they told end of 4th year, 5th year sold off? I mean, this drama will end here or it will go on? How long though? Infinity, correct? No, I mean something you should have captured. So how geometric means works is 4-year return. Have you found out? So multiply all those 4 returns. Take your calculator. Multiply 4. Quickly, keep doing. All the 4 years ka this number you multiply. Tell me quickly, I'm already getting 1.19 into 1.28 into 1.06 into 1.07. You do how much are you getting? You should get 1.7276. Correct? Some 4 decimals you're taking. Easy. So how to calculate geometric mean is square root of 4 years ka return. Square root of 4 years ka return. Now how many years return is available? 4. That means you have to find out 4th root of this number. You have to find out 4th root of this number. Why 4? They have given the return, or it's possible for us to find out the return only for 4 years. So n is for the data given. Here data is given only for 4 years. So n here stands for the 4th root. Okay, so you multiply all these numbers. You're getting how much? 1.7276. So how to find out square root, fourth root, sir? You have square root button. Like this, you have one button in your calculator. Sir, this root symbol stands for 2. We are finding second root or 4th root. Multiply this symbol in your calculator 2 times. 1.7276, you got it, no? Press this root button twice. Press this same root button twice. How much are you getting? 1.1464. Understood? Now it will go on only for 4 years or infinity? Infinity. Minus 1 you do this. Minus 1 is for the infinity element. So minus 1 you do. How much are you getting in your calculator? 0.1464. So this is in decimal. We want it in percentage. 0.1464. If you have to express in percentage, it will become 14.64%. According to me, this could be, yeah, correct. This is recently added in our material. Correct. Latest batch, I think they have added. Even we have covered this. Sir, what if 5th year data is given? Someone is asking, sir, what if 5th year data is given? That means you will calculate only 4 years ka return or 5 years ka. So you multiply 5 years ka return. Now 4th root you will find or 5th root? So 5th root how to find, sir? I'll tell you next problem. Okay, it will come. Not here. Let's not waste time. It will come somewhere. I'll tell you how to do that. Is it also okay? For that you have to do some big calculator drama. I'll tell you. Most probably they will not ask. In this problem, either they will give you 2 years return, my gut feel, or they will give you 4. Sir, if they give you 2 years return, you just have to press square root button once. If it is 4 means 2 times. According to me, I think they will not do much modification, but again, you can never trust ICAI. Oh, I think I now agree with Dilip sir. Dilip sir said that he fell off from chair one day here. No, I was about to fall only. And that looks scary. Okay, yeah, this chairs, no? Yeah. He actually fell or he was just kidding? Actually, yeah, I mean, thanks for that information. I'll be a little careful. Okay, sorry, sir. Taking your name, Dilip, sir. Okay, comfortable with this now? Everybody understood? Now, let's have a quick recap of this because this, I personally, I don't know, some liking. When I did this in class also, I told that I have a special liking for this problem. Don't know why. My gut feel is saying, someone liking this problem. Tell me, sir, which method are we finding cost of equity here? Realized yield approach. First, whenever they give you this data, first check, is it possible for you to find out year-wise return? Or it is not possible. If it is not possible, simply go for your normal IRR. If they give you year-wise data, then you will have to find it. This year-wise return is given by the formula. First year return is denoted by the symbol 1 plus Y1. Second year 1 plus Y2, third year 1 plus Y3, fourth year 1 plus Y4. How do you get this return? First year dividend plus first year ka price. So D1 plus P1 divided by P1 plus second year. D2 plus P2 divided by P1. D3 plus P3 divided by P2. D4 plus P4 divided by P3. So why you did not find out for 5th year? Because 5th year ka price you have only 4th year. Here they gave you only price for 4th year. 5th year price is not available. That means we were able to find out the return only for 4 years. Find the return for all the 4 years and then what you have to do? Multiply. And you have to find out the square root. How many years the return is available? 4. That means 4th root of this number you need to find and then minus 1 you do because this doesn't end here. This drama goes on for infinity. Hence minus 1 you do and you'll get a number in decimal converted into percentage and there goes your answer. Okay, G. That's it, G. One method down, 2 questions down. Can we go for next? Be careful, sir. Oh, thanks much. Growth rate also I will tell you. In the next question, I will tell you. Yes, so online also okay now, people? Everything going good now? Now, next method is So we found out cost of preference shares, cost of debt to cost of equity shares. So I bichara want to leave one. There is a cost of retained earnings. Cost of retained earnings. So retained earnings will have cost, sir. First of all, what does retained earning mean, sir? Name itself is saying retained earnings. Okay, let's take the again order. First, we'll start from EBIT. From EBIT, if you reduce interest, you'll get EBT. From EBT, if you reduce tax, you'll get EAT. Correct? Let's say we deducted preference dividend. After deducting preference dividend, the number what we get, we call it as net income. For our class purpose, we used to call this as EASH. Earnings attributable to equity shareholders. I use this term a lot when I did accounting standard 20 basic and diluted EPS. So I continued the same in FM also. Okay. But in our examination, FM exam, don't write EASH, use the word net income because our FM books does not use this like a pet name. Now from EASH, I reduce equity dividend. Let's say this is 1 lakh. I paid equity dividend of 20,000. How much money remains? This only we call it as what, sir? Retained earnings. Retained earning means how much profit after doing all adjustment, preference dividend, tax, equity dividend, after adjusting everything, how much profit is remaining with the company. That we call it as what, sir? Retained earnings. Now we are trying to find out the cost of this retained earnings denoted by the symbol KR. So that was all cost, sir. How, sir? Simple. This 80,000 belongs to whom? Equity shareholders. Yes, no? Because see, how much money was available for equity shareholders to give dividend? 1 lakh. Because if company wanted, can they pay entire 1 lakh equity dividend to equity shareholder? Yes. Did they pay entire 1 lakh or only 20? 20. How much money they have retained? 80. That means this money also belongs to whom? Equity shareholder. What is equity shareholder telling the company? Hey, macha, you keep the money. You, 80,000 you keep. No problem. This year I don't want this 80,000. You keep this money and use it for your business expansion. Correct or no? Will equity shareholders permanently sacrifice this money, or at some point of time they'll recover? Some point of time they would want to recover this also. Yes, no? So even retained earnings also will have a cost because equity shareholders currently have sacrificed this 80,000 for the purpose of business growth or business expansion. But at some point of time they will say, give. Yes or no? Suppose company says, I have no expansion plan. I have zero expansion plan. Now will equity shareholders accept 20,000 dividend or full money they want? See, now they are ready to accept 20 because company is telling the equity shareholder, I will use this 80,000 for future expansion. If company says, I know future expansion, then will the equity shareholder allow this money or they will withdraw? They will ask the money. Yes, no, sir. So even this will have a cost. That cost only we call it as what? Cost of retained earnings. That means big formula, sir. Very, very big formula and very easy also. This cost of retained earnings will be equal to cost of equity. Yes, sir. You did cost of equity various method. Here also same drama. What and all methods we did in cost of equity? Dividend price approach given by the formula. Dividend divided by price or P naught or whatever. Then what, sir? Earnings price approach. Earnings by price. Then Gordon's ka formula. D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by growth rate. Then we did a CAPA model where cost of equity is given by RF, risk-free rate of return, plus beta into RM minus R. Same ditto. Same ditto, except one component. Flotation cost now for retained earnings will not come. Sir, flotation cost means issue expense. Flotation cost means when you issue an instrument, like when you issue debentures, you have to file some documents with ROC. So there will be some cost, right? When you issue this debenture, you may take the help of a broker, and broker will charge some commission. That means all these are what's issue expense, denoted by the symbol F, called in FM as a flotation cost. But for retained earnings, will there be any issue expense? Sir, can you issue retained earnings or it is already there? Already there. That is the reason for retained earnings, flotation cost will not arise. So only difference between cost of equity and cost of retained earnings is whenever you calculate cost of equity, flotation cost will always be considered. But for retained earnings, flotation cost will never be considered. Like here, if I have to tell you in Gordon's formula, you used what here, sir? P naught minus flotation cost. Same Gordon's formula if you use to calculate cost of retained earnings. Tell me, how do you calculate? You will take a D naught into 1 plus growth rate divided by P naught. Minus F you will do? No. Cut off that minus F. Whole thing added by the growth rate. Wherever that flotation cost is there, cut it off. You have your cost of retained earnings. As simple as that. So no new formula. It is pretty much the same formula. Now people. So that means there is a linkage between cost of retained earnings and cost of equity. The only differentiating factor is the flotation cost. So if by chance, sometimes in the problem, this has not come recently, okay, but there are some problems like this. If they give you cost of equity, using cost of equity, you can find out cost of retained earnings. Because only difference is for equity shares, flotation cost is there. For retained earnings, flotation cost is not there. So if you want to calculate cost of retained earnings from cost of equity, that is given by the formula, cost of retained earnings is equal to cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Now when you pay dividend to equity shareholders, on that dividend, shareholders have to pay some tax to the government. That we call it as TP. TP means not company ka tax rate. TP means personal tax rate of the investor. You have studied tax. Tax you collect on slab basis also, no? Correct? Different investor may be subjected to different tax rate. If they have given, consider this. Otherwise, because this is pretty difficult to generalize because each investor has a different tax slabs. But anyways, if they ask, you can also, using cost of equity, also you can find out cost of retained earnings. Any doubt till here? So we have covered all the 4 costs of instrument till now. 2 more components if you do. Problems if you do means this chapter or. So far, okay, able to remember, recollect, yes. So next, what are those 2 minimum, extra component I said we have to learn? One is KO as in overall cost of capital. Another one is MCC as in marginal cost of capital. Now this overall cost of capital, sir, we call it as KO. Sometimes they also call this as cut-off rate. Instead of KO, they also call it as cut-off rate. Okay, they also call it as WACC. WACC as in weighted average cost of capital. Fine now people. Now what is this weighted average cost of capital? We call this as overall cost of capital. The overall cost of capital, we call it as weighted average cost of capital. So why is that necessary? Simple. Suppose I want to do a particular project. Okay, whatever. I want to do one project. That project needs a funding of 100 crore. I'm assuming. And I feel if I do this project, I will get a return of this project. Return R is how much, sir? 14%, I assume. If I do this project, every year I will get a return of 14% assumption. Now I need how much money for this project? 100 crore. Is it necessary the company will raise entire 100 crore through one source or can it be through multiple sources? Maybe of this 100 crore, 50 crore company issued new debt. 30 crore they came through new preference shares. 20 crore came through new equity shares. Possible. It could be any percentage. I've assumed it to be 50, 30 and 20. Comfortable? Now, sir, every instrument will have same cost or different cost? Different cost. Because on debentures, no, sir, debenture holders don't take so much risk. So that means cost of debt will be usually lower. Equity shareholders take a lot of risk and cost means, first only when I started the topic, I told cost means actual return or return expected. Cost here refers to return expected by the providers of finance. If debenture holders are expecting 10%, equity shareholders will accept only 10 or a lot higher. Obviously, equity shareholders are taking higher risk, they will expect higher return. So let's say cost of debt is 10%, cost of preference shares is 12%, cost of equity is 15%. Assumption. Now question to you is, should I take this project, accept or reject? Should I accept this project or reject this project? See, simple. I will tell you, we are doing a particular project using preference shares, or maybe I'll take cost. We are doing one project using debt. Debt cost is 10%. I'm using this money to do a particular project. That project is giving me 15% return. Now you tell me accept or reject. Cost is how much? 10%. How much is the benefit we are getting every year? 15%. So obviously benefit is greater than the cost. I mean, this is a loss-making project or profitable. That means what will you do with this? X. How did you find out or how did you do this decision? You compared cost with the return. If the benefit is greater than the cost or if cost is lesser than the benefit, then you will accept. Otherwise, reject. Correct? Right. But now here we have one instrument or 3 instruments. And all those instrument cost same or different. Now how will you decide? Easy to decide? No. Hence we find something called KO, overall cost of capital, so that we can take the decisions better. Easy everybody. Alright. So that means average is very easy now, sir. How do you find out average of three things? Add everything, divide by 3. Everything divided by 3. Yes, your method would have been acceptable. But did you use same fund from every source or different? From here 50 crore came. From here 50 came or only 30? From here how much came? 20. That means can we use simple average? No. Because the funding you have raised in the simple average mode or different amount? Different. Now simple average will not work. We have to find out weighted average. So you have to find the weights and accordingly do it. Yes, sir, people. Hence, we find out something called weighted average cost of capital denoted by the symbol KO. Very straightforward. This is in fact the last step. All right. This generally we solve in this particular table. You can solve in multiple ways. It's okay. First, we need the source of finance. Source of finance in my example is what, sir? 1 or 3 source, which is what? Debt, preference shares, and equity. For example, sake, I have taken only 2. Debt is, I've assumed it to be 30, maybe 30 lakh I'll take. Equity is 70 lakh. So totally how much funding, sir? 100. Out of 100 lakh, 30 lakh through debt, equity through 70 lakhs. Now we have to find out the weights. You have to find out the weights. Simple. How do you find out weights? Out of 100 crore or 100 lakh, how much has come through debt? 30 lakh. Tell me the percentage. Out of 100 lakh, 30 lakh has come through debt. How much is the percentage? 30%. Here we don't take the weights in percentage, we assign it in full number. So how did you calculate this? Tell me in numerical. 30 lakh divided by 100 lakh. So if you do that, you will get 0.3. Then 70 lakh divided by 100 lakh, which is how much? 0.7. So this is 30%, this is 70%. If you add, obviously you will get 100%. 100% is what? 1. Yes, sir. This is how you calculate weights. Any problem? Now take the weights of the instrument, and each instrument will have a cost. Each instrument will have a cost. How much is the cost of debt? 10. So take 10 here. And how much is the cost of equity shares I've assumed? 15 I've assumed. So take 15 over here. Alright. Now, how do you calculate KOS? Take that instrument ka cost multiplied by that instrument ka weight. Take that instrument ka cost and multiply that instrument ka weight. So I multiply these two. How much is that? 3. 10 into 0.3 is 3. Why do we do this? Sir, 10% is a cost of capital provided you have taken 100% of money from debt. Has 100% money come in this case through debt or only 30%? 30%. That's the reason accordingly we prorate. That's the reason we multiply these two. Similarly, next, that instrument ka cost, which is 15, and that instrument ka weight, 15 into 0.7 is 10.5. So adding these two, how much are you going to get? 13.5. That is your overall cost of capital denoted by the symbol KO. Yes, people, this you compare with project return. Project return, how much I assumed here? 15% or 14%. 14%. Whatever, it's okay. Number is okay. Now, let's keep it. It's fine, no issues. Let's say return of the project is 15%. Accept or reject now? Accept or reject now? Accept. Why? Return is 15%. So, benefit is 15%, but cost is only 13.5%. So, benefit is more than the cost. That means, is it a profitable project? Yes. So, can you accept it? Yes. So, to find this decision, we calculate the overall cost of capital. Now, you tell me calculation of KO is any different or very straightforward? Straightforward. Because to calculate KO, you need that instrument ka cost, which you will get it using the respective formulas. So, in fact, this is the very last step. Yes, people. Now, to calculate weights, there are two approaches. One, you can use market value. Another one, you can use book value. Book value means historical cost. Suppose I have issued equity shares. Company issued 1 lakh equity shares of face value 10. So, what is their equity share capital? 10. Yes, now, the shares were issued 10 years back. The shares were issued 10 years back. How much capital is showing in my books currently? 10. That we call it as what? Book value. Have issued this instrument now or many years back? Many years back. And currently, what is the value of this instrument in my books? Books means accounts. Accounts means this capital is shown at what value? 10. That we call it as what, sir? Book value. Now, you are finding KO 10 years before or now? No. That means this 10 rupees, no sir, is it now ka value or many years back? Many years ago, you issued this instrument for 10. Now, we want to find KO now means should we take book value or better one is market value? Market value. So let's say currently this shares, no sir, are trading in the market at 25 rupees. One shares ka share price today is how much? 25 rupees. We have 1 lakh shares and each share ka price I've assumed it to be, maybe I'll take it as 30. That means what is the market value, sir? 30 lakhs. Okay, this is what, sir, no? Market value. So you can calculate weights either by taking book value or market value. Market value means multiply by market price. Book value means multiply by the face value. As simple as that. Easy, people, or the value shown in the books. Easy. Sir, which one to use? Now you would tell me, sir. We want to find KO 10 years back or now? That means among these two, which is better approach? Market. Because market value captures most recent data. So market value is preferred. But usually in the examination, they'll only tell which weight you need to use. Whether you should use book value or market value, they'll only mention. If they don't mention and if they give you market value in the question, my preference is always to use the market value because it captures the most recent data. Yes, people, that's it about KO. Okay, G. Sir, can we also say other sources are external and retained earnings are internal, so it doesn't require additional cost? No, much. Retained earnings, no, you are not giving out of retained earnings. You can give dividend to equity shareholders, but currently you are not giving. So that means equity shareholders are sacrificing. So that sacrificing cost is what we are calling it as cost of retained earnings over here. So even pages, even your retained earnings will have cost much. Anything else? Okay, here. Now last concept. Polama. Okay. MCC as in marginal cost of capital. Sorry, ditto. Meaning the way you calculated KO, the same way you will calculate marginal cost of capital. That means it is the same. That means cut. Okay, bye. So what is the difference? Simple, sir. Way of calculating marginal cost of capital and the way of calculating KO is ditto, no change. What is the meaning of the word marginal cost of capital is? Marginal cost of capital means it's a cost of raising the additional finance. It's a cost of raising only the additional finance. So what is that, sir? Check. I'll give you written a small example here. Let's say, sir, company currently has 10 lakh rupees equity. When I write equity, no, here equity means equity share capital and retained earnings put together, sir. Usually equity and retained earnings, they will not split it. They'll combine it and give it to you in the problem, because we know the only difference between cost of equity and cost of retained earnings is flotation cost. And flotation cost will only come every year or only when you issue the instrument. So that year when you issue equity shares, the retained earnings ka cost and cost of equity will change. Thereafterwards, it will change or same. That's the reason these two usually they combine and give it to you in the question. Okay. Now that I've assumed it to be 10 lakh. Debt I've assumed it to be 5 lakh. So what are the total capital? 15 lakh rupees. Easy, people. Now if you find out the cost, the KO for this, if you find out the KO for this, we call it as weighted average cost of capital. Fine. Now, company wants to expand. For expansion, they need some extra funds. They need 30 lakh rupees extra for funding. Okay. Out of this 30 lakh, 20 lakh they want to raise from new equity shares. 10 lakh they want to take a new debt. That means what is the total capital they want to raise? 30 lakh. Listen carefully. For this 30 lakh alone, not this 10 lakh, for this 30 lakh alone, if you find KO, for this portion alone, if you find KO, it is called as what? Marginal cost of capital. Calculation steps are ditto, but it is not total. KO is at what level? Total level. KO is always for the total funds or total capital. MCC is only for the new funds. For new funds or additional funds, if you calculate KO, that we called as what, sir? MCC. Yes, people. After you raise the new funds, how much equity you will have? 10 you had, 20 you raised. How much is it? 30. 5 you had, 10 you raised. How much is it? 15. So total is how much? 45. This is what, sir? Only new or total? Again, for this, if you find KO, that is also known as what, sir? Weighted average cost of capital. Only for this portion, if you find KO, we call it as what? Marginal cost of capital. That is the meaning. But calculation steps are ditto. So this is some problem specific pointers. It's okay. So with this, all the concepts relating to cost of capital fully we have covered. 2 minutes, can we quickly revise this? Would you be okay? Okay, everyone pay attention. Cost of capital means amount paid or return expected. It's a return expected by the providers of finance. That is one. Next, we have to find out in 6 components over here: cost of debt, cost of preference shares, cost of equity shares, cost of retained earnings, MCC and KO. So for debt, and we are considering only what here, sir? Long-term sources of finance. So how do you get long-term debt? First check whether they are redeemable or irredeemable. If it is irredeemable, then the simple formula is payment divided by receipt. So it is what? Interest into 1 minus tax rate divided by net proceeds. Why do we do 1 minus tax rate for only debt? Because on debt you get tax benefit. And what is the priority for NP? First priority for issue price. IP missing, then market value. That is also missing, then face value. In that order only. If it is a new debt, then rather if it's an existing debt, then first priority to market value. If market value missing, face value. Doesn't matter what you take, flotation cost should always be reduced. So do that. By doing that, you will get net proceeds. If it's a redeemable debt, then what's it? Say, cost of debt is given by interest into 1 minus tax rate. That's all, or some extra also will come. Not only we call it as RB minus NP divided by N. Whole thing divided by RB plus NP divided by 2. RB as in here, redemption value. NP is still the same. N is your remaining life. Okay, this method we call it as approximation method. There is another method called IRR method, where we have to take present value of cash inflow, compare it with present value of cash outflow. The rate will be given or we have to find? We have to in fact assume. Will the assumed rate be the IRR rate? No, because usually IRR will be in decimal. If the rate that you have assumed, if it is right, means NPV will be exactly 0. If it is not, assume one more rate and finally use the formula called what's it? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate, whole thing multiplied by higher rate minus lower rate. Perfect. Next, we looked at cost of preferential. In fact, if you have convertible debentures, for convertible debentures, we have the only drama is around redemption value. Because here usually two options will be given. Either investor can accept cash or he can accept equity shares. Naturally, the investor will accept the higher of the two. So calculate redemption value for both cash value and share value and take the higher of the two to be redemption value and plug it into your formula. Then cost of preference has also same drama. Check whether they are redeemable or irredeemable. If it's irredeemable, then you do preference dividend into 1 minus tax rate. No, on dividend you don't get any tax benefit. So it will be preference dividend divided by net proceeds. If it is redeemable, preference dividend plus the RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. Awesome. Next, you can also use IRR method for preference shares also. Next, the cost of equity shares. For cost of equity shares, we have multiple methods. Earnings price approach given by the formula EPS divided by NPS. Dividend price approach given by the formula DPS divided by price. Gordon's growth model given by D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by growth rate. Alright, if they directly give you D1 in the question, then take D1 divided by P0 minus flotation cost, whole thing added by the growth rate. Okay, then we have CAPM model. CAPM model where cost of equity is given by RF plus beta into RM minus R. Great. Then we have realized yield approach. That blindly or careful. First be careful whether can you find out year-wise return or not possible. If you are able to find year-wise return, then you have to find whatever return, 4 years return in our problem. They don't by the symbol 1 plus y1, 1 plus y2, 1 plus y3, 1 plus y4. First year return is given by d1 plus p1 divided by p0, d2 plus p2 divided by p1, d3 plus p3 divided by p2, d4 plus p4 divided by p3. Since 4 years return you are able to find out, multiply them and find how many, what root? 4th root. This will end here or go on? Hence you do minus 1, you will get the answer in decimal converted into percentage. That's one. Or another approach is your normal IRR approach. Next we saw retained earnings. Retained earnings can cost of equity different or same? Same. Only difference is the flotation cost. Wherever you reduce flotation cost, ignore that. You have your retained earnings cost formula. Yes, people? Okay, that is one. Then KO. KO is anything new? No. KO is the overall cost of capital. Because to raise the funds, we take different money from different source. To take the decision, we compare project return with project cost, denoted by symbol KO. If benefit is greater than the cost, accept the project. Otherwise, reject. How to calculate this KO? Take that instrument cost multiplied by that instrument weight. And similarly, for debt also you do the same thing. Equity also you do the same thing. Preference shares also you do the same thing. Retained earnings also do the same thing. Finally, add all of them. You will get KO. Yes, people. And this weights can be calculated either using book value or market value. Right? Preferred one is the market value because it captures the most recent data. That is one. Next is MCC. MCC means the cost of additional source of finance. Only for additional funds, if you find KO, that we call it as marginal cost of capital. Yes, one of the problems quickly we'll run through, or maybe one more is there. Maybe I'll come back to this. Remind me. Okay. Now, quickly 1 or 2 questions we will run through this. Question number 21. Sir, can we say if I practice all IS and sums in the cost of capital means I can get marks? Here, all study material questions, you're good enough. But off late in the last 2-3 attempts, they're asking some good questions in RTPs, MTPs also, which we have done it in our regular class. Just say, yeah, but okay. I mean, if you have shortage of time, this plus study material questions should be a good start. Okay. All right. All right. Same. Now, calculate WACC using the following data. Now, they're asking you to calculate WACC means we have to calculate KO using what, sir? Both book value as well as market. So, whatever we have learned, it will sum up here. Now, debentures, rupees 100 per debenture. 100 is the face value. This 100 is also face value. This 10 is also face value. This is what, sir? Sir, this is the face value, one instrument. This is what, sir? Total face value. Done. Okay, they have given face value and total value. So, in fact, total capital employed is how much? Total source of finances, 20 lakhs. The market price of these securities are also given because they asked us to find out market value of weights also. No? For that, we need a market price. One debenture ka market value is 105, preference shares ka value is 110, equity ka market value is 24. Fine. Additional info, rupees 100 per debentures are redeemable at par. 1 second. They said redeemable. That means irredeemable debt or redeemable? Redeemable. For that, we need RV. They said redeemable at par. Par value means face value. So, how much is R? RV is 100. 10% coupon rate. Instead of interest rate, they use the word coupon rate. Coupon rate is nothing but your interest rate. 4% flotation cost. This is your F component. 10-year maturity. 10 becomes your N. N actually is not total life, it is the remaining life. Okay, check in some problem, they will give you a remaining life. Okay, here I think they have not, so that means N only will take it as N. Yes, people, with this instrument, what you can find out? You can find out cost of debt. Can we quickly do it? Tell me the formula, what will take? No need to solve. Quickly, I'll project it. Just tell the formula. Interest into 1 minus tax rate plus RB minus NP divided by whole thing divided by RB plus NP divided by 2. Josh, we will do that. You should not do. Why? Use YTM method. YTM means yield to maturity. That is known as IRR. We want to use formula. Our mind, our heart, our kidney is saying formula. But ICAI doesn't agree with you. They are saying use a check. If they have not given option, you can use formula. Otherwise, B. Because Josh Meshme, we will do all this. We said full didn't came. You did wrong method. That means obviously how much marks? So 0 marks. So just read the question fully because all the data they will not give in one place. They will put information all over the place. So before you start the solution, give the question one read first. Okay? Like this also many students have lost marks. Full answer right. Just that they solve using wrong method. Okay? So don't be of that sort. Now, YTM method, how to do it? We need inflows and we need outflows. Sir, what is outflow? You tell me. Think from investor perspective. Outflow is your net proceeds. Inflow will be your for debt. Inflow will be interest or interest into 1 minus tax rate. Into interest into 1 minus tax rate plus what's R. This has to come. Yes, people. Can we quickly do it? So how to assume the rate, sir? Sir, there is one shortcut which I used to suggest for our regular class because students will find it difficult to make an assumption. In class, now I write 10%, bindas, you copy. In exam, no. 10, 8, 15 I'll take. Like this, all these doubts will come. If you want to avoid that doubt, there is one shortcut. Can I tell you that? This will take 1 minute extra, but it will get you answer faster and it will probably give you some mental relief. What is that? Is simple. First, not trial and error. First, solve using approximation method. Solve using approximation method. Sorry, they have not asked that. Still do. Still solve using approximation method. This is the number, no? Where I've solved here. If you solve, that's now the formula you told. I solved that. How much am I getting? 6.89. That means, sir, IRR method and approximation method will give same answer, sir. No, but they will give a reasonably close answer. How much is the answer here? I'm getting 6. That means maybe IRR method also will give me more or less same answer. I'll assume the discount factor to be 5 and 7. Because 5 and 7 is lying somewhere between 6.8. Maybe I'll take 5 and 8 just to be on the safer side. So we got this as a benchmark. It's not mandatory. Okay, this is not mandatory. This is just a simple way to identify which discount factor I have to assume. Solve using approximation method and accordingly figure out what discount factor we need to assume. Got it, everybody? This is anyway same, no? Interest into 1 minus tax rate. That is fine with you. How do you find out NP over here? Tell me. I'll show you the data once again. Tell me how much is NP over here. We discussed what is NP ka first priority. Sir, we don't know. Check here. Have they told these instruments are issued? We don't know. That means we don't know whether it is new debt or existing debt. Doesn't matter if no information is given whether it is new or existing. First priority still always to what? IP. If IP missing, market value. Market value missing, face value. In this order only you take it. If you are not able to find out whether it is existing or whether it is new, you will still follow the same order. Correct? Check here. IP given or missing? There. Given or missing? Missing. So IP is missing. That means next priority you will take it for what? Market value. Is market value of debenture given? Yes. That means how much is that? 105. So take 105. That is your NP. No. Whatever instrument you take, flotation cost you should compulsorily reduce. What is the flotation cost for the debt they told? Flotation cost is 4%. From 105 reduce 4%, you will get your net proceeds to be 108. Yes, people. So NP is covered. RV they only told in the question. They are redeemable at par. RV is how much? 100. N also you know, which is what? 10. So plug the numbers, you will get the answer. Yes, people. Now this is the one they asked, or we have to use IRR method. IRR method. What discount factor will assume now? 5% and 7%. So take your year. And IRR means outflow and inflow. Both will be there. Outflow happens later or immediately. I mean your data should start from year 0. Year 0 what will come? Net proceeds. Every year what will come? Interest or interest into 1 minus tax rate. Interest into 1 minus tax rate. At the end of the instrument what will come? RV as in redemption value. So IP will come at year 0. What is IP, sir? 100 or IPL or rather NP will come at year 0. How much is that? 100.8. You will get the signs from company perspective or investor perspective. From investor perspective, investor is to purchase the debenture, he has to pay the money. Pay the money means inflow or outflow? Outflow. Then interest into 1 minus tax rate. Interest is 10 rupees. Tax rate is 30%. So this becomes 7. I'm not solving. I'm quickly reviewing the solution with you. Okay, Saru? So this is the interest into 1 minus tax rate. Is interest changing every year or same? Same means should we use PVIF or PVAF? PVAF. So at 5% for 10 years, PVAF will be 7.721. Meaning 1 divided by 1.05 you do. Press equals to button how many times? 10 times. Then in your calculator, there will be a button called GT. GT stands for grand total. Press that GT button, you will get the number to be 7.721. Okay now. So multiply these two to get the present value. This is your outflow. This is your inflow ka present value. If you sum it up, how much are you getting? 14.647. So that means this 5% by IRR. If 5% was IRR means this number should have become easy. It is not. So assume one more rate. What is the rate we have assumed? 7. So work out the same using 7%. You got negative. Ideally, for the best answer or the closest answer of IRR, one NPV should be positive, one NPV should be negative. Ideal. Not in every case. Ideally, I say solves the question that way. Okay. So this way, if you solve, you will get the answer closer. If you assume any other discount factor, let's assume you did 5% and you took 10%. Will you get the same answer? No. You will get slightly different answer, but that is acceptable because that's how the method works. Yes, sir, people? Wrong. So you got the cost of debt plugging in the formula. You know formula for IRR, no? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Plug the numbers into the formula and you will get the cost of debt to be this the particular number. Oh, any doubt? In many cases also, they will only give you the discount factors. Check. Also in some problem, they will only give you the discount factor. Suppose the question said use 5 and 7. You are a Burospati, you are taking 8 and 12. Will I get marks, sir? Absolutely no, sir. When question does not give you rate, you have a liberty to choose whatever the hell rate you want to choose, you can. But when question only clearly says what rate to be chosen, you can't override. That's what I keep saying. Don't question the question. Go with the flow. If they give something, always take it. Yes, are people done? In a similar way, we have to also find out KP. We have to find KP. Both KD and KP we have to find using which method? Why? IRR method. IRR ka another name is realized yield. Another name is YTM as in yield to maturity approach. One and the same. Yes, people. Now, you can directly start the problem or what you can do? First solve using approximation method. That way you will get to know which discount factor to assume. Okay. Should I have to take you through this or got this? I'm just quickly reviewing. Comfortable with the way of solving? So I think we can move forward now, everyone. So here if you solve, you will get 4.06. That means you tell me what rate can you assume? Maybe 3 and 5. Take one number lower, take one number higher. Maybe 1 or 2 number lower, 1 or 2 number higher you take. That should be good. So 4 ka 1 number lower is 3, 1 number higher is 5. So take 3 and 5% and work it out. You will get the answer. Okay, you will get, plug into the formula, you will get IRR answer to be 4.0. So you got cost of debt also, you got cost of preference shares also. Now for equity shares, we have equity shares also, no? Check this. Equity shares has 4 rupees flotation. 1 minute. So if you just check first one, they gave flotation cost in percentage. Here they give it in number. So when they give you percentage, what we should do, sir? So when they give percentage, no, always calculate the percentage. If you take IP, then flotation cost ka percentage on IP itself. If IP is, let's say, 120, you will multiply 4% with the IP itself. Suppose you are taking MP, then multiply flotation cost with the MP itself, whatever number. But in some problem, they clearly specify, calculate flotation cost on the face value. Only in that problem, calculate flotation cost on the face value. Otherwise, whatever you are taking as what, sir? In IP or MP, whatever you are taking, on that only you calculate the flotation cost. But in this instrument, equity, should we have to calculate flotation cost or clearly given? Clearly given. Okay, equity shares has 4 rupees flotation cost and market price is 24. So this is current market price, no? We denote this as what, sir? T naught. The next year expected dividend. Next year expected dividend means dividend already paid, we call it as D naught. This is dividend expected. Expected dividend, what do we call it, sir? D1. Annual growth rate is 5%. So growth rate is clearly given to be 5%. The firm has a practice, that's okay. So that means you can, the moment G comes in, what should click? Which method? Because we have cost of equity using multiple methods. What do you use? Golden, what formula will you write? D1 plus or D1 divided by P naught minus flotation cost, whole thing added by the growth rate. P naught here is your current market price. Yes, people? Okay, I've plugged in one number and got cost of equity. Any problem in this? No. So they asked this or they asked you to calculate KO. KO. How do you calculate KO? First, you have to calculate using book value also, you have to calculate using market value also. First, if you calculate using book value, quickly I'll run through. Book value means you should take market value or the value given in the books. What is the value of debenture as per books? 5. Preference shares as per books. Equity as per books. Total is how much? 20. Calculate the weights for me here, let's see. How do you calculate weights? Out of 20 lakh, 5 lakh has come through debt. So what is the weightage? 5 lakh divided by 20 lakh, which is 0.05% or 5%. 0.25, huh? Okay. This also will be same number. This will be what? 10 lakh divided by 20 lakh, which will be 0. That is your weights. Yes, people, plug the numbers. That's all. So that's what I've done the presentation here. Debentures, preference shares, and equity shares. This is the book value given in the question. I've calculated the weights. Cost of capital. Just now we calculated using our golden formula and IR. Plug that number. How do you calculate KO? Take that instrument ka cost, multiply by that instrument ka weight. If you do that, you'll get 0.172. Here I've taken decimal. Okay. If you do on decimal, you can take it in percentage. If you take percentage, final answer also will be in percentage. That is your presentation call, how you want to present it. Again, for preference shares also same. Take that instrument ka weight multiplied by that instrument ka cost. Basically, KT multiplied by preference shares ka weight. To multiply, you will get. Similarly, here you take cost of equity multiplied by equity ka weights. Add everything, you will get 0.0074. That you express in percentage. It becomes 7.74%. This is calculating KO using what? Book value. Any doubt? Just reviewing, people, no time to solve full. Hope it's understandable because I want to cover more questions in less time. Done. Okay, that's all they asked, or one more? One more. What are one more they asked? Calculate KO using the market value. That means now can we take this value? No. This is what, sir? Book value. Now check everybody. Total face value is how much? 5 lakh. And face value one instrument is how much? 100. If you do this, 5 lakh is a total face value and one instrument ka face value is 100. If you do this, how much you going to get? 5,000. 5,000 is a number. And do you know market value of each debenture? That means how do you find out market value? Can I write like this? 5 lakh divided by 100. If you do, you will get number of debenture and each instrument ka market value is 10. Is this okay? That is what I have done over here. Check. 5 lakh divided by 100 multiplied by the market value, you will get 5 lakh 25,000. Do the same drama for others also. For like equity shares, if I have to show, 10 lakh is the total face value and face value of one equity shares is how much? If you do this, you will get number of equity shares. How much is the number of equity shares? 1 lakh. And what is the market value of each equity shares? 24. Multiply, you will get 24 lakhs. That becomes your market value. Now calculate the weights using market value. How do you get weights using market value? Adding everything, what is the total market value? 34 lakh 75,000. Out of 34 lakh, only 5 lakh 25,000 has come through debt. What is the weight? 525 divided by 34 lakh 75,000, which is 0.150. Like this, calculate the weight of each instrument. This cost of capital we already calculated, and mind you, we should not take cost of capital, we should take after tax cost of capital. That anyway, when you calculated cost of debt, did you take interest or after tax interest? After tax interest. So you're getting after tax cost of capital only. Okay, people? Alright. So take that instrument ka cost multiplied by that instrument ka weight. Go on doing this for all the instrument and then sum it up. You will get the overall cost of capital to be 8.58%. Any doubt, anybody? Easy. Pakka manageable. FM is a topic where you will get the confidence only by solving. Now, when I am doing here, no, things will probably click. It will be like, okay. But when you start solving, you will start showing creativity. It will come. Trust me, it will come. Okay, so if you want to gain confidence in this paper, for that matter, any practical paper like costing, FM, okay, accounts has become these more like a accounting standard driven paper now, so that's okay, all right. But most of the practical papers, you will gain confidence only by practicing. So few questions compulsorily practice. That's the reason I'm not keeping too much marathon session every day. If you want, we can also do 10-hour session and finish off in one day also, right? But it will be just me speaking and you probably nodding off. Because trust me, after that 4-5 hours, our attention span will be some boy has come from some place, so Papa, we have to entertain, so we will sit. Later on, we will recap it. We'll watch it again on YouTube. That all a feeling will come. So I don't want that. That's the reason if you just check, though it is marathon, I'm telling the formula again and again because I want you to remember everything in here. Okay, though it's marathon, I'm not treating as one, I'm treating it as entire concepts here. Okay, Saru. Done. So this is done. No, next 1 or 2 questions we will take up, then we'll see. Yeah, this is one popular question. It has come quite a few times. I'll take up question number 22, or maybe once again. Hang on. I think we'll take up this. This is okay. This is a repetitive question. I do 2 more questions, people. Another 10-15 minutes time, maybe. Okay, I'll see the time and accordingly I'll decide. Concepts we have revised everything. Time basis me. I look at the time. I think I have on time only for 2 or 3 more 2 questions, maybe more. Listen, now concept is online also okay, G? Oh, sorry, my bad. Yeah, they'll respond after a few seconds. Anyway, coming back. You remember convertible debentures? Convertible debentures. What is the funda around convertible debentures, sir? You should, redemption value is the main problem. You have to take either cash value or shares value, whichever is higher. This question targets that. Can we quickly review that and understand this a little better? Okay, this is also a latest question added from our study material, and this is from one of the previous year paper or RTP question. Okay, check this. 15% convertible debentures of 100 each. 100 each means 100 is what? Face value. And 15% is the coupon rate or interest rate. They are 15% convertible debentures of 100 each at par. At par means they are issued at par. So IP is also what? IP is equal to face value is equal to 100 in this problem. With a maturity of 6 years. I mean 6 becomes your N. Why am I stressing all this? Formula. Right? The moment N comes, it is a redeemable debt. For redeemable debt, we have a different formula. Don't blindly apply formula. It could also be yield to maturity also, that they will tell at the end. First read the question fully. On maturity, check this, each debenture will be converted into 2 equity shares of company. 1 debenture, 1 equity share nahi babu. It is one debenture mein it is 2 equity shares. Okay, so be a little careful here. The risk-free rate of return, that risk is how much? 10%. This only we call it as what, sir? RF. Risk premium. Oh, risk premium means RM minus RF. If you do that deducted number, only we call it as risk premium or market risk premium. How much is that? 18%. Beta. Our beta G is 1.25. Company has paid. Paid dividend means D1 or D0. Dividend already paid, we call it as D0. That is how much? 12.76. 5 years ago, it paid a dividend of 10 rupees per share. Oh, 5 rupees it was 10. No. Now how much did you pay? 12.76. So dividend same or it is increasing? 5 years ago it was 10. Now it has become 12.76. Sir, is dividend constant or dividend is growing? Growing. That means, is there any growth rate for dividend? Yes. Given? No. We have to find. Okay, now I'll tell you. Flotation cost is 5% of the issue amount. Flotation cost is also there. 5% preference shares of 100 each at a premium of 10%. That means here issue price is what, sir? Are you issuing it at 100? No, you are issuing it at 10% premium. So issue price is 110. These shares are redeemable after 10 years. 10 years is what here? N. And they are redeemable at par. At par means RV is 100. Flotation cost is 6% of the issue amount. Meaning of the issue price, you have to multiply 6% to get the flotation cost. Tax rate is 40%. Calculate cost of convertible debentures using approximation method. So this is good for us. No, we are also expecting formula. They also told formula. We don't want to use IRR method because it is lengthy. We don't like. But unfortunately, institute disappointed your feelings in the next point. Use yield to maturity to calculate cost of preference. Done, people. No, this is a good question. The reason is it's a convertible debentures. For convertible debentures, we need meaning since the life, life is how much? 6 years. No? So life is 6 years means obviously these are what sort of debentures? Irredeemable or redeemable? Redeemable. For redeemable, we need RV. RV, we have to take what, sir? Cash value or share value, whichever is higher. Don't do that. Why, sir? Sir, these are convertible debentures. Convertible debentures means usually in convertible debentures, option will be given to the debenture holders either to select cash or select shares. Here option is given or direct conversion. If option is given directly, they will tell you in the question, debenture holder has an option to choose cash or shares. We read the whole problem. We found anything like that? No. That means these are what? Optionally convertible debentures or compulsorily convertible? Compulsorily convertible. For compulsorily convertible, will company give cash or no cash at all? No cash. Only one option, which is what? Shares only. Yes, sir. So that means here redemption value is exactly what, sir? Share value. No cash value because cash option is not at all given. Manageable. Now you have to find out share value. But unfortunately, share value given missing. If they had told share value is 50 rupees, we could have easily found out and happy face. We could have ended this question. But unfortunately, institute doesn't want to hand in a happy face. They want us to put effort. So can we put that effort? So I'll tell you how this connection is linked. You remember cost of equity. First, is cost of equity given or they have given CAPM data? Tell me CAPM formula. RF plus beta into RF minus. Correct. Using this, first find out cost of equity. Then maybe I'll tell this. Check here. That's what I've done over here. Using CAPM model, I've got cost of equity to be 32.5%. All the data is given. Here RM minus RF, we had to compute or they only give? They only give, which is this. These two are deduction only. We call it as market risk premium. It was given directly in the question to be 18%. Plug the number, you'll get cost of equity. Any problem? Now this is a combination question. This is a good question. Why? Using CAPM, you need to find out cost of equity. Now they mentioned something about growth also. I didn't say, they said no. Dividend a few years ago was 10 rupees. 5 years ago it was 10. Now it has become 12.76. That means dividend has increased. So dividend is there any growth rate? Yes. Which formula uses growth rate? Gordon. So tell me, how do you calculate Gordon's growth formula? They gave what here? Check. They gave dividend, expected dividend or dividend paid? They told in the problem dividend paid. Dividend paid means we'll use what formula? D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by growth rate. Yes, sir. Now, why am I writing this? This. What is this? P0 means current market price of what? Equity shares. To calculate a redemption value, we need a share value, and that share value we will get to using Gordon's formula. Because cost of equity we already know. We calculated here from CAPM how much? 32.5. So cost of equity you already know 32.5%. So cost of equity you know, D0 you know, growth rate we'll find out, flotation cost given. So means which is missing? P0. So using this formula we will find what's a P0. Yes, people, you have done your topic. I hope you remember. You can find out P0 also. We have done this in dividend decision chapter. If you cross multiply, how do you find out P naught here? Here in this problem, any flotation cost will not be there, right? G. Flotation cost will not be there. Cut off that. How do you do that? See, this you send it to the other side. So it will be cost of equity minus growth rate divided by P naught into 1 plus D naught into 1 plus growth rate divided by P naught. Therefore, P naught will come to the other side, K minus G will come to the other side. Yes. So therefore, how do you get P naught? We have used this formula in dividend decisions. If you remember, price of the share is given by what, sir? D naught into 1 plus growth rate divided by cost of equity minus growth rate. You can rephrase this equation. You can keep this only and solve, not a big deal. Or you can rephrase this equation, which you anyway know because we have done it in dividend decision topic. Plug this number and get what, sir? P naught. Everybody understood the approach? Paka, what is our approach? First use CAPM because they have given CAPM data to find cost of equity. Now use Gordon's formula. All the numbers are known except P naught. So you have to find out P naught using this. So growth rate to growth rate to, yeah, growth rate we will find out. Simple. Here if you just check on chin to table have they given. Are you able to observe? This is what? PVIF. Okay. PVIFA. PVIFA as in this is PVAF, sir. First two are PVIF. Next two are PVAF. This is at 0.03. 0.03 means 3%. This is at 0.05, which is 5%. So basically at 3% and 5%, they have given PVIF and PVAF. They have given only present value factors or also FVIF. FVIF, that is your future value factors. Future value factors. Now, some problem they will give you this. If they give you this, growth rate is very easy to find out. Usually they will not. If they give, how to do it? Simple way, check. Sir, how much is the current dividend? Everyone pay attention here. What is the dividend that you paid in the current year? 12.76. Okay, now. How much dividend you paid 5 years ago? 10. So divide that. How much are you getting? 12.76 divided by 10. You're getting 1.276. That's the number you're getting, 1.276. Have they given future value table here? Yes. Simply look for this 2.76 in that future value table. Which rate has more? Do keep in mind that is how many years is this? 5 years ago dividend was 10. So look in 5 years column only. Which percentage has 1.76? This is your 5 years. We can't take 6 and 7 because the term is how many years? 5 years. Here, this is your 5 years. Here, check in this row, which number has 1.276? 5%. That means automatically growth rate is 5%. Got it? Lucky if they give you like this. Possible. Sometimes they give. Once more, got it. So simply take current dividend. Take a current dividend. Okay. Current dividend is how much? 12.76. Divide by what was the dividend 5 years ago? What was the dividend 5 years ago? 10 rupees. So divide those two numbers. You're getting how much? 1.276. They have given comparison for how many years? 5 years. So check. This is your 6 years. This is your 7 years. We don't want that. We want only 5 years. Check in which table, which row 1.26 number is available. That is there in 5%. Yes, no. That means automatically the growth rate is 5%. If you don't want all this also, simple, you can go for trial and error method. Trial and error method. Simple. How much was the dividend 5 years ago? 10 rupees. Now, no, sir. Allah, Shiva, Jesus, whatever. Assume one rate. Let's start maybe with 7%. We are testing if growth rate is 7%. Sir, how many years ago was it 10? How many years ago was it 10 rupees? 5 years ago. Okay. How much we want to test it at? 7%. 5 years over, no. Add 7% 5 times. Add 7% 5 times. How much are you getting? 14 point something. Sir, is that answer or current dividend is 12.76? Current dividend is 12.76. That means it is 7 or lesser? Lesser. Now let's test it maybe at 5%. Assumption. So 5%. How many times you will add? 5 times. Why 5 times? Because dividend paid 5 years ago was 5%. Do much, how much? 12.76. How much dividend currently you paid? 12.76. Thank you, Jesus, Allah, Shiva. So the growth rate is what? 5. Plug in some random numbers and add it. If they give you 7 years ago dividend was some amount, then you will add it how many times? 7 times. 10 years ago it was that much. Add it 10 times. What percentage to assume? You take your favorite number. So my favorite number is 1000%. Get lost. Yeah, 1000%. And I don't take. Usually it will be bare between 1 to 10. So like this you can calculate. Yes, sir, people. Yes. This is another way. Easy peasy. Okay, G. Now how much is the growth rate we got, sir? 5%. Now come back to the formula. You have your B naught also you have, growth rate also you have, cost of equity also you have, this also you have. So if you do this, you get plug in the numbers and you will get P naught. Can I directly review the answer? Would you be fine with that? So if you do the Gordon sky, you will get P naught to be 48.72. Congratulations, you got your RV. Okay, now wrongo. Why? Sir, these are not equity shares. These are convertible debentures. What is this? What is this? Share price currently. Share price. Equity share ka current market price. That only we call it as P naught. Will you convert the debentures today or after 6 years? Read the question. They said maturity period of the debenture is after 6 years. That means you will get the shares now or after 6 years. After 6 years, if you get the shares, means can you take today the share market price or after 6 years ka share market price? Got my question? This question is good because of all these extra fittings. Okay, now so can we take current market price? No. We don't want current market price. We want the market price after 6 years. Why 6 years? Because debentures are getting converted only after 6 years. That means this will not be 48.72. Do you know growth rate? Yeah, just now we found out how much is growth rate. Right. If share price is 48.72 now, after 6 years it will be same or going on increasing? How much it will increase by? 5%. So 6 times you add 5%. Take current market price of 48.72 and add 5% 6 times. How much are you going to get? 65.28. This is one way of solving the question. Easy. Yes, sir. Or you can use your mathematics. 48.72 is current market price. That means it is present value. We don't want current market price. We want value after 6 years. That means we want future value. Remember, present value, future value formula was that? How do you get future value? Present value into 1 plus I whole power n. So present value is 48.12. I here stands for your growth rate. How much is the growth rate? 5%. N for you need the value after how many years? 6 years. Plug in the formula, you will get that. This is in calculator. This is your mathematics ka formula, whatever you're comfortable. Easy G. Any problem G? So this is the expected. No, this is the answer. No. You have to be a little more careful here. Why, sir? Sir, they told on one debenture you will get 1 equity shares or 2 shares. This is the value of equity shares after 6 years, but only for how many shares? 1 share. You will get 1 share or 2 shares. That means RV of convertible debentures will be what? Value of equity shares after 6 years multiplied by 2, which will be 130.5. That is your RV. Now problem became simple. Okay, now manageable. Now you plug in the data into your formula. I is given, RV minus NP, redemption here is anyway premium. There was any flotation cost for debentures? Do not forget flotation cost. Yeah, here no, somewhere flotation cost. How much is the flotation cost? 5%. That means you got your RV. How do you get NP, by the way? How do you get NP? Issue price. If your new issue means you are always first prioritize issue price. IP missing, market value. Market value also missing, face value. Here IP, ironically, the IP and face value was same. But don't take directly that to be net proceeds. How do you get net proceeds? Whether you take IP or MV or face value, you should always remember to reduce flotation cost. So reduce flotation cost, you will get net proceeds to be 95. Plug the numbers into formula and get cost of debt. Preference shares is pretty straightforward, nothing much to learn there. It's a ditto. But this was a good question targeting cost of debt. Okay, people. So that way, I would say all those questions, little bit of revise. So, yes, people. So can you please tell us when the classes? I don't know, macha. Starting for auditing and all, I don't know. Da? You ask Karthik sir, macha, or you call up our team. They'll tell. Da. No information. Da. Yeah. So this is done. Or you want me to start after auditing is what you're saying. I think that's what we're doing. Auditing is getting over at what? Currently, law is going. Huh? Oh, here law. I thought he was taking auditing. Okay, fine, no issues. That I don't know much of that. Auditing there. You can ask maybe with the team only. Now, fine. Yes. Specific question. Maybe what I can do is I have maintained some LDR. One of you are existing. Is there any regular batch student over here who has taken the batch currently? In online, anyone is there? I've given an LDR list. last day revision list. Can you please share it so to the students? You can just in this live chat, you can put it up. I've given for each chapter some last day revision questions, right? You can share that list, okay, so that others can review that. That's just my not intelligent, just my reasonable guess as to what could be expected, some questions, okay, and just prioritize that. You can share that. I don't have it with me currently. If necessary, maybe tomorrow I have the data, I'll pull it and I've got it, because I've not got the books and all. All my books are there in Bengaluru. I didn't get the books for marathon class. I just got my iPad. In my iPad, all that is not there. So in case anyone is there, please do this. That is also same. All right. So this is about cost of capital ka question. Thank you so much for your patience. Let's take a break for about 15 minutes is good. Yes. So today's target, I'll tell you before I wind up. Today's target will be little more. Tomorrow and day after, the target will be little less. So today probably will cross that limit. Maybe we'll end up by post 8:30 only. Maybe 9ish also. Tomorrow, I think by 7:30ish we'll wind up. Okay, sir? Because I can't start a topic and leave it midway. I have to finish that. Yes. Come back in 15 minutes. Thank you. Yes, people, welcome back after the break. So I was reminded that one small thing in the chart book which I asked you to remind for the previous topic we didn't cover. Maybe we'll quickly run through that. It's not going to be a problem. Okay, so about same cost of capital topic mein. Okay, so one thing is sometimes what happens, no, sir, the actual debenture interest and expected interest will not match. The actual debenture interest which the company is giving and expected interest which the shareholders or debenture holders are expecting will not match. In that case, what to do? Let me tell you a small example. Let's say our competitor companies, they are issuing on their debentures or on their debt interest at the rate of 12%. But our company, no sir, we want to give an interest rate or coupon rate of only 9%. What is the market rate of interest? 12%. But we are only giving how much? 9%. Now tell me, will anybody buy our company ka debt? No. The reason is other competitors are giving 12%. We are giving only 9. So obviously they will buy other company ka debentures and not our company ka. Yes or no? So in this case, what to do? So in this case, there will be a hidden adjustment. What is that adjustment is? Let's say the face value of this debenture is 100. The only way you can convince the debenture holders to subscribe our company ka debentures, the only way we can make the debenture holders purchase our company ka debentures is to issue the debentures at discount. We can't issue it at 100 because you are giving only 9% interest rate. Market is expecting 12. So now we will convince the debenture holder telling, boss, I understand you are expecting more, but I will issue the debenture at discount. Not at 100, but below 100 rupees. So this will be a hidden adjustment in the question. How to find it? Very simple. So first of all, how do you find out interest? Interest amount, normally, how do you find out? You will take debenture value, correct? You will take debenture value and multiply it by the interest rate, correct? This is what you do. Any problem? Now, if I give you interest amount in the question, if I give you interest rate here, can you find out debenture value? Tell me in equation, how do you get that? Debenture value, how do you get? You do interest amount divided by interest rate, correct? If you do this, you will get the debenture value. Yes, people. Now, the same thing you do over here. How much interest actually you are paying on one debenture? Face value is interest is always calculated on the face value. How much interest company is actually paying? 9%. What is the face value of each debenture? 100. 100 ka 9% is how much? 9 rupees. That is the actual interest amount divided by what? Interest rate. Now don't take 9%. How much are the debenture holders expecting? 12%. So divided by expected interest rate you take. That's what I've written in the formula. Okay. Interest amount divided by not the actual interest rate but the expected interest rate. How much is the expected interest rate? 12%. So divided by 0.12 you do. How much you're going to get? 75. That means 100 rupees of face value of debenture. You have to issue it at how much? 75. 25 rupees is the indirect discount. Understood, people? This also can be tested in a bigger problem. Any confusion or okay? Everybody good? So this gives you what? IP. This will give you NP? No, doesn't matter whether you take IP, MV or face value, you have to compulsorily reduce face value or rather flotation cost. So to get NP, you take IP, that is 75 minus flotation cost. Here in this problem, I've assumed flotation cost to be 5 rupees. So that means NP will become 70. That's another adjustment. Got it up, people? So that means how do you get the issue price? Tell me. It's simply interest amount divided by actual interest rate or expected. Usually actual and expectations will match. If it doesn't match, you take the interest amount in the numerator and divide by the expected interest rate in the denominator to get the issue price. And from that issue price, reduce the flotation cost to get the net proceeds. Can be easily fitted into any question for that matter. Okay, G. Can I move forward, people? Alright. Another one hidden adjustment is working capital. We'll do it on the last day, sir. Now, so another adjustment is sometimes, sir, they will say redeemable debentures. They will say redeemable debentures or redeemable preference shares. But RV, NP, all this will be same. All this will be same. Meaning usually this will be equal to face value itself. Redemption value, net proceeds, etc., will be same. In that case, you have an option. You can use approximation method and do the whole drama in formula and calculate it. That is one way to do it. Fine. Or you can use a shortcut. What is the formula to find out cost of debt, by the way? You do interest into 1 minus tax rate. If it is a redeemable, then you do what's our RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Yes, no. Suppose interest rate is 10. Interest rate is 10%. Tax rate is 30%. So you do 1 into 1 minus 3 or 10 into 1 minus 3 plus what's RV. Let's say redemption value is 100. Net proceeds is also 100. Okay, now divided by life. Let's take it as 5 years. I've assumed all these numbers. Into what? Divided by what, sir? RV. RV is how much? Redemption value at par. So 100. Net proceed is also how much? 100 divided by 2. Calculate this for me. How much are you getting? This will be 7. This will be how much? This is 0. This will be what? 100. How much are you getting? 0.07 or 7%. So if you plug in the formula, you're getting 7%. Any problem till here, anybody? Once more or okay? Everyone okay now? Have taken your break and come back, right? How's the Joshua? Louder. Fine. Cost of debt is 7%. Easy. Now, if you just check RV, NP and all was different or same. If it is same, instead of doing that, no cost of debt, no sir, you can get it in straightforward way. Interest into 1 minus tax rate. That's all. No need to do anything else. Interest into 1 minus tax rate. How much is the interest rate? Don't take the interest amount. Take the interest rate. How much is the interest rate? 10% into 1 minus tax rate. Tax rate I've assumed it to be 30%. How much are you getting? 7%. What was your answer? Shortcut. That is what I've written in this section of the chart book. If redemption value, issue price and all, if it is happening at par value itself, you can use approximation method, nothing wrong. But instead of that, you can use a shortcut. What is a shortcut? Interest into 1 minus tax rate. Here, I is not interest amount. I is the interest rate. A quick way to get the answer quickly. That's okay, people. Same goes for preference dividend also. If it is redeemable preference shares, and if the redemption value and your net proceeds and all, if it is same, if it is par value only, then what you have to do? Here, what are you doing? Interest into 1 minus tax rate. Why 1 minus tax rate? Because on interest you get tax benefit. On preference dividend, will you get tax benefit? No. That means how do you get cost of preference share? Shortcut method. Preference dividend ka percentage itself is what? Cost of preference. Even if you plug the numbers into formula, you will get the same answer. This is a quick way to work out the answer. That's all it is. Comfortable, Asaru? Everyone cool? Yeah, thanks for reminding that. Yeah, that's what. Flotation cost, yeah, all that. I mean, see, what did I say over here? All the shortcut will only work when RV and NP are same. Okay, if flotation cost is there, or if RV is different, NP is different, can you work out like the shortcut method or normal formula? Normal formula. If you want to use shortcut, then they have to be same. Only in that case, this will work. Again, you can just check in the bigger problem whether shortcut you want to use or not. Regular class, 3-4 problems, we have used the shortcut. Alright, I've mentioned it also, but anyways, it's there in the chart book and covered also. Done, people? Got it? Okay, thank you. Yes, people. Now we'll be starting the next topic. The next topic we're taking is capital structure. So in the previous session, will advanced accounting marathon be conducted? This time, no. The marathon that is already conducted, that would hold good. You can refer the same. For May attempt, I would be doing one. Okay. For Jan attempt, you can refer the previous one itself. Alright. FM we are doing any which way here. FMA, there was some extra additions which happened and also I wanted to re-record the marathon. That I don't see it in advanced accounting. So the same one would help. Okay. Fine. Alright. That you need to check with the team, Murugappan. I'm not sure about those, but I don't look into the operation side of things. You raise a ticket and concerned person will definitely help you with that things. Okay. Now coming back. So in the previous session, we looked at cost of capital, meaning every source has a cost, and what is that cost? How to find out that cost through various methods we found out. Yes. Now in this chapter, we are trying to figure out, suppose I need 100 crore rupees funding for a particular project. I need a funding of 100 crore. Now company has an option either to raise entire money through equity shares or debt or preferences. Now we are, this chapter ka concern is this 100 crore should come from which source? If you say it should come from all the three sources, then how much from each source? Like that. So now we are trying to figure out how, from which source you will select the funding so that your value of the firm is maximized. In fact, FMA, when we initially started first topic of theory, we said that one of the main objective of FM is simply a managerial activity which deals with effective procurement of funds and utilization of funds. This procurement and utilization we do to achieve business objective. That is to maximize the overall value of the firm. Okay. This is also same thing. From which source of finance we should select the finance so that the value of the firm is overall value of the firm is maximum. That's all is a goal over here. Cost we have already found out. Now here it deals with from which source to pick it. That's the overall objective of this particular topic. Can I move forward? All right. So like last topic, here also there will be some formulas that will be thrown across at you. If you remember, maybe around 6 to 8 formulas at best, maybe. If you remember that, if you remember like its application in through few problems, and we'll be more or less done with this particular chapter. Okay, sir. Now the first formula that comes in this particular chapter is, here we're talking about what here, sir? Select that source of finance which maximizes value of the firm. Value of the firm is denoted by the symbol V, or it's also called as VF sometimes. Okay, value of the firm, we just call it as V. V is no need to write down, everything is there, just listen. And I have told you if you want to buy this chart book, where to buy it also. Yes, so just listen, that's good enough. No need to worry too much about the running notes for the time being. Anyway, these videos will be available on YouTube also. It's nothing like hurry burry. So aram se whenever, I know that these are some topics, no? Initially we will understand, later we will forget. So it will always be available. You can revise it again by opening that respective topic. So for now, just concentrate and as much as possible, try to intake. So we are trying to find out now value of the firm. Value of the firm is denoted by the symbol V. V is equal to EBIT divided by KO. V is nothing but EBIT divided by KO. EBIT stands for earnings before interest and tax. KO stands for overall cost of capital. So if you do EBIT divided by KO, you will get value of the firm. Quite simple actually. Just check here. Sir, suppose you are an investor. All right. So investor will invest the money. Suppose investor invested 1 lakh rupees. One particular investor, he invested 1 lakh rupees. He is expecting 10% return on his investment. How much is the return amount? 1 lakh he is ready to invest and he is expecting a return of 10%. How much is the return amount he is expecting? 10,000. Excuse me. Okay. Now, if I give you the return amount, if I give you the return percentage, can you find out value? How do you find out investment value? Tell me. Return amount divided by rate of return. Yes, sir. That's what you found out the investment amount. Now, this is from whose perspective? Company or investor perspective? Investor perspective. Now, we're doing all this from whose perspective? Investor or company? Now, change the table and think from company perspective. For investor, it is an investment amount. But for company, it is known as the value of the firm, because to run the business, company needs funding. That funding either will come through debt or through equity shares or through preference shares, whatever. Right? So the investment amount becomes what's the value of the firm. Return amount. Return means you can pay interest from what? You can pay interest from what? EBIT. EBIT is what? Earnings before interest and tax. Yes, no? First you will deduct interest and then only you will pay the tax. So before paying, because you took the finance only from equity shareholders or also maybe from debt. Also maybe from debt. Hence we take in the numerator what? Return amount here becomes EBIT, because interest also is a source of, interest is also a cost, because one of the source of finance is a debt. Only on debt you pay the interest. So instead of return amount, it becomes what, sir? EBIT. Divided by rate of return. For an investor, it's a return. For a company, it is a cost. And your funding has come through one source or multiple source. When multiple source comes in, we take cost of debt, cost of preference shares, cost of equity, or overall. That is denoted by which symbol? K. So hence value of the firm is given by the formula EBIT divided by K. Got it? You don't have to know the derivations and all. You just have to know the formula and apply it. Just for, in case you forget, you can construct few things like this. Done, people? This is the first formula you need to know. Value of the firm is given by the formula EBIT upon KO. That is one. Second one. So usually, sir, the source of finance will either be equity or debt. Will either be equity or debt. Because on preference shares, no, usually finance managers don't prefer the preference shares. Why? Because fixed cost. On preference shares, company pays fixed rate of dividend. On debt also, interest rate is fixed. But on debt, you get one extra advantage. Company gets one extra advantage, that is a tax benefit. But on preference shares, you don't get the tax benefit. Now you tell me, if you are finance manager, will you prefer preference shares or debt? Debt. That's it. From here onwards, normally, the majority of our topic, preference shares will not come. Okay, the whole chapter is built around equity and debt only, because preference shares is not so much preferred because of that debt advantage of tax benefit is not there in preference shares. So the value of the firm denoted by the symbol S, no sir, is given by one more formula called S plus D. S for what are the two sources of finance for company? Equity and debt. So S stands for your market value of equity. D stands for market value of debt. Here we are taking market value only because the overall objective of this chapter is what? Is to maximize the value of the firm. Which value we are talking about? Book value or current value? Current value means what? Market value. So here all the reference will be given with respect to the market value terms only and not the book value. Yes. So value of the firm is given by one more formula, that is S plus D. S is your market value of equity plus and D is your market value of debt. Yes, people, you have to use one of the two depending on what data they've given to you in the question. Easy, easy, easy. Now stop there. How did you find value of the firm? V. EBIT divided by KO. V stands for value of the firm. Value came only through one source or multiple source? Okay. Can I find out value of equity alone? Can I find value of equity alone? Market value of equity is denoted as a symbol S. Now you tell me, can I take, see, to find value of the firm, I took EBIT. S is what? Market value of equity. Is EBIT available for equity shareholders? No, 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 no. From EBIT you reduce interest, you get EBT. From that reduce tax, you get earnings after tax. From that you reduce preference dividend and then you will get EASH or net income. This is available to whom? Equity shareholders. Now tell me, should denominator be EBIT? No. If you're finding out S, instead of EBIT, you should take net income or EASH. Now, here the denominator was KO because we are finding overall value of the firm. Here we are finding overall value or only cost equity. For equity, can you take KO or KE? So that's your second formula. Market value of equity, somewhere I must have written here, or maybe it's there in the next page, but it's okay. Market value of equity is given by EASH divided by cost of equity. These are the three things. Depending on the need, we may have to use this particular formula. So far, good people? Yes? Okay. Great. Now, there are some theories around this particular chapters. Quickly, it may not be that important, but quickly 5 minutes we'll run through. Then we will dive into the numerical side. There are some extra components also, but these are not that important. Now, sir, there are some theories around capital structure topic. Broadly, the theory can be classified into relevance theory and irrelevance theory. Relevance and irrelevance. Relevance theory ka argument is use debt. Use debt. By using more and more debt or by controlling the usage of debt, value can be changed. By using the debt, market value of the firm can be changed. That is the relevance theory ka argument. Irrelevance theory is saying what nonsense. Debt is irrelevant for value of the firm. Whether you use 100% debt or whether you use 0% debt, value of the firm will not change. That is irrelevance theory ka argument. That means they are same or completely different. Completely different. Okay, so means which to follow? Exam will tell. Question will tell. In fact, we don't have to worry about that. Problems are pretty straightforward. Done. So if they ask by chance theory, we may have to explain in 1 or 2 pointers. So relevance theory ka argument is debt is relevant to find what? Value of the firm. Irrelevance theory ka argument is debt is irrelevant for the value of the firm. That's the fundamental things. Under relevance theory, we have two approaches: net income approach, traditional approach. Net income approach and traditional approach. Net income approach ka argument is this. Now, suppose cost of equity is 15%. Will cost of debt also be 15% or lesser? If cost of equity is 15%, will cost of debt also be 15%? No. Sir, who takes more risk? Equity. Like, suppose you took a bank loan, all right, and there is an equity shareholder. Who takes more loan? Bank people or equity shareholders? Equity shareholders. Because, sir, whatever happens, every month we have to pay EMI to the banker. But every month will we give dividend to equity shareholders? If there is profit, we will pay dividend. No profit means go in the. Correct, no? Dividend equity shareholders may not get anything. So who's taking more risk? Equity shareholders. Simple funda, higher risk, higher the return. Equity shareholders are getting 15% return, means debt cost will be same or lot lesser? Lot lesser, maybe 10%. Possible. Now, first theory ka net income approach ka argument is, check here, this ka cost is 10, that ka cost is 15, which is cheaper. Debt ka cost is only 10, equity ka cost is 15, which is a cheaper source of finance? Debt. Debt is a cheaper source of finance. Yes, no? So first theory ka argument is, since debt is a cheaper source of finance, use debt bindas. Left, right, center, use debt. This theory is telling the company, use debt as much as possible, as maximum as possible, because cost of debt is cheaper. Because cost is cheaper, will your KO be more or KO will decrease? Sir, if you take more and more of debt, the overall cost of capital will reduce. Yes, no, like here, just to put up an argument, equity, debt, equity ka cost is 15%, debt ka cost is 10%. Let's say weight of equity was 0.9 and weight of debt is 10%. So calculate KO, 15 ka 9%, how much is that, sir? 13.5. This is what, 1. So overall cost of capital was 14.5. Yes, no? Suppose if I change the weight, percentage is same. Debt I make it as, let's say, 50%. Equity also I make it as 50%. Calculate KO for me. This is 7.5. This is 5. How much is that? 12.5. Check what happened to KO. From 14.5 it became 12.5. Why? We started using less debt or more debt. From 10% debt, we started using 50% debt. So if your debt increases, means your overall cost of capital will reduce. If KO reduces, means value of the firm will increase, because there is an inverse or ulta relationship between KO and value of the firm. If KO reduces, means value will increase. If KO increases, means value will reduce. This is the funda. This is what first theoretical argument is. Since debt is a cheaper source of finance, the more and more cheap source of finance if the company takes, the overall cost will reduce and the value of the firm overall will increase. So how is it ulta, sir? If you want, we can take some random numbers and prove it also. So I said no, if KO increases, value will reduce. If KO reduces, means value will increase. Opposite. Let's take some random numbers. KO is 10%, I've assumed. EBIT I've taken it as 90,000. How do you get value of the firm? EBIT divided by KO. EBIT is 90,000. KO is 10%, which is 0.1. How much is that? 9%. Now let's prove first equation. KO will increase. So from 10%, if I make it as 12%, EBIT is still same. EBIT is how much? 90,000. From 10%, overall cost of capital became 12%. Now find the value of the firm. How much is it? 90,000 divided by 12%. If you do, you will get 7 lakh 50,000. So what happened? KO increased. From 10 it became 12. Value from 9 lakh became 7 lakh 50,000. So value of the firm will reduce. So hence it has an inverse relationship. KO and value of the firm have ulta or inverse relationship. That's what this first theoretical argument is. Use as much as debt as possible. Because of the debt, overall cost will reduce and overall value will increase. Yes, sir, people. Now this theory has an assumption. Again, all this may be relevant for 1 or 2 marks MCQs. This theory assumes that the cost of debt and cost of equity is constant, which may not be practically true. Suppose I took 10 crore loan from bank at 9% interest rate. I took 10 crore loan from bank at 9% interest rate. After a few months, I told the bank I need 50 crore more loan. I need 50 crore more loan. Will bank give me at 9% only, or risk substantially increased? Now bank may tell I will give it to you at 11%. Possible, yes or no? So that means this cost same or changes. But this theory assumes that cost of equity and cost of debt is constant. Practically may be outdated, but may be relevant for our examination. Easier, people. No need to mug it up. Just quickly run through, just in case it comes as an MCQ. Comfortable? This is around net income approach. Next income is traditional approach. Traditional approach is saying, boss, net income, you are right only. You are right only, but you are not fully correct. What traditional approach is saying is, sir, debt no doubt is a cheaper source of finance, but debt is constant throughout or only up to a certain level. Only up to a certain level. See, for banker, up to 10 crore, they are ready to give me interest at what, loan at what rate? 9%. But once it crossed the 10 crore, they are asking 11%. So cost of debt is constant throughout, or it changes? After a level, it changes. That is what traditional approach is trying to say. Debt is not constant throughout. Up to a certain level, only debt is constant. And only up to that level, you need to use the debt. Here, after which percentage the interest rate increased? After 10 crore. So this theoretical argument is, don't take any debt beyond 10 crores. Take debt only up till 10 crores because after 10 crores, cost of debt will increase. Sir, we know if cost of debt increases, what will happen? Overall cost of capital also will increase. If overall cost of capital increases, value will reduce. That is what this theoretical argument is. Yes, sir, people. And moreover, another argument is also true. The more and more debt you take, business becomes risky. Because whether company makes profit or whether company makes loss, we have to pay EMI to the bank. Otherwise, bank people will come to our premises and take all our assets. So business, the moment you borrowed more and more debt, the business became more risky. Now equity shareholders, papa, bichara people, one corner mein they are sitting. Debt you are going on borrowing. The risk of the business is going on increasing. They will expect same return or higher return. The moment you borrow higher and higher debt, cost of capital, cost of equity also will increase, which will cause the K also to increase, which will cause the value to decrease. That is what this argument ka theory is. So basically, traditional approach is saying use debt, no doubt, but only up to a certain level, not beyond that. That is what this argument ka all about. Yes, sir. The overall synopsis of this discussion we have had till now is only 3 formulas we need to remember. What is those? Value of the firm is given by EBIT divided by K. Value of the firm is given by S plus D. S for market value of equity. D for market value of debt. And we need one more, that is, if you want to find out market value of equity alone, denoted by the symbol S, that's given by each or net income divided by that number. Okay, now that's all is the overall funda of this. Rest everything is okay. Fine now. So let's do a thing. Instead of going for irrelevance theory in a bit, so first can we do one question? Okay, usually you'll get questions like this. One question I will go through and come back to the remaining concepts. Great. Look at question number 5. Easy only, but has come a few times. So I would like to probably brush up on this question. Again, people, we have done 30 plus question in our regular class. I'll not have time for that. I may do at best 3 or 4 depending on the time availability as such. Okay, now hope that's understandable. Concept we will revise everything. Questions 3 or 4 maximum, not more than that. All right, now look at this. Alpha, beta limited are identical except capital structure, meaning only that capital values are different. Okay, 1 minute. So this one, 1 minute. I can solve this. I think net. Oh, they're using net operating income approach. Hang on, people. They're using net operating income approach. We just now discussed what? We discussed operating income approach. Yes, net income approach we use. There is one more theory, net operating income. Let's do a thing. Let's discuss that also, and then we'll go into the next question. Maybe better. Fine. Okay. Next is irrelevance theory. So far we saw relevance theory, net income approach, and a traditional approach. Then we have irrelevance theory. Irrelevance theory is saying what nonsense. Your theory and all is absolute nonsense. You use debt, you don't use debt, value will be same. That is irrelevance theory ka argument. The first irrelevance theory that comes under this is not net income approach, net operating income approach. Okay, operating income is also denoted by the symbol EBIT. Earning before interest and tax only, we call it as operating income. So this is just an extension of that theory. Net operating income approach. What net operating income approach ka standpoint or viewpoint is? Okay, debt is no doubt cheaper. Compared to equity, debt is a cheaper source of finance. Okay, cost of debt is cheaper. The moment you take a cheaper source of finance, what will happen? Overall cost of capital will reduce, value of the firm will increase. Correct. This is one point, which is true. Correct. No. But this theory is saying you are only looking at one side of the coin. A coin always has two sides. This is one side. This theoretic argument is the moment you take debt, business ka risk same or increased? Business ka risk increase. The moment business risk increases, somebody else will come knocking on the door. Equity shareholders. What will they say? Sir, the moment you took debt, risk of the firm increased. Risk increases means equity shareholders will expect same return or higher return. So cost of equity will, the moment you take debt, cost of equity will increase. If cost of equity increases, value will reduce. This increase in value, this decrease in value will get set off and overall value will still be same. That is the argument of this here. Understood? That is what they are putting up story here. Got it. Move on to the next. Okay. Sir, this theoretic assumption is, just check if you want, you can take it over here. Overall cost of capital, will it change or same? Overall cost of capital. In fact, 1 minute. You can write it like this only. If cost of equity increases, what will happen to overall cost of capital? increase. What will happen to value of the firm? Reduce. Here KO reduce and here KO again increase. So what happened to KO? It is in a way constant. So this theory ka assumption is KD and KO are constant, but cost of equity goes on changing, because the moment you take debt, expectation of equity shareholders will change. So this theory ka argument is cost of debt and KO, overall cost of capital, will be constant, and EBIT also will remain constant. That's the reason I stopped. I wanted to put this point across and then take up the next question. EBIT also will remain constant. Sir, why will it not change? It's simple. Now Arivupro, we took 10 crore debt. 100 students extra will come to our class. We took debt. We are marketing like this only in poster. We took 10 crore rupees debt. Please come to our classes. Will you come? Or how will you come to, or why will you come to our class? By looking at our debt, by looking at our capital, will you come to our class, or by looking at our product? Teachers quality, the pricing, the location, etc., etc. That will determine whether you will come to our class or maybe some other academy's class. Yes or no? Will debt influence our earnings? No. Debt will have zero impact on our EBIT. Debt only impacts what? Interest. Debt only impacts interest. If you take higher debt, you have to pay higher interest. If you take lower debt, then you have to pay lower interest. Yes or no? But EBIT, will it get affected due to debt or no impact? No impact. Hence, this theoretical assumption is EBIT is constant, which is pretty much rational. Understood? Okay. Now I think we can probably go into the question. Can we go into the question part of things? Again, recap me that formula. What are the three formulas? Value of the firm is given by EBIT divided by K. B is equal to S plus D. Then S is equal to net income each divided by cost of equity. Keep that in mind. And if it is net operating income approach, KO will be constant. KD also will be constant. EBIT also will remain constant. Yes, sir. Because we are about to solve that question. Comfortable with those? Take up this question number 5 now. Alpha and beta are identical except capital structure, meaning that capital structure is not same. Maybe one company has higher debt, another company has lower debt. Could be, we don't know. Alpha has 50% debt, 50% equity. Sir, when they say equity, it here means equity share capital and retained earnings. Because we know that just now we have learned that KR and cost of equity will be same. The only differentiating factor is the flotation cost. That's the reason here they use equity. Equity again here is equity share capital and retained earnings put together. So first firm has 50% equity, first 50% debt. Beta has 20% debt to 80% equity. Capital structure different. Yes, no? All percentage are in market value terms. Anyway, in this chapter, whole thing runs on market value only. Borrowing rate for both companies is 8%, and we assume that cost of debt is anyway constant. Whether you take high debt or whether you take low debt, cost of debt will be same. Assumption of this theory. In a no tax world, a no tax world means tax amount is 0. Capital market are perfect, that's okay. If you own 2% shares of Alpha, you are an investor who owns 2% shares of Alpha, determine your return. Investor ka return they are asking in the first case. If company has a net operating income only we call it as what's up? EBIT. Will this change for different firms or same? Whether it is Alpha or whether it is Beta, EBIT of both the firms will be same. Which is how much? 3,60,000. And overall capitalization rate. Stop. Overall capitalization rate means KD, KP or KO. KO is given to be how much? 18%. The moment you see EBIT and KO, what should click to you? You can find out value of the firm. Okay. Calculate implied rate of return on equity. Rate of return equity means they are asking you cost of equity. Okay, that's the first case. Then something else they are asking for beta. Can we quickly run through alpha? First. Now they ask company ka return or investor ka return? Investor. And he is an investor in shares. Share means what here? Share means equity shares. Now you tell me, sir, is EBIT available for equity shareholders or EISH? Is EISH given to you or they're given EBIT? EBIT. Yes, so that means can we take this and work out investor return? No, we need to find out what? EISH. So that is one working mode. We need to put it up. Fine. Before that, let's first find out the value of the firm. Let's find the value of the firm, because how do you get EISH? You start with EBIT given. From that you have to reduce interest. Do you know interest here or not? Not know. Interest you will know only when you know the value of debt. Debt value given or missing? Missing. First let's find out that. Comfortable? Now, whenever this missing question comes, now whatever you know, first put up that as a working note. They gave EBIT and they gave you KO. Using this, what we can find? Value of the firm. Let's find that. How do you find out value of the firm? EBIT divided by K. Plug in the numbers, you will get value of the firm to be 20 lakhs. Any doubt till here? This is only for alpha, beta we'll look at it later on. Easy. Now alpha has how much percentage debt? Check. 50% debt, 50% equity. Sir, what is the total value, market value of the firm of alpha? 20 lakh. And they said debt ka weightage is 50%, equity ka weightage is 50%. So if total value is 20 lakh and if debt ka weightage is 50%, means what is the market value of debt? 20 lakh ka 50%, which is 10 lakh. The other 10 lakh will be 20 lakh ka 50% will be market value of equity. Got it? This is a second working mode. We found out debt value also, we found out equity values. Yes, people? Now, they ask investors return. And for equity shareholders, what is available? EBIT or EASH? EASH. Now, let's start with that. Have they given EBIT in the problem? Yes. How much is that? 3 lakh? 60,000. Take that. From EBIT, you have to reduce interest. Now, do you know debt value? Yes. How much is the debt value? 10 lakh. Have they given the interest rate? Yes. Borrowing rate for both companies is 8%. Value of debt is 10 lakh and interest rate is 8%. So, calculate 10 lakh 8% how much? 80,000. From EBIT, if you reduce interest, you will get EBT. And they told in the problem, it's a no tax world. That means the tax is not there. So EBT, EAT, and there is no preference shares also. That means in this problem, EBT, EAT, and net income or EASH, everything will be same. If you want, you can put full format or directly stop here. Yes, sir. So EASH is how much, sir? 2,80,000. Now you are an equity shareholder owning how much percentage equity shares? I said 2%. What belongs to equity shareholders? EASH. How much is EASH? 2,80,000. 2,80,000 belongs to this investor or it's for 100%. If you own 100% of the company, 2,80,000 belongs to you. But you own in this problem 100% or only 2%. So calculate 2,80,000 ka 2% is 5,600. That is investors. Correct. Easy. Can I move forward? Okay, this we have asked. That's all they said, or they also asked cost of equity. Cost of equity. Okay, cost of equity, remember from this chapter only. Sir, cost of equity, how do you get S? Ratio divided by cost of equity. S means what? Market value of equity. Do you know that? Yes, market value of equity just now we found out, which is how much? 10 lakh. Okay, do you know EASH? Yeah, EASH just now we found out to be how much? 2,80,000. Can't you find out cost of equity? Rephrase the equation for me. How do you get cost of equity? You will take EASH and you will divide it by S. Correct? No, just this cross multiplication. This will go here, S will come here. Cost of equity is given by EASH divided by S. How much is EASH? 2,80,000. Okay, and S is how much? 10 lakh. So if you do that, you will get cost of equity to be 28%. That is for alpha. Any drama till here? Easy. The same thing what we did for alpha, we have to replicate for beta also. Same step. Ditto, ditto, ditto. Because next requirement is that only. Check. Beta has the same operating income. Even if they don't give this line, we know. Because this theory assumes that EBIT is constant. Cost of debt is also constant. So anyway, they have mentioned also. It has the same operating income of alpha. Great. Determine implied required equity return for beta. Implied equity return means cost of equity. Because for investor, it is a return. For a company, it is a cost. Since they are asking equity return, that means they are indirectly asking for company cost of equity. Same drama. Yes, people. All right. Analyze why will it differ. How do you get cost of equity? Run me through the process here. For beta, what do you do? First, find value of the firm because they have given EBIT and they have given KO because this theoretical assumption is EBIT and KO is constant. It is same for both the firms. EBIT is 3,60,000. KO is still how much? 18%. So value of beta also will be how much? 20 lakh. But beta uses same proportion of equity and debt or different? Different. Beta uses only 20% debt and 80% equity. Total value is 20 lakh and debt ka value or debt ka weightage is only 20%. So what will be market value of debt? 20 lakh ka 20%, which is 4 lakh. Equity ka value will be 20 ka 80%, which is 16. Got it off. Now to find out cost of equity, we need two components. We need S and we need a EASH. Can we first find EASH? EBIT is same, 3,60,000 minus what? Interest. Now don't take interest 80,000 because this company ka debt value is only 4 lakh. What is the interest rate? 8%. 4 8s are 32. So if you do this, you will get earnings before tax, earnings after tax, and net income. Everything is same over here because no data much came. So you got net income to be 3,28,000. S you already know. Can't you find out cost of equity? Yeah, how do you get cost of equity? Net income divided by S. Do that and you will get cost of equity to be 20.5%. Same step ka replica. Comfortable? Now they also asked you to analyze. Why does it differ from alpha? Why these both company ka equity, cost of equity here check. What is the cost of equity of this firm? 20.5. Here it is how much? 28%. They're asking you to analyze why is it different. You know this already. The moment this theoretical argument is what? The moment you take risk, the moment you take debt, business becomes risky. The moment the business becomes risky, equity shareholders will expect same return or higher return? Higher return. See, this firm uses only 20% debt. This firm uses how much? 50%. Who's taking higher debt? Alpha. That means the risk of alpha firm is higher. So if alpha is taking higher risk means equity shareholders of alpha will expect lower return or higher return. That's the reason this ka equity return is only 20.5. Here ka return is 28%. That's what you need to comment over here. I've just given that 1 or 2 pointers quickly. Done now. The reason for the difference is only the debt ka usage. Alpha is using higher debt, so expectation of equity shareholders also will be on the higher side. This problem, Damaru. Artha question, Paklama. Cost of debt will be. As per this theory, you cannot. So one question is, sir, what if cost of debt is not same? If it is different, the whole theory ka assumption is what? Net operating theory ka assumption is what? Cost of debt is same. So that will not work out because this theory ka judgment and its whole hypothesis is based on that assumption. Okay, then it will not hold good. They will not ask such questions. Anything else or move forward? Forward marcha. Okay, people, this is done now. Now next. We were discussing what theory? Relevance or irrelevance? Irrelevance theory. Like our class is one more irrelevant theory. Check. Now one more irrelevance theory is yum approach. Modi-Giuliani-Miller approach. Modi-Giuliani-Miller approach. Now Modi-Giuliani-Miller sir, no. He's batting for both sides. He's a pakka politician like our Modi sir. So AMM sir is saying debt is relevant also, debt is irrelevant also. That's what our politicians say, no? Good also, it is a bad also. Like that, MMS sir is also saying the same thing. It is good, it is relevant also, it is irrelevant also. I'm saying how? MM sir is saying if there is no tax, if there is no tax, then debt is irrelevant. Debt is irrelevant. If there is no tax, means debt is irrelevant. Whether you use a debt or whether you don't use a debt, value will be same. So MM sir says as if there is no tax world, then value of the levered firm and value of unlevered firm will be same. Value of the levered and value of unlevered will be same. So what is this unlevered? Sir, levered firm means that firm which uses debt. A firm which uses debt, we call it as levered firm. A firm which does not have any debt, that we call it as a unlevered firm. If there is no tax, then the firm which is using debt and the firm which is not using debt, both their value will be same. Hence, debt becomes relevant or irrelevant? Irrelevant. It becomes irrelevant only when there is no tax. That is what. Now, sir, this hypothesis, sir, given I think 1950s or something, long before you and I were born. Okay. Later, after a few years, sir grew some extra hypothesis and he gave some extra theory in 1961 or 63 or whatever. He came, sir, if there is tax, if there is a tax, then debt is relevant. Then debt is relevant. Now, in this case, my sir is saying, if there is a tax, then the market value of the levered firm, will be equal to market value of the unlevered firm plus a tax benefit. Sir, acknowledge one thing. You know what is that one thing? On debt, sir, the company will always get one extra benefit called tax benefit. That is what, using that, sir slightly brought changes in their theory. So, if there is a tax, then the market value of the levered firm will be equal to what, sir? Market value of the unlevered firm plus, can unlevered firm and market value of levered firm be same? No, levered firm will get extra benefit. If there is a tax, on tax benefit, they'll get it on what? On the debt only, So, plus the tax benefit. You take the unlevered firm value and add the what, sir? Tax benefit. So, how to calculate tax benefit? You will get tax benefit on debt. So, take the debt and multiply by the tax rate. You will get the tax advantage or tax benefit. By doing this, we will get the market value of the firms. Doubt G, got it G, what it G? Paka. Everybody cool? Cool? Yes. So, there is one more. Off late, I'm seeing a lot of questions from this connection. So we will take up, I'll go through this. I proved this theory in class. Okay, there were two equations like this. I proved it in my regular class. Now I'll not go into the proving and all. I just tell the formula. We will apply it in one of the question. I'm seeing this in a lot of RTPs, so probably the indication is this could be one of the expected questions. Again, sir, just my guess. Could be right, could be wrong. Don't blame me. Okay, don't give me credit also, don't give me blame also. Both you only keep it. Okay, now. All right. So what is this? Is, sir, as per approach, terminology is different. The firm which uses a debt, sir calls it as what? Levered firm. The firm which does not use a debt, sir calls it as unlevered firm. Sir, theory ka you can use and find out cost of equity. If you know cost of equity of unlevered firm I'm calling it as UL. UL stands for unlevered. Cost of levered firm, no, it's denoted cost of equity of the levered firm. Our ICAI represents as KEG. KEG is nothing but cost of equity of the levered firm. It's okay if you're not able to remember the symbols. That's okay. You can write it in words only. Cost of equity of the levered firm is equal to, and then you can write it. So there is a connection. If you know cost of equity of the unlevered firm, you can also find out cost of equity of the levered firm. There are multiple ways to find this. Use this. This will get you the answer sooner in examination. Okay. Formula may sound a little fancy. I've proved it to you. It's not really fancy. Okay. But anyways, I'll not go into the proving. Just will remember and replicate it in the question. Now, cost of equity of the levered firm is equal to, take cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. This you have to do. If you do this, you will get cost of equity of the levered firm. Okay. Okay. You have solved. There were like 3-4 questions in study material. You have not solved. Your faces look a little bleak. At least 3-4 questions I have solved the regular class in this. You have not seen this? Or first time seeing or forgotten? First time, huh? Yeah. Okay, fine. No issues. Now check this. Great. All right. So, since someone is saying first time, let's try to remember it. So, there is a connection. If you know cost of equity of the unlevered firm, you can also find out cost of equity of the levered firm. So, how do you get cost of equity of the levered firm? First, you take cost of equity of the unlevered firm in plus cost of equity of the unlevered firm minus cost of debt. Okay. Okay. Into debt into 1 minus tax rate divided by equity. That is what I've written over here. Yes, sir. Now, it's actually simple. It's actually, no, this is actually not a proof. In case you want to prove this, not a big deal actually. This is not even a formula. You know this formula. You know this formula, just that you know it in a different way. You know overall cost of capital you have calculated KO. Tell me in equation, what did you do? How did you calculate KO? You took weight of debt, you multiplied by cost of debt, and you added what, sir? Weight of equity multiplied by cost of equity. That way you will get overall cost of capital. This equation is derived from that only. This equation is derived from that only. Just that, leave it. Okay, why do you worry about derivation? Because they'll not ask you derivation, they'll ask you the formula. So at this point of time examination, why worry about derivation? We'll try to remember this. Yes, sir. No. Listen. This formula, sir, can be represented in two ways. Cost of equity of the levered firm, I'll write one more equation, is equal to cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into debt divided by equity. Only difference between these two, can you observe and tell me what is the difference? 1 minus tax rate here, and here it is missing. Can you tell me what is that? Or when you use this, when you use that? You know this already. When will you do 1 minus tax rate? When there is a tax on a debt, you will get a tax benefit. That means when there is a tax, when tax exists, you will use which formula? This formula. When there is no tax, you will use the second formula. It's not that for when the no tax may, if you use this formula, answer will change. Answer will not change because tax will anyway become what? 0. 1 minus 0 will be what? 1 only. If you use this formula, common also, answer will be same. But sometimes the marks and all will be given for formula also. So if you interchange the formula like this, though final answer is right, 1 marks they may deduct because of incorrect formula. Understood? This is the funda. Okay, G. Let's do a thing. Let's apply it in one question first, and then maybe we'll move on. There's one question I think I'd like to, since you said you are doing it, I thought I'll skip this by telling formula. Since you said you're doing it for the first time and all, why to skip? We'll take another 10 minutes we'll spend and go through of this question. Okay, sir. All these questions have been added newly in the latest version of study material. In Jan 2025 version or May 2025 version, ICAI has updated the study material. No? I think all this question has got added in that. Okay. Anyway, it could be important. I don't know. I'll cover it. If it comes, awesome. Good for you. Okay. But at the end of the day, we want what, sir? All of you to pass. Intention is that no teacher wishes any bad on any of the students, right? The whole efforts of any teacher for that matter is to make sure that student pass. Because ultimately that is a goal of us being over here. We can always choose. Even I could have chosen maybe to work in the corporate field and get higher salary or whatever. But still we have chosen here because now that gives a little bit of psychological kick. You know, different people get different kicks, vibes. Our kicks, our vibe is driven by your results. Okay, so the more and more people you tell. Last time, 2 people scored a rank and we were like all over the moon. They scored a rank, we were partying. So that is the influence you people have on us. And I've not even met those guys. They are recorded students. They're recorded students, both of them have not met. Just that their rank just brought so much proud feeling that it's as good as like I only scored a rank. Even I too had scored a rank, but that was like probably 15 years back or 18 years back, whatever. Alright. But suddenly the memories came away. I only got a types. Okay. So why am I indirectly saying you this? You also secure rank. No. Okay. Come back to question number 10. Blue Limited. Blue is an all equity financed company. All equity financed company means debt or no debt? No debt. Sir, if it is a no debt, our sir uses one terminology. What do we call this as? Unlevered firm. Levered firm means which uses debt. Unlevered firm means which does not use debt. So currently we are not using debt. So we are unlevered firm. They want to repurchase 275 lakh equity shares. They want to repurchase means buyback. Equity shares they want to cancel, meaning they want to buy back. Possible. There are some conditions, company law conditions you need to fulfill. Companies Act 2013 ka. That's okay. Up to 10% board resolution is good enough. Beyond the 10%, if your company wants to buy back, they have to pass a special resolution and accordingly do it. That's okay. That's an all this Companies Act ka. Let's not go in there. Now, company wants to repurchase not 275 lakh, rupees 275 lakh equity shares. So the value of buyback is 275 lakh. And replace with what? 15% debentures of the same amount. So that means till now we did not have debt. Now what came? Debt came in. That means now we are unlevered firm. No, from unlevered firm we became levered firm because debt has come in. For how much value debt has come? 275 lakh because they said same value. No? Current market value of the company is 1750. Before doing all this repurchase and replacements with the debt, our current market value is how much? 1750 lakhs. And its cost of capital is 20%. Sir, currently we have debt or we don't have debt? We don't have debt. Currently we have no, this is before. Current means you want to do all this. Is considering means already done or thinking about doing. Thinking about doing. Okay. So currently their value is 1750 and currently their cost of capital is 20%. Currently the company already has a debt or thinking to replace. That means currently company has no debt means can I say cost of equity is 20%? Yes, sir, because it's an all equity firm. All equity finance means the only source of finance available is equity. Equity here stands for equity share capital and retained earnings. Anyway, we know that cost of equity and cost of retained earnings are same. So you don't have to worry about that. Done now. I'll also say this is equal to KO. Do you agree with me? It is also equal to KO. Why? Sir, 100% equity. No. How do you get KO? Take the weight of equity multiplied by cost of equity. Weight of equity is 100% here. So yes, no other find is there. So 1 multiplied by 20% is how much? 20%. Even if you calculate KO, you'll still get the answer to be 20%. That is what? Current scenario. Now scenario will be same or it will change? Change. Companies EBIT are expected to remain constant in the future years. Company has a policy, that's okay, leave. Tax rate is 30%, fine. You are required to calculate the impact of the following due to changes in capital structure as per approach. You need to calculate market value of the company. Sir, given no, sir, 1750. No. 1750 is the market value of the firm before all this activity. Now you are buying back equity shares and replacing it with the debt. Once you do this activity, value will not be same, it will change. Because tax rate is there. When tax rate is there, approach is irrelevance or relevance? Relevance. Just now we learned. How do you get market value of the levered firm? How do you get market value of the levered firm? Value of or market value of the levered firm is nothing but market value of the unlevered firm plus the tax benefit. Yes or no? That's what we need to do and get the answer to the first question. That's pretty straightforward. Yes, people. Overall cost of capital, which is KO. So given us 20%. No. That is current situation. Now debt also came in. I mean, KO will be same. No, it will change. Then they also ask cost of equity, which is cost of equity means KE. Now, what we'll do? First, we'll find out the market value of the firm. Then we will go one at a time. So tell me, sir, how do you find out market? Now we are unlevered firm or levered firm? We are thinking about replacing with the debt. And that means now we are going from unlevered firm to levered. Tell me again, how do you get market value of the levered firm? Take the market value of the unlevered firm. To that you add the tax advantage or tax benefit. What is the market value of the unlevered firm? 1750. Take that 1 second. Take the market value of the unlevered firm, which is 1750. To that you add what, sir? Tax benefit. Okay. How do you get tax benefit? Debt multiplied by tax rate. Debt is how much? How much you are planning to replace the debt by? 275. So debt value is 275 multiplied by tax rate is how much? 30%. So take the total debt multiplied by the tax rate. You will get the answer. Sir, you get tax benefit on interest, no sir? Yeah. Interest you will pay for 1 year or throughout? Throughout. Hence we don't take interest in the formula. Instead of interest we take it as what? Total debt. Yes, no, because we pay interest for many years. How many years we don't know. Hence interest is substituted in this formula with total debt. Easy. So if you do this, you will get the market value of the firm. That is the first part of the question. I hope this is comfortable for everyone. Correct. So answer to the first question we have done. And they also asked the change, I think somewhere. They asked you to amount of change. How much was our market value currently? 1750. From 1750 it became 1832.5. So what is the change in market value? So due to this decision, market value has changed, meaning it has increased by 82.5. Yes, sir, people. Done. Next, you know that one more equation. V is equal to S plus D. S is market value of equity. D is market value of debt. We know. How much is the market value of firm? 1832.5. Do you know S or missing? Missing. Sir, S value 1750. No, that is before buyback. After you do buyback, equity share same, it is reducing. So we don't know S value. But do you know market value of debt? Yes. How much debt are you replacing? 275. So that means market value of debt is 275. Value of the firm is 1832.5. How much is S, sir? These two come minus you will get market value of equity, which is 1557.5. I'll tell you why I did this in a bit. Okay, people, let this be there. Easy. Okay, next. So just now I said that there is a connection between levered firm and unlevered firm. If you know cost of equity of the unlevered firm, you can also find out cost of equity of the levered firm. How do you get it again? Tell me. Cost of equity of the levered firm is nothing but cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into debt divided by equity if there is no tax into debt into 1 minus tax rate divided by equity in case there is tax. In this problem there is tax. So let's find it out. How much is cost of equity currently? Unlevered firm, how much is cost of equity? 20%. I've substituted. I've taken it in percentage. If you want, you can take it in decimals also. Plus cost of equity, which is 20 minus cost of debt. Check, sir. How much is the debt ka interest rate? How much is that? 15%. Minus 15 you do. Correct, people? Any problem? One doubt you should have asked. No problem. I'll explain that later. Into what, sir? Into debt. What is the value of debt? 275. So that is the value of your debt. Into 1 minus tax rate. Tax rate is given in the question to be 30%. So into 1 minus 0.3 you do. Divided by equity. What is equity ka value? Once. To apply this formula, we need market value of equity. That's the reason we first found that and we are applying it here. Yes, sir. Any problem? No? Pakka? One doubt should have come. What is that one doubt? What is that one doubt? Here one doubt should have come. Here. What is that one doubt should have come? Sir, here you are writing cost of debt, sir. Cost of debt is not 15%, sir. Interest rate is 15%. How do you get cost of debt? In fact, in cost of capital chapter only we discussed. If there is no information, you can find cost of debt using shortcut method. What is that? Interest rate into 1 minus tax rate. So interest rate is 15. 1 minus tax rate is 0.3. That means the cost of debt is not 10%. It is 10.5%. Sir, on what basis did you took 15, sir? It should have been 10, no, sir. That doubt you should have got. You understood. But still it is correct only. Why? Sir, check this number. What have I done here? 1 minus tax rate. That tax benefit, I multiplied it over here. So again, if you do 1 minus tax rate here, formula will not match. Is that okay with you? That's the reason here, no, though we write cost of debt, though we write cost of debt. Here cost of debt for this formula means not cost of debt, it is a interest rate, because anyway we are multiplying interest tax, 1 minus tax rate at the end, comfortable. Otherwise if you do 1 minus tax rate here also, it will be double deduction. On one debt, two times you will get tax benefit, or only once? Only once. That's the reason we take the interest rate here and not the cost of debt. Comfortable? Plug this, you will get the cost of equity of the levered firm. How much is it? 20.62. Any problem? Just apply on pure substitute. How much was existing cost of equity? Before you did all these changes, how much was cost of equity? 20%. From 20, now it became 20.62. That means cost of equity increased, no? Obviously it will, because this funda, this whole theory again, funda is what? The moment you take debt, risk of the business will increase. The risk increases means cost of equity shareholders will expect same return or higher return. That's the reason from 20, now it has become 20.62. It has increased by 0.62%. That's the funda. So second requirement also we have done. Market value of the firm we found, cost of equity also we found. KO is very simple. That is your last chapter ka question. Yes, no? Any doubt? Move forward. Okay, cost of debt, you can find it through multiple ways. You can find it in one liner also, or you can calculate like this. This is what we did in previous topic. If you don't have time to put up this table, essentially what you're doing in this table, tell me in equation, let's see. You're taking weight of debt and multiplying cost of debt. You're taking cost of weight of equity and multiplying cost of equity. These two you are adding and getting overall cost of capital. Yes or no? That means, can I write overall cost of capital is this? Take the weight of debt, multiply cost of debt. Take the weight of equity, multiply by cost of equity. Sum these two. If you want, you can put it up in table like previously we've been doing, or you can simply present it in this equation. This, if you do it, you don't have to put to the table, give the heading to that table, all that. You can cut and get the answer faster. Just another simple way to present or get the answer little faster. Okay, G. Done. Now, here, don't take cost of debt to the made to 15%. This is actual cost of debt. Actual cost of debt is 15%, or you have to take tax benefit. Now, RV, NP and all given in the question. So you want to use full approximation method ka formula or shortcut? Shortcut. What is the shortcut for cost of debt? I into 1 minus tax rate. I is interest amount or interest rate? Interest rate is 15, 1 minus tax rate you get cost of debt to be 10.5%. That is your cost of debt. Multiplied by what, sir? Weightage of debt. Tell me, how do you get weightage of debt here? You take the market value of debt divided by total. Market value of debt is 275. Market value of equity is 1557.5. Market value of the firm is 1832.5. How do you get weightage of debt? 275 divided by 1832.5. That's what I've done here. 275 divided by 1832.5. Similarly, cost of equity. Cost of equity, just now we got it to be 20.62 into what? 1557 divided by 1832.5. So that's your weightage. This is basically cost of equity. This is multiplied by weight of equity. This is nothing but cost of debt multiplied by the weight of debt. Do this, you'll get the overall cost of capital to be 19.09%. Yes, sir, people. Now, what was our existing overall cost of capital? Before this change, our overall cost of capital was 20%. After this change, it has become 19.09%. So, overall cost of capital has reduced because you have taken more debt. On debt, you get some tax benefit. Due to your tax benefit, our overall cost of capital has reduced. They have not asked analysis, just saying it for your reference. Okay, this could be one of the popular question in my view for the next few attempts because it's newly added. Done, G. That's all. The whole basis of this formula is 3. I mean, the whole basis of this question is 3 formulas. One, value of the firm is given by EBIT upon KO. Then S is equal to net income divided by cost of equity. And then V is equal to S plus D. Then value of the levered firm is equal to cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. So far, whatever questions we have done is revolving just around the 4 formulas. Practice all these questions. The more you practice, the more you'll get confidence. But overall basis, the way we are solving, is the approach looking good? You're able to understand numbers when you work out few things here and there, extra doubts can come. But overall, is it looking fine? Yes, so okay. So now moving along. Yeah. Yes. Correct. Done. So this is clearer. Let's go back to our chart book. So we have discussed this. Okay, sir. MM approach, we have done no tax scenario and tax scenario. In MM approach, one more question of late we are seeing a lot in our study material and as well as in our study material. So anyway, we had 4 questions on this concept. Now in RTP, MTP also they are asking. So quickly, I'll just tell you what is this. This process, what we are covering, so we call it as arbitrage. This concept, 1 minute. 1 second. Or else you talk, I'll drink. Okay, now we have a small concept called arbitrage. Whole arbitrage ka process is by doing some extra jugado, doing some extra fitting, no, you can earn some extra money. By doing some extra fitting, you can earn some extra money. That process we call it as arbitrage. Whole arbitrage, no, sir, will work in this. Check this. Sir, MM approach backs for both relevance and irrelevance. Let's take a minute. Irrelevance. Irrelevance theory comes in no tax, with tax or no tax? No tax. If there is no tax, what is MM sir saying? If there is no tax, then the market value of the levered firm should be equal to market value unlevered. Correct. If there is no tax, this is the fundamental assumption of MM approach. Now listen. Suppose they gave you market value of the levered firm to be, let's say, 100 lakhs. Market value of the levered firm is 100 lakh. There is no tax. So if there is no tax and if levered firm ka market value is 100 lakh, means unlevered firm ka market value also should be how much? 100. But when you calculated, you got 95 lakhs. When you calculated, you got 95 lakhs. So how do you calculate? We know. How do you find out value of the firm? EBIT divided by K. So when you calculated using this, here you are getting 100, here you are getting 95. Is it matching or not matching? In this scenario, you can do something called arbitrage. In this scenario, this particular concept will get triggered. Fair enough. When the value does not match, there is a scope to do some gain. Now there are 4 scenarios which can arise in arbitrage. 1, you can go from levered firm to unlevered firm. Meaning levered firm, currently you are a shareholder in levered firm. That firm ka shares, equity shares you are selling and buying unlevered firm ka shares. This is one scenario. Same, L to U only. This is approach number 1. This is approach number 2. Okay, this is from L to U. You can do another way. Unlevered firm to levered firm under approach number 1. Maybe we'll call it as 3. Again from unlevered firm to levered firm under approach number 4. So there are 4 possible arbitrage process that can work. Pretty much everything overall basis is same. 1 or 2 steps will change. Okay, this is just a hyped up topic if you ask me. Very simple topic. I don't know why people like, every time when I do marathon they be like arbitrage, not understanding. Easiest. Nothing, no dumb in question. Some process is there. Even if you remember our regular class, for all this 4 scenarios I had given 4 steps. We had solved 4 questions also. It was ditto. First problem took 1 hour. Next problem was hardly taking 10-15 minutes. Cut to copy paste. That's all is this. Okay. So I will not have time for all the 4 now. I will solve one scenario. Other scenario, I'll do an oral discussion. Using that, you can check. There are 4 questions in ICAI study material on this. If you want to practice that, you can take it up. Fine, now people. Now I'll just run through maybe this scenario here and I'll take you through with the question. Let's do a thing. If I tell probably the steps you may not understand, let's learn this process with the help of a numerical question only. But you want the basis for arbitrage? Arbitrage simply means doing some extra gain. When will this extra gain scenario arise? There is no tax, but both the value of the firms are same or change. If the value of these firms are not same, means you can do some extra jugaad and get some gain. That gain is what we refer to as, or that particular process is what we call it as arbitrage. Okay, so let's take up one question. Where is that? Question. These are 6, 7, 8, 9. Illustration number 6, 7, 8, 9 is from study material. All this 4 deals with arbitrage. Same thing is there in my notes also. In fact, my notes is pretty much same, sir. Cut, copy, paste of ICAI material plus last 4 attempts ka, 3 attempts ka, RTPs, MTPs also I have put in. So that's all I have done. I have not done anything extra there. Okay. Alright. Now look at this. There are 2 companies. Pay attention to this in case you have not done this. There are 2 companies, N and M Limited, having same EBIT, okay, of how much? 20,000. M is a levered firm. Levered firm means they are using debt. having a debt of 1 lakh and interest rate is 7%. The cost of equity of N is 10%. One second. M is a levered firm. That means N becomes, other firm becomes, see, all this arbitrage works between levered and unlevered. There should be both levered also, there should be unlevered also. If M is a levered means automatically the other firm is a unlevered firm. Meaning N has debt or no debt? No debt. The cost of equity of N limited is 10%, M limited is 11.5%. Compute how the arbitrage process will be carried on. Assume the investor owns 10% shares in the levered firm. Actually, this line is not there in study material. I have added. Okay. If they don't give this, no, you can assume that investor owns some percentage, maybe 10, maybe 5, maybe 15, whatever, and do the arbitrage process. Okay. In my study material, to avoid confusion, I have taken that. Currently, an investor is there in one of the firm and he's owning how much percentage shares? 10% in which company? Levered. Okay. Now we know that this arbitrage process only works when the market value of both the firm will not match. First, can we do that? First step is that only. That's what I dictated in my regular class. First, find out the market value of both levered and unlevered firm. Now you know this. How do you find out market value of the levered firm? EBIT divided by KO. EBIT divided by KO. Here be careful. Okay. They have given KO or they have given cost of equity. Here. Cost of equity. Using cost of equity, can you find out V or can you find out S? S. Because S is equal to what? Each divided by cost of equity. First to find S. Then add what, sir? D. Because V is equal to what? S plus D. First find S, then find D. You don't have to find D. It's given here. How much is the value of debt? 1 lakh. You add these two, you will get what, sir? V. This is the process. Comfortable? Okay. Now, 1 second. To find out S, what and all we need? We need each and then we need cost of equity. Cost of equity is anyway given in the question 10 and 15%. That means we need to find out only one more component, which is each. Each given or EBIT given? That means from EBIT we have to get what, sir? Each. How do you get that? Take the EBIT of both the firms. M is a levered firm and N is a unlevered firm. EBIT of both the firms are same. And we know this, right? Will EBIT, just now I gave an example. If Arivupro uses more debt, will we get higher EBIT or same EBIT? Same EBIT. EBIT is not impacted by your source of finance. You can take debt, equity, whatever, EBIT will be same. Because EBIT is influenced by your business decision. What is the quality of your product, price of your product, your marketing strength, etc., etc. Okay, it is not influenced necessarily by the debt or equity. So EBIT for both the firms same. We need each. Since what do? Reduce interest. Which firm has interest? M limited. How much debt? 1 lakh. What is the interest rate? 7%. 1 lakh into 7% is how much? This is an unlevered firm. Unlevered firm will have debt or no. So that means you get EBT. There is no tax. That means EBT, EAT, net income. Everything is same. If you want, you can do full process or stop there. So you got your net income. Then how we need for S one more component, which is what? Cost of equity. This we have to find out given in the question. Given in the question. Copy paste. Here it is 10 and that is 11.5, which I have copied. Yes, sir. So how do you get S? Each divided by cost of equity. These two division you do, you will get 113,043. Here you will get 2 lakh. So you got S, sir. But we need value of the firm. How do you get value of the firm? Take value of market value of debt also. M is a levered firm. Levered firm, will it have debt? Yes. How much debt? 1 lakh. So market value of debt is 1 lakh. How do you get value of the firm? These two addition, which is 213,043. Comfortable? Now N is an unlevered firm. Unlevered firm will have debt? No. That means their debt value is 0. So that means market value of equity and overall value of the firm will be same. Now check. This is levered firm. This is unlevered. There is no tax. There is no tax. That means both this firm value should be same. Is it same? No. Here it is 213. Here it is 2 lakh. That means value not matching. That means the moment value does not match, one process comes into picture which is called arbitrage. First step. Okay, Ji. Whatever arbitrage you do, first 3 steps same. First 3 steps ditto. Now think, sir. Now go back to the question. What are they saying? Assume that investor owns how much? 10% shares in levered firm. Use your common sense. You are currently holding shares in levered firm. But levered firm ka share value is 213, unlevered firm is 2 lakh. That means levered firm, can I say, is overvalued? Levered firm is overvalued. Why? There is no tax. Both ka value should be same. This ka value is only 2 lakh. This ka value is 213. Means this firm ka value is overvalued. Compared to the other firm, this firm ka value is overvalued firm. Would you like to buy the shares at a higher value or lower value? You sell low You buy low and you sell high. Correct? Now this is high. So what will you do? Will you buy or you will sell? Sell. Since you are a current shareholder in levered firm, and unlevered firm is cheaper. Unlevered firm is cheaper and levered firm is costly. Right? So what do you do now? Currently you are holding shares in levered firm. Levered firm ka shares you sell, unlevered firm ka shares you buy. That's all is arbitrage. Through this process, your return will not change. Whatever return you are getting, no, after you buy other company ka shares also, your return will be same. That is what we have to prove through this process. We'll prove it to you. Okay. Now, what is the arbitrage process again? Over here, sir. From L, you are moving to which category? Unlevered. From levered firm, you are going to unlevered firm because currently you are holding shares in levered firm and levered firm ka value is high. High means it is over value and other firm is under value. So, overvalued firm ka shares you sell, undervalued firm ka shares you buy. First, what is you are holding debt also equity or debt and equity or only equity? They said investor owns only 10% shares. Shares means debt or only equity. Only equity. What is the value of equity in levered firms? 113043. This 113043 is investor share or full firm? If you own 100% of equity shares of this firm, the value of equity, market value of equity is 113. You own 100% or only 10%? I mean, what is investor's value? If he sells the investment today, equity investment today, how much money he'll get? 1,13,043 is for 100%. For 10%, how much? 11,304. That is the market value of equity shares held by whom? Investor. Because who does the arbitrage? Company will do what? Arbitrage and all is a gain scenario. That is done only by the investors. So currently the market value of equity held by investor is 11,304. Till here good. Any problem? Everyone who's going for the first time also are able to comprehend. Now listen, by doing arbitrage, your return should change or it should be same? It should be same. Currently, what is your return? What belongs to equity shareholders? EBIT or EASH? Currently, you are a shareholder in M Limited. What is EASH of M Limited? EASH of M Limited. Net income or EASH of M Limited is 13,000. 13,000 is for 100% equity shares, correct? Investors owns 100% or only 10%? That means currently what is investors return? 13,000 into 10%, which is 1,300. After you do arbitrage, this return of 1,300 should be same. It should not change because this is the first process. Next process I'll tell you later on. So far good? Everybody? Alright. Now listen. Now if investor sells this company shares, how much will he get? 11,304. Correct? Now, 1 second, hang on. So, when you're doing this arbitrage process, no, risk should not change. Risk and return should not change. Now, currently, investor is holding shares in which company? Levered firm. Levered firm means it has debt also, it has equity also. That means investor, no, sir, currently is exposed to debt risk also, is exposed to equity risk also. Because this firm has a debt already. If this firm has a debt, means as an investor, you also have a risk on your head called debt risk. Yes, sir. Now, this risk can be changed due to arbitrage or it should not be changed. It should not be changed. Earlier, you had debt risk means now also you should have one risk on your head called debt risk. Since earlier you had debt risk, now also you should have a debt risk. That means what you have to do. But unlevered firm has a debt or no debt? No debt. Then how do you bring in this debt element? By taking a borrowing. When you borrow the money, when you're borrowing the money means you are taking a debt. Automatically when you borrow, debt risk will come on your head. Yes or no? That is how, because due to this arbitrage process, risk element should not be changed. Again, I'll repeat this. You are an investor in which company? Levered firm. Did levered firm have debt? Yes. If levered firm has debt means is investor exposed to that debt risk? Yes. Currently is investor having debt risk? Yes. Now when he's buying unlevered firm ka shares, should he change this risk or it should be maintained? It should be maintained. But unlevered firm does not have debt. So what to do? To bring this debt ka risk onto your head, the investor has to borrow the money. Next question is how much? Simple. Investor owns how much company? Currently, how much he owns? 10%. How much debt this company had? 1 lakh. That means investor had 100% exposure to risk or only 10%?
10%.
The total debt was 1 lakh, but investor was exposed to only 10% risk. So calculate 1 lakh at 10% is how much? 10,000. That means investor has to borrow how much? 10,000. Basically, debt multiplied by the what? Investor ka shareholding percentage you do. That means this much amount investor should borrow. Any doubt in here? Now, how much money is available with investor? By selling equity shares, he got 11,304. By borrowing, how much money he got? 10,000. So totally, how much money available? These two ka addition, which is 21,304. What is going to do with this? Invest. Where? From levered firm, he is going to where? Unlevered firm. 1 second, hang on. Now, currently, he owns shares in how much share percentage he owns? 10%. First kind of arbitrage, we call it as surplus cash approach. Surplus cash approach. In surplus cash approach, now shareholding percentage we don't change. Shareholding percentage we don't change. Currently, investor owns how much percentage shares in levered firm? 10%. I mean, after arbitrage also in unlevered firm still they own how much? 10%. This is first approach. There's another approach. I'll tell you what is that. Understood? Currently, he owns 10% means after he shifts or buys other company ka shares also, shareholding percentage will be how much? 10%. Now, what are we buying in unlevered firm? Equity shares. What is the market value of equity shares of unlevered firm? 2 lakh. 2 lakh is for what? 100%. Investor wants to buy 100% or only 10%? That means how much money is required? To buy 100%, we need 2 lakh. To buy 10%, how much we need? How did you calculate that? Market value of the equity of the unlevered firm. If you wanted as formula, market value of the equity of the unlevered firm multiplied by the shareholding percentage, which is how much? 20,000. Now check. How much money is available with you? 21. How much money is required? 20,000. Sir, you have 21,304, but you need only how much? 20,000. That means by doing this arbitrage, you got some extra cash. That only we calling it as arbitrage gain, and here gain is in the form of surplus cash. How much surplus cash? You have 21,304, you need only 20,000. So how much is surplus cash? These two come minus, if you do, you will get 1,304. This is the gain that you got due to arbitrage. Yes, sir, people? Now, return should change or it should not change? Return should change or not change? Currently, what was the return of the investor? 1,300. This is a return in which firm? Levered firm. Even in unlevered firm also, the value should be, return should be how much? 1,300 only. Can we test this? How do you get return for equity shareholders? Each multiplied by shareholding percentage. What is unlevered firm ka each, sir? Unlevered firm ka each is 20,000. This 20,000 is for 100%. But investor owns only how much? 10%. So calculate 20,000 ka 10% is how much? 2,000. Sir, wrong answer, sir. Return should be 1,300, sir. We got 2,000 rupees, sir. Wait. So far good? So far good? Investor only invested in equity or he also took borrowing? Sir, when investor takes borrowing, if you take a loan, you will get interest or you will pay interest? Pay interest. How much interest or how much borrowings you took? 10,000. What is the interest rate? 7%. So you took a loan of 10,000. On that you have to pay an interest of 7%. This is your return and this is your cost. Net of how much I get it? 1,300. What was your return before? 1,300. Now how much is your return? Change in return is how much? 0. So that means question only has answer. Under this surplus cash approach, this changes in return should be 0. If it is not, somewhere you have done wrong. Okay, I know that in the interest of time, for the first time, it may be a little difficult for you to comprehend, but in our regular class, for each step I had solved, each step I had dictated and solved. So 4 times if you dictate the steps and if you solve the question, it's like solving it 8 times. After 2-3 points of time, they were yawning. Same thing, no, you write the same thing and same thing and same thing. That's the reason now I've given you the steps, no? You solve 4 questions later on because I don't have time to go through everything with you now. Okay, so this is the overall process. Did we understand? No? Everyone good? Once quickly, I'll recap this for you. Okay, all right. Then I'll tell you the other 3 scenarios because I said how many scenarios are there? 4 different. I have covered only one scenario, which is what, sir? Surplus cash. So how to know whether it is surplus cash or what? They will mention to you in the question. If they don't mention, you are free to assume. Now listen, everybody. Arbitrage will only come when the market value of the levered firm and unlevered firm will not match. One will be high, another one will be low. High firm ka shares you will sell, low firm ka shares we will buy. That's your arbitrage. By doing this process, your return will change or it will not change? Not change because you are following which approach? Surplus cash. If you are following surplus cash approach, whatever return you are getting before, even after arbitrage, you will get the same return. Return will not change. Now, how to do this? First step is to find out market value of both the firms. Levered and unlevered firm ka both the firm market value you found out. And then, now you want to sell the shares. If you want to sell the shares means you want to know how much money you will get by selling. So how do you calculate that? Find out the market. You are currently shareholder in which firm? Levered firm. Levered firm ka shares you are selling and unlevered firm ka shares you are buying. What is the market value of equity of the levered firm? 113043. But this 113043 is for 1% or 100%? 100%. But investor is owning only 10%. So calculate 10% of this. How much is that? 11,304. So by selling through this arbitrage process, when you sell, investor will get how much? 11,304. That is one. Currently, what is the return investor is getting in the levered firm? Return for equity shareholder is based on each. What is the each in the levered firm? 13,000. How much percentage shares investor owns? 10%. So 13,000 into 10% is how much? 1,300. This is the current return. Now, since investor was a shareholder in levered firm there was a debt also, there was equity also. If levered firm has a debt, means equity shareholder also is exposed to that debt risk. By arbitrage process, can you change the risk level or it should be same? It should be same. But unlevered firm does not have debt at all. Then how can the risk be same? This firm has a debt risk. This firm has no debt risk. You are moving from here to here. That means the risk obviously will change. But through arbitrage process, the risk should change or no change. So how to do? Currently, we have exposure to debt risk, means after shifting to unlevered firm also, we still should have what? Debt risk. How do you bring that debt risk? By borrowing the money. How much borrowing? Currently, how much debt this company has? 1 lakh. You own 100% in the company or only 10%? So you will borrow how much? 1 lakh a shareholding percentage. 1 lakh into 10%, which is how much? 10,000. So by selling equity shares, you get this much. By borrowing, you get 10,000. So totally, how much money is available? 21,304. You are following which approach? Surplus cash. In surplus cash approach, shareholding percentage will not change. Now, if you have 10% in levered firm, even in unlevered firm also, you will have 10% only. Now, to buy 100% of unlevered firm, what is the market value of equity? 2 lakh. To buy 100%, you need 2 lakh. You buy 100% or only 10%? So, for 10%, how much money you need? 2 lakh cut 10%, which is how much? 20,000. Sir, you have 21,304, but you need only 20,000. So that means through this process, you got some extra cash. The difference between these two, that is 1,304. That is your arbitrage gain that you did in this process. Yes, this is proved. Next, we need to check that the return has not changed. How do we verify this? Check. Return for equity shareholders is from what, sir? Each. What is the each of the unlevered firm? 20,000. How much percentage share now the investor owns? Still 10%. So 20,000 into 10% is how much? 2,000. This is the return. But hang on. Did investor borrow? Yes. On borrowing, should he pay interest? Yes. Borrowing amount is 10,000. Interest rate is 7%. So how much interest he'll pay? 700. So net mein how much is his return? 1,300. Did that change or no change? No change. That's all. Same process. Nothing will change over here. Okay. These are golden questions. The reason is, instead of 10%, institute at best can make it as 15%. Instead of maybe EB80 20,000, they'll make it as 50,000. But steps, everything will remain same. Now, this is the first case of arbitrage, where you go from what to what? You go from, we wrote it here somewhere. No? Okay, maybe I'll write it here. You go from levered firm to unlevered firm. This is your first approach, called which approach? Surplus cash approach. Surplus cash. Now, next case is also same. Listen to this. This I'll discuss. Next, I think you should be able to comprehend. You are again going from levered firm to unlevered firm. This is the approach number 2. In approach number 2, no sir, simple. In approach number 1, may shareholding percentage changed or same? In approach number 1, may shareholding percentage same. And return also what, sir? Same. Correct? In approach number 2, no, we call it a surplus earnings approach. Surplus, not cash, surplus earnings approach. Here, what do we do is, we don't want to keep shareholding percentage. If possible, if we have more money, we will buy higher shares, meaning we will not expect same return. We will expect higher return. That's all. We don't want surplus cash. Whatever money we have, no, entire amount we will invest, and we will try to get what? Higher return. Currently, if you are getting 1,300 in levered firm, in unlevered firm, we don't want 1,300. We want more, maybe 1,500, maybe 1,800, etc., etc. That we are calling it as what, sir? Surplus earnings approach. Same step. Step number 1, ditto. What is step number 1? Market value of the levered and unlevered firm. Find. Same. Market value of the equity shares held by investors. Same. Existing return of investors. Same. Fourth one, borrowing also same. No change. Borrowing also same. Amount available step is also same. Now, 1 second. How much money is available? 21,304. In the first approach, did we change the shareholding percentage or same? To buy 10%, how much money we needed? 20,000. Here, what do we do is, we have 21,304, no? Entire amount we will invest off. Because we don't want surplus cash. Whatever amount is available with us, entire amount we will invest in unlevered firm. That means shareholding percentage will be 10. No, it may be 11, it may be 12, it may be 15 or whatever. That's all is a change in this step. Whatever amount is available, entire amount we will invest. So if you invest entire amount, obviously shareholding percentage will not be 10, it may be 11, 12 or whatever. So if you want higher percentage shares now, your return will be same or return will be higher. Return will be higher. Only this step, last 3 steps will change. Rest everything ditto. Okay, now only crux is what? How much ever amount is available, entire amount you invest. Since you are investing entire amount, shareholding percentage will not be 10, it will be more. Definitely more, maybe 11, 12 or what. That's the surplus earnings approach ka funda. Easy, sir. Understood or manageable. Or go through this question with this in mind. Try to, if you are doing it for the very first time, listen to this clip again. Try to solve those questions, 4 cases, whatever you have. You should be able to manage that. Done. Now this is from what to what? Levered to unlevered firm. There are other 2 cases also. What are the other 2 cases? Here arrow is going from L to U. Next arrow will be what, sir? U to L. You are a shareholder in unlevered firm. Now unlevered firm is overvalued. Arbitrage ka simple process is what? Whichever firm is overvalued, you sell. Whichever firm is undervalued, you buy. So currently you are a shareholder in unlevered firm. So you will sell unlevered firm ka shares and buy the levered firm. Approach is still the same. First approach is what? Surplus. Surplus cash approach. Another one is surplus earnings approach. Funda is very simple. First step is what again? Tell me, let's see how well our test. Remember memory? Market value of both firms. Same. Market value of equity shares held in unlevered firm. Stay. No change. Existing return in unlevered firm. Same. Okay, those 3 steps are same. 4th step, what did you write here? In this case, my 4th step, what did you write? Borrowing. You wrote borrowing. Why did you borrow? Because in levered firm, we had a exposure to debt risk. Unlevered firm, we did not have exposure to debt risk. That's the reason to bring the same risk or to maintain the same risk, we borrowed. Now check. You are in which firm? Unlevered. Unlevered firm has debt. No. That means as an investor in unlevered firm, were you exposed to debt risk? No. That means now we have to borrow the money. Now we have to borrow money, not required. Not required because we did not have debt risk at all. That means now should we have to bring in that? No. Borrowing is not required. Got it? But hang on. Levered firm already has some debt. That means levered firm has some debt risk. Yes. Unlevered firm had debt risk or no debt risk? No debt risk. Risk can be changed due to arbitrage or it should not be changed. It should not be changed. Here we didn't have debt at all, but levered firm has already debt. So that means one extra risk you are taking by going from here to here. Levered firm has a debt means as an investor, if you buy levered firm ka shares, you automatically get what risk? Debt risk. You automatically get what risk? Debt risk. To cover this risk, no, sir, you invest where? You invest not only in equity shares, but you also invest in debt also. There it was borrowing. Here you invest the money in equity also, you invest the money in debt also to cover this risk. Because on debt, no sir, you get a fixed return. On equity, you get fixed return or no return, no fixed. No. To mitigate that risk, we do like this. You invest in equity also, you invest in debt also. How much? Same. Which approach? Surplus cash approach. In surplus cash approach, shareholding percentage should change or should not change? Shareholding percentage should not change. Here also take. Whatever is that levered firm ka debt. How much is that levered firm ka debt in the previous example? 1 lakh. How much investor had a shareholding percentage? 10. That means you will invest of the amount available, 10,000 you will invest in debt. Some amount you will invest. You want the shareholding percentage to change or same? Same. So some amount you will invest. Let's say maybe you will, market value of equity is 2 lakh, let's assume. You want shareholding percentage of 10%. That means 20,000 you will invest in equity, 10,000 in debt. So totally it will become how much? 30,000. Let's say amount available is 32,000. Available is how much? 32. Invested is how much? 30. That means you got some surplus cash of how much? 2,000 rupees. That's all is this process all about. Again, once again, I'll tell you this step. What do you do here? Here to here, will you borrow or no borrowing? No borrowing. But hang on, levered firm automatically has one extra risk. What is that? Debt risk. So risk should change due to arbitrage or it should not change? It should not change. Hence, what do you do? The amount, whatever amount is available with you, no, right? You will invest only in equity? No. You will invest in equity also. You will invest in debt also. Shareholding percentage should change or it should not change? It should not change because which arbitrage? Surplus cash approach. So if you own 10% shares means still now also you will still own how much? 10% only. So that way you will get to know how much amount you will actually invest. Compare that with the amount available, you will end up getting some surplus cash. Return also, return should change or no, it should not change. In surplus cash approach, return should change or not change. It should not change. That's how you can confirm whether arbitrage process you have done correctly or not. Done, people. This is from which show? Unlevered to levered. In fact, in exam also so far I've seen only L2U scenario. I've not seen anything in other cases. Okay, first case only is coming in. Okay, but anyways way, I don't want to skip it, so quickly I'm doing it. Now there is another case of arbitrage. You tell me the process. Let's see now. You're going from again unlevered firm to levered firm. Surplus cash or surplus earnings? Surplus earnings approach. Okay, now what do you do, sir? Step number 1. What is step number 1? Market value of levered and unlevered. Same? Yes. Then market value of equity shares held by the investor. Different or same? Same. Existing return. Different step or same? Same. Fourth one is borrowing. Will we do borrowing here? No. Because we are a shareholder in which firm now? Unlevered firm. Unlevered firm has a debt or no debt? No debt. So borrowing will come into picture? No. Now which approach are we doing? Surplus earning. That means will we withhold some cash or entire amount you will invest? Whatever amount is available with you. If you have, let's say, 25,000 available with you, entire 25,000 you will invest only in equity or debt also. You will invest in equity also, you will invest in debt also. In the previous case, you had percentage, so it is easy to find out the value. But here you don't have percentage. No? Hence, what the suggested treatment is, whatever amount is available, no? You invest in equity also, debt also. In debt is to equity ratio. In debt is to equity ratio. Let's say equity ka value in levered firm is 1 lakh. Debt ka value is also 1 lakh. Usually in these sort of problem, debt equity ratio will be same. They will not change. That means what, sir? 25,000. Let's assume that this is 30,000. Let's assume that this is 30,000. What do you do? This 30,000 rupees you will invest in debt equity ratio. What is the debt equity ratio? 1:1. That means 15,000 you will invest in equity, 15,000 you will invest in debt. So obviously, since you are investing entire amount, shareholding percentage will change. Return also will change. And that return should be higher. Compared to the previous, the return should be higher. This all is arbitrage ka overall drama. Keep this in mind, play the recording. I know that some of you would have still not got it, especially if you have not done it in the regular class. Those of you who have done it in a regular class, I think probably you can forward this step on. Nothing. It's okay. Alright. Others, just watch those 4 questions if you can. So that's all is your overall arbitrage. Sir, is practically people do this, sir. Practically, no, sir. This process of approach will not work according to me. The reason is quite simple. See, in the previous case only, when we borrowed, how much borrowings we did? 10,000. How much interest are we paying? 7%. Why 7%? Because they are given in the problem that debt carries interest rate of 7%. Use your common sense. If Infosys borrows a debt at 7%, can I also borrow it at 7%? Infosys is probably 1 lakh crore company. I don't even have 1 lakh. We and investor and company are same. No. This method ka assumption is whether it is investor or very big company, both can borrow at same rate. Practically, will it work? No. All these are for the sake of exams, for the sake of marks. Don't use extra brain. Okay, pa? Done. Got it. Ajojo. Okay. This arbitrage process finally we have gone through. Great. Trade-off theory and all, it's okay. I'll cover the exam related things, sir. In the chart book, sir, I've written even theory related points. Okay. I mean, for the time being, I'll cover most exam related. Other things you can go through on your own. No? I'll mostly take up the exam. Okay. Now, pecking order theory also. Okay, maybe quickly we'll discuss this. Pecking order theory, what it says is a simple 2-marker ka theory question by chance if it comes. What this theory says is different people in the organization have access to different information. Different people in the organization have access to different information. Now you are sitting in our classroom now. You are part of Arivupro. You know little information about Arivupro. They have Dabba faculty, they have good classroom. Well, like that, some information you know. Yes or no, sir? Correct. Sir, you and I know same information about Arivupro, or I know better information? I know more information compared to you when it comes to company. Yes or no? Because probably I occupy a little better position than you. Yes or no? That is what pecking order theory says. Different people in the organization have access to different levels of information. A normal employee will have access to one information. Managing director will have access to more information. Now, pecking order theory, what it says is, you should select that source of finance which gives you maximum information. The overall topic, what is the funda of this chapter? You choose that source of finance which maximizes the value of the firm. You can take debt, you can take equity shares, you can take preference shares, whatever, or retained earnings, whatever. You should select that source of finance which maximizes the value of the firm. Pecking order theory says, select that source of finance which gives you the maximum information. As per pecking order theory, first priority you will always give it to retained earnings. Because retained earnings means what, sir? Your already whole year is over, you have already earned money. That means you know full information about it. Yes or no? Because the dividend you have paid, tax you have paid, everything you have paid. Anything more information you want to know about retained earnings, or full information is available? Full information is available. That means as per pecking order theory, first priority you will always give it to what? Retained earnings. Whenever you need money, first you pick it from what? Retained earnings. Then second priority you give it to debt. Second priority you give it to debt. Third priority or last priority you give it to equity, because equity shareholder ka expectations same or it will change. Equity shareholders expectations are very dynamic, it goes on changing. So you will have least information relating to new equity. Hence you will give the last priority to equity. First priority to retained earnings, next priority to debt, last priority to equity, as per pecking order theory. Again, theory not much relevant for exams. This is also okay, that's fine. This could be important. So from this topic, usually the next three sections are very important, has come a lot of times in examination and quite easy also. I'm sure you would have covered in your regular class as well. Anyways, nonetheless, quickly we will run them by. Financial break-even point. Financial break-even point. Financial break-even point simply means what should be your EBIT so that your EPS should become zero. What should be your EBIT so that your EPS number, it should become zero. That we are calling it as financial break-even point or FBEP. Okay, sir. Now, sir, again, this will come as a straightforward question. If you have only equity plan, all this I've proved it to you with example in a regular class. Again, I'll not go into all that. Straight away, I'll tell you the number and discuss. Sir, if you have only equity plan, then financial break-even point means EPS should become what? Zero. If you have raised money only through equity shares, EBIT has to be zero for EBIT also to become zero. That is the only case where EPS will become zero. Only if EBIT is zero means EPS will also become zero. If EBIT, suppose even if it is 100, EPS will not be zero, it will be something else. For EPS to become zero, EBIT has to be compulsorily what? Zero only. This is for which plan? 100% equity plan. If you have raised entire money through equity. If you have raised 100% money through debt by chance, then for EPS to become zero, EBIT should be equal to interest charges. If interest charges is, let's say, 10,000, then EBIT also should be equal to 10,000. That's what here it's a point. If EBIT is equal to interest charges, then EPS will become what, sir? Zero. That interest charges could be whatever. If suppose interest charges is 1 lakh, then for EPS to become zero, EBIT also should be equal to what? 1 lakh rupees. Meaning it should be equal to interest charges. Okay, sir. I'll not go ahead and waste the time in proving people because we not that time of the day. Yes. If you remember our regular classes, we proved. I took an example and proved all the three. But now remember, I think that's okay. Yes, sir. Comfortable. Full energy loan. Pakka loan. You can understand. Yeah. Papa, you're sitting from that time. But it's anyway, sir. That we are in that zone now. No. We should now stop worrying about the time. I'll study for 3 hours, 4 hours. I need 15 minutes break. I need half an hour break. All that time. No. Now it's past. Now it's for us to go in which gear? Highest gear. If possible, 6th, maybe 10th if you have. I don't know. But you should operate at the highest gear possible now. Now don't worry about the time. Alright. It's very simple. Okay. Now onwards, you should set a particular target. It doesn't matter how many hours it takes. You should do it. And you have time. You have 24 hours a day. Okay. You have 24 hours a day. To pass, I feel about 10 hours is good enough. 10 to 12 hours is good enough. So if you take 10 hours, if you calculate, roughly it is 33%. Roughly it is 33%. That means you are using only what, sir? 33% of your time. Whole day ka 33% only is what you are using. Another 60-65% you have for your personal work, sleeping, or your girlfriend, or your boyfriend, or okay, whatever friend, or all the things you can take care of in the other 60% quota. First priority for the timing has to be studies, because you have less than 1 month for your examination. Now don't be like, this not to that not. Whatever comes in your way now. Even if you have not learned few things, still keep an open mind and keep absorbing, keep practicing them. I know it is little difficult, especially to sit for 6 hours, 7 hours classes and to listen and all, because anyway, all this, we are not doing much problem. We are discussing in theory concept mode of things. So it is definitely difficult, but is it required? Yes. Because see, from there, if you have to go to a place where you get that degree called CA, certain sacrifices are required. Okay, so don't worry, it's not just you guys have done that. Even we were also sitting in the same place, maybe 15 years back or whatever, but still we were there right now. So even we have gone through the same journey. It's not that only you are going through, all others escaped do. Now my life is Giam Do, Jando, Bando and all. Nothing of that sort. Everybody's life, CA life was Jando only. Studies only. Studies was the major priority for everybody. So this is the time where you have to buckle up and prepare. Okay, so don't be like, sir, this is boring, sir, I can't, sir. Always don't ever say the negative things about yourself. Okay, maybe in this case I have just telling something. I'll tell you a small story. Okay, small scenario. I think it's a real incident that has happened. You can listen to that. There's just importance of psychology, you could say. How our mind tricks is probably the moral of, or the the final outcome of this story. I think I would have shared this in our regular class. I'm not sure. I'll tell any which way. Now, sir, there was a prisoner. There was a prisoner. He has got a life imprisonment. He has got, in fact, a death sentence. You know, normally in the death sentence, the way normally the death sentence is awarded is they hang, right? You hang the people, and like obviously in about a few seconds you go Kailasa. Correct? Huh? That's the way it works. Now, apparently, I don't know this, I've just heard this, that though it lasts only for like 5 to 10 seconds, it's a painful experience, because apparently your neck breaks. You feel that pain, the pain is so hard that you just vanish. Kailasa. Okay. So, there's one prisoner who had got this death sentence. So, one psychologist, they thought that let's do a small experiment. Anyway, this person is going, let's try to do some experiment. So they approached the judge and sought a small permission. All right. They said, anyway, this guy is going to go. No, let's do a small experiment if you wish so. Judge finally heard all this proposal and he said, no problem, go ahead. Now the psychologist, okay, or doctor you can call it, he went to that prisoner and said, boss, either ways you cannot escape from death sentence. You are going. The sentence currently, the way it is being rendered, no, it is quite painful experience. Though only for 10 seconds, it is still painful. I have another small extra option for you, which is less painful. Which is less painful. What it is, there is one cobra. There is one cobra, busso. Okay. That is most poisonous snake in the world. Alright. So now, as per our study, okay, we have conducted the test on 100 people. It is 100 people, literally. This is what psychologist is telling. Apparently, that cobra has bit 100 people. And all those people have died in 2 seconds. Within 2 seconds, so gone. That venomous or that poisonous. So this doctor is saying, we would like to test it on you. Because so far we don't have real data. This is what the others are claiming. That within 2 minutes or 2 seconds, the people will go off. And this psychologist or doctor showed some pictures of the people who died because of that cobra bite. All had like venom coming out of their mouth and etc. etc. The prisoner said, okay, fine. The other one is a 10-second approach. So it is more lasting, more painful. And this cobra ka bite, no, it is apparently very less painful, it seems. It's like a needle prick. When you prick a needle, you feel a pain? No. Cobra bite is like that, it seems. It bites and within 2 seconds you are gone. So no pain and quick remedy. So prisoner said, no problem. I would like to take up the cobra option. I don't want the hanging option. I will go with the cobra. So when finally the day came and it was due to hang that person, They showed the prisoner that there was a cobra. There was one person holding a cobra there, and cobra was made visible to that prisoner. He was also watching. Later on, after a few seconds, they blindfolded him. They covered his eyes. Okay, and slowly the whole room was silent, and slowly the person who was holding cobra, okay, he started coming towards the prisoner, obviously to get that bite. Now, just before few feet before that particular man with cobra approached the prisoner, no, he was swapped. The man holding cobra was swapped. Instead of him, another person came. Another person came. Not person with a cobra. Another person came. He was just holding a needle. He was just holding a normal needle. He took the needle. He pricked the prisoner. Prisoner died within 2 seconds. Prisoner died within 2 seconds. Not due to cobra bite. Due to that needle prick. Okay. You know the more shocking truth, when post-mortem report came, when that post-mortem report came, the report said the man died due to poison in his system. The man died due to poison in his system, because the moment he saw snake and the moment he felt that prick, his mind conceived that he has been bitten by cobra. His mind generated the poison within the body, and within 2 seconds that person died. That's the power of mind. So much mind or capability. That's what many people say, no? You think what you achieve. Many people, if you ask many athletes also, they say, any successful athlete you ask, right? How are you so successful? People say, simple. For you, I am successful now. For me, I was successful 1 year back only. Because in my mind, I was already an athlete. The world is seeing my success now. I already saw that success in my head only. So the way you think matters. I don't know how authentic the story is, but it just come out in few reports. I'm probably thinking it's fine. But the mind part is absolutely true, people. The more and more you remind yourself that I am capable, I am good, I can manage. The more and more positive you think, the more and more positive your life will become. If you only think, someone who keeps cribbing, someone who says, no, you're boring, oh, I can't do it, oh. Throughout the year, they'll be doing the same damn thing. Their friends also will be around that tone. If you are a cribbing person, your friend also will be like more or less that cribbing person only. Gossip. One will gossip the other, another one will gossip the other. Like this, the chain will keep going on. So that's the reason I say it's very important to what? Keep a positive frame of mind. At least for the next 1 month, don't put all that thought process in your mind that too less time or too much volume of syllabus to cover, etc., etc., etc. Always believe that you still have time. You can still do it. It's okay. Thousands of people have cracked examination. After all, it is one examination. Now, from first standard to 10th grade, have you failed any exam? Till your BCom, from first to BCom, have you failed any exam? Then why change the trend in CA? Trend, you are a trend setter, correct? All. Your trend is from first standard till BCom, you have not failed even one exam. So why the hell should you fail CA exam? Correct, no, same trend should be followed. So always positive framework. Okay, yes, that's all matters. Now coming back to this question is not over. Keep the Josh always high. The moment you slouch, the moment you knock off, right? Your body is sending a signal that it's time for me to nod off. No, full. Now I'm also uttering almost from 5 hours. You see me? No, because I take my work seriously. See, all this also, no, if I think arbitrage anyway, people have not learned, skip, no. Half an hour save for me also. Anyway, it's not that popular in exam also. Anyway, people don't know. Whoever has taken regular class from me will any which way solve. For them, it is anyway straightforward. I can tell you buy my regular class now. It will be marketing for me also. Yes, no. You buy 1 month. We offer 1 month validity for 1,250. I can also tell. I'll tell you which video. You buy 1 month validity of 1250. Spend 1 hour or 2 hours maybe for that arbitrage whole thing I've done. Do it. Good for you also. Good for me also. Easy, no, for me. Half an hour, my energy also saved, no, sir. Correct? But did I do it? No, still I made it an effort to convey, right? Because it's my moral responsibility that whatever I have planned to do it, at least I should make an effort to do it. Otherwise, I'll have guilty conscience after I walk out of this room. Now it may feel easy. See, now if I save half an hour, now I'll also feel good. Half an hour energy saved, half an hour class also got over early. But once I walk out of that room, no, I'll have guilt conscience. I think I should have done that. It's okay. At least I could have given it a shot. Now I don't want to go back with that guilty conscience. Okay, as much as possible, I have committed myself that I'll help you out in that regard. Rest is something you have to help yours. Okay, now. So now coming back to this topic. What is the topic again? Keep the Josh high. Everyone just get up for a minute. Get up. Stretch yourself. Jai Kalaveri. Stretch, laugh, stretch, whatever you want to do. 2 minutes you want. Online also people, yes. Chill up. Good. A punishment. Now you will listen only and you will stand only and listen. No, better no. This is only better, I think. No. You can sit down whenever you are ready. It's okay. Whenever you feel a little, yeah, you can sit. If you want to sit, you can sit. It's okay. Stand only. No, better. If you're feeling a little restless, you can always get up, take a small walk, and come back. I don't mind with all that stuff. Okay, that's all right. But class will still continue. That is pakka. Yeah? This topic is there, so we'll have to do it. Huh? Thank you. Okay. Now get back to this particular section. Macha is still standing. It feels like a punishment for him now. Okay. Now listen, everybody. We were discussing what concept? Financial break-even point. Break-even point simply means EPS should be 0. EPS should be 0. Now you should raise money only from one source, or it can be many sources. You can take money only from equity, only from debt, only from preference shares. If you have taken money only from equity shares, then for you your EPS to become 0, your EBIT also should be 0. That is the only circumstance. If your EBIT is 0, only then EPS will become 0. If you have taken money only from 100% through debt, then if your EBIT is equal to interest charges, only then EPS will become 0. Otherwise, it will not be. So if interest charges is 1 lakh means, if interest charges is 1 lakh means EBIT also should be equal to 1 lakh. Only then your EPS will become 0. Alright. If you have taken 100% preference shares plan, rare but possible. If you have taken money only from preference, 100% through preference shares, then for EPS to become 0, your EBIT should be equal to, there what do you write? EBIT should be equal to interest charges. Here you write what? EBIT is equal to preference dividend divided by 1 minus tax rate. Divided by 1 minus tax rate. That's what I've written in the formula here. Why, sir? Sir, for you to pay preference dividend, first you have to pay tax. Only after you pay tax, we will pay preference dividend. That means for your EBIT, for your EPS to become 0, your EBIT should recover tax amount also. It should recover preference dividend also. Hence, EBIT should be equal to preference dividend divided by 1 minus tax rate. If this number works out, suppose preference dividend is 10,000. Tax rate is, let's say, 25%. Calculate this for me, so how much it will be? 10,000 divided by 0.75. How much is this? Whatever number, it's okay. 13,333. So if your EBIT is equal to 13,333, then only your EPS will become 0. Otherwise, it will not be 0. Remember, all this will come as a straightforward question. We'll maybe also, if time permits, we'll take up one question on this. Okay, Saru? Alright, now coming back. This is also quite important. Indifference point. Sir, in the previous case, we studied what? Financial break-even point. Break-even point means EPS will become 0. Indifference point means, or maybe 1 minute, let me go back. Sir, is it necessary money you have to take from 100% equity, 100% debt, 100% preference shares, or all? Money can come, some money can come through equity, some money can come through debt, some money can come through preference shares. Sir, if all the three are there, meaning if equity is also there, debt is also there, preference shares is also there, then what is financial break-even point, sir? Simple. Financial break-even point means EBIT should be equal to what? Or if you have debt plan means EBIT should be equal to what, sir? Interest charges. If you have preference shares plan means you have to recover what? Preference dividend divided by 1 minus tax rate. That's what I've written over here. Okay. If all the three are there means financial break-even point will be interest charges plus preference dividend divided by 1 minus tax rate. Anyway, equity plan ka financial break-even point is EBIT is 0. You can ignore that. Other 2 points you can sum it up. Done. That is for all the 3 plans. Now moving on to the next one. Indifference point. Indifference point means Name itself is saying indifference. Indifference means it makes a difference or makes no difference. Makes no difference. Indifference point means, suppose we have first plan, we need money, we have two plans, let's say plan A, plan B. Plan A is 100% equity, meaning we need 10 lakh rupees, entire 10 lakh will come through equity. Plan B is 50% equity, 50% debt. That means out of 10 lakh, 5 lakh will come through equity, another 5 lakh will come through debt. This is two plan. Indifference point is trying to suggest what should be the EBIT. What should be the EBIT, so that whether you choose plan A or whether you choose plan B, EPS, no sir, will not be 0, it will be same. Meaning if plan A gives EPS of 0.5, plan B also will give EPS of 0.5 only. Such a component we call it as what? Indifference point. So indifference point, if I have to tell, what is it? Indifference point means what should be the EBIT, so that different plans will give you not 0 EPS, same EPS. Whether you go for first plan or whether you select second plan, the final EPS number will be same. Such a thing we call it as what, sir? Indifference point. Okay, G. Comfortable? Now, we are trying to calculate what? EPS. EPS of both the plans should be different or same? Same. Sir, how do you calculate EPS? Tell me. How do you calculate EPS? In fact, you have done this. Okay, we'll start with EBIT. First you do EBIT. Then what do you do? Deduct interest. What are you going to get? EBT. From this you deduct tax. You're going to get. Okay. From this you deduct preference dividend. Usually preference dividend in these cases will not be there. So let's cut it off. It's okay. Yeah. Or maybe let it be, no issues. Minus preference dividend. If you do, you will get net income or ish. Suppose this is 10 lakh. Okay. Number of equity shares, let's say, is 1 lakh. Now we want EPS. EPS ka full form is what, sir? Earnings per share. Now ish is also earnings. This is earnings per share or total earnings? This 10 lakh rupees is your total earnings. We don't want total earnings. We want earnings per share. How do you get earnings per share? Ish divided by number of equity shares. If this is 1, this is 2, 3 is equal to what? 1 divided by 2. Basically 10 lakh divided by 1 lakh, which is 10. Any problem? This is your earnings per share. Indifference point means first plan ka EPS and second plan ka EPS will be same. Now tell me EPS ka formula once again, everybody. Each divided by number of equity shares. That is basically 10 lakh divided by 1 lakh. Now look at this formula. What is this formula? Is it each divided by number of equity shares? No, it looks fancy. What are we writing? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1 is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by number of equity shares. This is the formula for indifference point. All the data will be given to you. We have to just find the EBIT. If you find EBIT, this question is solved. Sir, what is this formula? Sir, this is the formula to calculate EPS. This is a formula to calculate EPS. Very simple. If you want, we'll take some numbers and prove it for you. Let's say EBIT is 10 lakh. This is 1 lakh. Suppose then this will be 9 lakh. Tax is 30%. How much is this? 2.7 lakh. This will be how much? 6.3 lakh. Preference dividend is, let's say, 0. Okay, how much is this, sir? 6, or maybe let's make this as 30,000. So how much will be each? 6 lakh. Number of equity shares, let's make it 60,000 or maybe 1 lakh. So how much is EPS? 6, correct? Any doubt? Now let's write it on our formula. What is our formula saying? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Okay. Just check the same formula, sir. EBIT is how much? 10 lakh. I1 means interest. From EBIT, if you deduct interest, what are you going to get? EBT. So that means by doing this, what will you get, sir? EBT. That's all this formula is trying to calculate. From EBIT, if you deduct I1, you will get EBT. Okay. We want EBT or we want ish? That means we have to deduct tax. Sir, instead of deducting tax, no, from here, directly you can jump here. From 9 lakh, you can directly jump here. How do you do that? Is simply take EBT and do 1 minus tax rate. Simply take EBT, which is how much? 9 lakh into 1 minus tax rate you do. Tax rate is 30%. 0.3 you do, how much you getting? 6.3 lakh. Yes, no, if you calculate. That means from 9 lakh directly you can jump to 6.3 lakh. How do you do that? By multiplying what? 1 minus tax rate. That is what we have done over here. By doing 1 minus tax rate, directly we will get what? Earnings after tax. We need earnings after tax or ish. How do you get ish? We have to also deduct what? Preference dividend. Meaning by doing all this, no sir, we simply get what? Ish. That's all it is. Okay, now divided by even. What is even? Number of equity shares. That's all is indifference point. Done. Now express. This is a formula expressed from EBIT. That's all. Okay, G. Yes. Now indifference point means different plan will give different EPS or same EPS. That means both the plans we should equate. But the problem here is EBIT, in my example, I gave it to you. But in indifference point EBIT will not be given. You need to solve and get EBIT as a balancing figure. That's all is this question all about. Okay, G. And this two are okay. Fine, no issues. Yeah, I think we have 1 or 2 more questions, people. We'll do that and then we will wind up this chapter. Not class. 1 second. Okay. Everybody, fine. One pointer I will say, maybe take up one question. Listen to this, everybody. Indifference point. Remember this. This is a good question. Has come a few times in the examination. At indifference point, you can select any plan. It will not make any difference. Because both the plan will give you what plans? Same EPS. At indifference point, either you can select plan A or you can select plan B. Both will give you same EPS. If EBIT, suppose, or 1 minute, or let's do a thing. I'll tell you this with numbers in one of the question. Maybe easier to connect. Then I'll maybe come back to this. Now listen. Everyone, listen. Don't sway away. We'll do this and I'll give you a break. We have done almost everything. I'll just take this one. We'll take up this question, people. Everyone listen. Ganapati is considering, this is a good question. It has quite a few points. Listen. Ganapati is considering 3 financing plans. Key information is as follows. Total investment we want is 2 lakh. We need 2 lakh funding. Great. Plans of financing proportion. We have 3 different plans. In plan A, we will go for 100% equity. In plan B, 50% money will come through equity, 50% through debt. Okay, tell me sir, in first plan, how much money we need? 2 lakh. I mean, entire 2 lakh will come through equity. In second plan, 50% through equity. So 2 lakh of 50% is how much? 1 lakh will come through equity. Another 1 lakh will come through debt. This is the second plan called plan B. We have one more plan, plan C. Here 50% will come through equity, meaning 1 lakh will come through equity. 50% will come through preference shares, meaning 1 lakh will be through preference shares. So first is 100% equity. Second is equity and debt. Third is equity and preference shares. These are the 3 plans we have. Cost of debt is 8%. Cost of preference shares is 8%. Basically, interest rate is 8%. Dividend rate is also 8%. Tax rate is 50%. Equity shares of face value 10 will be issued at a premium of 10%. 10 is the face value, will be issued at a premium of 10. So what is IP? 20 per share. EBIT expected is 80,000. First plan, you need to calculate EPS. Tell me, sir, how do you calculate EPS? We need ish, but are they given ish or are they given EBIT? EBIT. So let's start with EBIT. Look at this. Just a 5-10 minute quick revision question. So it doesn't matter whether you go for whichever plan, EBIT will change or same. Earnings will not be impacted by the source of finance. EBIT everywhere will be 80,000. From that we have to reduce what? Interest. Now which plan has a debt? Only second plan. How much debt is there in second plan? 1 lakh. What is the cost of debt? 8%. That means what will be the interest amount? 1 lakh ka 8%, which is 8,000. Other 2 plan A and C does not have debt. That means interest also will be 0. EBT is this much. Tax rate is given in the question. How much, sir? 50%. So reduce tax at the rate of 50%. If you reduce, you'll get earnings after tax. We need EAT or ish. So reduce what? Preference dividend. Which plan has preference shares? First 2 plan has no. Third plan, yes. How much money has come through preference shares? 1 lakh. What is the dividend rate? 8%. What is the dividend amount? 1 lakh ka 8%, which is 8,000. If you do that, you will get net income, or also known as ish. Divided by what? Number of equity shares. How much money you need? 2 lakh. What is the issue price of each equity shares. Face value may be 10. Are you issuing it at face value or premium? What is the issue price? 20. 2 lakh is the total value we need from equity shares, and the value of one equity shares is 20 rupees. So how many equity shares will you roll out in the first plan? 10,000 equity shares. Correct, people? In second plan, how much money you want from equity shares? 1 lakh. What is the issue price of one equity shares? 20. So 1 lakh we need from equity shares, and the price of equity shares is 20. So how many equity shares? 5,000. Second and third plan, number of equity shares is 5,000. These two, if you divide, you will get DPS. That is the answer to the first requirement. Pretty straightforward. Everybody? Okay. First requirement done. Next, this one you will answer. Financial break-even point. Tell me, sir. For first scenario, what is financial? First of all, financial break-even point means what should be EBIT so that your EPS is 0. First is 100% equity plan. Under 100% equity plan, if your EPS has to become 0 means EBIT has to be what? 0. That is the answer to the first question. For 100% equity plan, financial break-even point is EBIT should be compulsorily equal to 0 for EPS to become 0. Second, what plan we have? 50% equity, 50% debt. For equity, we don't have to worry, but do we have debt? Yes. What is financial break-even point for debt plan? EBIT should be equal to interest charges. Go back to your previous working. How much is interest charges? 8,000. That means your EBIT should be equal to what? Interest charges of 8,000 for your EPS to become 0. Third plan, 50% equity, 50% preference shares. So equity, leave it, it's okay. For preference shares, what is financial break-even point? Preference dividend divided by 1 minus tax rate. Preference dividend is how much? 8,000. Divided by 1 minus tax rate. Tax rate is 0.5. Solve this, you will get how much? 16,000. So if your EBIT is 16,000, then your EPS will become 0. Any problem? This is your financial break-even point. And all this, I'm pretty sure you have done it in your regular class and comfortable and thinking. Okay, now just a quick revision of the question. Now check this. Indicate if any plans dominate and compute EBIT range among the plan of indifference. That means they're asking you to calculate what? Indifference point. Sir, one is this indifference point works only with two plans ka comparison. Here you have 2 plans or 3 plans. You can't compare all the 3 together. You can only compare 2 plans at a time. That means here how many indifference point you need to calculate? First you need to compare A and B, then A and C, then you need to compare B and C. 3 indifference point you need to compute. Can we do it quickly? Can we review? How do you get indifference point? Tell me the formula again. EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Indifference point means both the plans will give same EPS. That means both the equations should be equated. So is equal to what? EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Don't take off EBIT 80,000. Go in there. We have to find EBIT. This is normal plan ka EBIT. Indifference point means what should be the EBIT so that your both the plans will give you same EPS. EBIT we have to find out. Rest every data is known. See, first we are doing comparison. One maybe I'll show, others maybe we can manage. Yes. First we are doing indifference point between A and B. EBIT we have to find out. Let it be minus I1. Under first plan, what is the interest, sir? 0. So that means EBIT we don't know, minus 0 into 1 minus tax rate. Tax rate is 0.5. Under first plan, do we have any preference dividend? No. So minus preference dividend is also 0. Divided by E1. E1 is what? Number of equity shares. We already computed. Check how many equity shares we have in first plan. 10,000. This is the first part. Is equal to what, sir? EBIT is still unknown. Minus I2. Which plan we are comparing now? Plan B. Check. Plan B has any interest? Yes. Plan B has how much interest? 8,000. So EBIT minus 8,000 into 1 minus tax rate. Second plan also does not have any preference dividend. Divided by number of equity shares. How many equity shares are there in plan B? Number of equity shares is 5,000. Okay, sir. One way to do it is you can cross multiply 5,000 here, 10,000 there. Or if you want to work with smaller number, 10,000 divided by 5,000 you do. How much is that? 10,000 divided by 5,000 you do. How much is that? 2. That means directly you can squash off 5, you can squash off 10 and directly write 2. you can work with smaller number. Or if you want to work with bigger number, 10,000 you multiply here, 5,000 you multiply there. Your choice. Answer will any which way be the same. Solve this equation. If you solve, finally you will get EBIT to be how much, sir? 16,000. So, if your EBIT is 16,000, if your EBIT is 16,000, either you can select plan A or you can select plan B. Both plan will give you same EPS. Okay, now I have proved it to you in my regular class. I've just brought in the notes. Just quickly, 2 minutes, we will check. That means at 16,000, plan A and plan B should give same EPS. Can we quickly review this? EBIT, just now we got it how much, sir? 16,000. Minus, in plan A, interest is there or not there? Not there. In plan B, is interest there? Yeah. How much is that? 8,000. Updated. Then you'll get EBT, 16,000 and 8,000. Minus tax, 50% you reduce. You'll get EAT. Preference dividend is not there. So you get net income. Number of equity shares you already found. How much is that? 10,000 and 5,000. Calculate EPS, check how much is the number? Same. So if EBIT is 16,000, either you can select plan A or you can select plan B. Both will give you the same EPS. Yes, sir. Now listen. Of late, they've been asking you analysis also. They not only ask you to calculate, they also ask you to analyze. This is how usually they're asking. Listen, important. I don't know whether you have done this or not. At the indifference point, you can either select plan A or you can select plan B. It doesn't make any difference. If EBIT is lesser than 16,000, okay, let me see how many of you know this. If EBIT is suppose 10,000, which plan will you select? And if EBIT is, let's say, 20,000, which plan will you select? Like this question are being asked. Tell me, let's see. At 16,000, either you can select plan A or you can select plan B. Both will give you same EPS. Suppose EBIT is lesser than indifference point EBIT. What is indifference point EBIT? 16. If EBIT is lesser than 16, I have assumed some number 10. And if EBIT is actually higher than 16,000, which one will you select? Well, let's see. That is what this sentence. I told you I'll explain in numbers. Look at this. Everyone, pay attention to this. At indifference point, you can select any plan because both the plan will give you same EPS. If it is below indifference point, if your EBIT is below indifference point, what is our indifference point EBIT in our example? 16. But what did I assume? 10. If EBIT is lesser than indifference point EBIT, you will always select that plan which has higher equity. You will always select that plan which has higher equity because by doing so, you get higher EPS. If your EBIT in the second plan, what is the number I assume? 20,000. If your EBIT is greater than indifference point EBIT or if it is above indifference point EBIT, you will always select that plan which has higher debt because that plan will give you higher EPS. I'll prove this also with you. But you can remember this. So in case they ask you to analyze this comment, directly chapo. Copy paste. Okay, now 1 or 2 marks will be awarded for this. If you want 2 minutes, we'll spend and try to prove this also. In fact, I've done it in regular class. I'll show you the data and prove it. So what is the funda here? Tell me once again, what is that? At indifference point, select anything. Doesn't make any difference because same EPS. Below indifference point, if EBIT is below indifference point EBIT, then you will select that plan which has higher equity because that will give higher EPS. If your actual EBIT is greater than indifference point EBIT, you will select that plan which has higher debt because that will give you higher EPS. Can we prove this quickly? Using same example, we will just check this so that we don't have to write everything. Here I proved it already. What is indifference point EBIT, sir? 16,000. Let's take one number lesser than 16. I assumed it to be 10. If EBIT is 10, let's work out the EPS. EBIT, how much I assume? 10,000 minus interest. First plan, how much is interest? 0. Second plan, how much? 8,000. So you get EBIT 10 into minus interest you reduce. You're going to get earnings after tax. Preference dividend anyway not there. So you get net income. Number of equity shares is again 10 and 5. Check. How much is the EPS of this plan? 0.5. How much is the EPS of that plan? 0.2. Which is giving higher EPS? Plan A. Why? Plan A was 100% equity. Plan B was 50% equity and 50% debt. What did our analogy say? Below indifference point, you will always select that plan which has higher equity, because that will give you higher EPS. This has only 50% money coming from equity. This has 100% money coming from equity. Which is using higher equity? Plan A. Our analysis also said you should select higher equity wala plan. So that means we should select plan A, because numbers are also proving that they are giving higher EPS. Okay now? Yes sir. This is one. Next, another pointer, what did we write? If EBIT is above indifference point EBIT, you will select that plan which has higher debt, because that will give you higher EPS. What is indifference point for EBIT? 16. Now EBIT we have to assume a number greater than 16. I have assumed it as 20,000. Anything you can take. Anything above 16 is okay. Here I have taken 20. So EBIT 2020 minus interest. First plan is 100% equity, so interest is 0. In second plan, my interest is how much? 8,000. So this is your EBT. Reduce the tax. You will get earnings after tax. Preference dividend is not there. By doing that, you will get what, sir? Ish. Number of equity shares is still 10 and 5. If you do it and check the number, you're getting EPS of 1 here, 1.2 here, which is giving you higher EPS. Plan B. Our analysis said you should select that plan with higher debt. First plan is using 0% debt. Second plan is using 50% debt, which is using higher debt. Plan B. So you should select which plan. If they ask, write the comments, otherwise not required. Of late, I'm seeing these questions also. Then Asaru. Okay, super. You're looking for break. Oh, alva. Correct, no. If you want, if you can give me 10 minutes, one more question is there which is quite popular in exam, I'll do it. Or if you feel enough, we will manage, means this topic over. 10 minutes it will take revision. If you are okay, we will run through this question. It's quite popular. Is it okay? Do means you should not say do and you should do your own thing. No. Do means you are paying attention to this. Okay, then I'll give you a break. Then we will take a one more topic and then. Don't worry, tomorrow I've kept it pretty light. Tomorrow and day after it will be light. I want to finish up first day. Little more. First day bumper. Next day we will reduce. Okay, great. Listen. Question number 14. A good question again in my view. This. Complete attention. 10-15 minutes stops. Listen. Great. The following data is presented with respect to Quality Automation Limited. PB. No. This will not work. Okay. 10-15 minutes. I know. But one for the team. Okay. PB, profit before interest and tax. That is nothing but your EBIT. You can call it as earnings before interest and tax or profit before interest and tax, which is given to be how much? 52 lakhs. Interest at 12%. And check careful. All these are some hidden adjustments are there in this question. Interest on debentures at what rate? 12%. Interest is 12 lakh. One. When you quickly review the question, nowhere you see the debenture value. Nowhere you see the debenture. Now, interest amount is given, interest rate is given. Can you find out debenture value? Just now we said, how did you get that? Interest amount divided by expected rate. But here expected rate and actual rate are same. Interest rate is how much? 12. Expected and actual rate is how much? 12% or 0.12. So debenture value is how much? 1. Great. PBT you got, income tax you reduce. Here check. Number of equity shares of rupees 10 each, how much? 8 lakh. How many shares we have? 8 lakh. Each ka face value how much? 10. So what is equity share capital ka value? 8 lakh shares, each ka face value 10 lakh, which is 80 lakh. Let that be there. EPS, earnings per share is 2.5. PE ratio, so name only there is formula. Price, PE ratio stands for price earning ratio. Price earning ratio. That means formula is what, sir? Price divided by earnings. Price here is your price per share, which is MPS. Earnings per share will be EPS. So basically MPS divided by EPS, if you do, you will get what, sir? Price earning ratio. Easy now. Market price of the share is also given to be 25. Okay, this is one question. Company is planning to start a new project. So this is their existing capital. This is their existing capital. They are planning to start a new project requiring a total capital outlay of, they need extra funds to the extent of 40 lakhs. You are informed that debt equity ratio, and how do you calculate debt equity ratio? Here on the other, debt divided by debt plus equity you have to do. If that number crosses higher than 35%, it will push the KE, cost of equity, to 12.5% means PE ratio will reduce and become 8. From 10, PE multiple will become 8. When will this happen? If debt divided by debt plus equity you do, and if that number crosses 35%, then P instead of 10, it will become 8. Not me, problem say. Yes, sir. And interest rate on additional amount of borrowing will become 14%. Sir, currently what is our interest rate on debt? 12%. But if debt crosses 35%, we already know this. Debt crosses 35% means you are borrowing more and more debt. If you take more and more debt, debenture holders or bank loan will give you a loan at lower rate or higher rate. That's what they're saying. If the debt crosses 35% of capital, then interest rate will not be 12, it will become 14. This will happen only if debt to equity crosses 35%. Keep that in mind. Find out probable price per share. Probable price per share means we need to calculate market price per share. If additional funds, there are two options for us to raise the money. If additional funds, how much additional funds we need? 40 lakh. 40 lakh is raised through loan. Loan means debt. So first plan mein 100% of the money will come through debt. Second plan, amount is raised by issuing equity shares. In second plan mein 100% of the money will come through equity shares. Check this. Retained earnings of the company is 1.2 crores. Okay, Ji. Sir, how do you get P multiple? MPS divided by EPS. Therefore, can I write MPS is equal to what? P multiple into EPS. Yes, sir. So, if you know P multiple, if you know EPS, you will get MPS. Correct? So, they asked in the question MPS. For us to find out MPS, we need P multiple also, we need EPS also. P multiple, it's okay. If debt equity ratio is less than 35%, P multiple is how much? 10. If it crosses 35%, P multiple will be 8. So, P multiple any drama or given? Given. Now, EPS, no. EPS have they given? Yes, sir, here they have given no 2.5. So, that is for existing. We are taking existing or we are taking extra money? Extra money. When you take extra money, obviously number of equity shares and all will change. So, EPS also will change. So, we need to take this data or rework. To get EPS, we start with what? EBIT, reduce what? Interest, EBT, reduce tax, you get EAT, reduce preference dividend, we get each, then divided by number of equity shares, we get EPS. Here there is a big problem. Can someone tell me what the problem is? Here there is a hidden adjustment. Can someone tell me what is that? Thanks, Pa. Perfect. Sir, currently our EBIT is how much? 52. This is before expansion. Now when you expand, to expand how much money you need? Sir, expansion means you are taking a new project. When you take new project, you will get same EBIT or more? How much more? Can you see, sir? Earlier we had only one branch, Bengaluru. Now we have in Chennai also, we have in Coimbatore also. That means are we earning same or are we earning more? Because we expanded, number of students coming are more, so our earnings is also more. Don't ask how much and all. But we are earning more, correct or no? Here also, since we are going for a new project, EBIT will not be 52 lakhs. It will be more. How much? That is missing. That is the whole crux of this question. If you find that, this problem is solved. That's a hidden adjustment. Got it? Now, listen. Currently, what is your capital employed? Capital here in FM means share capital or total long-term source? Total long-term source. Tell me, sir, what and all is there over here? Do we have equity share capital? Yes. Do we have retained earnings? Yes. Do we have debt? Yes. How much is equity share capital? Remember, we solved all that here. Equity share capital is how much? Anyway, I've solved and take you through here. Equity share capital is 80 lakhs. Debt is how much? 1 crore. Retained earnings given is how much? 1 crore 20 lakh. Here they gave 1.2 crore. Can I write it as 120 lakhs? Adding all this, how much you going to get? 3 crore rupees or 300 lakh rupees. Correct? How much EBIT currently we are earning? That is also given. How much is that? 52 lakhs. Fine. Sir, listen. You have taken a total funding of 300 lakhs. You are earning totally how much from that fund? 52. Can you tell me what is the return percentage on your capital? This only, if you remember, we call it as a ROCE. ROCE as in return on capital employed. How do you get return on capital employed? EBIT divided by capital employed. Since we want the return in percentage, we multiply by 100. So, EBIT is given to be 52 lakh. Capital employed, just now we found it to be 300 lakhs, so 3 crore. Divided by 100 if you do, what is our existing return on the capital we are generating? 17.33%. Currently using the funds we are generating 17.33. The assumption is the new project also will generate the same return. The new project also will generate the same return if they don't give the information. Some problems may in last RTPs and all, they told new project will generate 2% extra. That means instead of 17.33 it will be 19.33. If they don't give any data, what is the assumption? How much extra money you raised? 40 lakh. On that 40 lakh also you will generate how much return? 17.33%. Got it, people? This is the funda. Now you will get, after doing new project, what will be your total EBIT? Can we do it? Everybody understood? Tell me, sir, how much is your new capital employed? Currently, how much capital you have? 3 crore. How much extra fund you took? 40 lakh. 3 crore you already have. 64 lakh extra you took for new project. So what is your new capital? Of 3 crore you already had, 40 lakh you took extra. So total will be 340 lakhs. On capital, how much return you generate? How much is your return on capital employed? 17.33%. You have totally, your capital is 3.4 crore and you are generating a return of 17.33%. Means what is your new total EBIT? 58 lakh 92. I mean, indirectly telling your existing EBIT was 52 lakh. After new project, it has become 58 lakh 92 200. The difference between these two is new project ka EBIT. We don't need new project ka EBIT. We need the total, because you will calculate EPS only for new project or total. Hence, we need total EBIT. Hence, I took new total capital employed multiplied by the rate and I got new EBIT for entire project. Once you do this, aram se more or less things are sorted. Till here, did we understand? So what is the fundamental assumption of this question? Whatever rows as in return on capital employed you are generating currently, the same return you will generate on new project also or new funding also. That's all. Use that and get new EBIT. How much is the new EBIT? 58 lakh 92 200. So option 1 is 100% debt. Option 2 is we have two sources of finance. So one, you can raise the money entire thing as loan, entire 40 lakh through debt. Second option, entire 40 lakh through equity. Now let's work out, because they asked us to find out MPS. No, for MPS we need EPS also, we need a P multiple also. EBIT we have worked out. How much is the new EBIT, sir? 58 lakh 82 200. That will be same. Yes, sir. Okay. Then reduce the interest. Here we have one interest or two interest? Two interest. One, the existing interest. How much is the existing interest? 12 lakh. Whether you go for first option or second option, existing interest will change or same? Same. So reduce 2 lakh at both the place. Then if you, under first option, entire money will come through what? Debt. Now they have brought in a small cash. What cash they bought? Sir, our existing interest rate is how much? 12%. They said if debt equity ratio crosses 35%, then the new debt ka interest rate will be 14%. That means, can we solve directly or first prove this? Prove. So check. Let's take a working note number 1. Sir, if you raise 40 lakh money through loan, what will be your debt equity ratio? Calculate. How do you calculate debt equity ratio? They told clearly in the problem, debt divided by debt plus equity. How much is our current debt to? 1 crore. If you raise another 40 lakh through debt, what will be the total debt, sir? 1.4 crores. What is the total capital employed? Just now we worked out. Total capital employed is 3.4 crores. So out of 3.4 crores, 1.4 crores has come through debt. What is debt percentage? 1.4 divided by 3.4. How much is that, sir? 1.4 divided by 3.4. 41 point something. Correct? Now, what did our question say? If debt divided by debt plus equity, if it crosses 35%, then P multiple will become 8. And new loan, you will get it at what rate? 14%. Since, has it crossed 35%? Yes. That means P multiple will be 8 and new interest rate will be 14%. Any confusion till here? Anybody? Easy? Pakka? Okay. Now, let's go ahead and work this out. Or maybe second option also, we'll work it out. Second option is raising entire 40 lakh through what? Equity shares. What will be the debt to? 1 crore only. Because any new debt came? No. It was 1 crore. No new debt came. That means now also total debt is how much? 100 lakhs only or 1 crore only. What is the new capital employed? 340 lakhs. Now calculate debt divided by debt plus equity. 100 divided by equity, 340 you do. How much is that? 29.41. Did it cross 35 or did not? Did not. If it did not cross means any change? No. PE multiples will still be how much? Market price of the equity shares will still be how much? 25. Correct? Any problem? Now why do I need this? 40 lakh you are raising through what? New equity shares. And what is the price of one equity shares currently? 25. You want to raise totally 40 lakh rupees and the value of one equity shares is 25. How many shares you will roll out? 40 lakh funding you want and price of one equity shares is 25. So how many additional equity shares will you issue? 1,60,000. Because to calculate EPS we need total number of equity shares. So if you want to raise 40 lakh through equity shares means we have to additionally give how many equity shares? 1,60,000 equity shares. Capture this data into the last table and answer is over. Can we do so? Okay. EBIT we have already updated. Will existing interest change or no change? No change. What about new debt? What about new debt interest? Will it come? Yes. For second plan, will there be any new debt? No. So that means interest is also 0. In the first plan, entire 40 lakh is coming through debt. And this debt will carry how much interest rate? 14. You want to raise 40 lakh and the new debt interest rate is 14%. So 40 lakh ka 14%. 14 4s are 56. So 5,60,000 is the new debt interest. From EBIT, if you reduce interest, you will get EBT. Reduce tax at 50%. You will get EAT. There is no preference dividend. So EAT and net income or each will be same. Divided by number of equity shares. So under first plan, are you issuing any new shares or no new shares? What about existing? How many equity shares we had currently? 8 lakh. Will that change or same? So number of equity shares will still be 8 lakh. This is your each. This is your number of equity shares. How much is your EPS? 2.5. Any problem? No? Okay. Sir, under first option, what will be your PE multiple? We have already written. If you go for first option, debt equity ratio has crossed 35%. So PE multiple will be how much? 8. Sir, EPS is 2.58. PE multiple is 8. Can't you find out MPS? How do you find out MPS? These two ka multiplication. That's what I've written here. 3 multiplied by 4. That will be how much? 20.64. Same data, work it out for the second plan. Same. Only data changes number of equity shares. And the second plan, number of equity shares will be 8 lakh. No. How many extra equity shares you issued? 1,60,000. That means number of equity shares will become 9,60,000. This is your each. This is your number of equity shares. So your EPS will become 2.4. P multiple. Did equity ratio cross 35%? No. That means P multiple will still be how much? 10. How did we get 10? It's given in the question. What is our existing P multiple? 10. So it will remain intact at 10. EPS we got. P multiple is 10. These two multiplication will give us MPS of 24.4. Sir, remember in these sort of question, when they ask you decision, when they ask you to decide, you will always decide based on MPS. Because do not forget, what is chapter objective? Maximizing the value of the firm. So always decision will be based on MPS. You will choose that plan with lower MPS or higher MPS. Higher MPS. Among these two, which is higher? 24.4. So you will select which plan? Option number 2. Okay, that is your decision. Done. If by chance, if MPS data is not given, if P multiple and MPS is not given, then you will decide based on what? EPS. Okay, check. If you are not able to find out MPS, decide based on EPS. Otherwise, always decide based on MPS. So, no. Someone is saying, sir, if it is based on EPS, I will select the lower number. EPS stands for what? Earnings per share. You want lower earnings or higher earnings? Higher earnings. The decision rule is always the higher number, not the lower number. Okay. First priority is always for higher MPS plan. If MPS is missing, you will always select that plan with higher EPS, not lower. Always the higher. Done, people. I think, yeah, we are 1 minute. Okay. No. I know that some of you are being seeing stars for a minute. 2 minutes from the top, whatever we have done, quickly will revise for this topic. 2 minutes. Everyone. Chapter name. Capital structure. Overall objective is to maximize the value of the firm. That is one we saw. Then here we have some relevance theory, irrelevance theory. Relevance and irrelevance is based on the debt. Relevance theory is arguing that debt are relevant. By using debt, you can change the value of the firm. Irrelevance theory is saying debt has no relevance to the value of the firm. Okay. Before that, we looked at 3 formulas. Value of the firm denoted by the symbol V is equal to EBIT divided by K. V also is equal to S plus D. S is market value of equity, D is market value of debt. How do you get S, market value of equity alone? E should divided by cost of equity. Okay. Then we saw some theories. That's okay. We'll quickly revise the formula. That is good enough for us. Now, next, excuse me. approach. If there is no tax rate, approach says value of the levered firm and value of the unlevered firm will be same. If there is tax, then value of the levered firm will be equal to value of unlevered firm plus the tax benefit. Okay, great. That is one. Arbitrage process we saw. One is from U to L under surplus cash approach. Again from U to L under surplus earnings approach. Then it is L to U under surplus cash, L to U under surplus earnings approach. Okay. There is a connection. If they give you cost of equity of the unlevered firm, can you find out cost of equity of the levered firm? Yes. How do you get that? Cost of equity of the levered firm is equal to cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into debt into 1 minus tax rate divided by equity. When you do cost of debt in this formula, don't take the actual cost of debt, take the interest rate, because anyway here we are multiplying 1 minus tax rate. Okay, so that is one connection. Then financial break-even point. Financial break-even point means what should be your EBIT so that your EPS will become 0. For only equity plan, 100% equity plan, EBIT should be 0 for EPS to be 0. For only debt plan, EBIT should be equal to interest charges. For only preference share plan, EBIT should be equal to preference dividend divided by 1 minus tax rate. Okay. If you have all the three plans, then EBIT should be equal to interest charges plus preference dividend divided by 1 minus tax rate. Okay. Then we looked at indifference point. Indifference point means you can select whatever plan, both the plans will give you same EPS. Here the comparison, mind you, is only between two plans. Okay, that is one. And how do you get this? EBIT minus I1 into 1 minus tax rate divided minus preference dividend divided by E1. This is equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. At indifference point, select whatever plan, it will give you same EPS. Below indifference point, if your EBIT is below indifference point EBIT, you will always select that plan with higher exposure to equity, because that will give you higher EPS. If EBIT is greater than indifference point ka EBIT, you will always select that plan which has higher exposure to debt, because that will give you higher EPS. Yes, sir. So that's all we decided, or we covered in this particular topic. Thank you. Yes, people, welcome back after the break. So now we will be starting a small topic called leverages. You'll understand hardly 3-4 concepts. That's all at best. Now, leverage means its influence of one financial variable over another financial variable. How one variable influences other. That is what we are trying to study in leverage study. Sir, which variable are we studying, sir? Sir, we are trying to study over here how fixed cost impacts your EBIT, EPS, etc. How fixed cost impacts your EBIT and EPS only we are trying to study. That means leverage is all about fixed cost ka study. If there is no fixed cost, there is no leverage at all. If there is no fixed cost, the entire leverage topic you can cut it off. Okay, because leverage is all about this. Now, there are three types of leverages as far as this topic is concerned. One is OL as in operating leverage, then financial leverage as in FL, combined leverage as in CA. So in all our problems, usually they'll be asking us to calculate this. So there are about 6 to 7 formulas which we need to know and to help us to tackle all our problems. Quickly, we'll run through that. Now, first, OL for operating leverage. Now, you know the order of P&L, right? So just now we studied that leverage study is all about fixed cost. So hence now the expenses are partitioned or segregated into two types. One is fixed, another one is variable, because leverage is all about fixed cost ka study. Hence expenses are categorized as fixed and variable. So the income statement gets redrafted like this. Sales minus variable cost gives you contribution. Contribution less fixed operating cost gives you EBIT. From EBIT onwards it is same. You deduct interest, you will get EBT. Deduct tax, you will get EAT or net profit. Deduct preference dividend, you will get EASH divided by number of equity shares, and finally you will get EPS. Only the EBIT and above portion. We start with sale and end up with the EPS. Okay, sir. Now we do the segregation because leverage is studying about the fixed cost. That's the reason. Now first leverage. What is the first leverage I said? Operating leverage. Operating leverage tries to study the relationship between the topmost number. What is the topmost number in our income statement? Sales and EBIT. Operating leverage is trying to study the relationship between sales and EBIT. Okay, this here to here, that's what I put the arrow mark here. From sales to EBIT, it tries to measure what leverage? Operating leverage. Operating leverage is also known as business risk. Operating leverage measures the business risk because your sales, so your EBIT and all, is influenced by our business decision. Now, if I keep very high price for my product, will it sell? No. So, because we have offered at a very nominal price, many of the people are purchasing it. All that is what? A business decision. So, operating leverage is trying to measure the business risk. Fair enough? Alright. So, what does it measure? I said operating leverage measures the relationship between sales and EBIT. Now, operating leverage is given by the formula contribution divided by EBIT. Or you can remember it as OLC. OL stands for operating leverage, C for contribution, E for EBIT. OLC. Contribution divided by EBIT. Or another way to construct is leverage is all about what study? Fixed cost study. Okay, from here, operating leverage measures only from here to here. It studies only from sales to EBIT. In this number, tell me what is fixed cost. What is the only number for fixed cost? Fixed operating cost. Yes, no? Take one number above fixed operating cost. Take one number below operating fixed cost. You have your operating leverage ka formula. What is fixed cost here? Fixed operating cost. One number above fixed operating cost is what? Contribution. One number below is what? EBIT. What is operating leverage ka formula? Contribution divided by EBIT. That's okay, sir. So this is the formula for operating leverage. Done. Now there is another formula called operating leverage measures the relationship between what? Sales and EBIT. So operating leverage is given by the formula percentage change in EBIT divided by percentage change in sales. These are the two ways to calculate operating leverage. Although this one they call it as DOL. DOL means degree of operating leverage. It is one and the same. Either you can calculate operating leverage using the first formula or second formula. Sir, when to use what formula? Sir, they are given percentage change. To calculate change, we need one data or two data. See, 100 became 120. Can I say change? Yeah, change is how much? 20. To calculate this change of 20, I need 100 also, I need 120 also. That means I need one set of data or two sets. So if two sets of data is given, meaning if 2 years ka data is given, you can use the second formula called DOL. Okay. Otherwise, if only 1 year ka data is given, you will use the first one. Comfortable? Or sometimes what happens, percentage change in EBIT itself, they will give you in the question. Percentage change in EBIT is 50%. Percentage change in sales is 10%. Now can you use percentage formula? Yes. Either percentage directly they will give you, or they will give you 2 years ka data. So in that case, you will use this formula. If only 1 year data is given, you will use the first formula. Comfortable? Okay, this is one. There is another way to calculate operating leverage. This is from costing concept margin of safety. You must have studied in costing margin of safety, MOS. So there is a connection between operating leverage and margin of safety. I proved it in the regular class. Now I'll not go in because for our examination, we need to remember one formula. So I'll leave it at that. Yes. Now, if you know margin of safety, you can also calculate operating leverage. Operating leverage is nothing but 1 divided by margin of safety. If you do 1 divided by margin of safety, automatically you will get the operating leverage. If you want more reference, you can recorded classes by it. Okay, for now I'll not go into proving of the formula. It will become too much. Okay, but all we need to do is remember the formulas. That is good enough. We don't have to know how it is derived. Okay, this is another way to get the operating leverage. 1 upon margin of safety. Now, how do you calculate margin of safety? To calculate margin of safety, we need break-even point. So break-even point also, there are two ways, two components of break-even point we have studied in costing. One is break-even point in units, one is break-even points in value. How do you calculate that? If you want break-even points in units, that's given by fixed cost divided by contribution per unit. If you want break-even points in value, that is given by fixed cost divided by PV ratio. PV ratio as in profit volume ratio. It is nothing but GP percentage. How do you get GP percentage? GP divided by sales into 100. Contribution percentage. No, instead of saying contribution percentage, they are calling it as PV ratio. Tell me, sir, how do you find out contribution percentage? Just like GP percentage, how do you get contribution percentage? Contribution divided by sales into 100. PV ratio ka formula is that only. Contribution divided by sales into 100. Just that instead of calling it as contribution percentage, they have given a fancy name called profit volume ratio or PV ratio. Yes, sir. So this is how you get break-even point. If you want it in units, fixed cost divided by contribution per unit. If you want break-even points in value, then you get fixed cost divided by PV ratio. Okay, sir. Now, why do we need break-even point? To calculate margin of safety. Because how do you calculate margin of safety? Total sales minus break-even point sales divided by total sales. Now, sir, this break-even point is same like previous chapter ka break-even point, sir? No. In the previous chapter, we studied financial break-even point. We studied financial break-even point. This is not financial break-even point. This is, we are studying what ratio? What leverage? What leverage we discuss now? Operating leverage. Operating leverage measures the relationship between sales and EPS. Financial leverage means what should be your EBIT so that your EPS should become 0. Does operating leverage measures relationship between sales and EPS? No. It measures relationship only between sales and EBIT. So this break-even point, what we are referring, no, it's not financial break-even point. It is operating break-even point. Operating break-even point means what should be your sales? What should be your sales so that your EBIT is 0, not EPS. What should be your sales so that EBIT is 0. Not that this and all is required for exam, just for your reference I'm saying, because some students get confused between financial break-even point and this break-even point. This break-even point is not financial break-even point. It is operating break-even point. And operating break-even point ends at what level? Not at EPS, but at EBIT. So what operating break-even point simply means how much should be your sales value so that your EBIT becomes 0. That we are calling it as operating break-even point. Okay, people, these are all some ways to derive the operating leverage. Again, what are the 3 formulas for operating leverage? One is contribution divided by EBIT. Next one, percentage change in EBIT divided by percentage change in sales. Third one, operating leverage is equal to 1 upon margin of safety. To get margin of safety, we need a break-even point. Break-even point, you can find it out in units called fixed cost divided by contribution per unit. If you want break-even points in value, then fixed cost divided by profit volume ratio or PV ratio. That is nothing but contribution percentage. PV ratio is nothing but contribution upon sales into 100. And how do you get margin of sales? Total sales minus break-even point sales divided by total sales. Do this, you'll get margin of safety. These are the few ways through which you can calculate your operating leverage. Any doubt till here, anybody? Okay, I told operating leverage measures the relationship between what to what? Sales and EBIT. What is the importance of leverages? It's one-way shortcut, sir. It's a shortcut. Meaning, let us say your operating leverage is or maybe we'll take this example on. If operating leverage is 2, you calculate operating leverage, you got it as how much? 2, assumption. Okay, what it means is, if operating leverage is 2, then the indication is, if there is one operating leverage measures the relationship between what to what? Sales and EBIT. If operating leverage is 2, if sales increases by chance by 10%, sales by chance increases by 10%, then EBIT will increase by twice. Why twice? Because operating leverage is 2. Sales will EBIT will increase by how much? 20%. If operating leverage is 5 and sales reduces by 10%, then what will happen to EBIT? EBIT also will reduce by how? 5 times. It will be 10% into 5, which will be how much? 50%. If sales reduces by 50%, EBIT will reduce by 50%. So operating leverage is a shortcut way to find out how EBIT will change. Because to calculate EBIT, we have to start with sales. Alright? But through operating leverage value, you can directly get the numbers like that. Okay, now this is a shortcut. And change refers to what, sir? It could be change in the form of increase or it could be change in the form of decrease. Both are considered for leverage analysis. This is the entire thing about, yes, our material is more than sufficient. Okay, yes, we have covered all the questions. So it's okay, it's good enough. Now, operating leverage over. Second leverage, what are we studying? Financial leverage. Financial leverage measures financial risk. Okay. Now, same number. What is the simple form in this? Financial leverage measures the relationship between where operating leverage ended, EBIT. Bottommost number is what? EPS. So, financial leverage measures the relationship between EBIT and EPS. From here to here, financial leverage measures. And this is called financial risk. Okay, now, fine. Okay, this is given with the formula. Financial leverage is given with the formula. Same way of construction. You have to take one number above fixed cost, one number below fixed cost. Here is usually interest rate is what, sir? When you take a bank loan, interest rate is fixed. Take one number above fixed cost, which is what? EBIT. Take one number below, which is what? EBIT. So financial leverage ka formula is EBIT divided by EBIT. Okay, sir. So what about preference dividend? That is also fixed, you know. In our 99% of leverage problem, preference dividend will not be given. So you will be using this problem only. What is what? EBIT divided by EBT. But this formula will work when there is no preference shares. By chance, if there is preference shares, very rare scenario, by chance if there is preference shares, then financial leverage is given by the formula, same EBIT divided by EBT minus preference dividend divided by 1 minus tax. Okay, because there are two components of fixed cost here, no? So this one also has to be triggered over there. This is like same. You remember financial break-even point we covered? Preference dividend divided by 1 minus tax rate. Same wala funda. But this is pretty rare. I've not seen too many cases from this. But usually majority of the cases, financial leverage, you will not have preference shares. So you will use the formula EBIT divided by EBT itself. For all our problem, this also, with this only will usually hold good. But by chance, examiner gets creative and if they include preference shares, then don't use this formula, use of this formula. Okay, sir? That is one. Alright. Now, there is one formula for leverage or two? One is the normal formula, EBIT divided by EBT. Then another one is a percentage formula, construct. Financial leverage measures the relationship between what to what? EBIT and EPS, which will change in a greater proportion. Bottommost number, which is EPS. So what is the formula for financial leverage? Percentage change in EPS divided by percentage change in EBIT. Like this. Okay, sir. If they give 1 year ka data, you will use EBIT divided by EBT formula. If they give you 2 years data, then you will use percentage change in EPS divided by percentage change in EBIT formula. If they directly give you percentage in the problem, then you can use the second formula. Check how they've given. But any which way, whether you use first formula or whether you use second formula, answer will be same. It will not change. These are just a different ways to calculate the financial leverage. And financial leverage measures what risk? Financial risk. Okay? Because if you take debt, you will get interest. If you don't take debt, you will not get any interest. So that is what that leverage, because interest cost is fixed. You know? If you raise new money only through equity shares, interest will not come. But if you raise money through debt, then interest will come. And interest, because of that interest, EPS will get impacted. That is what financial leverage is trying to measure. By taking a finance, your EPS is getting impacted. That is what financial leverage is trying to measure. Easy. 2 down. One more chapter over. Consumption. Then few problems. Chapter also over. Okay, now comfortable. Very simple topic. But yeah, you need to be careful when you're solving the questions. This is your financial leverage. Third one, the last leverage is your combined leverage. Combined leverage measures the relationship between topmost number and bottommost number. What is topmost number? Sales. Bottommost number? EPS. Okay. Now, combined leverage, no, we don't have to use any formula. Combined leverage is given by operating leverage multiplied by financial leverage. You take OL and multiply by FL, you will get the combined leverage. That is one way to calculate the combined leverage. You can also use percentage formula. To use percentage formula, we need 1 data or 2 data? Tell me, sir. Combined leverage measures the relationship between what to what? Sales and EPS. Construct the formula. Combined leverage is given by percentage change in EPS divided by percentage change in sales. That is one. Either they will give you 2 years data or they directly give you the percentage. If they give, you can use this formula. Otherwise, you can use OL into FL to get the combined leverage. OL is business risk. FL is financial risk. CL is total risk. Combined risk or total risk. That's a fund. Okay. For your problem perspective, I'll tell you a few points. Keep this in mind. Sir, these 3 numbers, no, they'll play around with the questions. That's the reason I'm stressing this point. These 3 numbers will always go hand in hand. These 3. Meaning, if sales increases by 10%, variable cost also will increase by 10%. Contribution also will increase by 10%. I proved this in my regular class. Now again, I'll not go for it. Just remember that's good enough. So these 3 will always change in same proportion. If one increases by 10% means all the 3 also will increase by 10 only. If one reduces by 5% means all the 3 will reduce by 5%. That is. Similarly, from here to here, EBT to EPS, they all go hand in hand. Meaning if EBT increases by 10%, EPS also will increase by 10%. Again, if you don't agree with my wordings, take this format, go assume some random numbers and try to prove what I'm saying. It will work. Okay, now I don't have time, so I'll not go into the proving part of things. Yes, people, why I'll tell you this equation. This is tested, this particular component of connection is tested in many problems, especially examination question. I'll solve one question also to kind of connect what I'm trying to say here. Comfortable? Now, or maybe this one I'll explain. I said what? EBT and EPS will go hand in hand. The reason is in this in all this, in all this problems, where preference dividend will not be there. Preference dividend will not be there. So tax is a fixed cost or a variable cost? Tax is fixed cost. I am telling to the government I will pay 10,000 rupees tax every year. Will they agree? Or it is based on my income? Based on my income. If I earn more, I have to pay more tax. If I earn less, I will pay less tax. So tax is a fixed or variable payment. That means the only component between here to here which is fixed is what? Preference dividend. In all of our 99.99% of our problems, preference dividend will not be there. So that means what, sir? All these will change in a proper proportion. Okay. So keep this in mind. Whether they tell EBIT increases by 30%, it is as good as saying EPS also has increased by 30% only. I'll apply it in one question maybe to get a little better understanding. Okay, so this is about your problem. Fine, this is okay. Financial leverage is a double-edged sword, they say. Sir, financial leverage measures what risk? Financial risk. Now, sir, debt is a risky affair. Do you agree with me? Taking a debt is a risky affair. Do you agree? Like taking a bank loan is quite risky. Why? Whether you earn profit or you don't earn profit, to banker you have to compulsorily make interest payment, EMI payment. If you don't pay, what will they do? They will come back to the premises and seize whatever assets. So it's a risky affair, correct? That is what they say. Financial leverage is a double-edged sword, meaning taking a debt is a double-edged sword, meaning it has benefit also. Double-edged sword means on one sword, talwar. On one end also it is sharp. They're saying double-edged sword means on one end also it is sharp, second end also it is small. That means what? You can do like this also to others. You can do like that to yourself also. Okay, so that's what it means, that there is some advantage also, there is some disadvantage also. That is what they mean by double-edged sword. What is the advantage of debt? One advantage is compared to equity, debt is a cheaper source of finance. And on debt, you get some benefit called tax benefit. Advantage. Disadvantage? Sir, obviously, debt can create some scenario called financial distress. Financial distress means it's a scenario, you must have learned it in chapter 1, where outflow is greater than your inflow. Suppose every month your outflow is 2 lakh, but we are earning only 1.5 lakh rupees. Our inflow is only 1.5 lakh. Every month, how much payment we need to make? 2 lakh. This scenario we call it as financial distress, meaning outflows or our inflows are not sufficient to pay our outflows. Such a scenario we call it as financial distress. If this financial distress goes on for a long period of time, what will happen to organization? It will survive or damar? Damar, meaning it will get insolvent. Okay. So how is this relevant? Sir, debt is a what? Risky affair, because whether you earn profit or no profit, you have to compulsorily make interest payment. So if you have to compulsorily make interest payment, whether you have inflow or not, outflow is pukka. So that can create one scenario called financial distress. If this financial distress goes for a long period of time, the firm can eventually become insolvent. Okay. So all that is okay. Some advantage, disadvantage you need to write there. That's what we mean by financial leverage is a double-edged sword. Sometimes the 2 marks the theory question they ask. Great. Trading on equity. Trading on equity means, don't be misled by the word. Trading on equity means you are using fixed cost instrument along with equity. You want money. Let's say you want 40 lakh rupees money. You have an option. You can raise the money through equity shares. You can raise the money through debt. You can raise the money through preference shares. Trading on equity means, let's say I take 10 lakh rupees through equity, 30 lakh rupees through debt. Preference shares I don't prefer usually, because on preference shares the payment is fixed, dividend is fixed, but you don't get the tax benefit. So compared to preference shares, which is better? Debt plan. That's the reason we said debt plan will dominate preference shares plan, because on debt plan we have one benefit, extra benefit called tax benefit. Okay. Now this scenario we call it as TOE, as in trading on equity. Trading on equity simply means you are using a fixed cost instrument. Your funding is arranged through fixed cost instrument. Now tells it, on equity, is there any fixed cost? Every month I have to pay dividend. Like that, is there any fixed cost or no fixed cost? On debt, is there any fixed cost? Yes. Every month, every quarter or every year I have to pay interest to the banker. And how much interest I have to pay is also fixed. So I'm using debt also. I'm using equity also. And debt is a fixed cost instrument. Using fixed cost instrument along with equity. That scenario only we call it as TOE. TOE means trading on equity. And the proportion of debt, will be higher when compared to proportion of equity. We'll use higher debt proportion than compared to equity. Such a scenario we call it as trading on equity. Yes, sir. Now, why do we do this? It's simple. Let's say our sales is, let's say our EBIT is 50 lakh. From EBIT, we have to reduce interest. Let's say interest is 30 lakh rupees. So, how much is earnings before tax? 20 lakhs. Correct now. This year, my earnings is EBIT is 50 lakh. Next year, no sir, bumper. My earnings is 500 lakhs. Full it increased. Now, what about interest payment? It will increase by this. See, 50 lakh became 500 lakh. Interest also from 30 lakh will become 300 lakh or same. What happened to my EBT? From 20 lakh, it became 470. Isn't this a good scenario? Yeah. Because what? Interest is a fixed payment. When you freeze your fixed payment, now calculate, sir. Let's say tax is nil for assumption purpose. So how much is each? Let's say preference shares is not there. How much is each? Here it is 20 lakh, here it is 4. That means by using debt in your finance, your each value is same or each value is increasing. Each value is increasing. That scenario we say trading on equity. You are using more debt so that your earnings for equity shareholders will increase. Such a scenario we call it as what, sir? Trading on equity. So basically, in simple words, using fixed cost instrument along with equity, and the fixed cost instrument ka proportion will be greater than equity. Such a scenario, trading on equity, again 2 marks ka theory question at best can come. We don't have any practical problem on this. Now this and all we have covered. Yes, no sir? All this we have covered, so this is fine. Okay. Now 2-3 equations I will tell, which is relevant for problems, the problems which we are about to solve. Keep this in mind whenever this equation plays out. Most probably, whatever I'm saying over here, if you apply, it will work. One common adjustment which they usually ask in examination is, they will give you financial leverage in the question. Financial leverage will be given to you in the question. Along with that, interest also will be given. Along with that, interest. This is a good combination with the examination. So how do you get financial leverage? EBIT divided by EBT. Now once again, how do you get EBT? Can you tell me? From EBIT, if you reduce interest, you will get what, sir? EBT. Any problem? Now you can do the substitute. Financial leverage is given to you in the problem. Interest is also given to you in the problem. So instead of writing financial leverage is EBIT divided by EBT, I will substitute. How do you get EBT first of all? How do you get EBT? EBIT is 1 lakh. Interest is, let's say, 10,000. How do you get EBT? 90,000. How did you get this 90,000? Tell me in equation. EBIT minus interest. That means, can I say EBT is nothing but EBIT minus interest? So substitute. Numerator will be EBIT only. Denominator instead of EBT, substitute with EBIT minus interest. Because financial leverage given to you in the problem, interest given to you in the problem. By doing the substitution, you can easily find out EBIT. This is one good combination of examination. Almost many questions uses this. So be aware of this. We'll also take up one question. Okay, Zaru. This is one good combo. There is another combination relating to operating leverage. So how do you get operating leverage? Contribution divided by EBIT. Okay. We'll take up the order. From sales, if you reduce variable cost, what are you going to get? Contribution. From contribution, if you reduce fixed operating cost, what are you going to get? EBIT. Comfortable? Now in this combinational question, what they will do is, they will give you fixed operating cost and they will give you operating leverage. Operating leverage will be given to you in the question and fixed operating cost will be given to you in the question. Now we have to do a substitute. Tell me again, what is the normal formula for operating leverage? Contribution divided by EBIT. Tell me, sir, can you calculate EBIT through an equation? Instead of EBIT, what you can write? Perfect. From contribution, if you reduce FOC, you will get EBIT. I mean, instead of EBIT, can I write contribution minus FOC? So how do you get operating leverage? Contribution divided by EBIT. So instead of EBIT, now I will write what? Contribution minus FOC. FOC will be given to you in the question. OL will be given to you in the question. So through the substitute, you can find out easily contribution. So these two are very good combination, which usually they use in examination. So be aware of them. That's what I've written over here. Comfortable, Asaru? And one more is, sir, leverage topic will not be straight away given to you in the question. They'll not give you some data and say calculate OLFLCL. It will be a missing figure identification wala problem. What the popular question, a way of asking leverage question is, they will ask you to prepare income statement. They will ask you to prepare income statement. Income statement means you will start with the sales and you will end up with the EPS. This they will ask you to prepare. And in this, many component will be missing. You need to figure it out. Okay, now even if they don't ask income statement, They will ask some data. They'll say directly calculate EBT or they will calculate EPS, like that. They will ask you. What the best way if you are stuck? If you feel you solved enough, now you feel you are stuck in leverage question. You don't know how to proceed. If you are stuck, one quick way to come out of that is put up an income statement as a working. Whether they have asked or not, just put up a income statement. That will give you some guidance. How I'll tell you in one problem. Okay, this by preparing this, you will be able to tackle a few adjustments. I'll see how. So these are some things you need to keep in mind. That's all with respect to the concepts relating to leverage. Can we take up a couple of questions just to see what we have learned? Okay, so let's take up question number 9. 1 or 2, 3 questions are there over here. That's it. Okay, pretty straightforward chapter. Capital structure of PS Limited for the year ended 31st March 2021 consisted of following. Equity share capital face value is 100 and the amount is 10 lakh. 10% debentures of 100 each, which is 10 lakh. Okay. During the year 2021, sales Inc. decreased to 1 lakh units compared to 1,20,000 units in the previous year. Last year it was 1,20,000 units. This year it is only 1 lakh units. Selling price is 12, variable cost is 8. That means easily you can calculate sales and variable cost for both the years. Fixed expenses were 2 lakhs. So whenever they give you fixed expense in these sort of problem, always take it as FOC. FOC means fixed operating cost. Fixed operating cost will always be excluding interest. See, interest is also fixed cost. That fixed cost will not be included in FOC because interest cost will come as part of finance. Fixed operating cost means it only measures the relationship between sales and EBIT. Interest will come much later. Okay, always when they give you fixed expense, take it as FOC. FOC means fixed operating cost, meaning this number will be including or excluding interest. Excluding the interest. How much is that? 2 lakh per annum. Income tax rate is 30%. Find out degree of financial leverage. Sir, they will ask degree of financial leverage or they will say financial leverage. It is one and the same. Just because they've used degree of financial leverage, don't think that we have to use second formula only. No, you can use anything. Okay, it is one and the same. You have to find out at 1,20,000 units and 1 lakh units. This mic is not that comfortable. Okay. Okay, degree of operating leverage at 120 and 1 lakh units and the percentage change in EPS is what we need to find out. It's a very straightforward question actually, but for some reason this question is repeated quite a few times. So I thought I'll just quickly run this question with you. So now to calculate operating leverage, operating leverage, what do we need? Contribution and EBIT. To calculate financial leverage, we need EBIT and EBT. Yes, no? So that means let's calculate that. So have they given or we need to calculate? We need to calculate. We'll start from sales. First, this is what, sir? 1,20,000 units was in the previous year. 1 lakh units is in the current year. Okay. What is the selling? Number of units you sold last year is how much? 1,20,000. What is the selling price per unit? Selling price is 12. 1,20,000 units into 12 you do. How much you going to get? 14 lakh, 40,000. That is your sales minus variable cost. 1,20,000 units and the variable cost per unit is given to be 8. 1,20,000 into 8 you do, you will get 9,60,000. Sales minus variable cost gives you contribution. Same thing you do it for 1 lakh units also. Okay now? Let's fixed operating cost. How much is fixed operating cost? Where is that? Question, or maybe I've solved it over here. Alright. So fixed operating cost is given to be 2 lakhs. Yes, no? Anyway, I'll take care of it. Minus fixed operating cost you'll get EBIT. So do we have any interest? Do we have any interest in the problem? Yes. Debenture value is 10 lakh and we have 10% interest rate. So what will be the interest? 10 lakh or 10%, which is 1 lakh. So 1 lakh interest you reduce, you'll get EBT. Tax rate is given to be 30%. So you get EAT. In these sort of problem, preference dividend will not be there. So EAT itself will become your EAT or net income. Divided by number of equity shares. Equity share capital how much? 10 lakh. Each ka face value how much? 100 rupees. So how many shares? 10 lakh divided by 100 if you do, you will get 10,000 shares. So calculate. If you do, you will get EPS of 12.6 and 7. Okay, now I've just started from sales and worked out till EPS because they also ask percentage change in EPS if you just check. Sir, this is what? Previous year. Last year, how much was EPS? 12.6. Now it has become how much? 7. So it has changed now. Yes. From 12.6, it has become 7. How much it has changed? It has reduced by 5.6. They did not ask change amount. They asked percentage change. How do you calculate percentage change? Change in amount divided by original amount into 100. The change amount divided by original amount into 100. How much it changed? These two minuses how much? 5.6. Original amount means previous year. Previous year, how much it was? 12.6. If you calculate this, you will get how much? 44.44%. So compared to last year, our current year EPS is reduced by 44.44%. One requirement. Easy. Then they asked operating leverage. How do you get operating leverage? At both the level, they asked operating leverage. Contribution divided by EBIT. 480 divided by 280. If you do, you will get operating leverage for last year. Current year, how much it will be? 4 lakh divided by 2 lakh. So if you do that, you will get operating leverage of 2. Similarly, financial leverage, how do you get? EBIT divided by EBT. EBIT is 280, EBT is 180. If you're confused with the formula, it's simple trick is take one number above fixed cost, one number below. That's all. That's why even if you forget the formula, you can reconstruct on your own. So 280 divided by 180 and 2 lakh divided by 1 lakh. If you do that, you will get the financial leverage. If they ask combined leverage, multiply the 2. But it's been not asked, so it's okay. Very straightforward question, but still a little popular in examination. One down, another 2 or 3 more. Can we look at it? Trading on equity is simply using more debt compared to equity. That's all. Okay, you are using more debt because on the debt you pay variable interest or fixed interest. Whether you earn more also, you will pay same interest. So by using debt, you can earn more each. Each value will increase. Each belongs to whom? Equity shareholders. By using debt, you are creating more value for equity shareholders. Such a scenario we call it as trading on equity. Simply using debt along with equity. But debt ka value will be on the higher side compared to equity. That's okay. Which one? That is also there because trading on equity means I told using debt or using fixed cost instrument. Though I said here word debt, usually we use, you only think logically, finance manager will prefer preference shares or debt. Debt. Why debt? You get one extra benefit. See, preference dividend is also fixed. Interest rate on debt is also fixed. But on dividend on debt, you get tax benefit. On preference dividend, you don't get tax benefit. Hence, in these sort of problem, usually in majority of the problem, preference shares will not be there. We'll have only debt. So that's the reason I'm using the word debt. Actual trading on equity means using fixed cost instrument. Which instrument carry fixed cost? Debt also, preference shares also. Okay, like that it means. But explanation sake, I think we can stick to debt. Move on. Okay, next question number 10. This is a good question. Be careful on this question. Sales of TM Excellence, sales revenue of TM Excellence is 20 per unit. Per unit ka selling price is 20. Output is rupees 20 lakh. Not in volume. Output they have given in rupees 20 lakh. That means the total sales itself is 20 lakh. Contribution is how much? 10 lakh. Contribution is given. Great. At present level of output, DOL is 2.5. Great, no sir. How do you get operating leverage? Contribution divided by EBIT. Operating leverage given? Yes. Contribution given? Yes. That means EBIT can't we find out? That is the first working. OL is contribution divided by EBIT. How much is OL given? 2.5. Contribution given is 10 lakh. EBIT don't know. Find it. If you do work it out, you will get EBIT to be 4 lakh. Easy now. Okay, let's proceed further. What have they told next? Company does not have any preference shares. Even if they don't mention anything, still we will assume that preference shares is not there. The number of equity shares is 1 lakh. Great. Applicable corporate income tax rate is 50%. The rate of interest on debt capital is 16%. Okay, keep that in mind. What is EPS? They have asked EPS. At sales revenue of 20 lakh, an amount of debt capital. They are asking you the value of debt. Interest rate on debt is how much? 16%. Amount of debt given or missing? We have to calculate. How do we calculate value of debt? We already know this. Interest amount divided by expected interest rate. Here expected and actual is same. Now check, this line is very important. You need to find EPS and debt capital. If 25% decline in sales, meaning if sales reduces by 25%, it will wipe out EPS. Wiping out EPS means it will become 0. So let's say EPS was 2 rupees. EPS was 2 rupees. If sales are reduced by how much? 25%, it will wipe out EPS means EPS will become 0. Okay, that means what is the change? From 2 it became 0 means can I say it is a 100% change? Because from 2 it has become 0 means that means the EPS is reduced by 2. 100% EPS has changed. Can I say so? Is my statement right? Okay, now you tell me, sir, which leverage measures the relationship between sales and EPS? Why am I saying that? Because they only said sales and EPS. Which leverage measures? Combined leverage. How do you get combined leverage? What one is that? Now using sales and EPS formula, tell me, how do you get the combined leverage? Percentage change in EPS divided by percentage change in sales. Percentage change in sales, they only given to be 25. And they said EPS will get wiped out. Wiped out means it will become 0. Whatever. If it is 5 means from 5 it will become 0. If it is 10 means from 10 it will become 0. That means EPS will reduce by how much? 100% indirectly. Yes, no? That means the change in EPS is how much? 100. Percentage change in EPS is 100%. Percentage change in sales is 25%. Calculate this. How much is combined leverage? Indirectly in this problem, they have given combined leverage to be 4. Easy. Yes. Now, sometimes in the problem, they will play around with your mind tricks. Instead of EPS, they will say it will wipe out net profit. They have done this in the previous papers, RTP papers. Instead of EPS, they will use the word net profit, or they will use the word EAT. EAT is rare, but they will use the word net profit. That is the reason, if you remember in the chart, I told from EBT up till EPS, everything will go hand in hand. If 100% wiped out, if there is a change in EBT, means there will be 100% change in EPS also. If they say that net profit has reduced by, net profit will get wiped out means net profit has reduced by 100%. EPS also has reduced by 100%. So keep this in mind in the problem. They've started playing this in a lot of questions. So instead of saying EPS is wiped out, they will say net profit has wiped out. If net profit has wiped out means it is as good as saying EPS also has wiped out. Instead of net profit, even if they use word EBT, then it is the same impact. If EBT reduced by 100% means EPS also reduced by 100%. That's the reason I'm saying all this will go hand in hand. Keep this in mind. Okay, sir. They've used this equation a couple of times in exam. But we have done this, we are aware of this. Correct now? Can I move forward? Now, this is one. We got, now check, sir. Operating leverage, you know. Combined leverage, you know. Can't you find out financial leverage? Because there is another way to get combined leverage. What is that? Operating leverage multiplied by financial leverage. Combined leverage, you know. Operating leverage, you know. Can't you find out financial leverage? How do you get financial leverage? Combined leverage divided by operating leverage. Do that, you will get financial leverage. Easy. Now, using first working out, you found out EBIT. How do you get financial leverage? EBIT divided by EBT. EBIT you already know. Financial leverage, just now you got it. That means can't you find out EBT? So how do you get financial leverage again? EBIT divided by EBT. Financial leverage you got. EBIT you got it in first working note only. So how much is EBT when you solve? 2,50,000. If you have this much means your EPS aram say you can do it. Okay, we don't have to start with full number. We can start from, if you want, you can start from top. Here anyway you know EBIT, you know, because did they ask you income statement or EPS? In fact, what is the requirement check? They ask you EPS. So we'll start from what, sir? Whatever data is given. We'll start from EBIT. How much is EBIT given in the question? Or how much did we work it out to be? 4 lakh. So this is 4 lakh. Do you know EBT? Do you know EBT? Yeah, we worked out EBT also as per working note number 3. How much is that? 2,50,000. So giving a reference, this 2,50,000 we got it from working note number 3. This one we got it from working note number 1. Sir, this is 4 lakh. This is 250 means how much is interest? From 4 lakh you have to deduct something so that it becomes 250. So how much is that? 1,50,000. How did you get that? I've showed it here only. 4 lakh minus 2,50,000. If you do, the interest will be how much, sir? 1,50,000. Any problem? Sir, why are you finding? I'll tell you. Okay, then reduce tax. Tax at what rate? 50%. You will get no preference shares, no preference dividend. So each will become 1,25,000. Number of equity shares is given in the question. How much? 1 lakh. So divided by number of equity shares, you will get EPS. EPS is one of the requirement. Any doubt here? There's one requirement. Easy, comfortable, everyone? Now they asked you value of debt capital. They ask the value of debt. How do you get value of debt? Interest amount divided by expected interest rate. Now you already know interest amount. How much is that? 1,50,000 divided by interest rate. Interest rate is how much is given in the question. Check. The interest rate on debt is 16%. Interest amount is 1,50,000. Interest rate is 16%. Means how much is the debt value? 9,37,500. That's all the requirements done. Okay. So that way, whenever you are stuck, put up this income statement. That's what I said. See, because easily you will be able to find out the interest. Now, when you solve naturally, see, how do you get interest? If I give you this, can you find out interest? Yeah. But if I say don't prepare income statement, without preparing income statement, will you arrive interest? No, you will be cracking your head. How, why, and how. But the moment you put this income statement, this is straightforward. This is 4 lakh and this is 250 means interest has to be how much? 150. So it becomes 1 minute exercise. That is the reason whenever you are stuck, I would always suggest putting up income statement. It will give you the answer like that. Done, G. This question over G. Awesome. 2, 4, 5, 6 weightages, 25 marks it seems. Great. So that means 25 marks in our pocket. Great. Next. Okay, this is also one good question. Easy question, but good on the presentation side of things. See this. Calculate operating. I can take another 15 minutes. Okay with you, no? Another maybe two questions, maybe. I'll try. Fine, fair enough. Okay, calculate operating leverage, financial leverage, and combined leverage from the following data under situation 1 and situation 2, financial plan A and financial plan B. 2 situations, 2 plans. That means we need to work out for 4 times. You can work out 4 times, or there are some changes of presentation you can do and get the answer faster. Installed capacity is 4,000 units, meaning you have a capability to produce 4,000 units. But actual production and sale is only 75%. Okay. Just because we can produce 4,000 units, should we compulsorily produce 4,000 or it is based on demand? Based on demand. Currently, maybe we have only demand for 75%. That means 4,000 ka 75% is how much? 3,000. So we have produced and sold only 3,000 units. Selling price is given, variable cost per unit is given. I mean, easily you can find out total sales and total variable cost. Sir, fixed cost. When they say fixed cost, it means FOC. FOC means fixed operating cost, meaning excluding interest. If it is situation 1, FOC is 15,000. 1 minute, I'll take this off. It's freaking a little. I'll have to change that mic. Okay. If it is situation 1, fixed cost is 25,000. If it is situation 2, fixed cost is 20,000. Now they said capital structure. Capital structure means the way we can raise the finance. We have 2 plans. If you go for financial plan A or you can go for financial plan B. If you go for A, you will raise equity of 10,000, debt of 10,000. Total will be 20,000. If you go for plan B, total money is required is 20,000 only. Out of 20, 15 will come through equity. Debt will come only to the extent of 5,000. So debt and equity will vary based on the plan. For this data, you need to calculate OL, FL and CL. Easy question, just the presentation. Check how I'm going to present. First, observe the question. Operating leverage measures relationship between what to what? Sales and EBIT. Now, based on financial plan, interest will vary. Do you agree with me? Because if you go for financial plan A, debt will be 10,000 and interest rate will be calculated on debt amount. So this here is 10,000, here it is 5,000. So based on the plan, interest will vary. Agreed? But for operating leverage, we want interest? No. Operating leverage measures relationship between only sales and EBIT. Interest comes much later. That means financial plan, does it have any impact on operating leverage or no impact? Financial plan impacts only interest and we don't need interest for OL. So that means, but will financial leverage or operating leverage get affected by FOC? Yes, because how do you get income statement? Tell me. Sales minus variable cost is contribution. Contribution minus FOC gives your EBIT. If your FOC changes means your operating leverage also will change. That means based on fixed cost, your operating leverage will change. And if it is situation 1, fixed cost is 50. If it is situation 2, fixed cost is 20. So I will present this data situation wise. Situation 1, situation 2. How much is sales? How much of capacity you have? 4,000. But you are producing only how much? 75%. 4,000 ka 75% if you do, you will get 3,000. What is the selling price per unit? 30. So multiply by 30 per unit, you will get total sales. Minus variable cost. Same way. 4,000 units you have capacity, but you have produced only 75%. What is variable cost per unit? 15. So multiply 15, you will get total variable cost. Same under both the cases. Less fixed operating cost. Fixed operating cost will be same? No. For situation 1 it is 15. For situation 2 it is 20. So here it is 15, here it is 20. So how much is your EBIT? That number. Now how do you get operating leverage? Contribution divided by EBIT. So basically 45 divided by 30 gives you OL of 1.5. 45 divided by 25 gives you OL of 1.8. This is calculating operating leverage situation wise. Financial plan has no impact on operating leverage. Yes, sir, people. Now the second one, they asked only operating leverage or also FL and CL. FL, I'll change the modification. I'll not present it situation wise. We have only situation or we have also plan. What are the two plans? A and B. I will present OL, FL and CL on a financial plan A, financial plan B basis. Okay. But they asked only for financial plan A or also situation wise. Situation wise. Let your heading be financial plan A, you can calculate this in multiple ways, by the way. I'm just showing you the way which probably can get your answer a little faster. So financial plan A, financial plan B. You have to also calculate it situation wise. So first situation I'll calculate. Now what I'm doing, if it is first situation and if it is financial plan A, what will be FL? If it is first situation, if it is financial plan B, what is your FL? Like that I'm trying to calculate. Yes, people. Now you tell me for FL I need two data. What are those? EBIT and EBT. Now we have already calculated. Careful. If it is situation 1, what is our EBIT? This is situation 1. For situation 1, our EBIT is 30,000. This is your situation 1. Here also 30, here also 30, because second situation will come later. Okay, now I'm pressing the data what wise? Plan wise. So here, if it is situation 1, we have already worked out EBIT will be how much, sir? 30,000. Copied at both the places. Minus interest. If it is plan A, how much debt you will raise? 10,000. What is the interest rate? 20%. Calculate 10,000 ka 20%. How much is that? 2,000 rupees is your interest. Correct? If it is plan B, how much debt you will raise? 5,000. 5,000 ka 20% is how much? 1,000. So reduce 1,000 over here. So you will get EBT of 28 and 29. That means now can you calculate financial leverage? Yes. It's given by EBIT divided by EBT. 30 divided by 28 is 1.07. 30 divided by 29 is 1.03. Any problem? This is plan A and plan B. But we have calculated so far only for situation 1. There's only one situation or 2. Now calculate for second situation. Situation number 2. If it is situation number 2, what is your EBIT? You already calculated. EBIT, this is situation 2. How much is EBIT? 25,000. So now you take situation 2. If it is situation 2, EBIT will always be 25,000. Less interest. Interest we already calculated. 2,000 and 1,000. Reduce that. You will get EBT. Using these two, you find out financial leverage. Like this presentation. Any problem? No calculation. This is a good question on presentation. In fact, last RTP September 24 question, if you open, they have given 3 plans, 3 situations. Just the way of presentation. Same presentation, one more column will come. If you want, you can take that question and practice for your reference. Then, in our study material, 2 plans are there. In one of the RTP, there are 3 plans, 3 situations. Then, now the last one is combined leverage. Combined leverage also same presentation as FL. FL, how are we presenting? Tell me. Financial plan A, financial plan B, and then situation 1 and situation 2. So let's calculate combined leverage in the same way. Financial plan A, financial plan B. First for first situation. Now be careful. If it is first situation, how much is OL? Because how do you get combined leverage? Operating leverage multiplied by financial leverage. If it is first situation, operating leverage will be how much? 1.5. Right? Operating leverage is not impacted by financial plan. It is only impacted by situation. If it is first situation, operating leverage will always be how much? 1.5. This is first situation. No? So operating leverage here also will be 1.5. Here also will be 1.5. Yes, sir, because operating leverage is impacted by financial plan or no impact? No impact. Like that. So copy of operating leverage data. Yes, sir. We need only OL or also FL? FL. Now figure it out. Financial plan A is this. Situation 1 is this. What is financial leverage? 1.01. If it is financial plan A, if it is situation 1, financial leverage will be 1.07. Now we are working that only. Plan A, situation 1. So what is FL, sir? Here we got it. 1.07. Copy that. Yes, sir. These two multiplication will give you combined leverage. Same scenario. If it is plan B, if it is situation 1, what is financial leverage? 1.03. Operating leverage we have already copied. Financial leverage you multiply 1.03, you will get combined leverage. This is for first situation. Now we will take up the second situation. If it is second situation, what is your, if it is second situation, what is your OL? 1.8. Will operating leverage vary based on financial plan or no impact? No impact. So how much is operating leverage for second situation? 1.8. This is your second situation. Operating leverage will be 1.8 and here also it will be 1.8. We got OL. We also need what, sir? FL. If it is financial plan A, if it is situation 2, what is your FL? 1.08. Check, have we multiplied 1.08? 1 minute. Here have we multiplied 1.08? Yes. Now, if it is second situation, if it is financial plan B, what is financial leverage? 1.04. Check, have we multiplied 1.04 here? 1.04. Multiply, you'll get the answer. Pure presentation technique, nothing to be worked out. Every data is given to you in the question there. Yes, our people? Okay. Awesome. Hungry, yeah. Okay. You be hungry, macha. One more I will do and then we will probably, yeah. I think this should be good. This one maybe I'll do it. Nah. Don't worry. Tomorrow I said no. Today stretching. Tomorrow, pakka. Before 8 only it'll get over. Pakka. Okay, because only two topics. Aram se. I'm thinking 7:30 only it'll get over. Okay. But it's okay because the topics are little lengthy, so I wanted to keep a less weightage. I mean, less hours for those topics. So no problem. Thank you for your patience, by the way. Even online also, many people are still sticking around. So that's nice to see. Even though you know that this video is going to be available on YouTube, still you are sticking around. So thank you for that. You people also, probably Papa, you're waiting while I miss my bus and all. Someone is eating only here. No issues. Aram se you have. I'm not that kind of person. Okay. If you are hungry, I don't mind. You can open whatever and eat. As long as understanding is happening, I'm absolutely okay. Okay, let's start off. From the financial data of company A and company B, prepare their income statement. So this is a pure question on income statement. Just 1 minute. You remember I discussed one shortcut. What is that? One, they will give you financial leverage. Another one, they will give you interest. So there you need to be aware on the substitute. So check. Here you need to prepare income statement for company A also, company B also. Variable cost they've given, great. Fixed cost they've given, great. Interest is given. Financial leverage is given to be 5:1. 5:1 is nothing but 5 divided by 1, which is how much, sir? 5. That's as good as saying financial leverage is 5. Financial leverage is 5. So just now we discussed financial leverage is given, interest is given. I mean, should we have to do any substitution work? Yes. By doing substitution, we will get EBIT. Okay now. So can we calculate? Income tax rate is 30%. So first let's calculate this. How do you get financial leverage, sir? EBIT divided by EBT. EBIT divided by EBT. Now instead of EBT, what will I write? EBIT minus interest. Now financial leverage is given, interest is given. How much is interest? 14,000. So you substitute and this way you will be able to get EBIT. How much is EBIT if you solve? 17,000. Fine. Comfortable, huh? And also one more thing you do is when they ask you income statement, no, have income statement ka format. From sales you start. They have not asked EPS, so you can stop at ish. You can stop at ish. Have the format ready. And what one way I usually recommend in my regular classes, when you're doing income statement, no, first they ask for company A and they also ask for company B. Along with that, have one working columns also. If it is very straightforward working, we'll do it here only. If it requires some extra calculation, we will put up a separate working. This way, we can do both parallelly. This is what the majority of my problems in regular class I've solved like this. Same goes for company A, same goes for company B. First check and update whatever data is given. They've given variable cost, they've given fixed cost. So update that. Variable cost, where is it? Here. This is given. Then they have given, maybe I'll tick off this here. Variable cost given. Next is what? Fixed cost of 26,500 also given. This is okay. 26,500 is also given. Done. Okay. Just now we worked out working note number 1 through financial leverage. What did we find out? EBIT. How much is that? 17,500. 17,500. We got it from working note number 1. Any problem? Now you see from here to top, yes, working income statement is done. This is 17,500. This is 26,500. That means how much has to be contribution? From, see here, this is 17,500. This is 26,500. So how much should be this? Obviously, if you add these two, you will get contribution. Correct or no? That's what I've shown here. It's a simple calculation. No? Why to put up a working note? Show it here only. So 17,500 plus 26,500 if you do, you'll get how much? 44,000. Because only from 44,000, if you reduce 26,500, you will get 17,500. So this is done. Correct? Now this you know. Can't you find out sales? How will you find out sales? These two ka addition. 44 plus 88 if you do, you will get sales of 1,32,000. From here till top, everything is done. Manageable. It just came in 2 minutes. If you don't put up income statement even as a working note, sometimes you will not figure out all this. That's the reason it's good. But here though, you have to put it up because that is a requirement. Like I'm just saying, even if you're getting stuck, always let your mind run through those three equations. Two equations I told plus income statement. Keep this in ready, so that should guide you in a big way. So EBIT is given. Okay, great. Next, so interest is given now. Yeah, interest expense is also given to be 14,000. Means below statement is also done. From EBIT, if you reduce interest, you will get EBT. Tax is already given. How much is tax rate? 30%. So reduce tax rate, you will get EAT. Preference dividend is not there, so net income is 2457. So whole income statement of company A was relying just on one working note. Financial leverage ka substitute. The whole problem got over. Done now. This is for company A. Any problems? Next for company B, they have given 50% of sale. Yeah, these are RTP only, correct. Some questions are RTP only. This is an RTP May 2024 question. I'm taking a more concept oriented question. I'm not worrying about whether it is RTP, MTP or study material. For my concept, for my marathon, whatever I feel that it is more appropriate, those questions I'm picking up. Alright. Now, simple trick is first update whatever data is given. For company B, what and all is given? Interest expense is given, EBIT is given. So let's update that. Interest is how much? 11,000. EBIT is how much? 14,000. That means from here to below, everything you can fill it up. From EBIT, if you reduce interest, what will you get, sir? EBT. Tax rate is already given. That means you will get EAT. Preference dividend is not there. So net income is over. Done now. So only the top portion you need to figure it out. Can we do it? Check what is missing. What they gave? They gave margin of safety. Sir, we know that there is a linkage between margin of safety and operating leverage. How do you get operating leverage? 1 divided by margin of safety. Margin of safety is 0.25. Do 1 divided by 0.25. 4. Operating leverage is 4. Pakka na? Yes, people? Okay. Sir, how do you get operating leverage? Contribution divided by EBIT. Operating leverage is 4. Contribution we don't know. Do you know EBIT? Yeah. EBIT is given in the question to be how much? 14,000. Therefore, contribution will be 14 fours of 56. Contribution also you got. Comfortable. Can we go ahead and update? So contribution we got it. How much? 56,000. You know this and you know contribution. Can't you find out fixed operating cost? How is that? 56 minus 14,000 and you will get a fixed operating cost to be 42. Yes, sir, people? Like this. And they check. They also told in the problem somewhere variable cost is 50% of sales. Now, one second. I told you, sales minus variable cost gives you what? Contribution. Sir, if variable cost they are saying is 50% of sales, sales will always be 100%. Variable cost is 50% of sale means contribution also will be what? 50% of sale. Correct or no, sir? Comfortable? So, if that means you already know contribution. How much is contribution? 56,000. So, 56,000, no, sir, represents 50%. Because variable cost is 50% of sales means contribution is also 50%. You can calculate this also. Contribution is 50% of sales. How much is sales or how much is contribution? 56,000 is equal to 0.5 of sales. Therefore, sales will be how much, sir? 56,000 divided by 0.5. How much is that? Double. 1 lakh, 12,000. Like this you can calculate. Done now. Or you can calculate straightforward only. 56,000 represents what? 50%. Sales represents how much? 100%. For 100%, how much? Pro rate. 56,000 into 100 divided by 50 you do, you'll get 1 lakh 12,000. Any problem? If sales is 1 lakh 12,000 means variable cost is 50% of sales. Basically, these two will be same, which will be what? 56,000. So if you just check, everything has got ticked off. Just 1 or 2 missing working notes if you do, the entire problem will fall like a domino. One fall means taka, everything will fall off. Yes, sir, people. Now you want to go taka home or taka one more when we do this is an MTP series to May 24 question. 4 marks. 5 minutes. Okay. 5 more minutes. Prepare income statement of company P and company Q. Number of equity shares both is given. Check. Financial leverage is given. The moment financial leverage is given, one good combo question will play there. What is that? They will also give you interest. Check. Is it given? Yes. Financial leverage 3:1 is nothing but 3. 4:1 is nothing but 4. Financial leverage, at least quickly we'll discuss this. Financial leverage is given, interest is given. What you can do? Through substitute, you can find out EB. Because financial leverage is given by EBIT divided by EBT. Instead of EBT, you will write what? EBIT minus interest. So do this, you will get EBIT. Both for company P and company Q, same drama. Done. That is one. Next, operating leverage is given. 2:1 is nothing but 2. 3:1 is nothing but 3. Okay. Now, using financial leverage, you found out what, sir? Using financial leverage, you found out EBIT. How do you get operating leverage? Contribution divided by EBIT. EBIT you already know. Operating leverage is already given. Using operating leverage, what you can find? Contribution. Because operating leverage is contribution divided by EBIT. This also you know. EBIT also know. If by doing this, you will get contribution. Plug this number into income statement. Rest every data will fall into place automatically. That's all was this working note ka drama. Okay now. Paka, manageable. Awesome. One more. Josh. Enough. Okay. So keep that income statement, those two equations in mind. That's all with respect to leverage. So see you tomorrow. Thank you for your patience. Bye bye. Yes. Happy afternoon, one and all. So today we'll be starting with the next session of our marathon, and we'll be taking up in the first session topic called investment decision. Okay, a big ticket topic. This and working capital management usually is considered to be a big ticket topic in our FM. So we'll be starting with this. The agenda is very simple. We'll finish this topic and then take a break. Resume and do one more topic and then data. Bye bye for today. Okay now. All right. Sir, investment decision. So what this topic is trying to assess is, sir, suppose we want to buy an asset. We want to buy it. Now, if you want to do any particular project, you need fixed assets for it. Now, if you want to buy an asset, these decisions, people, are not pretty straightforward. You'll have to take these decisions carefully. Like just to give you an example, let's say one company, they want to buy a plant and machinery. They are a manufacturing company. To produce a goods, they need a help of a machinery. Let's say this machinery, sir, it can be purchased via two options. There are two options to purchase this asset. One, locally you can purchase by paying 8 crore rupees, and that local machinery will last for 8 years, and it can be used for 10 hours every day if you purchase it in India or locally itself. Or there is an option 2, you can import the same machinery, let's say from Germany, for 9 crore Indian rupees. Useful life is still same 8 years only, but imported machinery you can use for 12 hours a day. Now this particular decision, it's straightforward? No. Company may want to choose option 1, or they may want to go for option number 2. So that means you need to use your mind and accordingly decide. So there must be some techniques or methods which helps in deciding all this. Yes. So that is what we're going to be studying in this particular topic called investment decisions. Whether should we buy this asset or not? Whether should we expand or not? Should we diversify or not? All that will get covered in this particular topic called investment decisions. Now in this topic, these sort of decisions, sir, to take this, there are certain techniques or there are certain methods that we call it as capital budgeting or capital budgeting techniques. So these are simply methods which helps you to decide whether should we go for option 1 machinery or option number 2 commissioner. Basically simple techniques. There are about 5 or 6 techniques. That's what we have to learn in this particular topic. That's all is the scope of this topic. Yes, people, everybody? Alright. The reason why this capital budgeting technique is required is, one, sir, all these decisions will involve huge amount. Like here, 8 crore rupees is small amount or looks quite big. The amount of this investment decision risk, these sort of decisions will have a huge expenditure and they will have an impact on a long period of time. See, once you buy a machinery, this machinery you have to use it for how many years? 8 years. So whatever decisions you take, you have to stick with it for 8 years. So that means it has an impact for a short duration or long duration? Long duration. So before you blindly take the decision, you need to do a careful analysis. Hence, this particular technique becomes a necessity. Okay, sir? Alright. Now, sir, normally we take the decision based on profits. Normally we take our decisions based on profit. But capital budgeting techniques, they don't worry about profits. They do the decisions based on cash flows. Here the decision is taken with the help of cash flows. And in majority of our problems, cash flows data will not be given. Cash flow we need to estimate or we need to find out. That is one of the crux of capital budgeting techniques. In some problem, cash flow will be given to you directly. So that becomes a very straightforward question. Some problems they will not give cash flows. And this is what we're going to do. I have picked up some few questions where we'll be doing from the beginning till the end. But I'll give you a quick overview now for the time being. So we need what for these sort of decisions? Profit or cash flows? Cash flows. And cash flows will be given, or we may have to estimate. We may have to estimate. Now, what usually they will give you in these sort of problem is, they will give you sales. They will give you sales. They will give you sales data and some income expense data. We don't need sales income expense. We need what? Cash flow. Finally, how much is the cash flow? So from sales, we need to find out cash flow. Tell me, you have done leverage topic yesterday, we have discussed. From sales, if you reduce variable cost, you will get a contribution. From contribution, if you reduce fixed operating cost, you will get EBIT. From EBIT, if you reduce tax, you will get EBT. Then if you reduce tax, you're going to get earnings after tax. So till here, it's the same drama. Okay, they will give you sales. First, arrive at what? Earnings after tax, or also known as profit after tax. Sometimes it is also known as net profit. One and the same. Comfortable, sir? Now, this supposes 1 lakh rupees. Do we need this for our in capital budgeting techniques? No, because this is what? This is profit. We need what? Cash flow. Now, from this, we need to arrive at cash flow. You are able to see here this number. From here, we need to arrive at this number. How do we get that? Very simple. Now, profit will consider all expenditure. Profit will consider all expenditure, whether it is cash expenditure or non-cash. Everything will be considered. One example is depreciation. Is depreciation a cash expenditure or non-cash? Like salary, 1 lakh rupees is there. Will the company pay 1 lakh rupees salary to the employee? Yes. That means will there be cash outflow? Yes. When I say cash, I mean cash in hand as well as cash at bank. Will there be a cash outflow due to salary? Yes. Suppose company charged 1 lakh rupees depreciation. Will 1 lakh rupees go out of company bank balance or cash balance, or it's a non-cash expenditure? Non-cash. But you already reduced. Because how do you get profit after tax? After reducing all the expenditure. Yes, for the purpose of tax, for the purpose of calculating tax, you have to reduce all the expenditure. But now from profit after tax, we need to derive what? Cash flow. So the first adjustment you do is you add back depreciation. For the purpose of tax, we reduce depreciation because that's an expenditure which is allowed for tax purpose. But due to depreciation, did cash go out? No. Hence, what to do? Add back depreciation. That is one such adjustment. Other than this, in my regular class, I used to say, do not forget to consider 4 things. Other than depreciation, usually 4 things as a checkpoint I used to tell you. Anybody remembers that? One is the salvage value. Another one is your working capital. Once I'll quickly tell so that the regular class students can comprehend better. One is salvage value. Another one is working capital. Then is your opportunity cost. Another one is your additional cash flow item. This 4 items, no sir, it may be there in all problem. It may not be there in all problem. Maybe only one component will come, or maybe all the 4 will come. It varies from problem to problem. But what I have constructed here is a format. So I brought in everything. Is this okay with you? All this should be considered. Now, all this I will explain to you in problem one by one. Okay, now don't have to worry. I'm just giving you a summary. All this we'll have to do some adjustment, maybe plus or maybe minus, depending on the data given to you in the question. Once you do after depreciation 4 adjustments if you consider, then finally you will get what, sir? Annual cash inflows. You will get from profit, you will get what? Cash flows. But all this cash flows, no, you will not get immediately, you will get in the future. Because now here, if you buy the asset, today only you will get the benefit, or you will get benefit over 8 years. You will get benefit over 8 years. That means the cash flow that you have arrived over here is a present value of cash flows or future value of cash flows. Future value of cash flows. But are you doing the decision in future or today? Are you deciding tomorrow or today? Today. That means can we decide based on future value, or we need present value? We need present value. So take the future cash flows, whatever you got. From that future cash flow, arrive what's the present value of cash flows. From future value, how do we get present value? Multiply by the discount factor, you will get present value. Alright. Using present value of cash flows, we find out usually NPV. We will use some techniques. The most common techniques we use here is the NPV. How do you get NPV? Present value of cash inflow minus present value of cash outflow. All these are present value of cash inflows. From that, reduce present value of cash outflow. If NPV is positive, go ahead and accept the decision. Otherwise, reject the proposal. That's all. This is simple perspective. Understood, everybody? That's just an overview. Don't have to worry. I'll take you a couple of questions where we will work from sales until the bottommost number. Done, people? Yes. So again, just to sum it up, for all these decisions, we need profit or we need cash flows. cash flows. But what will they give in the problem? They will get sales or expense and all. So what we have to do? Do your normal activity and arrive what? Profit after tax. From profit after tax, 5 adjustments you'll have to do. First is add back depreciation because it's a non-cash expenditure. Then if you have any salvage value, you have to consider that. If you have any working capital, consider that. Consider opportunity cost and consider any additional cash flows given to you in the question. By doing this, you will get future annual cash flows. Multiply discount factor to get the present value of cash flows and take the decision. A summary. Fine, now people. Now, all right. Now, this is the overview of things. Now, we will dive into some techniques one by one of capital budgeting techniques. All right. Sir, you have September 24 book. Can I use the same? September. I've made some changes in my latest batch, so it would be preferable if you can have the latest batch book, if possible. All right. All right. Great. Now moving along. Now, first technique of capital budgeting we are discussing is payback period. Payback period. Name itself is saying paying back period. Payback period is simply trying to calculate in how many months or in how many years you will recover your initial investment. Now, to buy a machinery here, how much you spent? 8 crore rupees. Yes, now suppose you went for option 1. In option number 1, what is the value of the assets, sir? 8 crore rupees. You are investing 8 crore today. Payback period is trying to calculate in how many years company can recover 8 crore rupees. Basically, 8 crore rupees is your II. II as in initial investment. In how many months or in how many years you will recover your initial investment, that only payback period is trying to calculate. Easy. Okay. Now, before you calculate payback period, let's understand payback period with the help of a small example. Let's say initial investment is 12 lakh. I purchased an asset worth how much? 12 lakh rupees. By using an asset, I'll get some benefit. So every year, let's say my annual cash flow, net cash flow is 3 lakh rupees. From this asset, how much benefit every year I'm getting? 3 lakh. That means in how many years I will recover my initial investment? I've spent 12 lakh now. Every year my net cash flow is how much? 3 lakh. So in how many years can I recover this 12 lakh? 4 years. How did you calculate that 4? 12 lakh divided by 3 lakh. Express that in formula for me in words. So payback period is given by initial investment divided by annual net cash flow. Correct. And that's what I've written over here. Fine now people. Okay. So you can do this only if annual net cash flow is a constant. Constant means annual net cash flow what you're getting is same every year. If annual net cash flow what you are getting from using the asset, if it is same every year, then payback period is given by the formula initial investment divided by annual net cash flow. That's what we did over here because every year ka cash flow was same. But is it mandatory every year cash inflow has to be same or it could vary? It could vary. If it changes, what to do? So if it changes, you can't use this formula. We have to adopt something called cumulative approach. We have to follow something called a cumulative approach. How this works? Simple, same example. I'll take it forward. Let's say initial investment is still 12 lakh only. But by using the asset now, I'll get the benefit. First year 1 lakh, second year 2 lakh, third year 4, fourth year 5 and 6. That means cash flow, net cash flow every year is same or changing? Changing. Now what you have to do is you have to find something called cumulative cash flows. Cumulative means English definition. Cumulative means what? Cumulate means accumulating. Accumulating simply means adding up. Simply adding up. So first year we have anything to add up or only one number? One number. So first year cumulative cash flow will be 1 lakh. Second year how much cash flow you got? 2 lakh. First year already how much you got? 1 lakh. That means what is cumulative cash flow? From the beginning how much have you got now? First year you got 1. Now second year you got 2. So total how much you got? 3 lakh rupees. Third year how much did you get? 4. So 3 lakh plus 4 lakh you do. How much you going to get? 7 lakh. Now 7 lakh plus 5 lakh you do. How much you going to get? 12 lakh. 12 lakh plus 6 lakh how much? 8 lakh. That's how you calculate cumulative cash flows. Easy. But concept of payback period is still same. In how many months or in how many years you will recover your initial investment. What is the initial investment? 12 lakh. So look for this 12 lakh number here. Which year is having 12 lakh? 4. Therefore payback period is how many years? 4 years. As simple as that. So if net cash flow is same every year, you can use this formula. If it is not same every year, you have to use cumulative cash flow and figure it out. Comfortable? Okay. So suppose initial investment is let's say 14 lakh rupees. Suppose initial investment is 14 lakh rupees. Now check, is any cumulative cash flow having a number of 14? In this case, what to do? Now you'll have to identify the range. Possible that the scenario also can come. Is 14 lakh available anywhere here? No. But just check. 14 lakh comes between what year to what year? Up to 4th year, how much you have earned? 12 lakh.
Up to fifth year, how much you have earned? 18 lakh. That means, can I say 14 lakh investment lies between year 4 to year 5? That 14 lakh, this 14 lakh is lying somewhere between 4 to 5. Now, how do you do payback period in this cases? It's lying between 4 to 5. No, take the lower number. What is the lower number? Lower year? 4. Plus, if you want it as formula, I've showed you multiple ways. Maybe we'll stick to formula. You'll get the answer faster. 4 plus required cash flow divided by actual cash flow. 4 plus, why 4? Because the lower number is what? 4. Plus what? Required cash flow divided by actual cash flow. What is required cash flow? So up to 4th year, how much we have? 12 lakh. How much we need? 14. Up to 4th year, how much you have recovered? 12. We need how much? 14. That means how much more cash flow you need? 2 lakh more. That's what we mean by required cash flow. Required cash flow is basically 14 lakh minus 2 lakh or 12 lakh, which is 2 lakh. Comfortable? Divided by what? Actual cash flow. In the 5th year, how much cash flow is actually earned? 6 lakh rupees. So do that number. Comfortable? By doing that, you will get something called 4.33. That is your payback period. Easy, everybody. That's all is the payback period for all the 3 scenarios. Any case they can test an exam if they are asked. One, they can make annual cash flow constant, or they can make it different, but cumulative cash flow number will tie out exactly with initial investment. Or third case will be cumulative cash flow number will not agree with initial investment. You'll have to find it out like this. Everybody understood this, Pakka? Okay, that's your payback period. Can I go for the next one? This is one such technique. So this technique only covers what, sir? In how many months or in how many years you will recover your initial investment. After you recover your initial investment, this technique does not worry. That's all is the scope of this particular technique. Okay, Saru? Okay. Next is payback reciprocal. Payback reciprocal is not really a technique. It is just an extension of payback period. Just an extension. Now, name itself is saying payback reciprocal. Reciprocal means something ulta. So, payback reciprocal is ulta of what? Payback period. That means payback reciprocal ka formula is what? 1 divided by PP. PP as in payback period. If your payback period is, let's say, 4 years. If payback period is, let's say, 4 years, then how do you get payback reciprocal? 1 divided by 4, which is 0.25. Okay, now people, that's how you calculate payback reciprocal. So, why do we calculate payback reciprocal? Sir, some people have done a study, and as per that study, the outcome is payback reciprocal, sir. Payback reciprocal will be approximating to IRR. Have you heard of this IRR? What is IRR? Internal rate of return. This payback reciprocal now will be more or less equal to IRR. If life of the project is at least equal to twice of the payback period. If the project ka total life, if it is twice of the payback period, then the payback reciprocal and IRR will be almost the same. So this is, you could say, one shortcut way of finding the IRR. This payback reciprocal. What does this mean? Life of the project is twice of the payback period. How much is payback period here? 4. What is twice of that? 2 into 4 is how much? 8. So if the project ka life, here project was machinery, that project could be machinery, it could be whole project, whatever. If machinery ka life is 8 years or more, if machinery ka life is 8 years or more, then 25%, 0.25 itself becomes your IRR as per some study. Is it okay? Sir, can we follow this for exam? Don't. When they ask you to do IRR in the normal way. Only they ask you to calculate payback reciprocal, calculate like this. Okay? But this is why, one of the reasons why they calculate the payback reciprocal. Usually payback reciprocal we have seen come as a 2-marker theory question. Explain payback reciprocal. You may have to write 2 to 3 pointers. That I've seen a couple of times coming in the examination. Any problem so far? Anybody? All good? So we have discussed only 2 techniques. In fact, second is not a technique, it is just an extension. First we discussed payback period. Another one? Payback reciprocal. I'll discuss 3-4 techniques. Then I'll take up one question which has all the techniques. We will arrive through the numbers. That's the way we will do. Is that okay with you? Okay. Next is ARR. ARR as in accounting rate of return, or also known as average rate of return, or also known as book return, or book rate of return also they call it. The multiple names, meaning is pretty much the same. Okay. Alright. Sir, one second. Usually capital budgeting techniques use profit or they use cash flow. Majority of the capital budgeting techniques use cash flow. But there is one technique of capital budgeting which uses profit. That is your ARR. ARR does not use cash flow because ARR is accounting rate of return. In accounts, we show cash flow or we show profit? Profit. So using accounting value, we take some decision. That is what accounting rate of return. For accounting rate of return, we don't need cash flow. We need to take the help of profit. Comfortable, sir? There are multiple ways you can calculate IRR. You can ARR. Both the ways are acceptable in examination. I'll tell you. First way to calculate ARR is take average profit after tax, average PAT, divided by denominator could either be initial investment or average investment. So average PAT divided by average investment or initial investment, if you do, you will get something called accounting rate of return. Okay, people, it's a very simple adjustment. Sir, if you want to earn a return means you need investment. If you want to earn return means we need to have investment. Suppose we invested 10 lakh rupees. We invested how much? 10 lakh rupees. We earned, let's say, profit of 1 lakh rupees. Can you tell me how much is the return? We invested 10 lakh and we earned a profit of 1 lakh. How much is the return? If you're confused, think about this way. How do you calculate GP? GP is also return, no? How do you calculate GP? GP divided by sales into 100. Here also same thing. You take, instead of GP, take PAT divided by sales. Here you're getting the return with the help of what? Investment. I mean 1 lakh divided by 10 lakh. Since we want it in percentage, we multiply by 100. So this is your ARR. That's all. That is what I've expressed as formula now. Tell me what is this 1 lakh? PAT. But they will not give you 1 year PAT. They will give you about 5 years ka, 6 years ka. So hence instead of PAT, we take what's the average PAT. Instead of PAT, it will be average PAT in the numerator divided by, directly you can take initial investment in the denominator. That is acceptable. Or you can also take, if you want, average investment. My preference is average investment because in numerator, what are you taking? Normal or average? Average. In numerator, if you are taking average for better result, in denominator also you should take average. My preference is average, but study material accepts both. Initial investment also, average investment also. Easy now, people. Now, how do you calculate average PAT? Tell me, how do you calculate average PAT? If they give you 5 years profit, what do? All the 5 years ka profit divided by 5. If they give you 3 years profit, and all the 3 years profit divided by 3. Suppose in that 3 years, 1 year is a loss means profit means you will add. Any year loss means you will minus. Correct? That's how you find out average PAT. Easy. Any problem? No. Initial investment should we have to calculate or it will be given to us in the question? It will be given to us in the question. Average investment we need to calculate. Now, average investment you can calculate in a very straightforward way like this, which I have discussed in class. But our study material uses fancy formula. So let's present like that only in the examination. Okay. All right. So how do you get average investment is half of initial investment minus salvage value, close the bracket, add salvage value and add working capital. WC for working capital. In these sort of problem, working capital will not be given to in the problem. If at all they get, add it. Why add it? I'll tell you in one or two problems later on for the time being. Okay, people. This is how our ICAI calculates the average investment. Okay. It's very simple actually. Suppose you bought the asset for 10 lakh rupees, or let's say you bought the asset for 10 lakh rupees. Salvage value is, let's say, 1 lakh. Useful life is, let's say, 9 years. That means, tell me, sir, how much is depreciation every year? As per straight line method. How do you calculate depreciation? Original cost minus salvage value divided by life. How much are you going to get? 1 lakh is the depreciation every year. How many years you will use the asset for? 9 years. That means, can you tell me what is a depreciation for 9 years? For 1 year, it is 1 lakh. For 9 years, total will be 9 lakh. That means, can you tell me what is the closing balance of plant, or maybe one? What is the opening balance of plant and machinery? How much did you buy the asset for? How much did you buy the asset for? 10 lakh. What is the closing balance of plant and machinery? How do you get closing balance? You bought it for 10 lakh. How much did you depreciate the asset? 9 lakh. That means after depreciation, whatever balance is remaining, that only we call it as closing balance. I'm talking about closing balance of the asset at the end of which year? At the end of 9 years is useful life. Huh? So 9 years. How much will it be? 1 lakh. Comfortable. Huh? Now, sir, calculate. How do you get average of this? Tell me, how do you calculate average? Average is nothing but what's the opening balance plus closing balance divided by 2. So one simple way to calculate average investment is 10 lakh plus 1 lakh divided by 2. How much is that? 5.5. Yes, sir, people. That is what I've written in my chart book. Okay. Initial investment plus salvage value divided by 2. Because if you just check, closing balance of the asset is how much? 1 lakh. What is that 1 lakh? Salvage. So if you take opening balance, which is 10 lakh, plus if you do salvage value and divide by 2, automatically you will get average investment. But our study material doesn't like this approach. They give one fancy formula. Can we test that? What is that fancy formula? They will calculate average investment like this: half of initial investment minus salvage value, close the bracket, add salvage value. If there is any working capital, add that. Most probably working capital will not be given to you in the question. If at all they get, add up. Okay, half, calculate, sir. How much is initial investment? 10 lakh. What is the salvage value? 1 lakh. So minus, plus what? Salvage value, plus working capital 0. Calculate this. 10 minus 1 is 1 lakh or 9 lakh. 9 lakh divided by 2 is 4.5 lakh. 4.5 lakh plus 1 lakh plus 0 is how much? 5.5 lakh. Answer is any which way? C. Okay, now, but better to sync up with study material for the sake of examination. Okay, so that's the reason I said this is a formula. Done, people. So now you know how to calculate PAT also. You know how to calculate average investment also. Any doubt till here? Sir, class 1 is removed when you re-upload. Yes, it will be re-uploaded again. Give us some time, another 2 days time. Yesterday's session also will be re-uploaded. Don't have to worry about that. Okay. Accounts marathon, you can refer to the existing one. For the January, we will not be doing any accounts marathon. Some RTP, MTP questions I will record and I will put it up. But existing marathon, you can refer for accounts. That is good enough for Jan exam. Now, coming to this component. Overall, this is okay. There is one more adjustment which usually can come in the examination, has come 1 or 2 times. What they do is, they will not give you every year ka profit. They will not give you every year ka profit. Sir, we have to calculate ARR, means we need average PAT. To calculate average PAT, we need profit of all the years. But profit will not be given. Instead of profit, they will give you cash inflow and they will give you cash outflow. Instead of profit, they will give you cash inflow and they will give you cash outflow. And they will ask you to find out ARR uses cash flow or it uses profit. That means, can we take cash inflow and work it out, or we need to find the profit? We need to find profit. In that case, what to do? That is what I have taken a small example over here. Let's say they tell you in the problem that every year cash inflow, every year cash inflow is 1 lakh rupees. Every year you are getting a cash inflow of 1 lakh. For how many years I was assumed? 10. That means, what is total cash inflow? For 1 year, it is 1 lakh. For 10 years, it will be 1 lakh into 10, which will be 10 lakh rupees. Any problem? No. Now, this is your total cash inflow. But to do this particular project, let's say we have purchased a machinery and so outflow is how much? 2 lakh rupees. It's very simple. If they don't give you profit, there is a workaround to get profit. There is another way to get profit. Very simple. How much total cash inflow you have got? 10 lakh. How much cash outflow is happening? 2 lakh. 2 lakh you invested. How much you are getting? 10 lakh. So how much extra you got? 8 lakh. That 8 lakh only becomes your total profit. That 8 lakhs only becomes your total profit. Is this exactly profit or one shortcut method? One shortcut method to get the profit. Is that okay with you? How did we get the profit again? Tell me. Total cash inflow minus total cash outflow. Your total cash inflow for 10 years is 10 lakh. Total cash outflow I assumed it to be 2 lakh. So 10 lakh minus 2 lakh you do. How much you going to get? 8 lakh. That 8 lakh is what? 1 year ka profit or total profit? Total profit. For ARR, we need total profit or average profit. How do you find out average profit? Total profit is 8 lakh divided by number of years. How much is number of years here? 10. So 8 lakh divided by 10 you do. How much you going to get? 80,000. That's another workaround or another shortcut method to get profit. Yes, sir, people? We understood? Again, all this I'll apply one more in the question. But quickly doing one discussion. So far good? Can I move forward? Okay, next is a technique which you are already comfortable called NPV. NPV stands for net present value. Alright. Now 1 minute. This two techniques, sir, this payback period and ARR, no, they don't give a damn about present value. They say they are non-discounting techniques, or also known as traditional technique. That means, do we need any discount factor required for them or no discount factor? No discount factor. If we have checked over here, anywhere I use the term present value for payback period or for ARR, anywhere did I even utter the word present value? No, because they don't take the present value techniques at all. And that's the reason we call them as what, sir? Non-discounting technique, or another name, traditional technique. Now we are moving towards those techniques which take the help of present value, which uses discount factor. That the techniques are, you know this already, those are NPV, profitability index, IRR. So these are the three techniques. Okay, Saru. First is NPV. So first discounting technique is NPV. How do you get NPV? NPV ka full form is net present value. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Alright. So you just need to find out present value of cash inflow and deduct the present value of cash outflow. The final number we call it as NPV. Done. Okay. So to find out present value, we need to take what? Discount factor. That discount factor, mind you, should always be after tax cost of capital. If they give you before tax, we should take after tax. Remember, we have already done in chapter number 4 called KO. KO, what is KO? Overall cost of capital. How did you find out KO? By taking before tax or after tax? After tax. Okay, so you should always take after tax cost of capital, KO, as a discount factor and find out the present value. Some problems may they will give you before tax. So what you have to do? After tax. How do you get after tax number? I already told you in previous, remember. If you want to directly jump to after tax number, we simply multiply it by 1 minus tax rate. I'll show you through another problem also over here, but just say. Okay, sir. So this is your discount factor. And this is your rate basically. Then how do you calculate discount factor? How do you get DF? We already discussed this. DF, discount factor, is given by 1 divided by 1 plus I whole power n. Alright. This, I think, well, I'll take you through one question and any which way you have done it, so I'm pretty sure you know it. Next is your PI. PI as in profitability index, or also known as present value index. Sometimes it is also known as desirability factor. Different names, one and the same. Sir, a profitability index is just an extension of NPV. It is same like NPV. How did you calculate NPV? Present value of cash inflow minus present value of cash outflow. Profitability index, no sir, there you reduced, no, here you divide. So profitability index is nothing but present value of cash inflow divided by present value of cash outflow. So why do we do this, sir? It's very simple, sir. How do we decide this? Based on these techniques, company will take the decision whether should we buy the asset or not is decided by these techniques. How? Sir, if NPV is greater than or equal to 0, then you can accept the proposal. Meaning you can buy the machinery or whatever. Meaning decision can be accepted. If NPV is negative, accept or reject like this. Okay, now. So calculate NPV if it is 0. In fact, usually in our old version of study material, 0 means the choice was with the company. If NPV is exactly 0, company can either accept or they can reject. Because neither they are getting benefit nor they are incurring loss. So if NPV was exactly 0, our previous version of ICAI material used to say either you can accept or reject. But in the latest version of study material, they brought in a small change. They said if NPV is 0 or more than 0, accept. If NPV is negative, then reject. So this they have brought in, so be aware of that. So those of you who are using my old study material, be aware of this. I've corrected I've changed this in the new material, but just say, though some of you said that I heard that you're using old material, so I wanted to bring that to your attention. Then people. Now let's say you have two machineries. First machinery ka NPV is 1 lakh. Second machinery ka NPV is 1.5 lakh. Which one will you select? You will always select that asset or that project which gives you higher NPV. So among the two projects, if you are comparing, means you will select the highest NPV like that. If you are doing only decision for one project, you don't have two machineries. You have only one machinery. Then calculate if that machinery ka NPV is 0 or greater than 0. Accept. If that machinery ka NPV is, if that one machinery ka NPV is negative, means reject. Like that. I've also written that, but just saying. Okay, people. Same goes for profitability index also. If profitability index is exactly 1 or greater than 1, accept the proposal. If profitability index is lesser than 1, then reject the proposal. I've written the decision here. I'll come to that, but just saying once. Okay. All right. Now another technique is IRR. IRR means internal rate of return. So IRR is basically a rate at which two things will be equal. What are those two things? Present value of cash inflow will be equal to present value of cash outflow. If inflow ka present value and outflow ka present value is same, means at what rate they become same, that we call it as IRR. Or you can reframe IRR like this. IRR is basically a rate at which NPV will become 0, because inflow and outflow are same, no? If inflow outflow is same, means even if you calculate NPV, it will become 0. Okay, Saru. And how to calculate IRR? You know this already. We have to assume two rates. Usually sometimes some problems they will only give you the rate. If question gives you the rate, assume the same rates. Don't bring in creativity. Okay. If they don't give the rates, then you are free to assume. And then plug the numbers into formula. What is that formula? We applied it in the previous topic only. IRR is given by lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Plug this into the numbers. Accordingly, you will get the IRR. Usually, majority of our problem, IRR will be in decimals. So you have to assume some two rates and work it out. Any problem so far? Decision rule, as I've already told, maybe we'll run through this also. Acceptance rule for the project. First, NPV. If it is individual projects, you tell me, sir, what you will do? If NPV is only one project is there, how will you decide based on NPV? If NPV is 0 or greater than 0, accept. If NPV is negative means reject. Based on profitability index, how will you accept? Profitability index should be 1 or greater than 1 means accept. Okay, like this. IRR. IRR is what, sir? It's a return. If the return is greater than the cost, if IRR is greater than which cost are we talking about here? KO. Because to buy a machinery, to do an expansion, we need funds. For that funds, we calculate a cost. That cost only we call it as what? KO. If IRR is greater than or equal to KO, you can accept the proposal or you will reject the proposal. This is on this three. Any problem? So if you have multiple projects, how will you decide based on NPV? You will select that project which gives you the higher or highest NPV. Same goes for this also. If you have multiple projects, you will select that project which gives you the highest profitability index. If you have multiple projects, you will always select that project which gives you the highest IRR. Okay, Saru? Now, if you have to decide based on payback period, pretty rare, but anyways, if they give you in the examination, if you have one project, they are asking you to decide based on payback period. What they will tell you is, suppose you calculated there's one project, project A, you calculated the payback period for project A to be 5 years. Assumption. This project, first of all, what does payback period mean? If payback period is 5 years means, what does it mean? Within 5 years, you will recover the initial investment. That's what payback period is trying to calculate. Yes. But company, no, sir, they have an internal policy. They have an internal policy, meaning they will only accept the project if the payback period is lesser than or equal to 4 years. Only those projects they will expect or accept whose payback period is 4 years or lesser. Now you will tell me, you will accept this project or reject it? Reject. Why? Because company has an internal policy of taking only those projects which have a PP of 4 years or less. That's how you take the decision. So if the payback period is lesser than expected period, then you will accept. Here it is lesser or higher. Expectation is 4, but actual payback period is 5. That's the reason you will do what? Reject. So now suppose payback period is only 3 years. In this case, now what you will do? You will accept it because it is 4 years or less. Comfortable? That is for payback period. Sir, if they give you multiple projects, how will you decide based on payback period? Payback period means the time within which you will recover your initial investment. You want this duration to be highest or lowest? You want to clear examination in the long CA exams in the longest duration or shortest? Same goes for payback period also. If they give you 2 projects for payback period, you will select that project which has the lowest or lower payback period. ARR. ARR is accounting rate of return. Okay, now you will select lowest return or highest return. If they give you multiple projects, you will always select that project with the highest ARR. Now, if they give you only one project, how will you select? Suppose you have a project B, you calculated ARR for project B, you got it to be 15%. Return is how much? 15%. Company has an internal deadline. They will only take up that project which has a return of 12% or more. They will only accept that project whose return is 12% or more. Now you tell me, this project B accepted or rejected? Accepted. Why? Minimum expectation is how much? 12. This is achieving how much? 15. So what? Reject or accept? Accept. Same if I modify, ARR is only 10%. Minimum expectation is 12%. Now what? Accept or reject? Reject. That's your decision rule. So you will compare ARR with expected return, which company has as an internal policy. Then accordingly you will accept it or reject it. These are your decision rule. Any doubt? Anybody till here? Comfortable? Okay, now let's do a thing. Let's take up one question and all the techniques we have gone through. 1 minute. Where is? Let me find. This one I think. Question number 20. Question number 20. The expected cash flow of 3 projects are given below. Earlier you said accept or reject. Now only accept. Is that right? What accept or reject you are talking about, Dinesh? Which technique are you talking about? I'm sorry, I get your chats a little delayed, so the response may be a little delayed, but type in your full question so that I can answer it in one go. You can type in Macha. I'll finish this question and then I'll come back to your doubt. Okay, look at this, everybody. The expected cash flow on how many projects? 3 projects are given below. Cost of capital is 10%. Cost of capital here refers to KO, right? And first of all, to find out present value, we need KO only given. Calculate payback period, great. NPV, great. IRR also we need to calculate. ARR also we need to calculate. One question you have to calculate everything. Okay, then you have to give a rank. Ranking you already know. No? Obviously, based on a payback period, if you have to give the rank, means you will give the what? First rank you will give to the lowest payback period. Based on NPV, if you have to give a rank, means that the project which has the highest NPV you will award first rank. Based on accounting rate of return, if you have to give rank, means that the project which has the highest ARR will get first rank, like that. Okay. Now let's calculate. How do you get payback period? For that, first you check, there are 2 approaches. You will check whether annual net cash flow is constant or whether it is changing. They're given for 3 projects, maybe 1 or 2 I will show. Everything is not required. Yes. Check project A ka, they only given, sir. For all this technique, we don't need profit, we need a cash flow. Have they given cash flow? Yes. That means we don't have to do any working note. They only given the cash flow. If you get, they're given period. Year 0 means what, sir? Year 0 means, at year 0 what will happen? You will invest the money. So year 0 is outflow, inflow. At year 0, first of all, to do a particular project, you need to invest, sir. Investment will happen at year 0 in majority of the cases. Then from year 1 to year 10, in fact, that's the reason they're given also here. They're denoted in negative. Usually for these problems, inflows, usually correct way only. For these problems, inflows are denoted as a positive number, outflows are denoted as a negative number. You are able to see negative 5,000. So that means this is inflow or outflow? Outflow. Year 0 means what, sir? It is nothing but year 1 ka beginning or initially. Alright. 1 year here means end of first year. 5 year means end of 5th year. Like that. If you do project A, every year you will get a cash flow and the cash flow is changing or same? Same. That means annual cash flow is constant. How do you calculate payback period? Tell me here only. Initial investment, which is 5,000, divided by annual net cash flow, which is 900. How much is that, sir? 5,000 divided by 900. If you do, you will get 5.56 years. That is the payback period for project A. Any doubt? Any doubt? No. I'll do it for project C. Easier. Or maybe I'll do it for project C. Project B, you do it. It's okay. I will anyway put up the solution. In the interest of time, that's all. Project C, how much is outflow? 5,000. Every year inflow, same or changing? If it is changing, can we do formula method or cumulative method? Cumulative method. So I'll show you the cumulative method. I worked out for B also. In the interest of time, I'll just take up C. Where is C? C not there only. Okay, C is not there over here. Okay, no problem. We'll take up B only then. Done. Sir, if you just check project B ka cash flow, is it same every year or changing? That means what you have to do? First, from year 1 to year 10, copy the cash inflow column. We need only what, sir? Cash inflow. Don't take cash outflow over here. Okay? Take only the cash inflows. And then what do you do? Cumulative cash inflow you have. First year, where is cumulative cash inflow? Cumulative means adding up. First year, can you add anything? No. So that means this will be 700. Next year, it will be 700 plus 800. It will be 1,500. Then 1,500 plus 900. How much? 2,500. Then go on adding like this. What is the initial investment of project B? 5,000. Check any number is having exactly 5,000 here. No. But 5,000, can I say, is lying between here. This is 4,500. This is 5,700. So payback period is lying between year 5 to year 6. Tell me, we did this. How do you calculate payback period? Take the lowest number. What is the lowest here? 5 plus what? Required cash flow divided by actual cash flow. 5 plus required cash flow. Up to 5th year, how much you have earned? 4,500. How much is your initial investment? I mean, how much cash flow more you need? From 4,500, if you have to go to 5,000, the cash flow you need is how much? 500. So the required cash flow is 500. Divided by actual cash flow. For 6th year, how much actual cash flow you earned? 1,200. So required divided by actual you do, you will get the number to be 5.41 years. That is the payback period for project B. See, I've done it directly. That's okay. You got the fund now? Just quickly revising so I don't have to take up every question. Yes, sir. So payback period we have done. Next is NPV. How do you calculate NPV? Simply take the cash flow. Here you will start from year 1 or year 0? Because for NPV, we need a present value of cash inflow also. We need a outflow also. I don't know where is that NPV. Maybe. Okay, I'll do it. I'll just check over here. Okay, check, sir. Project A ka. If you just check cash flow, is it different every year or same every year? Sir, if it is same every year, one option is you can have 10 columns and take PVIF. PVIF means present value interest factor, which we discussed. But is cash flow different or same? If it is same, then we can use shortcut method. What is shortcut method? PVAF, present value annuity factor. Since it is same, we'll use PVAF. So for project A, year 0, how much is initial investment of project A? 5,000. That will come at year 0. Then I'll write in the year column year 1 to 10. How much you're getting every year? 9. So here I will use what? PVIF or PVAF? At what discount factor you will take? For NPV calculation, you will take discount factor as cost of capital. Have they given? Yes. How much is that? 10%. So calculate at 10%. How do you calculate this? 1 divided by 1.1. Press equals to button 10 times. Then there is a button called a GT button. Press that in your calculator. You will get PVAF. How much is that? 6.1445. So multiplying these two, you will get the present value. What is this, sir? Total present value of cash inflows. This is your cash outflow. At year 0, discount factor is always 1. Because year 0 means year 1 beginning. Year 1 beginning means now. Now means this 5,000 is already on what platform? Present value platform. Something which is already there on present value platform. Should we again calculate present value of it or not required? Not required. Hence we say for year 0, discount factor is always 1. So multiplying these two, you will get what, sir? 5,000. This is your present value of cash outflow. This is your present value of cash inflow. Add up, what are you going to get? 530. That is your NPV. And what is the decision rule? If NPV is, if you have to do only for project A, if you have to decide, then if NPV is positive, meaning if it is 0 or more than 0, accept. If it is negative, reject. They not ask decision rule, just saying for your reference. Done? Any problem? No. Next, if you did they ask you only NPV in the problem or also IRR? For IRR, we need one discount factor or two discount factor. Then already we have got it 10 here. That means we'll assume another rate. Ideal scenario for IRR is one NPV should be positive, one NPV should be negative. So at 10% when I calculated, I got how much, sir? 530. The trick is the discount factor as you increase, NPV will go on reducing. The discount factor if you go on increasing, let's say here from 10 I made it to how much? 14. Check how much I got NPV? Negative. As you increase the discount factor, NPV will go on reducing. Now I'm testing it at 14. Should you also compulsorily do it at 14 or your choice? Your choice. I've taken 14 because of this IRR. This is actually NPV calculation. Because they asked IRR, I'm doing, instead of showing the table once again, in this table only I have solved it out. Now find out the discount factor at 14%. At year 0 it's always 1. Now at 14% for 10 years, I need PVIF or PVAF? PVAF. So now you will do what? 1 divided by 1.14 because the rate now is 14%. So 1 divided by 1.14, press equals to button 10 times and then press GT, grand total button. How much you getting? 5.261. So this is your cash flow, this is your discount factor, multiply. When you multiply, you will get this 5,000, this 4694.5. This is what? What is this 5,000? Present value of cash outflow. What is this? Present value of cash inflow. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Okay, when you do it, you will get 305. Done, people? Now, is 10% or 14% my IRR or neither of them? Neither. Because if 10 or 14% was IRR means my NPV at IRR will be what? 0. Is any number 0? No. That means IRR is lying somewhere between what? 10 to 14%. Now plug the numbers into formula. What is the formula for IRR? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. I've assumed 2 rates. What are those 2 rates I've taken? 10 and 14. So should you always take 10 only? No, your choice. 2 rates are your choice. Since one rate I've already taken for 10 to calculate my NPV, which they asked, then I took the other one as 14. If you want, I can take 11 and 14 also. Any other rate is also acceptable. So among 10 and 14, which is a lower rate? 10. So I've taken 10 here. Plus at 10%, what is NPV? 530. So divided by NPV at lower rate minus NPV at higher rate. Higher rate is 14%. At 14%, how much is NPV? 305. It's already negative. I have to reduce. So negative of negative will become what, sir? Positive. Into higher rate minus lower rate. Higher rate is 14, lower rate is 10. 14 minus 10 you do, you'll get what, sir? 4. So multiply, you'll get the IRR to be 12.53%. Understood? Huh? This is about calculating IRR using shortcut. What is the shortcut? PVIF or PVAF method? PVAF. You can use PVAF only under one circumstance. What is that? Cash flow should be constant. Only if cash flow is constant, you can use PVAF. Otherwise, you have to do each year ka discount factor separately. Done. I'll also show you maybe for project C. Now, if you just check project C ka cash flow same or different? Now, can I use PVAF or PVIF? PVIF. They ask you NPV also, no? So let's calculate how much. Same for project C. Let's calculate. Where is it? Here. What is the year 0 ka cash outflow for project C? 5,000. What are the inflows? 2,000, 2,000, 2,000 and 1,000. I've copied that. Now this 2,000 rupees you will get now or at the end of first year? End of first year. I mean this 2,000 is present value or future value? Future value. This 2,000 when will the company get? At the end of second year. That means this is what? This 2,000 is also what? Future value. But we need what? Present value. How do you get present value? By multiplying the discount factor. For NPV calculation, we should take what discount factor? Cost of capital. How much is it given to be? 10%. Now take a 10% discount factor and calculate. For year 0, discount factor is always 1. Now for each year I need to calculate. How will I calculate discount factor for each year? 1 divided by 1.1. Press equals to button, you will get first year ka discount factor. Again press equals to button, second year ka. Again equals to third year ka. Again equals to fourth year ka. If that equals to button and all, if it is not working in your calculator, buy a new one which works. Okay, because these are all necessary for FM. Done, people? This is your cash flows, this is your discount factor. Multiplying, what are you going to get? Present value. So if you add up all the present value, how much NPV we got? 657. That was one of the requirement of the problem. That's the reason I boxed. Whenever you get an answer, no, have this boxing system. So that invigilator will directly check the answer and give you off the marks. He doesn't have to go through your whole answer sheet to award the marks. So this box system can be followed. Now they asked only NPV or also IRR. IRR. One rate I've already taken. For IRR I need 2 rates. One I've already taken. Other one maybe since above I've already taken 14. No. Here also maybe I'll stick to 14. But is it mandatory or any rate is okay? In fact I've changed. At 14% maybe it is not coming. That's the reason I took it as 19. Alright, because ideal scenario for NPV calculation is one should be positive and one NPV should be negative. Okay. If it is not, ICAI will increase the interest rate and get one NPV positive, one NPV to be negative and then plug in the normal. So if I assume different discount factor, will my answer match? No, answer will not match. There will be a variance. Instead of 19%, if you take 18%, your answer will not match. That is fine. That is acceptable because IRR works in this fashion. But usually in IRR questions in exam, what they will do is they will only give you the discount factor so that every student will assume the same rate. So every student will also get the same answer. But if rate is not given, you are free to assume and you don't have to worry about the final answer. It will change. So at 19% if you discount, now here can I take PVAF or PVIF only? PVIF and I've calculated. Plug in the numbers into the formula and you will get the IRR. Quickly reviewing. Okay, no? The pattern of solving we have got it, no? That's okay, right? Now this is about your calculation of payback period and NPV and IRR. They also asked ARR in the question. Capital ARR they've asked. Huh? Okay. ARR. Tell me, sir, how do you get ARR? 1. ARR uses cash flow or it uses profit? Profit. But if you just check the question, they give you what, sir? Expected cash flow. Did they give you expected profit or expected cash flow? For ARR, we need profit, but profit data is missing. That means now, do you know a way to find out profit? Yes. How do you get profit, sir? Total cash inflow minus total cash outflow. If you do that, what you will get? Total profit. We don't need total profit. We need average profit. How many years is project A? 10 years. Calculate, let's see. Total cash inflow. I've done it, but you calculate. Let me see how you have understood. From year 1 to year 10, 900 into 10. What is the total cash inflow? Inflow is 900 into 10. How much is that? 9,000. How much is outflow, sir? 5,000. From total inflow, if you reduce total outflow, what are you going to get? Average profit or total profit? How much is total profit? 4,000. We want total profit or average profit? How do you get average profit? Total profit divided by number of years. How many years will project A go for? 10 years. That means you do 4,000 divided by 10, which is how much? 4. Easy now. So you got your average profit. Then calculate ARR for me. What is ARR the formula? Average profit divided by, either you can take initial investment or you can take average investment. Okay. If you take initial investment, what will be the answer? 400 divided by, how much are you investing for project A? 5,000. 400 divided by 5,000. Sir, ARR is a return. Return we want it in percentage. So we multiply by 100. How much is that? 8% if you'll get if you take initial investment. If you take average investment, number will be same or different? Sir, how do you get average investment? We just now looked at fancy formula. What is that? Half of what? Initial investment minus salvage value, close the bracket, plus salvage value plus working capital. Most probably working capital and salvage value will not be there in these problems. What is initial investment? 5,000. Salvage value 0. Plus salvage value 0. Working capital 0. If you do that, how much is it? 2,500. Now calculate ARR for me. Average profit is 400 divided by average investment, which is 2,500 into 100. If you do, you get 16%. Both the answers are acceptable. You can calculate ARR using initial investment or average investment, your choice. That's what I've worked out over here also for your reference. For project A. Yeah, I worked out using average investment over here. My preference is average because in the numerator we are considering average. So I personally would suggest average investment, but ICAI they have solved the question using both. So in examination, your choice. So this question was kind of a recap of all the techniques. Manageable. Can I move forward to the next? So capital budgeting and EAC we need to do by default. EAC we have not discussed much. Wait for a minute. 1 minute. I'll come to that. I'm just going step by step. Okay. So till here we have covered. So we'll come back to our chart book. So we have covered till what, sir? IRR. Can we move forward? Alright. There is one more called MIRR. One more called MIRR. MIRR is modified internal rate of return. Modified IRR. What is this MIRR ka concept is? It's simple. Let's say you are getting cash flows. Year 1, 2, 3, 4, you are getting cash inflows. Let's say you're getting 10,000, 15,000, 12,000 and let's say 20,000. By doing a particular project, you are getting cash inflows for 4 years. This I've assumed. Now, sir, with the company, at the end of first year, how much they got? 10,000. Will they keep this money idle or will they reinvest? Reinvest. Yes, no, into the project. If it's a suppose we are doing CA coaching now. If it's a profitable project, we will do 1 batch in a year or think to do more. Instead of 1, we will try to do 2 or maybe 3, maybe morning batch, afternoon batch or evening batch like this. Correct or no? Same with the company. If first year if they get 10,000 rupees cash inflow, will they keep that 10,000 rupees cash idle or will they reinvest? Reinvest. Into which project? Same project. And how many years can this amount be invested? 10,000 you got it at the end of first year. Project will run for how many years? 4 years. That means this 10,000 you can reinvest for how many years? 3 more years. Comfortable? If you reinvest this, will it be still 10,000 or its value will increase? That means that value, we call it as TCF, as in terminal cash flow. Terminal cash flow. So you reinvested 10,000. For how many years can you reinvest? 3 years. They will give you cost of capital. Let's say cost of capital is at 10%. Cost of capital is 10%. That means this 10,000 you can invest for 3 more years. Means what will be the value? 10,000 plus 10% plus 10% plus 10% you do. How much is that? Quickly, for everyone do. If you don't tell me the value, I don't have calci over here. 13,300. Like this. Okay, now sir. If you don't want to do like this, sir, this 10,000 is a value at the end of first year. We want value at the end of 4th year. That means this 10,000 becomes your present value. We have to calculate the future value. You know, mathematics may have formula. So to calculate present value, what do we do? We take future value into 1 divided by 1 plus I whole power n. This is what is discount factor. Future value we multiply by discount factor. If you have to calculate future value, what you will do? Present value, and this you might send it to the other side. So it will become what? 1 divided by 1 plus I whole power n. Correct? You can also calculate like this. 10,000 is present value into 1 plus I. I is how much, sir? 10%. How many years can you reinvest? 3 years. So calculate 10,000 into 1.1 whole power 3. 1.1 into 1.1 equals to button you press. 1.1 into 1.1 Press equals to button, again press equals to button. How much you going to get? You're multiplying and telling me, yeah, if you do the calculation, final number will also be 13,300. Whether you calculate like this or whether you calculate simply by adding percentage, answer will be C. Then Asaru, any problems, Saru? No. Tell me, sir, for second year, this 15,000, when did you get? At the end of second year. Okay. Now, this 15,000, for how many years can you reinvest? You got it at the end of second year and project ends at the end of fourth year. That means you can reinvest for how many years? 2 years only. That means what will be its value? 15,000 you can reinvest for 2 more years and return you will get is how much? 10%. That means you will add 10% how many times? 2 times. How much is this? 18,150. Now this 12,000 you can reinvest for how many years? You got it at the end of third year. Project ends at the end of fourth year. That means you can reinvest for 1 year. So here you will do what? 15,000 plus 10%. How much is that? Huh? 16,500. Okay. Huh? Which one? Oh, this is actually 12,000 into. Okay, fine. Cash flow is only 12,000. Okay, 12,000 plus 10% is 13,200 now. Okay, fine. Now this 20,000 you have received at the end of fourth year and project ends at the end of fourth year. How many years can you invest? No, you can't reinvest. Don't write 0. So simply that means what, sir? Its value is what? 20,000. No, because this is the value at the end of fourth year itself. Done now. Now add all these are values now or at the end of fourth year. Why fourth year? Because here project is ending at the end of fourth year. That we call it as terminal. Terminal means ending. Terminal means ending. Here project is ending on which date? Fourth year. So add up all the terminal cash flow. How much is that? 64,000. MIRR is simple, sir. First of all, you tell me what is IRR. IRR is basically a rate at which present value of cash inflow will be equal to what? Present value of cash out. That is your IRR. Correct now? MIRR is a modified internal rate of return by considering what? Reinvestment factor. MIRR is trying to calculate at what rate present value of cash inflow. Now what do we have? Terminal cash flow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. Now we have to see at what rate 64,650 will be equal to present value of cash outflow. Let's say present value of cash outflow is 20,000. Assumption. At what rate this 64,650 and 20,000 will become equal. Now what do you have to do? Same drama. How do you find out IRR? By assuming 2 rates. Here also you have to do the same 2 rates assumption. Plug the numbers into normal IRR formula. But the percentage you get, no, it is not IRR, it is MIR. That's the only distinction. Got it, Asaru? Any drama, sir, or got it, sir? Sure. Now I have one question also. Can we quickly 2 minutes review that question? If you have got this. So again, MIRR full form is what? Modified internal rate of return. MIRR considers the reinvestment element because every year cash flow what you get, company will not keep it idle. They will reinvest. At what rate? At the cost of capital itself, which in this example I've assumed it to be 10%. That means now we don't need cash inflows. We need what? Terminal cash inflows or terminal cash flows. So calculate total terminal cash flow and try to equate it with what? Present value of cash outflow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. Such a rate we call it as MIRR. And step of calculating MIRR is same as IRR. You have to assume 2 rates, plug the numbers into formula and get the answer. Now 1 minute, I'll show you one normal problem also. Question number 14. This is again ICAI question only. Question number 14 is an MIRR question. I'll bring the solution a little closer. Hang on. No, maybe it's here only. Okay, check here, sir. An investment of 1,36,000. What is this 1,36,000? I'll write it as present value of cash outflow because outflow happens immediately. So that means it is already on what platform? Present value platform. Yields the following. Yields means gets you the following cash inflows. This is profit before depreciation but after tax. So tax is already deducted. Before depreciation means, I told you in the problem, we need for all this analysis profit or cash flow. First, what do you do? Find out profit after tax. Then first adjustment you have to do in every problem is add back depreciation. If you add back depreciation, you will get one number, no? That we call it as profit before depreciation but after tax. Meaning tax is already deducted and depreciation is already added back. That means what is this? This is only your cash flows. That means they have done, should we have to find the cash flow or they have already done? they've already done. So this is nothing but your cash flow because they've deducted tax and added back depreciation. Since you have added back depreciation, they call it as profit before the depreciation and after tax. Okay, sir. There's nothing but your cash flows. Okay. Now all these are what? Cash inflows. What is your cost of capital? 8%. Now this 30,000 company will receive inflow at which year? End of first year. Will 30,000 company keep it idle or reinvest? Reinvest. At what rate? At cost of capital itself, which is how much? 8%. That means what, sir? Will this cash flow be same? So that's what I've done here. 1, 2, how many years cash inflow you're getting? 5 years. Cash inflows I've copied from the question. Then I brought in reinvestment factor. Reinvestment factor. You can do it in multiple ways. One simple way is take 30,000 and add what? 8%. Now you tell me this 30,000 you can invest for how many years? Maybe I'll write it as reinvestment years over here. How many years can you invest this 30,000? You received at the end of first year and project is ending at the end of fifth year. You can reinvest for how many years? 4. This 40,000 you got it at the end of second year and project is getting over at the end of fifth year. So how many years can you invest? 3. This one, 2. This one, 2. This one can you reinvest? No. Correct. Fine, people. That means you will add. If you have to use a shortcut method, you will take 30,000 and add 8%. How many times? 4 times. Like that you can do and get the terminal cash flow. That is one way. Our ICAI uses present value, future value technique. How do you get future value, sir? Present value into 1 plus I whole power n. This 1 plus I whole power n, no, in study material books, they call it as a reinvestment factor. Instead of discount factor, they are calling it as reinvestment factor. You can also call it as future value factor. Because using this, we are finding future. Okay, that is nothing but 1 divided by 1 plus I, or rather 1 plus I whole power n. Either directly you can do it in your calculator or you can multiply the reinvestment factor and get it. The choice is yours. Okay, people. Let this calculate terminal cash flow. That's it, or add up. Add all the terminal cash flow. How much are you going to get? 2,13,586. MIRR means what? In fact, they're asking us to calculate MIRR only. Determine MIRR. MIRR means it's a rate at which present value of terminal cash flow will be equal to present value of cash outflow. At what rate terminal cash flow and present value of cash outflow will be same? That rate we need to find. For that we need to what? Assume a rate. First rate I've assumed it to be 10%. Okay. Alright. Now, outflow will happen at which year? Year 0. How much is present value of cash outflow? 1,36,000. At year 0, discount factor is always 1. So present value of cash outflow is 1,36,000 only. Now this terminal cash flow, nice music, but keep it on silent. Terminal cash flow is how much total? 2,13,000. This you'll get it now or at the end of the project. Here project is ending on which year? 5th year. That means this 2,13,586 you will get it at the end of 5th year. So at 10% for 5th year, calculate PVIF for me. 1 divided by 1.1, press equals to button 5 times because we need 5th year ka PVIF. How much is that? 0.6209. Correct. Multiply these two, you will get the present value of cash inflow or present value of terminal cash flow. Present value of terminal cash flow. This is your outflow. This is your present value of terminal cash flow. Add it up. What are you going to get? 3385 negative. Sir, if 10% is your MIRR, means NPV should become 0. NPV should become 0. Has it become 0? No. Then you'll have to assume one more rate. But if you just check first rate only gave me of negative. Ideally, what do I want? One positive, one negative. As you increase the discount rate, NPV will go on reducing. But here it is already negative. That means I want one positive number. So rate I will increase or reduce. So instead of 10%, maybe I'll take 5%. You can also take 4, 3 or 6 or 7, your choice. I've taken 5. At 5%, if you work out, you got a positive number of 31,344. So is 5% my MIRR? No. If 5% was MIRR, means this instead of 31,344, it would have become 0. So basically, MIRR is lying somewhere between 5 to 10. Now plug in the formula. Same formula. What is that formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower. Do that, you will get the answer 9.5. This 9.5, don't call it as IRR, call it as MIRR, modified internal rate of return. Easy, people. Okay, so this is done. I'll move on to the next concept. Where is that? 1 second. So we have done payback, reciprocal, ARR. Then we looked at what's a NPV over, PI over, MIRR also over. All this is over. Next, we will move on to certain extra technique. Now, one simple question for you. Just 1 minute. So far, everyone is understanding? Online also, everything going good? According to NPV, what is cash inflow, outflow according to whom? NPV is always found out from company perspective. Okay. Only cost of capital chapter may we give the signs from investor perspective. Only when you're finding cost of capital, cost of debt or cost of equity under IRR, we put the signs from investor perspective. But because here, no, who's doing the project? No? Company. So who will get the return? Company. In the cost of capital chapter, may company was taking money, so it was cost. In who was giving the money? Investor. For whom it was a return? Investor. Hence we gave the sign from investor perspective. But in all this topic, company only is doing the project, so they will only get the cash inflows. So you get the positive, negative signs from company perspective. Great. Okay. Moving along. Next is certain extra cases or some extra fittings. Now, if I give you two projects, if I give you project, let's say two projects, project A, project B. One NPV of project A is, let's say, 50,000. For project B, it is 1 lakh. What will you select? You will select project A or project B? Project B, because selection rule says what? You will always select that the project with higher or highest NPV. Yes, sir. But hang on. Outflow of project A is, let's say, 20,000. Outflow of project B, let's say, is 80,000. Okay, that means these two projects are having same outflows or different outflows? Different outflows. That is a special case. Now we are looking at two special cases. So you can't do the selection only based on NPV. It will be not right, because bigger project, if you do big project, you'll always get big NPV. Right? So big project cash flows will be in crores. That means NPV also really will be high. But to do big project, you also need a big funding. So if you do the selection just based on NPV, that will not be right. You also need to consider what? Outflow in mind. Because these projects are having same outflows or different outflows? Different outflows. That we call it as capital budgeting under capital rationing. Capital budgeting, this decision or these type of problems, we call it as what? Capital budgeting under capital rationing. To ration something means what? To safeguard, to keep it. Yes, no? Like you are rationing your time now. Every day you're figuring out what I should study, where I should, how much I should attend class and all. That is what is rationing. Rationing means safely utilizing or carefully utilizing. You are carefully utilizing what here? Outflows. Now in these sort of problem, how it works is, you can't take the decision just based on NPV because outflow of the projects are different. You also need to consider the outflow and then make the decision. Such a scenario, we call it as what? Capital budgeting under capital rationing. I'll do a thing. Or I have an example. Maybe I'll take you through a small example over here. Then we will see, if required, we will take one more question. Or may not be required. Just check. Sir, let's say, sir, we have three projects, A, B, C. For project A, the investment required is 50,000. Initial investment is 50. Here it is 40. Here it is 25. Same number or different number? Different number. If you do project A, no sir, you get a total NPV of 15,400. I've assumed all this number. B will get you 18,700. C will give you 10,100. Now, plainly based on NPV, if you do the selection, you will select which project? You will always select that project which gives you the highest NPV. Which gives the highest NPV? B. So you will do that selection. But hang on. All the projects ka investment same or different? Different. That means investment is on one platform or different platform? Different platform. But to decide, everything has to be on the same platform. So what do we do over here is, or how they will ask this question is, they will say, company has, like this they will tell, company has a budget of 1 lakh rupees. Company has how much budget? 1 lakh rupees. Now you tell me, if you want to do all the three projects, how much money you need? 50 here, 40 here, 25 here. That means to do all the project we need 1 lakh, 15,000. But company has a budget of only 1 lakh. With 1 lakh, can you do all the three? No. That means we have to select. We have to select. So this scenario is nothing but capital budgeting under capital rationing. So we are not choosing one project here. We are choosing multiple projects. Now, which one will you select? Will you do A and B? Will you do B and C? Or will you do A and C? That we need to suggest. Done. But straight away we can't decide that because investment for all the projects same or different? Different. So the first thing you have to do here is get NPV to one platform. Get NPV to one platform. What is one platform? Simple. 15,400 is the NPV for how much investment? 50,000 as an investment means you will get how much NPV? 15,400. I will bring everything to 1 rupee platform. Just for comparison purpose, I will bring every investment to 1 rupee platform. Meaning if 1 rupee is outflow means how much is NPV? Like this. Understanding now? For all the projects, I will bring the NPV to which platform? 1. Sir, it should be mandatory 1, sir. No, you can take 1,000 also. No problem. Answer will be same. For easier calculation, I have assumed how much? 1 rupee ka platform. If outflow is 50,000 means NPV will be how much? 15,400. If outflow is just 1 rupee means how much NPV? Calculate. How do you get? How much is this? X. You have to cross multiply. So it will be what, sir? 15,400 divided by 50,000. If you do, how much is that? 0.308. Tell me this in formula. We can aram se look into it. How do you get NPV for 1 rupee outflow? NPV divided by initial investment. Can I say? Can I like call it that? NPV divided by initial investment. 15,400 divided by 50,000. How much? 0.308. Do this next same thing. 18,700 divided by 40,000. How much? 0.47. 10,100 divided by 25,000. How much? 0.40. Everyone okay? Now check the screen. All these are NPV for what? All these are NPV for what? 1 rupee investment. Now they are on different platform or same platform. Now can I compare? Yes. Everything is NPV for how much investment? 1 investment. Now you can do your normal investment. Now a normal rule. You will always assign. Now we have 3 projects means how much maximum rank you can assign? Now we have to assign ranks. How many projects are there? 3. That means maximum rank you will assign is 3. If you have 5 projects, how many ranks will you give? 5. Now you tell me, first rank you will give it to what? The project with the lowest or highest NPV? Highest total NPV, highest NPV for 1 rupee outflow. For 1 rupee outflow, which is the highest NPV? 0.47. That means first rank will be given to project B. Next, which is the highest NPV for 1 rupee investment? 0.4. Second rank will be given to project C. Third rank will be given to project A. That means you will take up the project in this order. First you will take up what? B. Then you will take up what? C. If still money remains, then you will take up project A. This is what is nothing but capital budgeting under capital rationing. Understood? Now, if budget is 1 lakh, we already know now. First priority will take up which project, sir? Project B. Project B, to take up project B, how much money we need? 40,000. How much NPV will we get totally? So 40,000 investment will be going there and NPV will get how much? 18,700. Second rank to which project? C. C requires how much investment? 25,000. How much NPV totally C will get you? 10,100. Stop. How much have you spent so far? 40 you spent for B, 25 you spent for C. Totally you spent how much? 65,000. You have a budget of 65 or 1 lakh? You have a budget of 1 lakh. How much you have spent? 65. Money is remaining still? Yes. How much? 35,000. Because if you add all this, how much you going to get? 1 lakh. Okay now. Now don't say project A ka NPV is 15,400. No. If you spend 50,000 for project A, then you will get an NPV of how much? 15,400. If you spend 50,000 outflow for project A, then you will get total NPV of 15,400. Are you spending full amount for project A or only 35,000? If 35,000 is the outflow means how much NPV you will get? Proration. Understood? Once again, got it. If 50,000 if you are spending on A means you will get an NPV of 15,400. You are not spending 50,000. You are only spending 35,000. If 35,000 you are spending for project A means how much NPV you will get? How much if you prorate that? X will be 35,000 into 15,400 divided by 50. If you do, you will get 10,070. Okay. Sir, this you can do only if the question says projects are divisible. Projects are divisible means you can do part project. You can do part project. Like our CA coaching. If you do CA foundation coaching, mandatorily we should do CA intervals. No. Right now here at CF and Arivupro, currently we are giving CA foundation coaching fully, CA inter coaching fully. CA final currently my subject is only one, which is actually available currently. In another 2-3 months, other subjects, other faculties also will come. Why? Because these are what, sir? Separate projects. Because these are what projects? Divisible projects. Divisible project means you can do only 10% of project A. You can do 40% of project A, or if you want, you can also do 100% of project A. Question will mention whether the project is divisible or not divisible. Suppose they say project A is not divisible, like that if they say, then what will you do? Can you do part project or not acceptable? Then A, you cannot take it up, you have to cut it off, like that. Okay, Saru? The question will usually say that these are divisible projects because these are good adjustment, so they will ask them that, if at all they want to ask the scenario. Done, Abhipal? Yes. So this is scenario, we call it as capital budgeting under capital rationing. So in simple terms, what is it? Simple. We have one budget. In that budget, we want to select one project or multiple projects. Multiple projects, but all that projects has same outflow or different outflow. So what do we do? Since they have different outflow, obviously they will also have different NPVs also. You get them all on one platform. Which platform is that? So a common platform you get, which is that find out NPV for 1 rupee investment. Should it be mandatorily 1 rupee, or anything else is also okay? Anything else is also okay. Final answer will not match, but I say also calculate NPV for 1 rupee investment. Based on that, you assign ranks. So you'll always select, or you'll give first priority first to which project? First rank project. Next priority to second rank project. If money is still there, then you will do other projects like that. If projects are divisible, means you can take up part project. Otherwise, you cannot take up the part project. Understood the scenario fully? I think I can go for the next case then. Yes, sir, people? Okay. Now the next case is, what if project has unequal life? Project has unequal life. Let's say over here, we have two projects, projects A and B. Let's say outflow for project A is also 10 lakh, B is also 10 lakh. Outflow is same. Now NPV here, let's say is 15 lakh, here let's say is 19 lakh. Now you tell me, sir, which one will you do the selection? Which project will you select? Both outflow are anyway same. Now you will compare NPV and select the lowest or highest. Highest, correct? But hang on, they will give you one more information. Project A can last for, let's say, 4 years. Project A can last only for 4 years. B can last for 5 years. Now you tell me, can you decide based only on NPV? No. Why? This project has a life of only 4 years. Other one has a life of 5 years. Can you ignore this life or consider the life? Consider the life. In the previous case, we considered outflow because they were on different platforms. Now we have to consider the useful life. Understanding this scenario only we call it as what? Projects with unequal life. This is actually a 2 minute. I doubt that they will ask all this for a 5 marker or anything. Usually for 2 marker MCQ question, all this can come because pretty straightforward calculations. Now, how this works? Very straightforward. They have given NPV, no sir. They have given NPV, but this NPV is for how many years? 4 years. That means we need to find out something called average NPV. We need to find out the average NPV because this 15 lakh is an NPV for how many years? 4 years. This 19 lakh is an NPV for how many years? 5 years. So we need to find out, for our decision making purpose, we need to find out average NPV. This is not simple average because we calculate NPV in a straightforward way or using discount factor. Discount factor. And is all the 4-year discount factor same or different? Different. So you can't do simple average because how do you get simple average? 15 lakh divided by 4 if you do, you will get simple average. But NPV calculation doesn't work based on simple average. It works based on discount factor. And every year discount factor is same or different? Different. Hence, how do we calculate average NPV? Here we don't use the word average NPV. We call it as EAC. Instead of average NPV, we call it as EAC. Equivalent annualized criterion. Equivalent annualized criterion. So basically in simple terms, it means what? Average NPV. So what you have to do is very straightforward. You have to first find PVAF. You have to first find PVAF. PVAF means what? Present value annuity factor. They will give you the discount factor. Let's say discount factor is 10%. Calculate for me, sir. For 4 years at 10%, what is the PVAF? How will you calculate? 1 divided by 1.1. Press equals to button 4 times and then press GT button. How much is that? 3.169. Great. Similarly, at 10%, same discount factor, for 5 years, calculate PVAF for me. How much is that? 1 divided by 1.1, press equals to button 5 times and then GT button. 6.96. one number. I don't have, I can't confirm. 3.790. Okay, now pakkana 1 divided by 1.1, press equals to button 5 times and then press GT button. Good enough? Okay. No. How do you calculate average NPV? Is very straightforward. Take the NPV and divide by PVAF. Take the NPV and divide by PVAF. Because you found out NPV using what? Discount factor only, So you find out average NPV also using what? Discount factor. That's all it is. Okay. So 15 lakh is your NPV divided by 3.169 you do. How much is that? 15 lakh divided by 3.169. How much is that? 4 lakh, 41? 47? Okay. 47,333. Okay, I'll keep it as 47. That's 4,73,000 some change. Similarly, calculate for project B. Take NPV. How much is the NPV? 19 lakh. Divided by 3.790 you do. How much you getting?
5 lakh 1.
501? 31? Correct. Now you will do the selection based on not total NPV but average NPV. So first project is giving how much average NPV? 4,73,000. Second project is giving how much average NPV? 501. Which has the highest average NPV? 3. That means you will select which project? Select project B. That's all it is. Understood the calculation? So simple way, how do you calculate EAC? Take the NPV. In all this problem, NPV will be given to you in the question. Even if they don't, you know how to calculate NPV? Calculate NPV divided by what? PVAF. At what rate? At cost of capital, which will be given to you again in the problem. So NPV divided by PVAF will give you average NPV. Just that we don't call it as average NPV, we call it as what? EAC. Equivalent Annualized Criterion. Done, Azaru. And selection rule is what? You will select the lowest or highest EAC. Highest EAC. But be careful, don't blindly mug up. Here it was what? They are given NPV. NPV means what? Net present value. Meaning if NPV is positive means, can I say benefit is greater than the cost? If NPV is positive means benefit is greater than the cost. So if they give you NPV, you will do the selection this way. You will select what, sir? You will select the project with higher EAC. In some questions in the previous papers we have seen, they will not give you inflows. They will only give you cost. They will only give you cost. Like when you buy a machinery, they will say, for next 5 years, we don't have any inflow. We have to invest now to buy the machinery. For next 5 years, we have to incur some repairs and maintenance also. They call it as running cost. To maintain the asset, there is some repairs and maintenance. Year 0 also there is an outflow. For next 5 years also outflow. Okay, like that data they will give for project A. Project B they will say year 0 outflow, 7 years repairs and maintenance. How many years? 7 years. First project ka how much maintenance? 5 years. Second project ka how much maintenance? 7 years. You have inflow data or only outflow data? Outflow data. Yes. Same way you calculate. But here EAC is from benefit angle or cost angle? Cost angle. How do you calculate EAC? Same. Find out the present value of cash outflows. Or here you have, can you find out NPV? In fact, how do you find out NPV? Tell me. Present value of cash inflow minus present value of cash outflow. Inflow is not even given. So that means can we find out NPV? So only thing you can find out here is what, sir? In these sort of problems, you can only find out present value, or maybe I'll build up a small scenario. You answer this question for me. You will find out present value of cash outflows by considering the discount factor. You got that to be, let's say 10 lakh. Here you got it to be 11 lakh. Any problem? No. Same number or different number? Different number. And same life, different life. Different life. When there is a different life, first thing you need to find out is what, sir? EAC. To get EAC, we need two numbers. One is the cash flow. Here we don't have NPV, so we will use present value of cash outflow. And then we need one more number called what? PVAF. Calculate at 10%. Tell me PVAF for 5 years. I think you already. Let's maybe do a thing. Let's take 4 and 5 only, better, instead of recalculating. Anyway, we calculated in the last problem only, So we'll make this as 4 and 5 years only. So what is 10% ka PVAF for 4 years? We already wrote it here. How much is that? 3.169. Take that number, 3.169. Here also it will be what, sir? 3.169 or 3.790? 3.790. This is what, sir? Cash outflow, right? So we want what? EAC. EAC here is what? Average cost. It's not average benefit. It is average cost. How do you find out that? 10 lakh divided by 3.169. How much is this? 3 lakh? 360, 316, 3,16,000, I'll write. Okay, leave, it's fine. Here it will be what, sir? 11 lakh divided by 3.790. How much is this? 2 lakh, I'll keep it as 2 lakh 90. Okay, now you tell me the decision rules. Above me, you took the highest EAC. Here you will take the highest EAC or lowest EAC. Above me, it was benefit. So whenever you're working from NPV angle, you'll select the highest EAC. But when you're working the same data from cost angle, what will you do? You'll select the lowest EAC. So don't mug it up, check what data you are working with, and accordingly EAC called decision rule will change. All this we have done in our regular class. I think it's okay. I mean, you understood this one, no? Same question. Yes, that we need to calculate. Done, people? Yes. So you do capital budgeting, people. One more thing is which common doubt we get is capital budgeting in EAC. No, you calculate only if question asks. Otherwise, not required. Okay. Because usually in investment decision chapter, no, the problem will already be lengthy. They'll give you 2 projects. Many cases, that project life will not match. But project question will already be lengthy. So what ICAI does with bigger problem is they'll directly give the answer based on NPV. They'll not calculate EAC. If you calculate EAC, it is not wrong. Just that ICAI is saying that it is not required to be done. Okay. If they ask you to specifically calculate. Otherwise, don't calculate. Comfortable? Even if you calculate, it is not wrong. In fact, if you ask me, calculating EAC is more appropriate because you are getting everything to one platform and accordingly taking the decision. But ICAI is giving one shortcut. When ICAI gives a shortcut, we should not question at all. Full swaha. Yes, no, because ICAI always puts extra headache to us. If they're giving one shortcut means, do not question, around say take it up. Yeah, thanks for reminding that. Sir, will there be chances that value of PVAF will be given in the question? Sometimes they may give, sometimes they may not give. Okay, I doubt PVAF will be given because all these are 2-marker questions. At least something you need to put efforts in. If every data they only give means, yeah, at least PVAF, I think they might expect it from you. Anyway, if they give it, do it. Replacement chain model is not required there. Yeah, that's foolish method. That's the reason. There is one more method under EAC that is not that popular, so leave that. Yeah, it's okay. We'll stick to EAC. That's good enough. Okay, sir. So with this, we have done all our normal questions and normal concepts of this topic. Now we will take up some examination questions, and what you can expect from this particular topic. It will take another 1 hour. Okay, now another 3 or 4 problems I will take up and take you through how questions from this topic usually comes in examination. 1 minute, I'll see which question can I take or if there is any pending. MIRR we did, no? This also we did. There was one question on EAC. I think you're comfortable with EAC now? Yeah, I think it's there. So I think we can consider it as done, then not done. It's there in your study material also. If you want, you can go through that. This is done. Okay, EAC 1 is done. This is done, no. This is done, no. I think only examination questions are pending. I'll finish this 4 questions I think I have. I'll do that and then we'll take a break. Would you be fine with that? Okay. Let's take up this. Maybe we'll start with Navajivani. I think this was one of the previous year paper question or RTP question. Now it is there in our study material also. Now 1 second, I'll give you a quick recap of the things. Not the entire thing, but for the sake of problems. Now we will be using, they will give you a data, okay, relating usually to one project, and they will say this project should be accepted or rejected. That's all a decision we need to take, whether project should be accepted or rejected. Sir, if they just ask for the decision rule, always give the decision rule based on NPV. You don't have to calculate IRR, profitability index, just calculate what? NPV, and accordingly give the decision rule. And we know the decision rule. For one project, what is the decision rule? For a single project, what is the decision rule of NPV? If NPV is 0 or greater than 0, meaning if NPV is positive, accept. If NPV is negative, reject. Okay, that's what we have to do. But for the sake of calculation of NPV, we don't need a profit, we need a cash flows. And in all these sort of problems, cash flow data will not be given to you in the problem. They will give you sales, so variable cost, to fixed cost, to etc. etc. That means from the topmost number sales, we need to derive cash flows. That's what I put up a small format for. Anybody remembers that format? Tell me. You start with sales. From sales, reduce variable cost. You will get a contribution. Contribution less fixed operating cost will give you EBIT. From EBIT, reduce interest. You will get earnings before tax. Reduce tax. You will get earnings after tax. This is your normal working. Now your cash flow working starts. The first adjustment after earnings after tax. Now, if you want it as a checkpoint, once you get earnings after tax, 5 adjustment you should always remind yourself to consider. One is add back depreciation. Because for tax purpose, depreciation is allowed. Only after reducing depreciation, you will pay tax to the government. But we want cash flow. Did cash go out because of depreciation? No. Hence, the first adjustment you will do is what, sir? Add back depreciation. Then you have 4 more. One is your salvage value. Now, what is the salvage value? We'll go for that table now once again. Salvage value means, sir, you're buying a machinery. Machinery will last forever or it lasts only for few years. Let's say you want to buy a new asset. That new asset will last for 5 years. Meaning the useful life of that asset I've assumed it to be 5 years. After 5 years, what you'll do? Sell off that asset. Let's say if you sell the asset, it is expected to receive 10,000. That 10,000 only we call it as what, sir? Salvage value. Correct? Now you are working out cash flows for year 1, year 2, year 3, year 4 and year 5. Tell me this salvage value, which year you will consider? All the years or only 1 year? Because this 10,000 you will receive for all the years or only once? Only once. That too when? At the end of the project you will sell the asset. That means this 10,000 will only come in 5th year. Comfortable. So when you are estimating 5th year cash flow, you should consider the salvage value. That is one adjustment. Got it, everybody? Next is working capital. We discussed about working capital. I just told, right? Working capital should be considered. Now, working capital, no sir, and why to write it here? I have written. For year 0, you take working capital as an outflow. Outflow is denoted by which symbol in here? Negative. At year 0, you consider working capital as a negative. At the end of the project, you consider this as an inflow, meaning positive. The reason is, sir, if I want to, like here, let's say I want to start a new branch in Hyderabad. Arivupro, we want to start a new branch in Hyderabad. Can we start a new branch only with our laptop or TV, camera, iPad, or we need money for day-to-day business also? We need money for day-to-day business also. That we call it as what, sir? Working capital. The money required for your day-to-day operation is referred to as working capital. So if you want to do a project, you have to invest in your fixed asset also. You have to invest in working capital also. So at the start of the project, you will receive working capital or invest working capital. So that means investment means inflow or outflow. Oh, that's the reason we say at the start of the project, working capital is taken as negative or as an outflow. Understood? Now, once the project is over, whatever money I have spent, I will leave it or I will recover. Now, if I have invested some money for day-to-day operation, means I would like to recover that also. That means at the end of the project, working capital also we will recover. Hence, it becomes what, sir? Positive. Okay, sir, recovery should happen only at the end of the project, sir? No, working capital recovery can happen in first year only, or second year, or fifth year, we don't know. That data will be not given in the question. When the company recovered working capital investment, that information will not be given. Hence, we assume that recovery of working capital has happened at the end of the project. Just a convention, just an assumption. Okay, Saru? So, for working capital for problems, what do we keep in mind? At year 0, outflow. At the end of the project, inflow. That's it. Keep this in mind. Salvage value over, working capital over. Can we go for the third one? Third one is opportunity cost. Opportunity cost. What does opportunity cost means? It's a sacrificing cost. It's a sacrificing cost. Meaning, see, here I am teaching. That means I am letting go of my corporate job. See, either I can teach or I can work in corporate. I can't do both because timings will clash. It will not work. Correct or no, sir? Now, if I work in corporate, let's say I get a salary of, let's say, 40 lakh rupees. If I work in some corporate, my annual salary is how much, sir? 40 lakh rupees, let's assume. Because I am in teaching now, this 40 lakh I am getting or going now? This 40 lakh I am getting or sacrificing? This becomes for me operating cost. Now you think about it now. Now suppose I am working in corporate. Now I want to shift to teaching field. Will I ignore this or consider this? Now think practically. Let's assume that I am working in corporate. I am earning how much? 40 lakh rupees. Now I thought corporate job is boring. Let me start teaching. Now I will ignore this 40 lakh or consider this for my decision purpose. I will consider, because in my mind it will be there. No, I am leaving corporate job, in teaching minimum I should earn how much? 40 lakh. Otherwise it will be loss for me. No, I mean I'm taking the decision ignoring 40 lakh or considering 40 lakh. Considering 40 lakh. This is, am I getting this 40 lakh or not getting? Not getting. So in accounts, opportunity cost we never consider because it is notional. I'm not receiving anything. But for decision, will you consider opportunity cost? Yes. For FM, opportunity cost should always be considered. But for accounting purpose, opportunity cost is never considered because you don't get this. Comfortable? Yes or no? No. Now, opportunity cost here, no, it can either be an inflow or it will be an outflow. As simple as that. Now, you tell me for this 40 lakh, for me, it's an inflow or outflow. What I should consider? I'm in teaching field. So, this 40 lakh rupees I'm sacrificing. That means my income is getting reduced. Sir, if my income is getting reduced, means I can as well treat it as what, sir? Outflow. I can treat it as outflow. Done now. Sir, opportunity cost can either be outflow or it can be an inflow depending on the information given to you in the question. Understood? It can either be an outflow or it will be an inflow. In this case, in my explanation, for me, opportunity cost is an outflow because my income is reducing. Because I've cancelled my corporate job, I quit my corporate job, one income of 40 lakh which I was getting, now I am not getting. That means there is a loss of income. Loss of income, we are calling it as negative. Because when income reduces, what will happen? Inflow will reduce. Inflow ka reduction, you can indirectly denote it as what? Outflow. Because outflow also you show it in negative number. Reduction in income was also you show it as what? Negative number. Hence, reduction in income we presented in our working note as what's an outflow with a negative sign. So when I do cash flow estimate, I will show this 40 lakh rupees as a positive or negative? Negative. So how many years will you show this? I get salary only once or I may get it every year? Every year. That means this 40 lakh I can consider for all the period or maybe only once depending on information given in the question. That depends. You have to read the question and figure that out. Okay, people? Now, one more, I think we have understood this. So one more discussion I'll do and then I'll go into the problem. This opportunity cost from an application is the very next problem we are about to read. Okay, it will come. So far, did we understand? So we discussed depreciation. Then we discussed salvage value. Then we discussed opportunity cost. Then we discussed working capital. The last one is additional working capital or additional investment. Sir, if you do a particular project, should investment always happen at year 0? No. Some project may say 10 lakh rupees we will invest at year 0. Another 2 lakh rupees we have to invest at third year. Possible. Possible. So if they give you that, that is what I mean by what's an additional investment. This again may be there in the problem, it may not be there, we don't know. We have to read the question and figure it out. Okay. Usually investment in majority of the problem will happen at year 0 only. But sometimes the question may say that we need additional working capital investment or some additional investment. If it is there, you need to consider this also. If you are investing means it's an inflow or outflow. That's the reason if you just check the signs, what have I done here? Minus. Then now people, considering all this, you will get the cash flow. But all this cash flow will be represented on what platform? Future value platform. Consider discount factor and consider and find out what? Present value. Find the NPV and accordingly take the decision. This is what we have to do. Can we take up one question now? Great. One second. Now, which question? 1 second. Navajivini Hospital is considering to purchase a machinery for medical projectional radiography, which is priced at how much? 2 lakh rupees. So if you want to do a particular project, means you have to buy a machinery and it will cost how much? 2 lakh. This is what? Inflow or outflow? Outflow. Life of the machinery is
8 years.
8 years. It has an expected salvage value of 18,000. The moment salvage value comes, what is it? It will come every year or only once? And when is that?
8 years.
End of 8th year. 8th year, you should not forget to consider salvage value. Annual operating cost of the machinery is 22,500. Some repair cost or maintenance cost. It is expected to generate a revenue of 120. Stop there. For all this decision, we need cash flow. But they give cash flow or they give revenue? That means they have given sales. From sales, we need to derive cash flows using our same approach. And 1,20,000 is a cash flow per year for 8 years. That means, should we have to put cash flows for 8 years or can we do only for one column? Sir, if every year ka sales or expense, if it is changing, that means for year 1, year 2, year 3, up to 8 years, we have to calculate the cash flow separately. But here, if you just check from year 1 to year 8, cost is 22,500, revenue is also 1,20,000. You can calculate it 8 times or you can calculate it only once. Answer which way, any which way will be same. Done now because cash flow every year is same. That is the reason. Presently, check this line. Presently, hospital is outsourcing radiography work. Some probably X-ray machine we want to buy, sir. Currently, we don't have X-ray machinery. So whenever patient comes and says we need X-ray, no, that work X-ray, since we don't, this hospital does not have X-ray machinery. What we are doing is we are outsourcing this to neighboring test center. We are telling, okay, no problem. We are telling the patient, I will get your X-ray, not in my hospital, but in my testing center, in some other neighboring testing center, and it is earning a commission income of how much? 36,000 per annum net of tax. So that means we are not giving the service free of cost. We are telling the testing center, we have a jugaad, adjustment. Hospital is telling the testing center, I will refer the patient. You give me commission. How much commission? 36,000 per annum net of tax. Done. That means till now we used to get this income. Do you agree with me? Till now we used to get this, hospital is getting this income. Agreed? Now, after I buy X-ray machinery, will I outsource this work or I will only do the X-ray? I will only do the X-ray. I will not go to the testing center. Now means if I don't refer patient to testing center, will that testing center give me commission or commission go in there? Commission go in there. That means what will happen? This income till now I was getting. Now I will get a loss. Loss of what? Income. Now you tell me, sir. This only we call it as OC, as in opportunity cost. Consider or ignore? Consider it as what? Inflow or outflow? Consider it as an outflow, because an income which we were receiving till now, we will henceforth not reduce. Inflow ka reduction only, you can present it as what's an outflow. How much so? 36,000. And this number is already given on what basis? Net of tax. Always remember, opportunity cost you should take on a net of tax basis. Net of tax means after tax. If they give you before tax, what you will do? You do 1 minus tax rate and get after tax number. Analyze whether it will be profitable for the hospital to purchase machinery. You have to give the recommendation using NPV method, profitability index method. Consider tax is 30%, PV at 10%. At 10% discount factor, they only given. Sir, if they give you discount factor with 3 decimals, you should compulsorily take 3 decimals. Don't go round off. If they don't give, you are free to choose. Maybe 2 decimals, 3 or 4 decimals. If they give you exactly 3 decimals, solve your answer with exactly 3 decimals only. Now, how do we calculate? Tell me, sir. We need cash flow, but they have given sales. So what to do? First working note is to calculate the annual net cash inflow. Should I have to calculate 8 years or not required? Not required, because every year cash flow anyway which way is same. Okay. Now, first we will start with sales. How much is sales? Are 1,20,000. From the sales, reduce all the expenses. What and all expenses have they given? It's not necessary you have to present it in same format, like sales minus variable cost, contribution and all. Our intention is what? Cash flow. I mean, simply we will do what? Sales and reduce off all the expenses. You don't have to give any name, contribution or EBIT and all, not required. Here what cost we have? Operating cost, how much? 22,500, reduce. That's it, or there is depreciation also. Depreciation. What is the cost of the asset? 2 lakh. How much is the salvage value? 18,000. What is the life of the asset? 8 years. How do you calculate depreciation? Original cost minus salvage value divided by life. Calculate this. How much is it? 22,750. It's a straight line method depreciation. So will it change or same? Same. So where they have told straight line, so if they give you life and if they give you salvage value, we always calculate depreciation using straight line. If it is WDV method of depreciation, question will clearly specify. If there is nothing mentioned, always calculate using the straight line method. So you reduce all the expenses. That's all they gave. So you will get what's up? Profit before tax. How much is the tax rate? 30%. Where is that? Here. Somewhere we saw, no? Somewhere tax rate is 30%. So reduce tax at 30%. You will get earnings after tax. Till your normal working. From now onwards, investment decisions are working. How many components? 5. First, add back depreciation. How much depreciation you reduce? 20 to 750. Add back 20 to 750. Clear up. Then 4 more. What are those?
Opportunity cost.
First, okay, opportunity cost. 1 minute. Okay, no problem. Opportunity cost we can consider. Have they given opportunity cost? Yes. How much is opportunity cost? 36,000. Opportunity cost should always be considered on what basis? Net of tax. Why net of tax? This is what, sir? This is what? Earnings after tax. Tell me if you are comparing some number. One number is after tax. Can you take this number before tax and compare? That's the reason we say opportunity cost should always be done on an after tax basis. Because this EAT is on a what basis? After tax basis. Now in this problem, opportunity cost is an inflow or outflow? Outflow. So negative 36,000. Got it? Second component done. Depreciation done. Opportunity cost done. Then salvage value. Salvage value is there? Yes. How much? 18,000. But hang on. What is my heading? Annual net cash inflow. That means I should only consider that the component which comes every year. Because I have presented my working note like this. Can I put salvage value into my table now? If you put in here, no, then it is an indication that you are getting salvage value every year. Will you get it? You will get it every year or only once. That means when I put up my NPV calculation, check here I have written 8 and I have written what? Salvage value. Because salvage value comes only once. If I put up cash flow for all the 8 years, then I could have considered my salvage value. But this is the cash flow for what? 1 year, and since all the data is common, I am calculating only once. That's the reason salvage value I will not bring it in here. It should be considered. Not here, I will consider in my table. Understanding because if you consider salvage value here, then it will be what? It's an indication that you will get salvage value every year because this is net cash inflows per annum. Every year from what year to what year? Year 1 to year 8. Will you get salvage value every year for 8 years or only once? Hence we can't. When you present the cash flow in this format, you can't calculate salvage value here. Done, people? Just over. Next is working capital. Have they given working capital anywhere? No. If it is there, what do you have to do? At year 0, outflow. End of the year, inflow. End of the year means can I bring it in here or in my table only? In my table only. Because working capital recovery will happen every year or only once. Once. Like salvage value, even working capital recovery will only happen once. That too at the end of 8th year. If you just check in my MPI calculation, I have written 8 columns too. 1 8 years for salvage value, another 8 years for working capital. No, not there, just for your reference. Done. Okay, by doing this, how much you going to get every year ka cash inflow, sir? 39,075. This is what, sir? This is positive number. That means 39,075 is the net cash flow you are getting from the project every year from year 1 to year 8. But this is what? First 39,075 you will get at the end of first year. Next 39,000 you will get at the end of second year. That means all these are what? Present value platform or future value platform. That means using discount factor, now we need to find out what? Present value. That is a normal NPV calculation. How do you calculate NPV? Year, cash flow, discount factor. They have given discount factor at what rate? 10%. And present value of cash flows. Since every year ka cash flow, is it different or same? Sir, if it is same, should I have to calculate 8 years or can I use shortcut? Shortcut means PVIF or PVAF? PVAF. Done. So at year 0, how much are you investing? Check how much did you buy the machinery for? 2 lakh. At year 0, you will invest. Outflows 2 lakh. At year 0, PV discount factor is always 1. So present value of cash outflow how much? 2 lakhs. This is your present value of cash inflow. Since it is same every year, we use PVAF. So how much is the present value of cash inflow? 2,08,426. But in this 39,075, 2 components are not considered. What are those? Salvage value, working capital. Because you will get this every year or only once. That's the reason I will consider them separately over here. Salvage value is there over here? Yes. How much? 18,000. 18,000 you will get every year or once? That to which year? 8th year. That means you will take PVAF or PVIF. At the 10%, you will calculate PVIF for 8th year. 1 divided by 1.1, press equals to button 8 times. How much is it? 0.647. This you will get at the end of 8th year. That means this is future value. Multiply discount factor, you will get present value. In this problem, if they are given working capital, two things I would have done. What is that? Year 0, I would have also added working capital. At the end of 8th year, again I will consider working capital. Anyway, not given, but if it is there, means I would have done it like this. Fine. Now what is your final NPV? 16,832. So what is the decision rule? NPV is 0 or greater than 0 here. NPV is not negative basically. So if NPV is 0 or greater than 0, what is the decision? You can accept the particular project. They not only ask NPV, they also ask profitability index. How do you get profitability index? present value of cash inflow, that is these two number, and present value of cash outflow, that is this number. Add these two and divide by 2 lakh, you will get profitability index. Profitability index, the decision rule is also same. If it is 1 or greater than 1, accept. If it is lesser than 1, reject. It is greater than 1, so that means the decision rule is what? Accept. These sort of questions usually comes in examination. Manageable. One or two more I will do since I have some time. Done. Based on time, I will decide number of problems. Any doubt? Any question you have so far? Or okay? Alright. Next, maybe I'll take up this question, question number 31. Look at this. XYZ Limited is planning to introduce, pay attention to this one, sir. XYZ is planning to introduce a new project with a life of 8 years. So the total life is 8 years. Initial equipment cost is 3.5 crores. Initial equipment cost means this is year 0 ka. So you have to buy a machinery for a particular asset, for this project, which will cost 3.5 crore. Additional equipment costing 25 lakh will have to be purchased at the end of third year. That means here investment is happening only at year 0, or there are additional investment. Additional investment when it's happening third year. That means this 25 lakh you will consider in which year? Third year, as an inflow or as an outflow? You remember 5 things we discussed: depreciation, salvage value, opportunity cost, working capital, and additional investment. In this problem, additional investment is also coming in. Comfortable? Okay, next. At the end of 8th year, original equipment is this 3.5 crore. They said it will not have any resale value. No resale value means no salvage value. But additional equipment can be sold for 2.5. That means additional equipment has salvage value. You will get the salvage value every year or only once. When? Which year? End of the project, which is 8th year. That means this 2,50,000 is year 8 ka inflow. Year 8 ka inflow. A working capital. Now good question. Working capital also came off. Yes, now a working capital of 40 lakh will be needed. Sometimes they will give extra information. Sometimes they'll only give this much. I think this is good enough for us. When there is working capital, what do you do, sir? At year 0, you will consider it as an outflow. At the end of the project, which is in this case year 8, you will consider it as an inflow. Yes, sir. How much value? Same amount, 40 lakh. In fact, I've told that also. Check. A working capital of 40 will be needed and it will be released at the end of 8th year. They've given not needed also. The project will be financed with a sufficient amount of equity capital. Or just maybe 1 minute, just out of curiosity. If they say it is released at the end of 5th year, usually I have not seen that question. Suddenly that thought came. If they say working capital of 40 lakh will be needed, but it will be released at the end of 5th year, that means you will consider inflow for 8th year or 5th year? 5th year. Such adjustments till now I have not seen, but I'm just saying, whichever year recovery happens, that year you need to consider. But usually that recovery date will not be given. Hence, what is the normal assumption we make for working capital? It will be recovered at the end of project life. In this case, which year is that? Year 8. Perfect. The sales volume over 8 years have been estimated as follows. The last problem, sale was same every year. Here check, year 1 it is 72,000 units. Year 2 it became 108. Year 3 260. For 4th year and 5th year 270. 270,000 per annum. Meaning year 4 you will sell 270,000 units. Year 5 also you will sell 270. Year 6 180. Year 7 also 180. Year 8 also 180. Like last problem, can we club and find out annual cash flow or separate cash flow? Because the sales for each year is different, here we have to calculate the cash flow 8 times. One particular column, and how many columns? 8 year columns. So they have given sales, so we need to arrive a cash flow. I mean, that is one working out. Once you do that, this is become Chintu problem. Okay, now can we do it? Maybe we'll read off more data. This is selling units. How much is selling price per unit? 240. That means easily you can find out sale value. When the numbers are big, present it in lakhs or thousands. I think here numbers 72,000 if you have to present in lakhs, how much it will be, sir? Can I say 0.72? 72,000 if you have to present in lakhs, it is 0.72. 1,08,000 becomes 1.08 lakhs. This is 2.6 lakh. This is 2.7 and this is 1.8. Because you have to fit 9 columns, one particulars and 8 columns. So if you take full number, then you may have some space problem. So work it out by taking hundreds or thousands or lakhs, so that numbers become smaller so you can fit in. Selling price is 240 per unit. Variable expense is 60% of sales. So you can find out variable cost. Fixed cash operating cost will be 36 lakh. So fixed cash operating cost means is depreciation included or excluded? Depreciation is excluded. Why? So depreciation is cash expense or non-cash? That means here I can write that this is excluding depreciation, because they did not use the word fixed operating cost. They use the word fixed cash operating cost. That means only cash expenses are considered. Depreciation is a non-cash expenditure. So depreciation we need to calculate separately. It's not included. And this is changing every year or same? Same. Loss of any year will be set off from profit of 2 years. So if any year if you get a loss, using Income Tax Act provision, you can set off that loss with future year ka profit. Anyways, if you have not got, I'll tell you that with problem. Company has 30% tax rate. It considers 12% to be appropriate after tax cost of capital. So discount factor is given to be 12%. Company is following straight line method of depreciation. Calculate NPV of the project and advise the decision. And at 12%, they have only given the discount factors. The whole crux of this problem is calculating the cash flows. If you calculate that properly, remaining is straightforward. Can we quickly review? Like last problem, 2 columns or 9 columns? So start here, check. Working note number 3, present value, or maybe before that, no? For our cash flows, we need depreciation. We need depreciation. Depreciation given? No, we need to calculate. In that too, we have 1 asset or 2 assets? 2 assets. First asset you purchased at year 0. Second investment is happening at the 3rd year. That's what they said, no? 3rd year, right? That's all. The second investment is happening at year 3. That means you will have 1 asset or 2 assets. So calculate depreciation as one working note. First, year 1 I have put it as year 0 ka outflow. Why am I put a separate working notice? 2 components are there. What is that? At year 0, what and all you are investing. 1 year buying investment worth 3.5 crore. Then there is also working capital. We know working capital initially should be considered as an outflow. At the end of the project, we should consider it as an inflow. How much initially you bought the asset for? 3.5 crore. How much working capital? 40 lakh. Add the 2. I'm presenting every number in lakhs. So the total outflow at year 0 is 390 lakhs. Done. Next one, working out for depreciation. For first 3 years, can I say we had only 1 asset? Because second asset you purchased at the end of 3rd year. That means depreciation on second asset will come from year 4 onwards. Yes. So first asset ka original cost how much? 3.5 crore. They told first asset has salvage value or no salvage value. Divided by life. What is life? 8 years. 3.5 crore minus salvage value 0 divided by 8 is a life. You will get how much depreciation? 43.75. So from year 1 to year 3, depreciation is 43.75. Then from year 4 onwards, you will get depreciation only on original asset or additional asset? Additional asset. How much did you invest for additional asset? 25 lakh. How much is the salvage value of additional asset they said? 2 lakh 50,000. 25 lakh is the investment, salvage value is 2.5. Now don't take life for 8 years. Total project life is 8 years. You purchased additional asset at the end of 3rd year. That means you can use additional asset only from year 4, year 5, year 6, year 7, year 8. How many years? 5 years. If you can use extra asset only for 5 years, means depreciation also you will calculate for 5 years. Hence the denominator here is 5 years. So what is the depreciation on additional equipment? 4.5. That means from year 4 onwards, you will get depreciation on original also, on additional asset also. Put together, how much is it? 48.25. Any doubt? Got it. Now I think we can go ahead with our cash flow working. But we have to do it for all the 8 years. Hence I've started from year 1 and taken it up to year 8. They gave what data in the project? They started from sales. In that too, they did not give sales. They gave units sold. They have given units sold, and what is the selling price of each unit? 240. So how do you get sale value? I'm presenting this in lakhs. 0.72 into 240, how much? 1 or 2 I'll just show you and the things will follow. 0.72 into 240 is how much? 172.8 lakhs. For the second one, it will be 1.08 into 240. How much is that? 259.2. Like that to calculate for all the 8 years. Take the selling price per unit multiplied by the number of units sold. Okay now. Did they give you variable cost? Yes. They told what in the question? Variable cost is 60% of revenue. So that means variable cost is simply 60% of the above number. That is straightforward. Then what information they gave? You don't have to follow the format. Sales minus variable cost is contribution. We want cash flow. right? So go on deducting every expense. You don't have to give any naming for it. Then reduce what's fixed operating cost or fixed cash operating cost. How much is that? 36 lakh per year. Every year this will be 36 only, correct? Now, one more thing. Since they give fixed cash operating cost, this will exclude depreciation. So should we consider depreciation now? Yes. Have you calculated? Yes. From year 1 to year 3, it is 43.75. From year 4 onwards, the total depreciation has become 48.25. That's what I've done. So from sales, if you reduce all the expenses, you'll get profit before tax. No. 1 minute, everybody listen. Check the first year. You're getting profit before tax positive or negative? Negative. Yes. Now here the two options are permissible. Some problems when they will tell, see, you have learnt it in your tax that if you have any loss, you can set it off with the future profit. Here in this problem, have they mentioned? Maybe we do. Loss of any year will be set off from profit of the subsequent 2 years. Now, if you get any year loss, no, you can carry this forward for how many years as per question? 2 years. Now, here what will happen is, sir, if you have a profit, you will pay tax to the government. If you have loss, will you pay tax to the government? No. That year tax will be how much? 0. Next year, no, you will not pay tax on 23.93. Previous year, you made a loss. Set off that loss from 23.93, adjust 10.63. How much remains? 13. Some number. You multiply by 30%. On that number, calculate 30%. How much are you getting? 3.9. That's how calculate tax will be calculated. Comfortable now? Okay. Now, the year you make loss, that year you don't pay any tax. So the tax will be how much? 0. Future year you will not pay tax. Next year you will not pay tax on 23.93. Last year there was a loss, no? First adjust this loss. From 23.93 adjust 10.63. All of you do if you're confused. 23.93 minus 10.63 you do. How much are you getting? 13.63. For second year you will pay tax on 13.63. Multiplied by 30% you do. How much is that? 3.3. This we call it a set off of loss. So if any year if you get a loss, you can carry it forward and adjust it against future. All this more detail you'll learn in income tax. Understood? So is any loss pending to be adjusted or fully adjusted? Fully adjusted. That means from year 3 onwards, any drama or normal? Normal. So third year, take 169.85, multiply 30%. How much you going to get? 50.955. Take 174.95, multiply 30%. You will get 52.48. Like this, it will go on. Done, people? Now suppose there is another way this question usually they will ask. Okay. One is, they will not give anything about set off. They will not mention anything about set off. In this problem, what did they tell? Loss can be carried forward for how many years? 2 years, and you can set off. Like that they mention. In some problem, they will not mention that. If they don't mention, what usually RTP MTP question does is, okay, since they have not mentioned anything about set off, no, take the benefit due to loss. You check here, due to loss, your future tax is same or it is getting reduced. See, for first year, did you calculate tax on 23.93 or you adjusted the loss? You adjusted the loss. That means due to this loss, future tax amount is getting reduced. That means, can I say on loss you are getting tax benefit? On profit you pay tax. On loss you will get tax benefit. Like depreciation. On depreciation we get tax benefit. On interest we get tax benefit. Same like that, on interest we get tax benefit. If they don't mention anything about set off, what you do is calculate 10.63 ka 30% you calculate. How much is that? All of you, quickly tell me. 10.63 ka 30% is how much? 3.18. I'll take it as 1.8. So maybe 1.89. If they don't mention anything about set off, you will get, on loss you get tax benefit. Take the benefit that year only. Take the benefit that year. Which year loss you got? First year. So first year only, right? Instead of writing 0, write off 3.189. Done. Now tax you will pay. Tax you will pay. That means inflow or outflow. Tax amount normally you pay to the government. So it is inflow or outflow. Outflow. This 3.89 you are paying tax or getting benefit. That means you will show this as negative or positive now. Understood? Yes, sir. These are the two ways this tax adjustment can come in the question. One adjustment they will say you can carry it forward for few years. In that case, what do you do? In the year of loss, make the tax to be 0 and adjust that loss in the future years. That is one approach. If they don't mention anything about set off, then the year you make loss, that year only you take off the tax benefit. Calculate 30% or this ka 30% and write that number as negative or positive number. Positive number, because on loss you get tax benefit, and in these problems benefit you represent a negative number or positive number. Positive number. Understood both approaches? Working. That's all is one of the highlight of this question. So from earnings before tax, if you reduce tax, what are you going to get? Earnings after tax. Now 5 components, 5 adjustments. What are those? Add back depreciation. You already have depreciation here. Add back all the depreciation. Then what's salvage value? Salvage value you will get every year or only once? Only one. That too on original equipment or only new equipment? Additional equipment. What is additional equipment? The salvage value? 2.5 lakhs. When will this come? Year end of the project. Here end of the project is 8th year. I've considered salvage value. 2 components done. Next, opportunity cost given? No. That means opportunity cost is 0. Opportunity cost can be inflow also, can be outflow also. Hence I've written plus minus here. It depends on the information given. Then working capital there. Yes. For year 0 working capital I've already considered in this working note. That's all will come, or one more adjustment. Initially working capital will be treated as an outflow. At the end of the project you will treat this as an inflow. The end of the project means year 8. In year 8 you will take working capital as a positive number 40. Done now. One more, which is what? Additional investment. Here do we have any additional investment? Yes. We did purchase an additional asset. No. When did we buy that additional asset? We invested how much? Additional equipment of 25 lakh will be purchased at the end of 3rd year. That means in 3rd year May you will get an extra outflow in the form of 25 lakhs. Got it up? Every year or only once? Only once. Which year? 3rd year. Now 3rd year check, have I taken 25 lakh here? Yeah. Cash outflow 25 lakh. Outflow means we present this as a negative number. Do all this number, you will get respective years ka annual cash flows. But this cash flow of 33.12 you will get at the end of 1st year. This 63.69 you will get at the end of 2nd year. That means all these are there on which platform? Future value platform. Now you can take this data and put up NPV calculation in a table like the way you used to do it. Or here only you can find out present value. Because anyway cash flow is there. To get present value, what is the only component we need to consider? Cash flow is one component, another one is discount factor. So here only put up discount factor. That means you don't have to put up extra table again, saving time. If you want, you can take this number and do separate NPV calculation in a new table again. That is also fine, but that is a wastage of time. Here you anyway have cash flow. Take discount factor here only. So what will you get? All these are what, by the way? All these are cash inflows for respective years. So that means you will get only by what I have written here. Present value of cash inflows. By adding all this, you will get what? Total present value of cash inflows. Got it up? Yes. But for NPV, I need only inflow or outflow also. But in outflow ka present value should we calculate, or outflow happens at year 0? At year 0, total outflow is nothing but present value. I mean, straight away we can calculate NPV. How do we calculate NPV? Present value of cash inflow, we got it here. Adding up, how much is that? 551.127. Minus present value of cash outflow. We already done year 0 ka outflow. How much is that? 390. Reduce that. Inflow ka present value this much. Outflow ka present value that much. So NPV is positive. NPV is positive means reject or accept the project. That's all is this question all about. Okay, Saru. Any problem, sir? EB? Which one? Instead of 10.63, it is 210 negative. And then you will have to carry. Someone is saying, sorry, this is 210 negative. What to do? Now, carry forward the loss. This one, in this problem, you can carry forward the loss for how many years? 2 years. I mean, this year you will make the tax to be 0. Next year you will adjust. But we have 210 loss, but amount is only 23.93. That means you can adjust what, sir? Only 23.93. So second year tax payable also is 0. So in 210, how much got adjusted? 23.93. How much loss still is yet to be adjusted? Do 210 minus 23.93. 186 point something. But you have 186 or only 169. That means you can adjust only 169, and the tax payable for third year also 0. The question clearly told you can carry the forward loss only for 2 years. If you are not able to utilize within 2 years, going. After that, no drama. Next third year onwards, normal 174.95 ka 30%. Okay, because question ka clear requirement is you can carry it forward only for 2 years. If you are able to utilize the loss within 2 years, awesome. If you are not able to utilize, it will get lapsed. Nothing can be done. Good question. Now, that's what the question will mention that. Okay, if the question does not, someone is saying, sir, if the question says loss cannot be carried forward. If loss cannot be carried forward means in that year directly you can write 0 because will you get benefit or no benefit? No. If the question says loss cannot be carried forward, the year you make loss directly write 0. Next year should you have to worry about set off drama or no set off? Because question is saying what? Loss cannot be carried forward. In that case, you will calculate next year 23.93 ka 30%. Like that. That is rare, but it can come. Usually in many 2018-19 questions, they used to ask such adjustment. Possible. Done. 1 minute. I'll take you through replacement decision also. Wait. I'll take you through one question on that also. No need to worry. Okay, thank you, Anjana. She has sent some LDR question in the YouTube live chat. So if you want, you can take up all the chapters. Ka LDR question, which I had referred it in my regular class. A person has pulled up. You can take on YouTube. You can take a screenshot and refer. Fine. Anyways, thank you for that. So can I move forward? Yes, Aru? Or anything else? No. I'll do one more question maybe. Okay, no, we have time. Okay. Sir, I will take up this Paramartha Limited. This is a question which came in MTP September 2024 for 8 marker. Now, this one concept is there called depreciation. Okay, that I'll explain through this particular question. So pay attention to this. That will be one of the highlight of this question. Maybe first I'll tell you the concept. Sir, now we consider depreciation. Why, sir? Initially we reduce depreciation, then we add back depreciation. Correct? Why do we reduce depreciation? Because depreciation is an expense which is allowed for tax purpose. Correct? That means on depreciation, can I say you will get tax benefit? On depreciation, you will get tax benefit. Okay. Then, if since I'm considering depreciation for my working, because on depreciation I get the tax benefit. Now they tell you in the problem in accounts I am following straight line method. For tax purpose, we are following WDV method. Like this, some adjustments some question will have. You tell me for your now NPV calculation, you will consider accounts ka depreciation or tax ka depreciation. You will take depreciation as per accounts or tax? Tax. Why? First of all, why are you considering depreciation in this chapter? Because on depreciation, you get a tax benefit. The reason for considering depreciation is the tax benefit. So is accounts depreciation relevant to us or irrelevant? What we want is what, sir? Depreciation as per income tax. And income tax is suggesting which method? WDV. In fact, Income Tax Act says that every company should follow WDV method only. Certain exceptional units like power generating units and all can go for straight line method. Otherwise, majority of the organization has to follow WDV method. Now, your Income Tax Act says, this is not your FM provision, this is your Income Tax Act provision. What it says is, if you're following WDV method, no, depreciation as per WDV method works on something called block basis. It works on a block basis. Block means a group of asset which has similar characteristics. Like if you have three furnitures, all three put together become one block. Three furniture will become one block. If you have, let's say, 4 plant and machinery, all the 4 put together will become your block number 2, like this. A group of assets which has similar characteristic, we call it as block. Now what Income Tax Act says is, you will charge a depreciation as long as the block exists. Till the time block is there, you can go on charging depreciation. If the block comes to an end, if the block exists means what you can do? You can calculate depreciation as usual, no problem. But if the block comes to an end, if the block ceases to exist means depreciation or no depreciation? No depreciation. That is what Income Tax Act of 1961 suggests as per the block method. What is it once again? Till the time block is there, depreciation also will go on continuing. If block comes to an end, then depreciation also will come to an end. So block continuing means what? Block means what's a group of assets. So if you have at least one asset in the block means block continues. If you have at least one, here you have 3 furniture, no? Suppose 2 I sold off. 2 I sold off. Still one is there. Even if still one is there, block also will still continue. Here I have how many missionaries I have? 4 missionaries. All the 4 I sold off. All the 4 I sold. That means block there or block gone. As long as the asset, even if one asset is there in the block, block will continue. If all the assets in the block are sold off, means the block will come to an end. Understood? Again, not FM concept, but basically your income tax concept, but it is relevant for FM. That's the reason giving a quick 2 minutes discussion. Done now. So again, what is the final point? As long as the block continues, depreciation also will continue. If block comes to an end, means depreciation also will come to an end. Done now. Now, how do you calculate depreciation? Let's maybe, or is it okay if I calculate with the help of this number only? Would you be fine instead of making another example? Can we learn through this? Okay. I'll do a thing. Maybe I'll take up one smaller. Is it okay if I take another 20-25 minutes? There are 2 questions on this block. If you're comfortable, I'll go through all the 4. I mean, all the 2. It'll take another 20-25 minutes. If you're okay. If you feel fed up to boring, I'll do one and I'll move on. Both or one? Both. They're not answering one. Yeah, you don't know, you understand. This question number 22. We will learn depreciation concept. This is a simpler question. We will learn depreciation with the help of this concept. Once again, if you want, we can apply it in the next question. Check this. HMR is considering replacing a manually operated old machine with a fully automated new machine. This we call it as replacement decision. We have an existing asset. It has become old. Now we want to replace this with a new asset. This we call it as replacement decisions. Now whenever they give you replacement decisions, you calculate NPV on an incremental basis. You calculate NPV on an incremental basis. Meaning, one way to calculate is, now you have one asset or 2 assets. We have old machinery and we have a new machinery. One way to calculate is calculate NPV of old machinery separately, calculate NPV of new machinery separately. Let's say NPV of old machinery is 10 lakh, NPV of new machinery is 11 lakh. Then you can take the decision. What is the decision? Since new machinery is giving higher NPV, you go ahead with a new machinery. This is your normal approach. But if you follow this approach, you have to solve the problem twice. Once for old machinery, once for new machinery. We will not be following this because all our ICAI solutions here are based on incremental approach. In incremental approach, what do we need is, for calculating NPV, what do we need? Cash flows. Incremental means extra. Incremental means extra. Okay. What they will do is, they will give you sales. They will not give you cash flow in these problems. They will start from sales. We don't need sales. We need a cash flow. Suppose old machinery generates a sale of 50 lakh. New machinery gives you a sales of 25 lakh. In incremental approach, everything you should take on an extra basis. Instead of sales, you will take extra sales. Instead of variable cost, you will take extra variable cost. Instead of fixed cost, you will take extra fixed cost. Like this. Instead of cash flow, we want extra cash flow. Instead of NPV, we want extra NPV. That is all simply incremental approach. Got it? That means for our NPV calculation, we will take 50 lakhs? No. We will take 75 lakhs? No. Compared to old machinery, new machinery is giving how much extra sales? 25 lakh. How did we get this? 75 lakh minus 50 lakh. Now we will put only extra numbers. So we will get what? Extra cash flow. That means we will get extra NPV. If that extra NPV is positive, accept. Otherwise, reject. That is your incremental approach. Got it? Move on. Check this. The old machinery has been fully depreciated for tax purpose. So 1 second. If it is fully depreciated for tax purpose, means what is WDV of the machinery as per tax? It's fully depreciated. That means WDV is 0. It's fully depreciated. Correct? No. But it has a book value of 2,40,000. Just now they said fully depreciated. Now they are saying WDV 2,40,000. It is fully depreciated for tax purpose. Means as per tax record, WDV is how much? 0. So depreciation in accounts and depreciation in tax are completely different. Accounts depreciation is based on Companies Act Accounting Standard 10 ka provisions. Income Tax Act depreciation is as per Income Tax Act of 1961 provision. Both are completely different. Okay. So here what are they given book value? This is as per accounts. Now you tell me, for our FM we need accounts ka depreciation or tax ka? And as per tax, do we have any WDV or full gone? Full gone. That means is this relevant or irrelevant? That is just given for us to deviate. We will not get deviated. That 240 number is dead to us. It is not there for us because that is as per accounts. We want as per tax. The mission has begun causing problems with the breakdown and it cannot fetch more than 30,000 if sold in the market immediately. 1 minute. If you sell this old machinery now, it will fetch you how much? 30,000. It will have no realizable value after 10 years. If you continue to use it for 10 more years, just old machinery ka salvage value is 0. The company has been offered 1 lakh for the old machinery as a trade-in for the new machinery. Now normally that's what we do, no? We do exchange system. When we have to buy a new asset, old asset we exchange and buy a new asset. So because we are doing exchange, that vendor is saying, if you give old asset to me, I will take the value of old asset to be 1 lakh. Good deal, no? Because currently market value of that old asset is only 30, but vendor is giving how much? 1 lakh. That means we will sell it outside or this vendor only? Vendor only. As a trade-in for new machinery, which has a price before trade-in how much? 4,50,000. The new asset actual value is 4,50,000. Should we have to pay 450 to the new vendor? No. 1 lakh he will adjust from the old asset. That means balance we have to pay only how much? 3.5 lakh rupees because we are doing a barter or exchange system. The life of the new machinery is 10 years. Salvage value is 35,000. Do not forget the moment salvage value comes, end of the project you should consider. Furthermore, company follows straight line method. I don't need that. I need what is the method you are following for tax purpose. Because your accounts is also there, tax is also there. But for tax purpose, WDV method is relevant. Now you tell me, straight line method relevant or irrelevant? Irrelevant. Because we want depreciation as per tax. And tax allows SLM method or WDV. And have they given the rate? Yes, they have given the rate of depreciation to be 7.5%. Yes, sir, people. And considering that this is the only mission in the block. You had old asset. Only one asset was there in the block. That old asset gone. Is there no or gone? But instead of old, what came? New came. So block now has ceased to an end or it is still there? Still there. But you will use new asset for how many years? 10 years. After 10 years, what will happen? The block will come to an end because old also gone, new also gone. That means at the end of 10th year, the block will cease to exist. Understanding of in that year we have to do something. I will tell you what to do. Understanding of. In fact, in this problem, nothing needs to be done. But anyways, given below are the expected sale from both old and new. Now we want the total or incremental? Incremental. But just check one good thing is sales or material cost to labor cost to variable overhead, fixed overhead, same different every year or same every year? Given below are expected sale and cost from the old and new machinery, meaning every year this data is changing or same? Because this is the data not for 1 year, sir. This is the data for how many years? 10 years. Every year you will get the same sales, same cost. That means should you have to calculate the cash flow 10 years separately or we can do only once? You know, we do it. But depreciation will change, no, sir. Because depreciation, which method? WDV method. WDV method means you will get same depreciation every year or different? That means now you have to calculate the cash flow for 10 years. One particular column plus 10 years column. Totally how many columns? 11 columns. So how to fit in exam? You can use 2 sheets. 2 sheets and you can write it, fit it vertically or whatever you're comfortable, do it, but you have to do it. Okay. Alright. Now, one component. Depreciation they're given. Is this depreciation relevant for me or dead for me? Why? Because this is depreciation as per accounts. Because, yes, no people, because see here they're told depreciation every year is what? 24,000. WDV method will give you same depreciation every year. Which method gives you same depreciation every year? Straight line. And you're following straight line method where? In accounts. Is that relevant or not relevant? They have found out profit before tax by considering tax depreciation or accounts depreciation. Because profit before tax is a number from accounts only, no? So they have reduced accounts depreciation, but we don't need accounts depreciation. We want tax depreciation. That means in this one more adjustment you have to do. Whatever depreciation they have reduced, first we need to add back. Then deduct what? Correct depreciation as per tax. And the tax depreciation will not be same every year, it will be. That means you can't put one column, you have to compulsorily put 11 columns. Easy but lengthy. Easy but lengthy. Got it? Now I'll show you the working. I don't have time to run through solving will take minimum 1 hour this. Okay. I'll quickly run through. Tax rate is given. Check this. Analyze whether old machinery should be replaced or not. Ignore capital gain tax. Ignore capital gain tax. So you have to do something called capital gain. But in this problem, they have asked us to ignore. Okay, I'll tell you what, if they don't tell, ignore what to do also, I'll tell. So maybe we learn of entire concept with this problem only. So that next problem may not be required, it's the same. So that we'll try to learn this. So first, how depreciation works. Let's understand this. And this is as per Income Tax Act, nothing with accounts, nothing with FM. How Income Tax Act suggests there is, first, do you know the WDV? Listen everyone, this one, I don't know how much of it you remember. So I'll try to be a little more clear, a little slower on this. First, we need depreciation as per accounts or tax. What is the WDV of the existing machinery as per tax? 0. Why 0? Because they told in the question asset is fully depreciated. If asset is fully depreciated means WDV is how much? 0. Correct? Any problem? No. Tax base of the existing machinery is how much? 0. Tax base means on what component you calculate depreciation. On what value you calculate depreciation, we call it as tax base. Tax base here is 0. Why 0? Because as per tax, asset is any which way fully depreciated. That means any more depreciation can you claim on old asset or nothing allowed. That means the tax base of old machinery is also how much, sir? 0. Any doubt till here? Any doubt till here? Okay. Okay. Now, old asset you are giving away. Is new asset coming in? Yes. Now, normally what do you do, sir? In accounts, now what do you do? How much you are purchasing new asset for? 4,50,000. That means you will calculate depreciation directly on 450. But tax, it doesn't work like that. How tax ka block method works is, first to take WDV of existing machinery. How much is that? 0. From this, is old machinery there or it is sold off? Is old machinery there or you are selling off? Selling off. How much are you selling old machinery for? The company has been offered how much for the old machinery? 1 lakh. Reduce the sale value from the WDV. How much is WDV? 0. How much is the sale value? 1 lakh. Reduce. How much are you getting? Negative 1 lakh. To this you add the cost of new asset. What is the cost of new asset? 4,50,000. Now you will get depreciation base for the new machinery. This is how you calculate when you sell an asset. Now, first what you have to do is take the WDV of asset sold. From that reduce salvage value. Then you add what? Cost of the new asset. Whatever value you get here, how much value you are getting? 3,50,000. On this 3,50,000, you will calculate depreciation on new machinery. Understanding? Got it? Once more. Now, once more, tell me what is it. Once more. Okay, I'll make another example. Let's say WDV of old asset is 1 lakh. Assumption. And we're building another example. WDV of old asset is how much? 1 lakh. In this problem, it is actually 0. I'm taking another example. Now, this asset there or it's sold off? Or maybe I'll make this, instead of 1 lakh, I'll make this as, let's say 20,000. Okay. Now, reduce the sale value. What is the sale value of old asset? We will use this information. What is the sale value of old asset? 1 lakh. Correct? Now you are trying to calculate on new machinery how much depreciation you will charge. On new machinery, how much depreciation you will charge. You will not calculate depreciation straight away on new asset cost. First you have to do is, first take old asset WDV. Because depreciation as per tax is not on asset, it's on the block. It's on the block. That means we don't want asset value, we want block value. How much was the block value before? 20,000. But this block there, you sold it. You sold it for how much? 1 lakh. Reduce that. That's it. Or new asset came in the block. So new asset came in the block for some value. Add it. So that we call it as cost of new asset. How much is the cost of new asset? 4,50,000. I mean, what is the block value now? You had a value of 20. You sold out that block for 1 lakh. Now a new asset came in the block with how much cost? 450. That means how much is the block value? 3,70,000. Now you will start charging depreciation on 3,70,000. This is how block method works. Understood? If you don't want so much drama, simple ways: WDV of old asset minus salvage value and cost of new asset. That will give you what, sir? Block ka value for the new asset. You will charge depreciation on new asset how much? 3,50,000. Okay, now, so on what value you are calculating depreciation, that we call it as what? Depreciation base. Now onwards you will start depreciating or calculating depreciation on what value? 3,50,000. If you had old asset, what was the depreciation base? 0, because it is already fully depreciated. But because of new asset, how much depreciation you can charge? 3,50,000. That means, are you getting extra depreciation? Do not forget, we are working using what approach? Total approach or extra approach? Your old depreciation base was 0. Your new depreciation base is how much? 350. How much extra you are getting? From 0 you are getting 350. So how much extra? 3,50,000 extra. This we call it as what? Incremental depreciation base. Every number we want incremental. Every number we want Incremental. Old asset ka depreciation base was 0. New ka is how much? 350. That means how much extra depreciation base you got? 350. That only we call it as incremental depreciation base. Easy, people. Pakka. Okay. Now, if you just check out, only one culprit is there which we're feeling very bad. That is depreciation. Only that the data now is changing every year. Rest every data was same. Correct? No. That means what I'll do is, instead of finding profit before tax, first I will find profit before depreciation. Shortcut way, a presentation. You can choose to ignore this also or follow this. Your call. I'll find profit before depreciation. Because why am I doing this? Only one component in this is changing every year, which is what? Depreciation. The rest everything is what? Same. So first let's find out profit before depreciation. Okay now? And should I take this depreciation or I should ignore? Ignore. Why? Because this depreciation is as per SLM. So from here, in fact, you don't have to rework again. How much is profit after deducting depreciation? 3,24,750. Can we consider this depreciation or we have to recalculate? Because this depreciation is as per SLM. We want depreciation as per tax, which suggests which method? WD. But they have already reduced 24,000. So what do you do? Add. These two you add back. Quickly do it. 3 lakh? 48,750. Similarly, you do here also. These two you add back. 42875 correct. See, that's what I've done over here. First, I've calculated earnings before depreciation. Okay, the profit as given I've taken. They've already reduced depreciation. I've added back. That's the number you're getting. Now we want this profit or we want incremental. You want extra. Old asset used to give me profit before depreciation 348. New is giving me 428. So compared to old, the new is giving how much extra? 80,000 profit extra every year. Every year. This way, now in my cash flow, when I put up my cash flow here, I'll show you also. I will not calculate sales gains and all from the beginning. Directly, I'll start with earnings before depreciation. Shortcut. If you don't do this, every data you have to copy again and again for 8 years. By doing this, I can reduce my efforts a little bit. Understanding, got it or what it are. So what did I do? Just quickly tell me once again here. What did we do? Only one number was changing, which was depreciation. Hence, we found out what? Profit before depreciation. But in the question, after deducting depreciation, they had given profit. Hence, what do? Added back. I added back these two numbers and we worked out that. We calling it as earnings before depreciation. Old asset was this much, new asset was this much. Now, under this incremental approach, we don't want old car, we want new car. We want what? Extra. So, old is giving 348, new is giving 428. Compared to old, new is giving how much extra? 80,000. This is what? This is what? Earnings before depreciation. Will this number change for 10 years or same every year? Same every year. Only one component will change, which is depreciation. That is what I'm about to do the next. Is it okay? Since depreciation changes every year, we need to calculate depreciation. We want depreciation or extra depreciation. That means will we take depreciation base or incremental depreciation base? Incremental depreciation base. Yes, sir. This is a block. Old had a block of only how much? 0. New has how much block value? 350. Compared to old, new has how much extra block? 3. Oh yeah, we have to do A minus B. That's what I've written here. See, B minus A. Okay. A ka value is 0. That's the reason clearly I've given. A ka depreciation base is 0. New ka depreciation base is 350. From 350 reduce 0. That's what I've written here as B minus A. You will get extra incremental depreciation base called 350. Now on this, go on calculating depreciation. But unfortunately, depreciation value will go on changing. So opening balance how much? 350. How much is the rate of depreciation? They told as per income tax 7.5%. Calculate. So one I'll show, that's it. 3,50,000 into 7.5% you do. You'll get 26,250. This is your opening balance. After reducing depreciation, you will get what? Closing balance. First year ka closing will become second year ka opening. Now on this opening, calculate 7.5%. You'll get the value. Like that you calculate for how many years? 10 years. Lengthy but easy. Okay now. Just you need to practice all this. Now when I say maybe you will get it, or sometimes you may feel that you are not getting it. Sit through, revise, you will get it. Or ideally you should practice all this. Now this is the depreciation every year from year 1 to year 10. Depreciation or extra depreciation? Extra depreciation. Do you know extra earnings? Yeah, we already found out that. How much is the extra earnings before depreciation every year? 80,000. So in this 80,000 is depreciation considered or not yet? Not yet. So reduce depreciation or incremental depreciation? incremental depreciation, which you got it from year 1 to year 10, this number, copy this number, that's what I've done. Yes, sir, people? So from profit before depreciation, if you reduce depreciation, you will get profit before tax. Now about same working. From that reduce tax, you will get earnings after tax. Now 5 components here same, which is add back, incremental depreciation, which is there, then salvage value Allah, incremental salvage value. How much new asset ka salvage value? So new asset ka salvage value is 35,000. Old asset, if you use it for 10 more years, they told its salvage value after 10 years is 0. New asset ka salvage value after 10 years is 35,000. Old asset ka salvage value after 10 years is 0. So how much is incremental salvage value? 35,000. That's what I've written clearly over here. Yes, sir. That's the reason 35,000 minus 0 I've written. This salvage value will come every year or only once? Which year? End of 10th year we have to consider. Then working capital not there. Additional investment not there. Okay now. Then this is all your cash inflows. Multiply discount factor. You will get present value of cash inflow. From that reduce present value of cash outflow. What is present value of cash outflow here? So how much what is the value of new asset? 4.5 lakh. But should you have to pay cash of 4.5 lakh, or vendor is saying 1 lakh I will deduct from old asset? 1 lakh from old asset. So at year 0, how much to buy you have to spend? Only 3.5 lakh. This is your present value of cash inflow. This is your present value of cash outflow. That means you will get NPV. You will get extra NPV called incremental NPV. How much is that? 44,671. So if incremental NPV is positive, go ahead and accept the project. Otherwise, reject. Yes, sir. Comfortable. Paka. There is one adjustment which we had to do, but question said not required. Only that I will tell, so that this problem only will become full-fledged for us. And all this drama will only come if you are following WDV method of depreciation. Because on straight line method, there is no block concept. There is asset to asset depreciation. Okay. So all this drama will only come for, remember, only for WDV. Now what is that extra fitting is? I think I've solved that. 1 second, hang on. Here, block. Now, one working note we need to put up when they say block ceases to exist. In this problem, block there or block gone? Block gone. Check, sir. Maybe once again I'll tell you. Year 0 mein, in this block mein, how many assets you had? You had one asset called old asset. Is that old asset there or old asset gone? Gone. But at same year 0, new asset came in. That means block ceases or block continues? Block, I'll write here, block continues. Correct? Old asset is gone. Instead of old asset, new asset has come. So that means a block continues. No. Will this new asset last forever? No. It lasts for how many years? 10 years. In the end of 10th year, what will you do for this new asset? You will sell. The new asset means there or new asset gone now? New asset is gone means now at the end of 10th year, block there or block endo? Block ending. Correct? So whenever block ends, Income Tax Act suggests that you'll have to do a few things. Okay, actually IT Act suggests slightly different thing, but our material is slightly doing different thing. Forget about income tax, we will follow what is required for exam marks here. Okay, now what you have to do is, first, this which year, when is the block coming to an end? 10th year. That means all this drama will only come in which year? 10th year. That's what I've written here. Block ceases to exist. Which year again here? Year 10. First, to find out the WDV of the asset, of which asset now? 10th year, old asset will be there or new asset will be there? New asset. That your previous working note will give you. See, year 1, 2, 3, year 10 is there over here. What is the closing balance of the new asset at the end of 10th year? 160,504. Any problem? Take the WDV of the new asset. For which year? When the block comes to an end. Here block is coming to an end on which year? 10th year. Take that WDV. From previous working note, you will get it. You can give the references working note number 2. Okay now. Compare this with salvage value. Are you at the end of 10th year? Are you keeping the asset, new asset, or selling it off? What is the salvage value of the new asset? 35,000. Very simple. Worth of the asset. WDV means worth of the asset. What is the worth of the asset? 1,60,000. How much did you sell it for? 35. Happy face or sad face? Sad face. Why? 1,60,000 was the worth of the asset. You sold it only for 35. That means you made a bumper loss. Correct? No. When the block ceases to exist, no, you will get short-term capital gain or short-term capital loss. One gain or loss you will get. That gain or loss, Income Tax Act calls it a short-term gain or short-term capital gain or short-term capital loss. So 160 worth of asset, you sold it for 130 or at a 35. That means it's a what? Short-term capital loss. How much? 125. Now you know. Just now we discussed on loss, you pay tax or you get tax benefit. Perfect. On loss, you will get tax benefit. Tax benefit means outflow or inflow. Inflow. Which year? Block comes to an end that year. Which year is that? 10th year, you have to take this number. Normally, they will give you capital gain ka tax rate is 20%, 10%. Like that, they will give you a different tax rate. If they don't give, normal tax rate you can take. What is the normal tax rate in this problem? 30%. Calculate 30% of this. How much is it? 37,651. This much you don't have to pay tax. You will get to the benefit. Getting the benefit means is an outflow or inflow. Which year? Year 10. Now we have calculated inflow here now. In this column, one more cash flow will come component here called short term or tax benefit due to what? Short-term capital loss. Every year or 10th year? 10th year. How much is the value? 35 or 37? 37,651. What? Oh, correct number. 37,651. This will come. Sir, why you didn't do in this problem? Because question told to consider this capital gain or ignore. If they had not told ignore, I would have done this. That's what happens in next problem. You got the funda. This is what I wanted to explain the next problem, but I hope you got it. This is good enough, no? Okay, let me quickly recap once again. What is it? This you will do only when what's it? Block ceases to exist. Block ceases to exist means block has come to an end. In that case, now what do you do? Take the WDV of the asset at the end of 10th year. Actually, Income Tax Act suggests slightly different. Don't compare. Don't say Dilip sir taught something and doing this. Okay, this is wrong only. But our books are doing this. For FM marks, do this only. Don't change it. Don't say I am wrong or he is wrong. He is right as per Income Tax Act. I am right as per FM. Both are right as per the sake of marks. Follow this only. Do not change. Don't compare with this income tax and say he taught rubbish. I am not teaching rubbish. This is what our ICAI has done currently. Okay, follow this only. First, take WDV at the end of 10th year. Compare this with what? Salvage value. So WDV is the worth of the asset. Compare it with salvage value. If you have sold it at higher price, you have made a gain. If you have sold it at lower price, you made a loss. On loss, you get the tax benefit. On gain, you have to pay tax. Can we redraft one scenario with gain? Because next problem is on gain scenario. Okay. So gain scenario, when it will come? Let's say WDV of the asset is sale 1,60,504. Sale value, no. So let's assume salvage value to be 2 lakh. Now you tell me 160 is the worth of the asset. You sold it for 2 lakh. Now it is loss of gain. We call this as what? Short-term capital gain. How much is this? 39,496. Sir, on gain, will you get tax benefit or you have to pay tax? Paying tax means inflow or outflow? Outflow. Calculate. 39,496 ka 30%. 39,496 ka 30%. How much? 11,848. This 11,848, when you're working cash flow workings, 10th year, you should consider this as an outflow because you are paying tax. On loss, it's an inflow because you get tax benefit. On gain, you have to pay tax, so it will become an outflow. That's it. Manageable. This is the concept. But all this drama will only come in the block ceases to exist. And mind you, whenever they say this problem, they will not give you tax rate 30%. They'll give you 2 tax rates. If you want, maybe I'll show you that problem once. 1 minute. Check. We'll not solve, but we'll quickly review. Check here. Normal tax rate is how much? But capital gain tax rate is 20%. I mean, now when you calculate capital gain, no, don't apply 25%. Take 20%. But for normal tax, take 25%. If you want, you can go through this MTP September 2024 question. That's the difference. Understood this? I think that's good enough. Yeah, we have spent quite a few time on this. So with this, our investment decision topic finally has come to an end. Thank you. Let's take about how much break you want, sir? 1 hour, right? I think we will take about 15 minutes is good enough. No? Not enough. 20 minutes you want. Okay. So let's take about 20 minutes break. We'll come back and then we will take up the next smaller topic. Thank you. Well, hello people. Welcome back after the break. So next we shall be starting with new topic, that is financial analysis and planning. That is ratio analysis. Okay. An easy chapter. There are about few ratios. You need to remember the way to calculate those ratios. Usually they ask a fill in the blanks type of questions from this particular topic. meaning they will give you some data, some components will be missing. We need to find out that. First of all, ratio means simply take one number in the numerator and one number in the denominator. It is just a mathematical expression of a numerator divided by denominator. But the problem is, or the thing you need to keep in mind is, you can't take any random number. Like, can you compare GP with current liability? Can you compare GP with current liability? Are they related or unrelated? So ratio always works with a related number. If you are taking one number in the numerator, it's a related number only you should take in the denominator. Like GP is expressed on sales. Sales and GP are connected. So that should be the numerator and denominator. Unrelated variables you should not consider. That is one. Now, why do we calculate ratio is, with the help of ratios, you will be able to identify the strength and weaknesses of the company. Whether the company is doing good or bad, you will be able to identify. That's one of the reasons the ratios we calculate. Okay. So let's do a thing first. Let's quickly run through all the ratios, how to calculate them. Then we will take up few questions, and that's how we're going to cover this particular topic. Is my voice okay? Feeling a little continuous speaking, no? Gets a little daunting at times. Okay. Now, what? I didn't understand. What I've been drinking only. Continuous. No, we're not used to speaking marathon. You have to take continuous, right? So sometimes it gets you. It's okay, no problem. Tomorrow off, huh? I will off and I'll go to Bangalore. Okay, tomorrow I'm traveling back. Anyways, first set of ratio is liquidity ratios. There are broadly few ratios: liquidity ratios, efficiency ratios, etc., etc. You don't have to remember the category. You just need to know weights calculation. First is current ratio. Current ratio is given by current assets divided by current liability. Ideal number is 2. This ratio is trying to measure whether we have enough balance or enough investment in current asset using which we can settle current liabilities. Next is quick ratio or asset test ratio, sometimes also known as liquidity ratio. Given by, instead of current assets, you take quick assets divided by current liability. And how do you get quick assets? Quick asset is nothing but your current assets minus your inventory minus your prepaid expenses. Usually prepaid expenses will not be given. So in this case, quick asset is given by current assets minus inventory divided by current liability. So we are trying to ascertain or find out whether we have enough balance in quick assets through which we can settle current liability. Next is cash ratio. In cash ratio, it's given by the formula. This ratio is trying to ascertain whether we have enough balance in cash through which we can settle current liability. And cash here refers to cash in hand, cash at bank, as well as short-term investments. So numerator will be cash in hand, cash at bank plus short-term investment, that they refer to as marketable securities, divided by current liabilities. Okay. Next is basic defense interval ratio. This ratio is trying to test if it's a doomsday, meaning if revenue of the company stops. If revenue of the company stops, then how many days can business survive? If the revenue of the company completely stops, how many days can the business survive? All right. So that is given by the formula. Same. What is the previous one formula? Cash in hand plus cash at bank plus marketable securities. Here we add one more called net receivables divided by operating expense per day. It's like this. Let us say our operating expense for whole year is 365 lakhs. In a year, how many days are there? 365 days. That means, can you tell me what is operating expense per day? 365 lakh. 365 lakh is for 365 days. For one day, how much is it? 1 lakh. Okay. Suppose I have a cash balance of 25 lakhs. Cash in hand, cash at bank, marketable security plus my debtor put together is how much? 25 lakh. How many days can I survive? My expense every day is how much? 1 lakh. I have how much with me? 25 lakh. How many days can I survive? 25 days. That's all is basic defense interval ratio is trying to calculate. So how do you get this as formula? Cash in hand, cash at bank plus marketable security plus net receivable divided by operating expense per day. That's what they're calling it over here. Operating expense divided by number of days. If you do, automatically you will get what? Operating expense per day. Again, all these are not that very important. Whatever is important, I'll tell you in exam what usually comes. Net working capital. How do you get net working capital? Current assets minus current liability. These are your some liquidity ratio. Okay. Next, equity ratio. These are all some capital structure ratio. First capital structure ratio is Equity ratio. Equity ratio is trying to measure of your capital employed. How much money has come through equity? You need funds, no? The fund can be arranged through equity share capital or through retained earnings or through debt or through preference shares. Equity ratio is trying to calculate among your funds how much money came through equity. Equity here refers to not equity share capital. Equity here refers to equity share capital and retained earnings, or you can also call it as reserves and surplus. Okay. So that means the formula for equity ratio will be equity divided by capital employed. And how do you get equity? Equity share capital plus reserves and surplus divided by capital employed. There are some different names for this. Instead of equity, you can call it as shareholders equity. Instead of equity, you can call it as shareholders equity, or sometimes it is also referred to as net worth. Same name. Equity or shareholders equity are also denoted or also called by net worth. Capital employed is also called as net assets. Another name, that's it. Okay, na sir? So basically, how much money has come through equity is what we are trying to measure. Similar way, debt ratio. How do you get debt ratio? Of your total capital employed, how much money has come through? Debt. So that means the total debt divided by total capital employed. Either you can write capital employed or you can write net assets. It's okay. Then debt to equity ratio. This ratio is trying to measure the relationship between debt and equity, because this is one of the industry norms. Usually when people invest in the company, they check debt equity ratio. The industry norms for majority of the company is 2:1. Meaning if you have taken 1 rupee equity, maximum debt company should have is 2 rupees, not more than that. More than that signifies that business is very risky. Many people, investors, stay away from such companies. Hence, this is quite popular since we are saying. So debt equity ratio is given by the formula debt divided by equity. Okay, now usually in the numerator, don't take total debt for our problems. No, we take long-term debt for problems. Actually, the ratio says total debt divided by total equity, but for our problems, we don't take total debt. We take the long-term debt. Usually, question will specify. If they don't specify, also take it as long-term debt divided by equity. Equity ka another name is what? Shareholders fund. No, you can call it as shareholders equity or net worth. Okay, debt to total asset ratio. Debt to total asset ratio is trying to measure. Name itself formula. Name only formula is there. Debt to total assets. So formula is what? Total debt divided by total assets. This ratio is trying to measure how much money or how much debt you have used to buy your assets. To buy assets, you need money. Money can come either from equity or through preference shares or through debt. This ratio is trying to measure how much money has come through debt. Because debt is risky, no? If you're using debt and buying an asset, suppose you don't pay bank interest, what will bank people do? They will take off that asset because that asset will be given as security, no? So that's what this ratio is usually trying to measure there. Capital gearing ratio. Of late, I've seen 1 or 2 questions from this, so this could be considered as important. Capital gearing ratio. So capital gearing ratio is trying to calculate, or capital gearing means what? When we say put gear in car or gear in bike, we want to go slow or fast? Fast. Gearing means to go on high speed. So what capital gearing ratio is trying to signify is, we studied this is trading on equity, remember? Yesterday. Leverage, we studied leverage or somewhere, we studied trading on equity. Trading on equity means what? Using fixed cost instrument to increase the return of the equity shareholders, I tell. That's the same way as capital gearing ratio. Capital gearing ratio is trying to measure, you basically use a fixed cost instrument to increase equity shareholders' return. You want to use fixed cost instrument to increase shareholders' return. How? Yesterday I gave you an example, remember? Sales is, let's say, 10 lakh. Current year, let's say interest is 1 lakh. That means how much? Sales minus interest is how much, sir? 9 lakh rupees. Let's say no other expenses there. That means this becomes profit before tax. Next year, sales became, let's say, 60 lakh. Will interest also increase or it will be same? That means how much will be your profit before tax? What happened? Let's say tax is not there. That means PBT only will become EAT, and preference dividend is not there, means EAT only will become EASH. So you used a fixed cost instrument and your EASH from 9 lakh because of that became 59 lakh. So that means you are using fixed cost instrument because the interest on them is fixed. Later on, when you start earning higher profit, equity shareholders will get higher returns. Understood? That is what is capital gearing ratio means. You want to use a fixed cost instrument so that the return for equity shareholders will be on the higher side. That is what is capital gearing ratio. Now tell me, sir, How do you get capital gearing ratio or formula? Capital gearing means using fixed cost instrument. Which instrument have fixed cost? Preference shares and debt. That is your numerator. Preference share capital and debt divided by denominator. Whose return you want to increase? Equity shareholders. That only you call it as equity, because what and all belongs to equity shareholders. Equity share capital and reserves and surplus. That means the denominator you can call it as equity share capital plus reserves and surplus, or you can call it as equity. You can call it as shareholders equity, or you can simply call it as net worth. Fine, okay with this? Of late, 1 or 2 questions I've seen on capital gearing ratio come in the examination, so be a little careful on that. Move on. Proprietary ratio. This also is used a few times in problems. Proprietary ratio means how much proprietary funds is used to buy assets. How much proprietary funds is used to buy assets. So what is proprietary funds? Proprietary means owner. Who are owners of the company? Shareholders. Who are shareholders? Equity shareholders and preference shareholders. Now that way calculate how do you get proprietary fund. What belongs to equity shareholders? Equity share capital and reserves and surplus. What belongs to preference shareholders? Preference share capital. Adding these three, you get proprietary funds. Okay, now. So this ratio is trying to calculate again how much proprietary fund is used to buy total assets. Hence, proprietary ratio is given by the formula what? Proprietary funds divided by total assets. And this is how you calculate proprietary funds. Okay, G. There is one more way you can express proprietary funds. I'll tell you that in the problem. Okay, G. Any doubts, sir? Whether net asset and you're saying net asset or capital employed and PF is it same? No, sir. Because in net assets, no, you take fixed asset, you take current asset, and you reduce current liability. Debt is not included. Okay, so here we get, excluded there. That's the reason. And yeah, actually you can, no, that number will get excluded. No, it will not be same in that case. Because the way of calculating will be different. You put a balance sheet if you're confused there. Okay, when you put a balance sheet, you have equity share capital here. Then you have, let's say, reserves and surplus. Then we have preference share capital. Then we have debt. All this becomes your capital employed. Yeah, okay, now here is your current liability. Then is your FA and then in your CA. Let's assume some random numbers. This is 10 lakh. This is 2 lakh. So total will be how much? 12 lakh. Here also it will be how much? 12 lakh. Okay. Now let's assume this to be 1 lakh. That means all this 3 should become 11. Maybe I'll make this as 3. I'll make this as 2. Then I'll make this as 1. So 3, 5, 6, 7. So that means there should be 4. Comfortable with some random numbers. How do you get proprietary funds? These 3 ka addition. So 3 lakh plus 2 lakh plus 1 lakh. It will be how much? 6 lakh. Okay, now how do you get net assets? Net asset is your capital employed. How much is your capital employed? Add all this. How much is it? 3 plus 2, 5. 5 plus 1, 6. 6 plus, rather 5, 6. 6 plus 4 is 10. Same or different? Okay. If debt is not there, then your statement will work out. If debt is not there, then proprietary fund and capital employed will be same. Okay, G. Can I move forward? Everybody good? Any problem? No? I will use the same table and also tell you one more way to calculate the proprietary fund that I will tell you in problem. First, let's quickly revise the ratios once. Next is, this is okay, not that importantly, interest coverage ratio. Interest coverage ratio. Interest coverage ratio is trying to measure how much profit you have to pay off interest. Interest coverage ratio is given by the formula. You want to know the profit before interest. Before interest, what profit you get? EBIT. So interest coverage ratio is given by the formula EBIT divided by interest. Let's say EBIT is a 10 lakh. Interest is 1 lakh. So how much is this? How much is coverage ratio? 10. That means whatever indication is, company has profit using which they can pay the interest 10 times. Company has enough profit to pay the interest 10 times. So coverage ratio and all, who will keep in mind? Debt people, because who will get the interest? The providers of debt finance. So they will watch out for this. They want this number to be low or very high. The higher this number, they will have a sigh of relief. That company has enough profit so that they will not default our interest. So coverage ratio should be ideally on the higher side. Done, people? Okay. Similar to interest coverage ratio, can you calculate preference dividend coverage ratio? See, interest coverage ratio, how did you calculate? EBIT divided by interest. Preference dividend coverage ratio, can I take EBIT? Using EBIT, can I pay preference dividend, or with what I will pay preference dividend? Earnings after tax. So you will take EAT or PAT. There it was divided by interest. Here it will be divided by preference dividend. Done now. Similarly, can you also calculate equity dividend coverage ratio? Is profit after tax available for equity shareholders, or what is available? Each or net income. So the numerator will be each or net income divided by total equity dividend. That will give you equity dividend coverage ratio. Any problem so far? This is not required. It's okay. Leave. Now this is quite important in almost every ratio question. This efficiency ratios, no, 2 or 3 efficiency ratios will 100% be there in majority of ratio questions. So this I would probably put it on the rate on the higher side. Excuse me. Now, efficiency ratio is trying to measure how efficiently you are using the components. It could be assets, it could be capital, whatever. First, total asset turnover ratio. Total asset turnover ratio. One simple way. I mean, look at the name and tell me what is the formula according to you. Total asset turnover ratio. Turnover means sales. Looking at the name of the definition, what according to you should be the formula? Total asset is coming first, turnover is coming next. That means ideally the formula should be assets, total assets divided by total sales. Correct now. This should be the way it looks like, but hang on. Now sir, this is an efficiency ratio. So this ratio is trying to measure how efficiently you are using the assets. How efficiently you are using the assets. Let us say total assets is 1 lakh. Okay. Sales is 1,50,000. Calculate this for me. Let's see. Total asset, I've assumed it to be 1 lakh. Total sales is 1,50,000. How much are you going to get? 0.67. That means for one, so this is the right indication. Huh? No. Sir, by using asset, you want to generate lower sale or higher sale? Higher sale. Hence, the formula for any turnover ratio is, the formula is the sales should come in numerator. Sales should come in the numerator. So what is the formula? Now reconstruct for me. Total asset turnover ratio is given by the formula. Sales divided by total assets. Now calculate this. What is sales? 1,50,000. What is total assets? 1 lakh. How much are you getting? 1.5. This is efficiency ratio. This ratio is trying to measure how efficiently you are using your assets. How efficiently you are using your assets. It means if you buy asset worth 1 rupee, that asset will give you a generator revenue of 1.5. For 1 rupee investment in asset, you are getting a revenue of 1.5. So you want this number to be on the lower side or higher side? Higher this number, more efficiently the companies are using their assets. Hence, to get the right conclusions, we put sales in the numerator, other component in the denominator. Otherwise, it look like 0.67. Somebody looks at 0.67 and says, 1 rupee investment in asset, we are only getting 0.67 revenue. Is that say or ulta? That's the reason we put this formula in ulta fashion. Okay, that's the reason. And for any turnover ratio, sales will come in the numerator, other component will come in the denominator. So suppose sales is not missing means, if sales is missing means, next preference you give it to COGS. First priority always to sales. Sales missing, then you will take COGS. And in the denominator, I have written total assets. But what is the formula here say? Average. So for all these efficiency ratios, no, priority is average. Priority is average. But to calculate average, we need 1 year data or 2 years data? 2 years data. Correct. Now you need opening balance as well as closing balance to calculate average. Suppose opening balance not given. Can you calculate average? If you are able to calculate average, then calculate average. Otherwise, take what, sir? Closing balance of assets. Preference is average. If you are not able to calculate average, or if average is not given, then take what? Closing balance. They'll only give you 1 year data in majority of the problems. So we can't calculate average. We will take the closing balance of assets. Understood? This goes for every efficiency ratio. We're done. Can I move on to the next one? Next one is fixed asset turnover ratio. You construct the formula for me. Let's see. Fixed asset turnover ratio is given by turnover or sales divided by average fixed asset first priority. Missing means fixed asset, the closing balance, or simply you can write fixed assets. And if sale is missing means next priority to COGS, like that. Done. capital turnover ratio. Capital turnover ratio is given with the formula turnover divided by net assets or capital employed. Now, this ratio is trying to measure how efficiently are you using your capital. How efficiently are you raising the money and utilizing that money to generate revenue. Done. Working capital turnover ratio is given by the formula sales divided by working capital. So this ratio signifies how efficiently you are using your working capital. Inventory turnover ratio. Don't look at the formula. Tell me inventory turnover ratio. Ideally, what should be the formula? Sales divided by average inventory. Otherwise closing stock of inventory. Correct? But 1 second. Sir, inventory you have done. Inventory is valued at selling price or cost price? Inventories are valued at selling price or cost price? Cost price. That means which is a better? See, ratio analysis is one related number in the numerator divided by related number in the denominator. If inventory is valued at cost price, can your denominator be sales? Now, which is the best preferred then? COGS. For inventory turnover ratio, first preference is COGS. If COGS is missing, then we will take a what, sir? Sales. Or if question says it takes sales, then only we will take sales. Otherwise, first priority always to what? COGS. Divided by either average inventory, if you are able to calculate, otherwise take closing stock. Done. Now, one more information you can find out called inventory velocity. Inventory velocity. Sir, velocity means, in fact, maybe I'll tell you this. Inventory turnover ratio, let's say, is 6. Inventory turnover ratio is 6. What it means is, if you get inventory turnover ratio is 6, what it means is 6 times in a year you are able to sell your inventory. You are able to sell your inventory in the current year 6 times. That's what inventory turnover ratio signifies. Okay. 6 times in a year if you are selling inventory means on an average how many months are you holding your inventory? 6 times you are selling the inventory. In a year how many months are there? 12. You are selling the inventory how many times? 6 times. So how many on an average how many months you are holding inventory? 2 months. That holding period, no, we call it as inventory velocity. Inventory velocity. Tell me the formula. You did 12 by 6. What is this 12? 12 months. Divided by 6. What is this 6? Inventory turnover ratio. Tell me the formula again. Inventory velocity is given by the formula 12 divided by inventory turnover ratio. Sir, I want it in days. Then don't take 12. Take what? 365. So inventory velocity is given by the formula 12/365. If you want it in weeks, you will take 52 divided by ITR. ITR is in inventory turnover ratio. This will give you inventory velocity or average holding period of inventory. Move on to the next. So far good. Okay, next is debtor turnover ratio. Tell me, sir, debtor turnover ratio. So sales, the numerator, debtors will arise due to total sales or credit sales. So that means will you take total sales in the numerator or credit sales? Credit sales in the numerator divided by average debtor if it is available, otherwise closing debtors. If sales is missing, then you can go for COGS. Yes, no, here actually all this because debtor will not arise because of COGS. They will give you the information, don't need to worry. Done, people. So credit sales are divided by average accounts receivable. Accounts receivable, sir, is not just debtors, it is debtors and bill receivable put together. So this debtor turnover ratio considers both debtor as well as bill receivable. In majority of the problem, bill receivable will not be given. So that's the reason we say accounts receivable and debtors are same. But in some problem or in any problem, if they give bill receivable, be careful. I'll take you go through one question in that regard. Okay. All right. Now similarly, tell me how do you calculate debtors velocity? We calculated inventory velocity. In the same way, tell me what is debtor velocity ka formula? 12/365 or 52 divided by debtors turnover ratio. I can call it as a DTR. So 12/365 or 52 divided by DTR. If you do, you will get debtors velocity, meaning debtors ka collection period. Debtors ka collection period. Next is payable turnover ratio. Tell me, sir, what is the formula? Payable turnover ratio. Will you take turnover? Payable turnover ratio means payable is related to creditors. Creditor and sale, any connection or no connection? So instead of sales, what will you take in the numerator? Purchases. Annual and which purchase? Total purchase or credit purchase? Total credit purchases divided by average accounts payable if it is available. Otherwise, you take closing balance of accounts payable. Accounts payable means creditors and bills payable put together. But in majority of the problems, bills payable data will not be given. Okay, similarly, can you calculate payable velocity? Payable velocity. How do you calculate payable velocity? 12, 365, 52 divided by payable turnover ratio. Awesome. These are the turnover ratio. 3-4 of them usually comes in the questions, which we don't know, they keep changing, but these are quite popular. Yes, people. So this is, you are comfortable with the next set of ratio. Profitability ratio. GP ratio is given by the formula. GP upon sales into 100. Net profit ratio is given by the formula. Net profit divided by sales into 100. Operating profit. Operating profit only we call it as EBIT. Operating profit ratio is given by the formula. EBIT upon sales into 100. Next, COGS ratio. COGS ratio means COGS divided by sales into 100. What percentage of sales is COGS is what you are trying to measure. Operating expense ratio means administrative expenses, selling and distribution expense put together. Those two, if you add, we call it as operating expense. That ratio we want. How do you calculate that? Operating expense divided by sales into 100, or selling and distribution expense plus administrative expense divided by sales into 100. Next one is operating ratio, not operating expense ratio, operating ratio. Meaning this ratio is trying to calculate to generate revenue, what is the total operating expense you need to incur? To generate 1 rupee revenue, totally how much operating expenditure we need to incur. So to generate revenue, you will incur only operating expenditure or even COGS. COGS. Sales minus COGS will give you GP. GP minus fixed operating cost will give you EBIT. Correct, no sir? So operating ratio is given by the formula COGS plus operating expense divided by sales into 100. One of the previous examination question used this operating ratio. Okay. So basically again, what is that? Operating ratio is trying to measure what? What percentage of COGS and operating expense is related to sales. Suppose you got, or 1 minute, if I tell you operating ratio is 85%, that means what, sir? That means what? COGS plus operating expense is equal to 85% of sales. The COGS and operating expense put together is 85% of sales. Yes. So from sales, if you reduce COGS and if you reduce operating expense, what are you going to get? EBIT. So if these two are 85% of sales, means indirectly EBIT will be 15% of sales. This is what they used in May 2024 paper or something. The same equation. Same. They gave you operating ratio and they mentioned this. We have to solve this. Everyone, I hope got it. Yes, sir. Okay. Financial expense ratio. How do you get financial expense ratio? Financial expenses divided by sales into 100. Okay. Then return. Some profitability ratios relating to return. Return on investment you leave. There are 3 types of returns usually. One is ROS, we already know. Return on capital employed. Then return on equity. Then return on assets. These are the 3 returns. First, you already know. Tell me, sir, how do you get ROS? Return on capital employed? EBIT divided by capital employed into 100. That is your ROS. Sometimes they will say calculate ROS on an after-tax basis. Calculate ROS on an after-tax or post-tax basis. So in this case, what do you do? Will you take EBIT? No. You will do EBIT into 1 minus tax rate. When you do 1 minus tax rate, you will get after tax. So EBIT into 1 minus tax rate divided by capital employed into 100. If you do, you will get ROS on an after-tax basis. Now return on equity. Can I take EBIT for return on equity? Is EBIT available for equity shareholders or what is available? Each. So the numerator will be net income or each. Divided by what? Can you take capital employed or equity? So the formula will be what here, sir? You can take net income or you can take each. Divided by what? You can call it as equity or you can call it as net worth or simply it is calculated by equity share capital plus reserves. If you do this, you will get return on equity. Return usually is expressed in percentage, so we multiplied by 100. This is your ROS and this is your return on equity. Next is your return on assets. Return on assets. There are two ways to calculate return on assets. One, you can take profit after tax divided by total assets. If you know and if you can find out average assets, good. If average asset is missing, means take the total assets. So one formula to get return on asset is take profit after tax divided by total assets. That is one. Another way to calculate is sometimes you can use a debt fund also to buy asset. Hence, we calculate one more way to calculate return on asset is EBIT into 1 minus tax rate divided by average total assets or total assets depending on the case. Okay. So, which one to use in exam, sir? Sir, this one, second one is more popular. If they ask you to directly in the question to find return on assets, use this as what I would suggest. Meaning EBIT into 1 minus tax rate divided by total assets. Suppose they ask you EPS in the problem. They ask you EPS. To find EPS, first we need profit after tax. Which formula in this gives you profit after tax? The first one. Yes or no? So if you want to find out profit after tax, then you won't use this formula, use that formula. Right? Sometimes, as I said, ratio question will be missing. Fill in the blanks wala question. Many data will be missing. If you want to find out that, then use the first formula. If they ask you to calculate return on assets specifically in the question, calculate this. This is more popular. Both are acceptable, but ICAI uses this more predominantly. Fine now. Guys, so can I move forward? Understanding these are all some return or profitability ratio. Next, you already know EPS. How do you calculate EPS? Each divided by number of equity shares. How do you calculate dividend per share? Dividend per share. Total dividend divided by total number of equity shares. Correct now? Next is a dividend payout ratio. So payout ratio is always expressed on EPS. Any payout ratio is expressed on EPS. So dividend payout ratio is given by the formula dividend per share divided by earnings per share. Always remember payout is always on EPS. So DPS divided by EPS, if you do, it's like this. Suppose company earned 10 rupees. Out of earnings, they are paying a dividend of 4. That means what is this number? 0.4 or 40%. Basically, 40% of the earning company is paying out as dividend. That is what dividend payout ratio is trying to express. How much percentage of earnings company is distributing away as dividend. Good, sir. Okay. Price earning multiple. How do you get P multiple? You already applied this. How do you get P ratio? MPS divided by EPS. If you do that, you will get the price earning multiple. Okay. Alright. Dividend yield. A simple way to remember is whenever you see the word yield, right? NPS should come in the denominator. Whenever you see the word yield, denominator will come as what? MPS. So dividend yield is given by the formula DPS divided by MPS. Earnings yield is given by the formula EPS divided by MPS. So it's like this. Let's say market price of the share is 100 rupees. A share currently is trading in the market at 100. One company in the current year, they gave a dividend of 10 rupees. Dividend is a return for shareholder, no? Dividend is a return for shareholder. Can you tell me what is the return percentage? Shareholder, to buy the share, he is investing 100 rupees. And one share, he got a dividend of 10 rupees. So how much is the return for shareholder? 10%. How did you calculate that? 10 divided by 100 into 100 you did, you got 10%. Express this in formula. What is this 10? Dividend per share. What is this 100? Market price per share. To get percentage, we multiply 100. Yes, people. That is nothing but your dividend yield. Hence, I said any yield, if they ask, always put in the denominator MPS. Good it. Yes, sir. Next, market value book value ratio, not that important, but in the name only ratio is there. Market value book value ratio. So it's given with the formula market value divided by book value per share. Something I pulled. Oh, 1 second. 1 second. I think George may pulled off this. I think now it's back. It's fine, no? So okay, here also it's good enough. Okay, this is done. Next, Q ratio. Again, not that very important, but quickly we'll review. Q ratio is given by the formula market value of equity and liabilities divided by replacement cost of asset. Market value of equity and liabilities divided by replacement cost of asset. So they did one study through Q ratio. Basically, every asset at some point of time you need to replace. To replace the asset, you need money. Where will that money will come from? Equity or liabilities. Liability means what's a debt, whether long term or short term. Correct? No, you will take a short term loan and buy some asset, or you will take a long term loan and buy some asset, or you will take equity or preference shares and buy some assets. So what they did a study is usually asset ka replacement cost and market value of equity liability should be same. If it is same, they say if Q ratio is basically 1 means they say share is the share ka price. If it is, it's at a fair valuation. It's valued properly. If Q ratio, if you calculate this market value of equity and liabilities divided by replacement cost of asset, if you calculate this ratio and if you get a number greater than 1, then the asset ka stock, the company ka stock price is overvalued. If Q ratio is lesser than 1, then the share price is undervalued. That is a study. Just know this in case they ask as an MCQ question any chance. But I have not seen this coming in any problem so far till now. Done, Azaru. Last ratio, then we will take up some problems. Can we? Next is the dew point model. Dew point model law is little crazy. Why? Sir, one person, I think, I don't know the for some name, I forgot the name now. Okay. As per dew point model, no, you will calculate the same ratio, but not using one component, but using more than one component, meaning rows. Yeah, this is added newly. It is added newly. Or it's there in the new material. Maybe you have old material. In this batch, I added this. Okay, dew point model. Using dew point model, we can calculate rows. So, what is the normal formula to calculate rows? Normal way to calculate rows. EBIT divided by capital employed. Our dew point sir doesn't like this model. Sir is using different way to get the same answer. Finally, how do you want rows? You tell me. To calculate rows, what do we need? EBIT divided by capital employed. As per dew point model, you can calculate rows by like this. First, take operating profit margin. First, take operating profit margin. It's all written here. You don't have to write it down. Just listen. Operating profit margin multiplied by capital turnover ratio. Here only is there. No, here only name is saying. This is the rows. No. How to remember this? O for operating profit margin. C for capital turnover ratio. Capital turnover ratio. So if you take operating profit margin and if you multiply capital turnover ratio, you will still get what, sir? Rows. How? How do you get operating profit margin? EBIT divided by sales. How do you get capital turnover ratio? Sales divided by capital here means capital employed. This sales or that sales you will get cut off. What remains? EBIT divided by capital. You got the same answer. But you are not going like this. You are going like this. Okay, now that's all is dew point model. Instead of calculating the answer straightforward, maybe you are using multiple ratios to calculate the same answer. Understood? One or two times I've seen this also asked in the previous year paper. 2 marker or something started asking this. Done, sir. This is using dew point model to calculate rows. Similarly, you can also use dew point model to calculate return on equity. So, to calculate return on equity, what do you need, sir, essentially? How do you get return on equity? Return on equity. Can you take EBIT or EASH? EASH divided by what? Equity. You can call it as equity or shareholders equity, or you can call it as net worth, whatever. Now, using dew point model, if you have to calculate return on equity, it's a multiplication of 3 things. 1, there you took operating profit margin. No? Here you will take the shareholders. No, shareholder means end point. So, it will be net profit margin. Take net profit margin multiplied by the asset turnover ratio multiplied by equity multiplier. 3 things you need to multiply and you need to remember this. Okay. One is net profit margin, then multiplied by asset turnover ratio multiplied by equity multiplier. It's very simple. How do you just see? Equity multiplier, what it is, you will only know. How do you calculate net profit margin? Net profit divided by sales. How do you get asset turnover ratio? Sales divided by total assets. 1 second. You need what number for return on equity? We need equity. Okay. Sir, anyway, in these sort of problems, net profit means profit after tax. In these sort of problems, preference shares will not be there. If preference shares is not there, net profit itself becomes ish. Net profit itself becomes ish. So ish, have you got it? Yes. We need what? Equity. But here sales is there. See here. This sales to that sales are cut. Okay. That means you are left with total assets. We want total assets or we want equity. Now you tell me, how do you get equity multiplier? Equity multiplier is nothing but total assets divided by equity. So if you do ultimately this sales will be cut. This asset will be cut. What remains? Net profit divided by equity. Net profit is nothing but profit after tax. If you don't have preference shares, then profit after tax in each will be same. You will get the same answer. But you are getting the same answer not directly, but by using three components. What are the three components? Net profit margin multiplied by asset turnover ratio multiplied by equity multiplied. That's all. This data will be given to you in the question. You just need to multiply and get a return on equity. Let me give you all this as a 2-marker MCQs and test. So with this, all the ratio concept we have done. Now we'll have to go through some questions. Based on the time we will see, we'll work out few questions and then we will say bye bye for today. Okay, now today I'll leave you a lot early. Just a minute. Sir, what does operating profit include? Operating profit no macha is like this. From sales, if you reduce variable cost, you get contribution. From contribution, if you reduce fixed operating cost, you will get EBIT. This only we call it as operating profit. This only we call it as operating profit. Now operating expense means to run the business, you will have some administrative expense. Like for us, receptionist salary and all. That becomes your one part of operating expense. And also, to run the business, you also need some salesmen and all. To salesmen, you will have some selling expenses or marketing expense. That becomes your selling and distribution expense. These two expenses, if you add, that we call it as operating expense. Now, operating ratio means the total expense you will incur, the total operating expense overall you will incur to generate a revenue. To generate revenue, you have to incur some direct cost also, which will be captured in COGS. And you will have to also incur some operating expense. This is the difference. Okay, now, I think you will respond later. I've told the answer. Great. Now, let's go over this question. Sir, majorly the way they ask the ratio question is, they'll give you some data, they will give you some ratios, and they will ask you to construct income statement and balance sheet. Some data will be given, some data will be missing. We need to fill out those data. I will work out few problems so you get a basic idea. Now check this. From the following information of Lakshmi Private Limited, prepare summarized balance sheet. So in this problem, we need to prepare balance sheet. Net working capital is given. Okay. So one quick point is, whenever they give you net working capital, so usually they will also give you current ratio. Because this is a good combination. Check, is it available? Net working capital is here, current ratio is here. These two we will use. How I'll tell you. Always watch out for this. There's one combo. There are 2-3 combo questions here. One combo is this. Okay. Bank overdraft will come under where? Current liability. Fixed assets to proprietary ratio. We know already proprietary ratio. How do you calculate? For proprietary ratio, we need proprietor funds. One way to calculate proprietary fund is what, sir? Equity share capital plus reserves and surplus plus preference share capital. This is one way. There is another way which I'll prove it to you and use it over here. Done. Next is reserves and surplus 3,20,000. Current ratio 2.5. Liquid ratio is 1.5. The moment you see liquid ratio and current ratio set up, you will be able to find out closing stock. Be aware of this. Okay, liquid ratio and current ratio, the moment they give, that is an indication that you can find out closing stock. How I will show you. This is again a good combo. So in this question, 2 combos we have seen. net working capital and current ratio, and current asset and liquid ratio. Using this, you will be usually able to find out closing stock, or if closing stock is given, you will be able to find out current assets. We will see. Now, what you normally do is, when they ask you to prepare balance sheet, P&L and all, have the format of P&L and have the format of balance sheet ready. And whatever data they have given, first insert that. Now, they ask balance sheet only over here. Let's prepare balance sheet. So here I have already prepared. First, whatever data is given, update. Any balance sheet data given? Yes. Working capital. Or rather, they given bank. Working capital will not come in balance sheet. What will come in balance sheet? Current asset separately, current liability separately. Bank overdraft is there. Okay. Now, bank overdraft will come where? Under current liabilities. And always use this approach when you're doing balance sheet. Have one inner column and have one outer column. This will help you to figure out few things faster. Why? I'll tell you in a bit. Okay. All the components of current liability you write in the inner column. Total current liability you write it on the outer column. This is a better approach. Why? First, let me do on this problem. That way you'll understand. Now, first, bank overdraft. How much is bank overdraft? 80,000. Put it in the inner column because we will show what in the outer column total. So bank overdraft 80,000 you write in the inner column. This is done as in when I find, I'll put off a tick. Yes, let it be. Anything else they have given? Yeah, they have given reserves and surplus. So reserves and surplus we will show 3,20,000. Done. Okay, this is also done. Next, anything else in the balance sheet they have given? Nothing. Alright. First combo I already told you. What is the first combo? Working capital and current ratio. Okay. So how do you get current ratio? Tell me. Current assets divided by current liability. So let's use that. Current ratio, they have given it to be 2.5. How do you get current ratio? Current assets divided by current liability. When you're solving, that means can I say current asset is equal to 2.5 times of current liability? We got this. Substitute this in the next one. What is the next component again? Net working capital. Net working capital is given to be how much? 4,80,000. How do you get net working capital? Current assets minus current liability. Current asset minus current liability is 480. Now don't write current asset. Current asset is what? 2.5 times of current liability. Substitute. Instead of current asset, write 2.5 times of current liability. Let current liability be as it is. This is equal to 480. Solve. You will get current liability to be 320. Easy now. Yes. If you know current liability, you know current asset also. How much is current assets? 2.5 times of current liability. Multiply, you will get current assets. Till you are good. That's the reason I said this is a good combo. Net working capital and current ratio. Now you have got current assets and current liability. Where will it come? Balance sheet. There's a total. Total we put it in which column? Outer column. What is total current assets? 8 lakh. Show it in the outer column. What is total current liability? 3,20,000. Put it in the outer column. Why I suggest this is check. Total current liability is how much? 320. In that, if 80,000 is bank overdraft, means balance will be other current liability. Alright, that's what? Balancing figure. If you don't do like this, you'll never figure out what is just 240. You'll be wondering why balance sheet not matching. That is the reason this inner column and outer column approach, you don't have to even think also. If total is 320 and in that 320 bank overdraft is 80 means the other component, the other could be bills payable, creditors, we don't know. That is how much, sir? Obviously, it is how much? 2 lakh. Calculated or arrived as balancing figure? Sir, in balance sheet, can you show balancing figure? Sir, usually they ask you to prepare summarized balance sheet. Summarized balance sheet means to the extent possible. How much ever extent or how much ever data is given, using that you will prepare balance sheet. There's not exact balance sheet which you prepare as per Schedule 3 of Companies Act. No. Okay, now that way this inner column and outer column. Now you got the importance of inner and outer. Yes, sir. Same thing do for current assets. What is current assets outer total value? 8 lakh. We'll figure out the other components later. This is done. So one combo we have used. Whenever you use, put up one tick so that we will know. This we have used. Next we have used this. Next, these two are good combinations. Let's use this. Current ratio and liquid ratio. Liquid ratio, they can call it as liquidity ratio or liquid ratio or quick ratio, or sometimes they'll also call it as asset test ratio, one and the same. How much is asset test ratio? 1.5. So let's use that. Quick ratio or asset test ratio is 1.5. How do you get quick ratio, sir? Quick ratio or quick assets divided by current liability. And how do you get quick assets? Current assets minus stock divided by current liability is equal to 1.5. Current liability value you already found. How much is that? 3,20,000. Current asset value also you already found. How much is that? 8 lakh. So that means using this, you can figure out what's closing stock. That's what I said over here. The moment they give you a quick ratio, the idea should click that you will be able to find out closing stock. That's a connection. So using this, you solved closing stock to be how much? 3,20,000. Outer column or inner column? Inner column. Total current asset is 8 lakh. In that closing stock is 3,20,000. That's what we found out. If possible, give a working note reference. How? Which working note gets this answer? Done. Yes, people. So this information we've used. Next, they've given fixed asset to proprietary ratio is 0.75. They said fixed asset to proprietary ratio. That means, can I say fixed asset divided by proprietary funds is equal to how much? 0.75. Therefore, fixed asset is what? 0.7 times of proprietary fund. Yes, sir. That is what I've written here. Easy. Till you're good. Now, this you need to pay attention. How do you normally get proprietary funds? Normally, how do you calculate proprietary funds? Equity share capital plus reserves and surplus plus preferential capital. In this problem, equity share capital given? No. Reserves and surplus given? Yes. Preferential capital given? No. That means equity share capital missing. Preferential capital, maybe you can assume 0. But equity share capital given a missing. So you can't use that approach. You have to use the opposite route. You have to use the opposite route. What is the opposite route? I'll tell you here. Wait. Right. Here, let's forget this balance sheet. Let's take a small number. This just for our reference. I've made this balance sheet. I will give some random numbers. Equity share capital, reserves and surplus, preferential capital, long-term debt, current liability is this much. Fixed asset, current asset is this much. Okay, sir. Calculate proprietary funds using this. Don't look at the solution. Directly tell. Proprietary funds is how much? These three addition? These three addition? Yes. How much is that? 13 lakh. There is another way to calculate this proprietary fund. First of all, proprietary fund means this. Either you can calculate direct way or there is an indirect way. Indirect way means you can take the total assets. From that you can reduce current liability. From that you can reduce debt. That way also if you do, you will get the same answer. Express this in equation for me. How much it will be? Proprietary fund is equal to fixed assets plus current assets minus current liability minus long-term debt. Yes, sir. Now, 1 second. Why am I using this? You know current assets and current liability is what, sir? Current asset minus current liability is what? Net working capital. That means you can restructure this equation once more. Proprietary fund is equal to fixed asset. This minus this is what? Instead of that, can I call it as NWC? NWC as in net working capital minus what? Long term. Yes. Why did I do this? Net working capital was given to you in the question. For proprietary fund, we have a substitute. That means this one we will use and calculate. If you do this, also check if I do the calculation. How much is how do you calculate this? Fixed asset is 12.5. How do you get net working capital? 4 lakh minus 50,000. That's what I've done. Minus long term debt is how much? 3 lakh. If you calculate, how much are you getting? 13 lakh. Normal route also, how much you got? 13 lakh. That means this is what we're going to apply in this particular problem. So what is another way to calculate proprietary funds now? Fixed assets plus net working capital minus long-term debt. I'll be using this. That's what I've written here. Check. Proprietary fund is given with the formula of fixed asset plus net working capital minus debt. Now proprietary fund is PF as it is. Instead of fixed asset, I know that fixed asset is 0.7 times of proprietary fund. So substitute. Instead of FAD, you will write what? 0.7 times of PF. Correct? Plus net working capital is net working capital given in the question. Yes, how much is that? 4,80,000. Debt is not given. If they don't give it, take it as 0. Solve. This is 1 PF. 1 PF minus 0.75 is how much? 0.25. 0.25 PF is 4,80,000. So PF is how much? 4,80,000 divided by 0.25. You will get 19,20,000. This way you will get proprietary funds. So got it. Any problem? So if you know proprietary funds, can you find out fixed asset? Yes, fixed asset is what? 0.75 times of proprietary funds. So 0.75 if you multiply, you will get fixed asset also, which is how much? 14,40,000. So fixed asset you can tick off. What is the total proprietary funds? 19,20,000. What is the direct way to get proprietary funds? Equity share capital plus reserves and surplus plus preferential capital. Total proprietary fund we got it as 19,20,000. Equity share capital we don't know yet. Reserves and surplus we know. Yes, it's given in the question. How much? 3,20,000. Preferential capital, any reference? No. I mean, take it as 0. Using this, we'll get equity share capital how much? 16 lakh. Go back to your balance sheet, tick equity share capital, 16 lakh. Balance sheet total, liability side done. If this side total is 22.4, means that side total also should be 22.4. Any other information given, or that's all? That's all. Total current assets is 8 lakh. In that, if closing stock is 320, means balance will be others. Alright, calculated or arrived as balancing figure. So by doing this inner outer approach, you will be able to figure out this other component easily. Otherwise, you will struggle normal way. Okay, that way you will finish off this. And don't worry, this is summarized balance sheet. So every information you cannot find out. Whatever information is available, use that and find the component. Other components you find it as balancing figure. These kind of questions you can expect from ratio. Okay, so this is not complex. It is just that they will do all. So I mean, you don't have to remember fancy ratio problems that they are not testing. They are asking you fill in the blanks questions. So these are little time wasting questions. So you need to practice enough to know that what ratio is connected with what component. If you are the moment you are able to identify that, you will be able to answer these questions faster. Otherwise, you will get it, but you will take a lot of time. I'll give you a minute. If you have anything, you can ask. So far comfortable? So the takeaway of this question is what connection? Three things, if you want, we can summarize from this question. One, the moment net working capital is given and current ratio is given, we can use substitute and find out current asset and current liability. The moment they give you current ratio and liquidity ratio, we can easily find out stock, closing stock specifically. Okay, that is one. And then there is another way to learn or calculate proprietary funds. One is a direct route, equity share capital plus reserves and surplus plus preference share capital. Another route, fixed asset plus net working capital minus long-term debt. So those are the takeaway. And one more is a balance sheet presentation. Have an inner column and have an outer column. Total you present it in the outer column. Like total current assets you put it in the outer column. Components ka value you show it in the inner column so that you will be able to figure out the balancing figures. Okay, we'll take one or two more questions. Following information relates to MIRR Limited. Again, this is also a previous year paper. Now it's added in study material also. Debtor velocity. I think you know what this means. What does debtor velocity mean, sir? Holding. A debtor's collection period. We don't hold the debtors. No, we usually collect from them, right? So debtor's velocity is nothing but your debtor's collection period. Okay. Creditor's velocity is creditor's payment period because we have to pay the creditor. First, we will read off the data and see what we can figure out. Stock turnover ratio. Tell me the formulas. How do you get stock turnover ratio? CODS divided by average stock if information is available. Otherwise, closing stock. We'll see. GP ratio is given. How much is that? 25%. 25% of what? Sales. Bill receivable, bills payable is given. Do remember that when we calculate debtor velocity and all our debtor's turnover ratio, it is not debtor, it is accounts receivable. So that means that particular accounts receivable will include debtor also, it will include bill receivable also. In this problem, BR and BP both are there. So be a little careful there. GP is given. Oh, awesome. No. Sir, gross profit is given 4 lakh. GP percentage is given. That means easily using this information you can find out sales. If GP is 25% of sales, then COGS will be. Or you can find like this also. Sales, you know, GP, you know. Can't you find out COGS? You can directly calculate like that. Or COGS will be 75% of sales. Because how do you get GP, sir? Sales minus COGS will give you. Sales minus COGS will give you gross profit. If gross profit is 25% of sales, sales is always 100%. No. If GP is 25% of sales means COGS will be what? 75% of sales. Like that you can calculate, or take sales amount and take GP amount and calculate. So how do you get now COGS if you wanted an amount? You take sales, from that sales you will reduce the gross profit, you will get COGS. Any which way you can do, you can work out in multiple ways. Comfortable? So using these two you can find out sales and as well as you can find out COGS. The moment you know COGS, you can apply in stock turnover ratio and either get average stock or closing stock. That is the connection. All this question you need to practice, because unless you establish the connection, you will be going on goal. You'll be wasting time. Okay. So the moment you read the question, that connection should get established. That will come only with the practice. Okay. Alright, next they've given fixed asset turnover ratio. You know, fixed asset turnover ratio, how do you calculate? Sales divided by fixed assets. You know sales already. That means using this equation you can find out fixed asset. That is also sorted. They told closing stock of the period is 10,000 above opening stock. That means have they referred to some opening stock and closing stock? Yes. So if they have given opening stock and closing stock, in COGS always take what? Average stock, because there is a possibility to calculate average stock. If there is a possibility to calculate average stock, you should always take average stock. If you cannot find average stock, then only you will use closing stock. Here, since they have given some equation about, because to get average, to find out average stock, we need opening stock as well as closing stock. They have given some reference. So use average stock only. Using this reference, we can figure out closing stock. Fine. Now determine what and all. Sales and COGS, straightforward. Debtors, creditors, okay. Closing stock and fixed assets. These are the 5 components you need to find using this ratio. Now don't worry about this rate. If you are not able to figure out few things, don't worry about that. Whatever you know, start with that first. Then as you do, you will get the more information. Now they have given GP and they have given GP percentage. Using this, what we can find? Sales and COGS. So first working note, we'll put up for sales. GP amount is given to be 4 lakh. GP percentage is what? 25% of sales. Yes, no? So therefore sales will be what, sir? GP divided by 25% or 0.25. GP amount is 4 lakh. Divided by 25%, if you do, you will get sales value to be 16. Now sales is 16 lakh, GP is 4 lakh. So COGS has to be 12 lakh. Or if GP is 25% of sales, COGS will be 75% of sales. 16 lakh or 75%, if you calculate COGS, you will get it as 12 lakhs. That is the first requirement which we have done. Any doubt? No. Alright. Next, there's no order, you can follow in any order, it's okay. I've put up next as a debtor. Then what they've given in the question? They've given debtors velocity. Velocity means what, sir? Collection period. How much is that given to be? 3 months. Okay. Very straightforward now. Proration work. Do you know sales? Do you know sales? Yes. How much is that?
16 lakhs.
Now this 16 lakh is for 1 day, 1 month or whole year. This 16 lakh. It is for whole year. Meaning it is for how many months? 12 months. Because here the data is given in months. No? So I'll present it in months. If they give it in days, I will take, instead of 12 months, I will take 365. If it is given in weeks, 52 weeks. Like that. Now 16 lakh is the data for how many months? 12 months. Do you give 12 months credit to your debtors, or what is your debtors velocity? 3 months. So for 12 months, if it is 16 lakh, means for 3 months, how much? That's all is a debtor value. Got it up. Because the debtor comes from what? Sales only, no? So debtors comes from credit sales. Have they told cash sale is something in the problem? No. If they don't give information, we will assume that total sales and credit sales are same. So total sale and credit sale is 16 lakh. That is for the whole year. Will you give whole year credit to your debtors or only 3 months? For 3 months, how much is the sale value? That is only weird. How much is that? 4 lakh rupees. Got it. That is what I have expressed. Now tell me this is formula. Let's see how will you calculate. How do you get X? 16 lakh into 3 months divided by 12 months. Express in words. What is the 16 lakh? Sale. Annual credit sales. Here total sales and annual credit sales are same. Multiplied by credit period. Divided by 12 months. That is what I have written it over here. Done, sir. Any problem? No. You can also calculate in multiple ways. Sir, using debtor turnover ratio, can you calculate debtor velocity? How do you get debtor velocity? 12 divided by DTR. That means if you want to calculate DTR using velocity, can you do it? Debtor velocity is equal to 12 divided by debtor turnover ratio. Therefore, can I say debtor turnover ratio is 12 divided by debtor's velocity? So if you do this, what are you going to get? 12 divided by debtor's velocity is 3. So that means this will be 4. Yes, no. Now, how do you get debtor turnover ratio? What is the formula? Sales divided by average accounts receivable. If average is not there, we will use accounts receivable. Like this also you can work out. What is debtor turnover ratio? 4. What is the sales? 16 lakh. Divided by accounts receivable. Therefore, accounts receivable will be how much? 16 lakh divided by 4, which is 4. This is a little lengthy route, but you will get the any which way the same answer. Or directly you can prorate. Ratio chapter you can solve in multiple ways. Whatever way you're comfortable, you can solve. But solve properly. Okay, now done. No. Any order may you can present. Absolutely no issues. Now 1 minute. This is not debtor. This is what? This is accounts receivable. Accounts receivable means it is a debtor and bill receivable put together. And in this problem, do we have bill receivable? Yes. Bill receivable is how much? 25,000. That means the 4 lakh no is what? 4 lakh is accounts receivable. And how do you get accounts receivable? Debtors plus bill receivable. Accounts receivable is 4 lakh. In that, a bill receivable is 25 means what will be debtor? 3,75,000. Watch out, especially in the problems where they've given BR and BP separately. If it is not given separately, then accounts receivable and debtor will assume it to be same. Meaning BR will or bill receivable will assume to be 0. When they have given, be a little careful. Done, Azaro? Now, I think they asked closing stock also. Can you find out closing stock? Sir, check. Normally, to find out, if they ask you to find out closing stock, they will give you inventory turnover ratio. Inventory turnover ratio also known as stock turnover ratio. How do you get inventory turnover ratio? COGS divided by first preference to denominator first preference to average stock. If average is missing, then closing stock. So tell me, sir, formula. Inventory turnover ratio is given to be 1.5. Tell me what is the formula for this? COGS divided by average stock. Why did I take average in this problem? Because they told closing stock is 10,000 more than opening stock. So there is a reference given to opening and closing. That means we can't find out what? Average stock. So hence in my inventory turnover ratio, I'm taking average stock. COGS, do you know? Yes, we found out COGS. How much is that? 12 lakhs. Average stock, do we know or we have to find? Inventory turnover ratio or stock turnover ratio given in the question to be 1.5. Substitute and you'll get average stock how much? 8 lakh. Any doubt till here? How do you get average stock? Opening stock plus closing stock divided by 2. How much is average stock? 8 lakh. Do you know opening stock? No. Do you know closing stock in value? No. But what did they say? Closing stock is 10,000 above opening stock. So if opening stock is 1 lakh, then closing stock will be 10,000 more than opening stock. Not me telling, question is given. You can take any number. Yes or no? That means let opening stock be OS. Let opening stock be OS. Therefore, closing stock will be what? OS plus 10,000. Instead of OS, you can also make it as X, A, B, whatever variable. I'm just taking it as OS only. If opening stock is OS, means closing stock will be OS plus 10,000 divided by 2. Solve this equation, you will get opening stock how much? 7,95,000. If opening stock is 785, means closing stock will be 10,000 more than that. So it will be 8,05,000. So closing stock also you have solved. Yes, people. Next, what is the requirement? Sales we did, debtors we did, creditors I think we are yet to do, closing stock we did, fixed asset they've asked. Any information they've given about fixed asset? Yeah, they told fixed asset turnover ratio is 4. How do you get fixed asset turnover ratio? Sales divided by fixed asset is equal to 4. Sales we know 16 lakh, fixed asset we don't know. So substitute and you will get fixed asset to be 4. That's pretty straightforward. Yes. Okay, last requirement they asked you is what, sir? Sundry creditors. Oh, excuse me. Sir, how do you calculate sundry creditors? How did you calculate debtors in this problem? You took sales. Sales was 16 lakh. 16 lakh was for 12 months. Debtors credit period was only 3 months. Like that you prorated. Creditors also can you prorate? What you will take? COGS? No. You will not take COGS. From creditors, what will you do? You will purchase. That means for finding out creditors, we don't need COGS. We need purchases. We need purchases. Yes. From COGS, can you find purchases? Yes. How do you get COGS? Opening stock plus purchases minus closing stock. COGS is given to be 12 lakh. Opening stock and closing stock, just now we found out. So that means purchases is missing. Substituting, you will get purchases how much? 12 lakh 10,000. Like this. Understood? This 12 again proration you do. 12 lakh 10,000 is for 1 day or whole year? It's a purchase that's for whole year, which is how many months? 12 months. What is creditor ka velocity they gave in the question? 2 months. Velocity means creditors ka credit period or payment period. For 12 months, if purchases is 12 lakh 10,000. For 2 months, how much is it? Prorate and tell me. 12 lakh 10,000 into 2 divided by 12, if you do, you'll get 2,01,667. Is this X creditor or accounts payable? It is accounts payable. Okay, accounts payable means creditor and bills payable put together. So accounts payable, you'll get 2,01,667. How do you get accounts payable? Sundry creditors plus bills payable put together. Check the question. Bills payable, they have given in the question how much? 10,000. So this you know, this you know. Can't you find out creditors? Yes. So by doing this, you'll get creditors to be 191,667. Connection. The sooner you establish the connection, the faster you will be able to solve the problem. That will come only with the practice. Here I can just revise, but same question if I ask you to solve it now, you'll take some time. Because you'll read, you'll forget, you'll do it. On the examination day, if you have not practiced, then it will be like you'll be going on in circles, what to use, where to use and all that stuff. So as much as possible, I would say FM is one such topic where if you want to gain confidence, you have to solve as many questions as possible. If you don't have time, no issues. Whatever time you have, do the best in that allocated time. Available time rather. Done, sir. Can you do 1 or 2 more? You are in mood for 1 or 2 more, or you want to wind up? Wind up, Paka. Voice is gone, no, Papa. Sir, an asset turnover ratio, if both sales and COGS is given, which one should we choose? Sir, from asset you will generate cost or you will generate sales? Sales. So, priority will be sales. Okay, first priority for asset turnover ratio, whether it is total asset or fixed turnover ratio, first priority to sales. If sales is missing, COGS. If both are given, still choose what? Sales only. Correct. For inventory turnover ratio, you give the priority to the COGS. Thank you, Anjan. I think you have answered that. Great. Someone is saying continue. No. Fine. Okay. 1 or 2 more questions we will do. This question came in May 2024 paper. This particular question. Let's see what we can learn from this question. And don't worry about number of questions we have solved in class. We have solved more than 25-30. Okay. Now I'll not have time to go through all of them. If I go through all, then we need 4 or 5 hours just for ratio going through. Yeah. Anyways, Theme Limited provides you the following information. Firstly, read the requirement. What are they asking? Interest coverage ratio. How do you get interest coverage ratio? EBIT divided by interest. That means we need to find out EBIT. We also probably have to find out interest. GP ratio. That is okay. GP upon sales into 100. Current assets. Fine. We'll see how to find out current assets. Now, 12.5% debt they have given. All these are subtle information. 12.5% is what? Means what? Interest rate. For interest coverage ratio, we need a interest. Interest is already given. Or you can easily calculate. Now, again, they will not give you interest in the problem. The moment they gave 12.5%, this 12.5% itself is interest. What is the debt value? 45 lakhs. That means how much will be the interest? 45 lakh ka 12.5%, which will be 5 lakh 62,500. So that means one component of your interest coverage ratio you already found. Another component we need to find out is EBIT. Okay. Whenever they ask you to find out EBIT, sales, COGS, PAT, in case you are getting stuck, put up income statement. Put up income statement. There will be the clue. Okay. If you are getting stuck, you can always put it up. Here, though they have not asked income statement, if you put it up, you can kind of maneuver or you can find out a way. So let's see. Debt they have given 45 lakh. Debt to equity ratio they have given is 1.5:1. 1.5:1 means 1.5 divided by 1 is what? 1.5. So it's as good as saying debt divided by equity is what? 1.5. You know debt. That means using this equation, what you can find? Equity. Equity here refers, means what? Net worth. Or what? Shareholders equity or equity share capital and results in surplus put together. So using these two you can find, or maybe we'll solve up directly. Why do I again read? So debt equity ratio is given as 1.5:1. Debt is 45 lakh. Equity we don't know is equal to 1.5. Solve this and get equity to be 30 lakhs. Easy now. That part is covered. Yes. Okay, moving along. Return on shareholders funds. Return on shareholders funds means this is nothing but your return on equity. Another way of calling return on equity is shareholders funds. Shareholders funds is nothing but equity, no sir. right? You can call it as return on equity, or you can also call it as return on shareholders funds. Tell me, how do you calculate ROE? EBIT along. Each divided by net worth, or you can call it as equity. And equity you already got through above equation. And return on shareholders funds is given to be 54%. So this is 0.54. Each we don't know. Equity just now we got it to be how much? 30 lakhs. That means using this number, what we can find out? Each. Comfortable? That is the next clue. So you can find out each, or in all these problems. Now if you just check quickly, nowhere they have mentioned preferential capital. Read. Nowhere they mentioned preferential capital. That means preferential capital is 0. If preference share capital is not there, means preference dividend also not there. That means PAT and each will be same. PAT and each will be same. So that's the reason in my heading I've given. You can either call it as each, or you can call it as net income, or simply you can call it as PAT. How do we find this? Using return on equity. Just now we did, right? So if you calculate return on equity, you will get PAT. How much is the PAT you will get? 16 lakh by solving this equation. Actually, this is not PAT. Actually, this is what? Each. Since there is no preference dividend, each and PAT will be same. Done now. Work. This number is done. Next, any other information. Whenever we use, we'll pick off. This we have used. This we have debt equity we have used. Return on equity also we have used. Operating ratio, not operating expense. Operating ratio. I just now explained the same using ratio. Operating ratio is how much? 85%. How do you get operating ratio? COGS plus operating expense put together is what? 85% of what? Sales. Therefore, EBIT will be what? 15% of sales. Done. But we don't know EBIT nor we know sales. That means this information right now is helpful or not so much? Not so much. Ratio of operating expense to COGS. So they told operating expense divided by COGS is what, sir? 2 by 6. That means we can substitute operating expense, we can substitute with COGS, or COGS we can substitute with operating expense. We'll see later. Tax rate is given in the question as how much, sir? 25%. Fixed asset they are given it as 39 lakhs. Okay. Current ratio is 1.8:1. So looks like we're not able to proceed now. Whenever I told you stuck, what to do? Income statement. Put it. Working note. Income statement. Now, did we find anything related to income statement? Yeah, we found out PAT. How much is that? 16,20,000. Got it up. Check the question. Have they given tax rate? 25%. Now, this is the order. Yes. From EBT, if you reduce tax, you're going to get EAT. In this problem, EAT, you can either call it as EAT or you can call it as each. One and the same, because there is no preference dividend. Now check, sir. 1 minute, everyone. If EBT is 100, what will be tax? 25%. 100 got 25%, which is 25. So each will be how much? 75. That means, can I say 16,20,000? 16,20,000 represents 75%. After paying tax, what remains? 75%. Okay, but we want before tax. Before tax represents how much? 100%. So prorate. That's what I've written over here. 16,20,000. This number represents 75%. Or 100%, how much? How much are you going to get? 21,60,000. Got it now. This is 21.6. This is 16.2. That means what will be the tax amount? These two cut difference, or you can directly calculate. 21,60,000 cut 25% you do, you will get 5,40,000. That means this portion of our section we have done. Okay. Interest was already given to you in the question. We found out also. 45 lakh cut 12.5%. How much is that? 5 lakh 62. Fine. So this you know, interest you know. Can't you find out EBIT? How do you get EBIT? Adding these two. And you wanted EBIT only. Because they said operating ratio is 85% of sales. Therefore, EBIT will be what? 15% of sales. Now you got EBIT means you can also find out sales connection. Okay. So, next working note I'll put up to find out sales. I'll stop here. Okay, I don't need, because they have not asked income statement. No. Sir, if they have not asked income statement, you don't have to solve it fully. Whatever information you need, till then you solve. Rest of it you leave blank. Nobody will deduct marks for it. If you want, you can solve full also, no big deal. Otherwise, you can stop wherever it is required. Done now? Now, Sales we can find out. How? Since operating ratio is 85% of sales. And how do you get operating ratio? COGS plus operating expense put together is 85% of sales. Therefore, what will be EBIT? 15% of sales. Do you know EBIT? Yeah, just now we figured out. EBIT is how much? 27,22,500. That is your EBIT. Is equal to 15% of sales. Therefore, sales if you solve, you will get 1,81,50,000. If you want to fill income statement, you can go to the sales and write 1,81,50,000. Done now, people. Any problem, people? No. Next, what have they asked? Interest coverage ratio. That we can easily solve up now. We need EBIT and we need interest. Both we have now. This is your EBIT and this is your interest. These two are division. If you do, you'll get interest coverage ratio to be how much? 4.84. Next, they ask GP ratio. For GP ratio, we need GP also. We need sales also. That means I have to fill my income statement here. Yes. Now, how to do? You remember one equation they said. What is that? Operating expense to COGS is 2/6. Okay. Yeah, I'm not saying problem is saying correct. No, operating expense is to COGS is 2:6. Basically, operating expense divided by COGS. If you do, you'll get 2/6. Solve. 6 times of operating expense is equal to 2 times of COGS. Therefore, can I say COGS is equal to 6 divided by 2? If you do, you will get 3 times of operating expense. Substitute. Substitute where? Sir, they gave operating ratio. You only told. How do you get operating ratio? COGS plus what? Operating expense is equal to what, sir? 85% of sales. Instead of COGS, substitute. What will you write? Instead of COGS, you will write 3 times operating expense plus operating expense is equal to 85% of sales. Sales we already know. How much is sales? 1,81,50,000. Do this, you will get operating expense. I think I've already done somewhere here. Just check. Operating expense, we will get it to be 38,50,000 or 56,875. Done now. If you know operating expense, you know COGS also. COGS will be 3 times of operating expense, which will be this amount. Now you know sales, you know COGS. Sale minus COGS will give you what? GP. And how do you get GP percentage? GP upon sales into 100. That's a problem. Okay, G. Got it, G. Yes, G. Requirement over. One more. One more. They asked what? Current asset. Somebody used their kidney too much in this problem. See, sir, nothing they gave. You tell me, sir. Don't look at the solution. How can we find current? How can we find current assets here? Tell me, sir. If they're given working capital, net working capital, they're given current ratio. That's fine. If they're given working capital and if they're given current ratio, I could have substituted and got current assets. Or at least if they're given current ratio and if they're given liquid ratio, something I could have worked out. Nothing given. Only current ratio is given. How do you get current ratio? Current assets divided by current liabilities. How much? 1.8 is to 1 means this is as good as saying 1.8 divided by 1, which is same as what? 1.8. Therefore, current asset is what? 1.8 times of current liability. That's all we got. Now, how to proceed? How to proceed? They did not give any data. Now, I'll find out capital employed. From that, we can deduct. Sir, the way you have to do is, though they have not asked balance sheet, you should visualize your balance sheet. Tell me, how do you get total asset side of balance sheet? What and all is there in asset side? Tell me. Fixed asset plus current assets. Yes, sir. On the total equity and liability side, what and all components will come? Total equity and liability side, if you add, what and all will come? Equity share capital plus reserves and surplus. Okay, plus what? Plus long-term debt plus current liability. Preference share capital they have not given, so I'll take it as 0. If you want, you can write it in the equation. Plus PSC plus long-term debt plus current liability. This is how you get asset side of balance sheet and liability side of balance sheet. And we know asset side total assets and liability side balance sheet will match. Yes, that means these two equations you have to equate. These two you need to equate because balance sheet ka liability side and balance sheet ka asset side are same. That means how will you solve? Fixed asset plus current asset is equal to equity share capital plus reserves and surplus put together only we call it as equity. PSE not there. So I'll take it as 0. Long-term debt is given in the question to be 45 lakhs. Current liability, let it be as it is. Fixed asset, do you know? Yes. How much is that? 39 lakh. Instead of current asset, I will substitute. What is current assets? 1.8 times of current. Instead of current asset, I will write 1.8 times of current liability. Do you know equity? Yes, first working note only you worked out. Check. How much is equity? We don't know breakup. Equity means equity share capital and reserves and surplus. Breakup we don't know, but put together we don't know. How much is that? 30 lakhs. Preference share capital 0. Long-term debt is given to be 45 lakhs. Current liability as it is. Solve this. So this will be what, sir? 75 lakhs so minus 39 lakh. When you solve, I think I have done it. It's okay. Where? Somewhere it should be here. Right? It's not there. Okay, people, you solve. Okay, here it's there. If you solve, you will get current liability to be 45 lakh. And what is current assets? 1.8 times of current liability, which you will get it as 81 lakhs. It is alright. If one or two components doesn't click in the examination day, it is alright. Don't worry about all the adjustments. Each, they have given 5 adjustments here. No, each adjustment will carry 2 marks. One adjustment, if you don't do it, out of 10, at least you will score what? 8. That is still 80%. Good enough. Don't freak out, I lost for 2 marks and all and waste your next question. Move on. Give it some time. Later on, if you are able to figure it out, you can come back and finish it. Otherwise, okay. No problem. Done, Aji. Got it, Aji. Pakka, Aji. Enough, Aji. Enough, sir. We've sorted today, sir. Okay, sir. Okay, one last question we will do. Small one. Okay. MTP May 2024 wala, September 2024 wala question came for 5 marks. You are required to calculate, underline the word you. Yeah, you are required to calculate total current assets of Ananya Limited from the given information. Stock turnover ratio they have given. Sir, stock turnover ratio's formula is COGS divided by first priority to denominator, average stock. Average stock missing, closing stock. Sales they have given, fine. GP they have given. GP is 25%. 25% of what? Sales. Current liability is given. Liquidity ratio is given. Okay. Tell me, sir, how will you proceed? And here they told away stock at the end is 30,000 more than stock in the beginning. So that means they have given some reference to opening stock and closing stock. So that means stock turnover ratio you will take closing stock or average stock? Okay. Tell me, sir, how will you just proceed? Tell me that. Just how will you proceed? Solving, I'll show it to you how I've done.
Find out cost of goods.
Find COGS. Fine, great. Sales is given. GP percentage is given. If GP is 25% of sales, then COGS will be 75% of sales. Okay, first let's find that. Correct. COGS is 75% of sales, which you get it as how much? 5,40,000. Then, which ratio uses COGS? Stock turnover ratio. Stock turnover ratio is given as, sometimes they will say 5 times. 5 times is nothing but 5. Sometimes they will say 5:1. 5:1 is also what? 5 divided by 1 is nothing but 5. So various ways in which they present, but everything is any which way same. So stock turnover ratio is given to be 5. So using this you can find out not closing stock but average stock, because they have given a reference to opening stock and closing stock. So stock turnover ratio is 5. Stock turnover ratio ka formula is COGS divided by average stock is equal to 5. COGS just now we found it as 5,40,000. So when you solve, you will get average stock to be 1,08,000. And you know average stock, and how do you get average stock? Opening plus closing divided by 2. Let opening stock be OS. Therefore closing stock will be what? They told stock at the end. Stock at the end means closing stock is 30,000 more at stock at the beginning. If opening stock is OS, means closing stock will be 30,000 more than OS. So solve this, you will get OS to be how much? 93,000. So therefore closing stock will be 30,000 more, which is 1,23,000. Then okay. Now next what we can use? They are given liquidity ratio. How do you get liquidity ratio? Current, this basically liquidity ratio means quick ratio. How do you get quick ratio? You take quick asset divided by current liability is equal to 1.25. How do you get quick assets? Current assets minus closing stock, not average stock. Current asset minus closing stock divided by current liability is 1.25. Current asset we don't know. Closing stock just now we got how much? 1,23,000. Current liability is given in the question to be how much? 2,40,000. Solve this equation and you will get the current assets. That value is 4,23,000. That's all. Okay. Practice. More and more you practice, the sooner you will be able to get it. Okay. Also maybe written some, maybe I'll just take you through this. Maybe helpful. 1 second. This we wrote, no? Always write current assets and current liability in the inner column of balance sheet. That will help you to figure out balancing figures easily. Accounts receivable means debtors and bill receivable put together. Okay. Basically, debtor turnover ratio and all will not use debtors. They use accounts receivable. That is one. And proprietary fund, we have another way of expression. One is fixed asset plus net working capital minus debt. Okay. Now, I've just given question reference. This and all I did in my regular class. So, it's okay. Don't worry about this. Then, sometimes what will happen is, maybe this one I'll quickly orally discuss with you. This is question number 14 of our class notes. This was also an LDR, but that's okay. Since you don't want to solve it, 2 minutes, I'll tell you what it is. What they will give you is, sometimes they will give you first year balance sheet. They will also give you second year balance sheet. First year ka closing balance will become second year ka opening balance. Year 2 ka balance will become closing balance. They will give you some component. Sometimes they will give you balance sheet or some component ka balance they will give for 2 years. One major thing is like this, they will give equity share capital 10 lakh, 10 lakh, retained earnings 15 lakh, 20 lakh. Looking at this, and they will also give you debt 20 lakh, 20 lakh. Tell me, by looking at this, what you can make out? Looking at these three figures, is there any point that is clicking in your mind? Perfect. Sir, these two are same, but retained earnings from 15 lakh has become 20 lakh. That means what? Current year, no, sir, you have made a profit of 5 lakh rupees. Not PAT. Current year ka profit after all the adjustments. But in this problem, equity dividend, preference dividend and all will not be there. That means current year ka PAT will be directly 5 lakh. Like this, by looking at the number, because retained earnings balance from 15 has become 20, means current year ka profit after all adjustment is 5 lakh. But there will be no equity dividend, no preference dividend. That's as good as saying PAT has increased by, or current year ka PAT is 5 lakh. One hidden adjustment, one question. This is your question number 12. I think ICS question number 14 we had done this. This one we already used. Right? Total assets will be equal to, or total assets component will be equal to total liability side and equity side. We need to substitute. Operating ratio also be used. If operating ratio is 85% of sale, means EBIT will be equal to 15% of sales. And always check if NWC and current ratio is given, means you can substitute one and get current asset and current liability. If current ratio and quick ratio is given, means you can use the substitute and either get closing stock or current asset, current liability as a balancing figure. These are some quick pointers relating to some questions. So I think we are good enough for today. So we'll take up the remaining questions or topics in the tomorrow's session. Thank you so much for your patience. Take care. Bye-bye. Yes, people, welcome to the next marathon session where we'll be starting with a topic called working capital management. A big ticket topic, takes substantial time. We almost spent 25 to 30 hours just for this topic in our regular class. Okay, but unfortunately, we'll not have so much time here. We will try to cover as much as possible in the quota of time available with us. Okay. All right. So working capital management means, as the name itself says, working capital management. So we are just managing our working capital. So how do you get working capital? Current assets minus current liability. So in this topic, essentially we are managing current assets and we are managing current liability. As simple as that. We're just managing current assets and current liability. So why do we need to manage current assets and current liability? The reason is, one, there are some advantages of having a high levels of current assets and having high levels of current liability. Let's take a small example. Let's say if inventory level increases. In our regular class, I used to give tomato example. Let's say there is a vendor, he normally stores 50 kgs of tomato. There's a tomato vendor, he buys and he sells tomatoes. He normally stores 50 kgs. One fine day, he stored 200 kgs of tomato. That means inventory level from 50 became 200. So how many kgs increased? 150. Is there any advantage of increasing the level of inventory? Yes. One advantage is, now earlier he used to sell only 50 kgs. Now there is a possibility for him to sell 200 kgs. because he's storing more means he can sell more and he can earn more profit. That's one of the advantages. Correct? And also, since he's buying more, he'll also get some price advantage. He'll get some bulk discount. Those are some advantages. Is there any disadvantages? Yes. So earlier, if going happened means he used to lose only how many kgs? 50 kgs. Now, if unfortunately Vastu is not on his side, he will lose entire 200 kgs and probably his business is down the drain. Correct? No, that means liquidity risk. Liquidity risk means the chance that the business will shut down. That risk will be on the higher side. And also funds are getting blocked. Earlier, let's say he used to buy tomatoes at 10 rupees per kg. That means how much money was blocked? How much money was needed? 500. Now to buy 200 kgs, how much money he needs? 2000 rupees. Earlier, only 500 money was invested. Now, how much money has got invested? 2000. That means fund has got blocked to an extra amount because he'll be able to recover this funds only when he sells the inventory. Hence, funds gets blocked for a longer duration and a lot higher funds gets blocked. Okay, sir. These are some of the disadvantages. Similarly, if you have higher levels of debtors, if debtor level increases, is there any advantages? Yes. So when will debtor balance increase? When you give more credit to the customer. Instead of, let's say, giving 30 days credit, company started giving 90 days credit. Instead of 30, some company started giving 90. That means debtors will buy more. Rather, we will sell the goods to the debtor more. So our sales will increase and our profit also will increase. But is there any disadvantages? Yes. Earlier we used to recover the money within how many days? 30 days. Now we are recovering within 90 days. That means for extra 60 days my funds are getting blocked. And Govinda risk means bad debt risk increases. Because now I have to wait for 60 more days. No. In that 60 days, if that customer leaves the country means like some person you know who, yeah, that means my money also gone. So bad debt risk increases and business shutting down risk, liquidity risk also increases. Yes, that is the reason we say working capital management is a trade-off. It's a balancing act between liquidity and profitability. Because by holding more investments in current asset, your profitability will increase. But at the same time, your business shutting down risk, that is your liquidity risk also will increase. So we don't want to take too much risk, nor do we want to compromise on our profits. Somewhere we are trying to balance the two. That is what we mean by working capital management. Understood? Yes, sir. Similarly for creditors also, if creditor level increases, suppose creditor balance from 1 lakh became 10 lakh or 1 lakh, from 1 lakh it became 3 lakh. How will this happen? One way this can happen is, am I paying the creditors on time or am I delaying the payment? By delaying the payment. Let's say earlier I used to pay the creditor within 30 days. Now I am paying within 50 days. That means I am delaying the payment by how much? 20 days. That means for this 20 days, I can use the money for some other purpose. Earlier I used to pay the creditor within 30 days. Now I am paying on the 50th day, means extra 20 days I can use the money and use it for some other purpose. So that means by delaying the payment, it acts as a free source of finance for me. Because usually by delaying, the interest and all will not pay to the creditor. All the agreement says nobody expects that. Okay. So it acts as what's a free source of finance. That is one of the advantage. Similarly, is there any disadvantage? Yeah. Creditor is going on asking the payment. We are going on telling tomorrow I will pay. Day after tomorrow I will pay. That means your words will have value or it will lose the value. That means one disadvantage is it will lead to loss of goodwill or reputation. Now, if you are doing games, if you are playing games, creditor also can play games. He may say, earlier I used to supply the goods to you at 100 per unit. From now onwards, 150 rupees per unit. Go. That means he may increase the price of the goods. That could happen because obviously if you are playing, he can also play, right? Or he may say, I will not supply you the goods on credit. Pay cash, take the goods. He may stop supplying the goods on credit. Or he may take an extreme action and say, I don't want you, you are one dabba customer, I don't want to transact with you. Meaning he may stop selling the goods to you forever. Those are some of the disadvantages that can happen. Fair enough? So that means hence we need to balance these. That is what is working capital management all about. Okay, people. Now in this chapter, broadly, if I'll have to say, there are about 1, 2, 3, 4, 5, about 6 types of problems. There are about how many? 6 types of problems. If you solve this chapter, alright. But for each type in our regular class, we used to solve 6 to 8 problems. Overall, we did 50 plus questions for this chapter alone. Okay. But now we will see based on the time we will take. But every type, at least one question, I'll pick it up. Is that okay? If more time is there, I'll pick more. Otherwise, one question for each time. Don't worry, I've made a format for every types of question. So even if one question, if we understand properly, you will be able to handle others also. That's the way we have built up this particular format. Can we dive into the topic now? Okay. Now, one more if I have to say on the theory side of things, working capital management can be looked at from two angles. You can assess it from two angles. One from the angle of value, another from the angle of time. From value angle, if you want to define working capital, there are two types. From value, there are two types of working capital. One is gross working capital, another one net working capital. Gross working capital means, name itself is saying gross. How do you get working capital? Current asset minus current liability. If you talk only about investment in current assets, meaning if you sum up or if you total the current assets, that total number we call it as a gross working capital, meaning only the total of current assets if you find, that's what we call it as investment in current assets. That only if you find, we call it as what? Gross working capital. Take only current asset portion. From current asset, if you reduce current liability, that we call it as what? Net working capital. This is from value angle. Next, from time angle, if you have to define working capital, they are broadly again further categorized into two parts: permanent working capital, fluctuating working capital. Permanent working capital means every organization, sir, will maintain some amount of cash, right? Minimum cash they will maintain in stock and all. In costing, you might have learned about buffer stock and all. Certain minimum stock they will maintain. That level will be brought down or it will be forever maintained. Forever maintained. All that buffer stock, that minimum cash balance, all that is an example of permanent working capital. Other than permanent working capital, whatever current assets, current liability you have, that becomes your temporary working capital. As simple as that. Okay, Saru? Alright. So in the chart, I've written a lot of things. I'll not discuss everything. I'll only be discussing the exam related things now. Okay. So a few things and all, like factors affecting working capital and all, I'll not go for it for the time being because they're not that important for examination. Alright. Now, first exam or first type of question that you can expect in examination from this particular chapter is one is on the operating cycle. Operating cycle means simply the time gap. It is the time gap between what? Between the day you purchase the goods and pay for it till the time you sell the goods and recover the money. What did I say? Operating cycle means it is the time duration or the time gap between the day you purchase the goods. After purchasing the goods, what will any trader do? He will sell the goods. Sales will happen on cash basis or usually credit. Usually credit. That means you have to recover money from your debtor. So the day you pay the creditor till the time you recover money from your debtor, that duration or that gap only we call it as operating cycle. Understood? Fine. So an operating cycle is given by a small formula called R plus W plus F plus D minus C. As an operating cycle is raw material holding period plus work in progress holding period plus finished goods holding period plus debtors credit period minus creditors ka payment period. Okay. Once again, I'll take a one question to prove this. Suppose operating cycle, you calculate it. So operating cycle, usually we calculate in days. Not that you can't calculate in months. Usually you calculate in days. Let's say you calculated, you use this particular equation and you got operating cycle to be 90 days. You got it to be, you plugged in this number and got the number to be how much? 90 days. What is the meaning of that is, if you pay creditor, if you pay the creditor, why will you pay the creditor? If you're buying the goods, means will you buy it at free of cost or you have to pay money? So if you pay the creditor today money, that money you can recover on the 90 days. So if you pay the creditor, after you sell the goods and recover money from your debtor, no, that duration will be how much? 90 days. That means your funds are getting blocked for how many days? 90 days. So if operating cycle is 90 days, it means how many days for which the funds are getting blocked. So in my example, funds are getting blocked for 90 days. Now means can company tell the employees, hey macha, see my operating cycle is 90 days da. Don't ask salary for 90 days. Can you tell the landlord, I will pay the rent not every month, I will pay after 90 days. Can I tell like that? No. That means if my funds are getting blocked for 90 days means how will I pay my salary? How will I pay my monthly electricity bill, monthly rent? For that, you need to take up a short-term loan or working capital loan. This is what it means. So because your funds are getting blocked for 90 days. So manage this 90 days business, the companies may have to take some short-term loan, which we refer to as overdraft or cash credit or working capital loan. Understood? Now this particular calculation, can we look at it in one question? Okay. So once again, how do we get? Tell me, operating cycle, how do you get? R is in raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditors payment period. Awesome. So let's look at the question just to apply this. 1 second, I'll show you. It's there in different pages. It may take a minute to find it. This one. Question number 19. So let's take up this question and learn a little bit more about this operating cycle. From the following information forecasted by R Limited for the year ended this, first check the requirement. What do you need to calculate? Net operating cycle, meaning we need to calculate OC. They're asking us to assume that 1 year is how many days? 360. Watch out, sometimes they say take 360. In this problem, we have to take how much? 365. Then they ask number of operating cycles in a year and working capital requirement. First, we'll calculate operating cycle first. Now, check for that. What do we need, sir? First, we need R. R as in raw material holding period. Check the question. Have they given? They gave raw material. But what is this? Is this in days or is it in lakhs, sir? It's in value. So they have given check balance as on 31st March 2022. So we are in which year now? Our current year is ending on 31st March 2022. That means this is what, sir? All this balance is the closing balance. They have also given balance on 31st March 2021. That is what? Last year ka closing balance. Last year ka closing balance only will become current year ka opening balance. So basically, as far as raw material is concerned, they have given opening stock of raw material and closing stock of raw material. This holding period which you calculate, is it a pakka number or average number? So if I tell you are the finance manager, I ask you how many days do you store raw material? Can you give me a pakka number or an approximate number? You can only give me an average number, yes or no? I mean, so should we take opening stock, closing stock or average stock? For our calculation, we always need to consider the average stock. Yes or no? Alright, now I'll show you one in the same grounds. We'll have to calculate the other as well. So now first, let's find, take your calculator, find out the average stock for me. How much is average stock? 65 plus, how do you find average? It's not always, in fact, this is average. So how do you find average stock? Opening stock of 65 plus closing stock divided by 2. How much is this, sir? 55. This is in days or 55 lakhs? 55 lakhs. Now listen, everybody. 55 lakhs is the value for 1 day or whole year? This is the average stock for 1 day or whole year? Whole year. And whole year in this problem has how many days? 365 days. Correct now. Everybody good? Or on 1 minute. Hang on. Just 1 second. I think I'll use this. Not this bad actually. Okay. Sir, raw material. What will you do with raw material? Using raw material, will you sell the raw material or will you consume the raw material? Consume for what purpose? For the production of goods. Yes, no? So check. Have they given annual consumption of raw material? How much raw material consumed annually? Given or missing? Missing. What have they given? Annual purchase of raw material. Annual purchase of raw material. Annual purchase means it is for the whole year. I need raw material purchased or raw material consumed. So how will you get raw material consumed? Tell me. Raw material consumed, how much? Or why to see it over here? We'll only see it. Okay. How do you get raw material consumed? Opening stock of raw material plus purchase of raw material minus closing stock of raw material. Do you know opening stock of raw material? Yes. How much is it? 65. How much is the purchase of raw material? 400. Minus closing stock of raw material, how much? 65. By doing this, you will get raw material consumed, how much? 380. This is what, sir? You took annual purchase of raw material. That means this is what? 380 is what? Annual raw material consumed. That means this 380 lakh is a number for 1 day or whole year? Whole year. On an average, how much raw material cost stock do you maintain? Just now we found out. How much is raw material cost stock on an average? 55 days. So this 380 lakh represents 365 days ka stock, means 55 lakh ka average stock represents how many days ka stock? Are you getting it? If this 380 lakh represents 365 days ka stock, a 55 lakh ka average stock of raw material represents how many days ka stock? Find out that proration. How do you get that? 55 into 365 divided by 380. If you do, you will get 53. 52.5. Round it off to 53 days. That means on an average, you are holding raw material for 53 days. For operating cycle, we need R. This is your R. First component. Like that, we have to find W, we have to find F, we have to find D, and we have to find C. Once you do that operating cycle, we can figure it out. Understood? Yes. So this is your R. Next is what's our W? W as in what? Work in progress. Work in progress eventually will become 100% complete. That means work in progress is related to what's the cost of production, can I say? It's linkable with cost of production, because eventually work in progress first of all means what? It's 100% complete or not yet? Not yet. It is neither raw material nor it is finished goods. It is stuck somewhere in between. But eventually it will become finished goods, no? Correct? Yes, that means work in progress is better linkable with what? Annual cost of production. But anyways, we need to take opening stock of WIP, closing stock of WIP, or average. First find average. How do you find average? 51 plus 35 divided by 2. So that gives you your average WIP. How much, sir? 43 lakhs. How much is your annual cost of production? 450. This 450 is for 1 year or whole year? This 450 lakhs cost of production is for whole year. WIP are you maintaining, or how much is the average WIP you are maintaining? 43 lakh. If 450 lakhs represents 365 days ka stock, 43 lakh represents how many days ka WIP stock? Pro rate, how much you going to get? 35 days. So on an average, you hold in your business WIP for 35 days. Like this, every component. Have you got the approach? Okay. Next is what, sir? Finished goods. First find out what? They're given opening stock of finished goods and closing stock of finished goods. First find what? Average stock of finished goods. 70 plus 60 divided by 2. How much is that? 65 lakhs. Okay. So finished goods, eventually what you will do? You will cost, it's finished goods is better linkable with what? Annual cost of the goods sold. Right? How much is the cost of the goods sold annually? 525 lakhs. That means 525 lakhs is a number representing 1 day or whole year. 525 lakh is for 365 days. But do you want how many average finished stock you hold, sir? 65 days or 65 lakh represents how many days ka finished goods. So prorated, how much you going to get? 45 days. So finished goods on an average we are holding for 45 days. R we got, W we got, F we got. Next is what? Debtors. So check, sir. Debtors will come with respect to sales or credit sales? Credit sales. Have they given annual credit sales? Yes. How much is that? 585. So they have given opening receivable and they have also given closing. So which one we should take? Opening, closing, or average? First find average debtors. How much is average debtors? Opening plus closing divided by 2. You will get 123. How much is your credit sale, sir? Annual credit sale is how much? 585 lakh. Since it's an annual credit sale will be for whole year. Whole year has how many days? 365 days. So 585 lakh is for 365 days. How much for 123.5? When you prorate, how many days ka average debtors you are holding? On an average, debtor ka collection period is 77 days. Is this pakka number or average number? Average number. Okay, some debtor may pay a little early, some debtor may pay a little later. But we are taking an average number and working out our operating cycle. Easy. On the same parlance, we also have to find out the creditors. For creditors, you want raw material consumed or raw material purchased? We want raw material purchased. Is that given? Yes, 400. But have they given creditors or have they given opening and closing? Opening and closing. First find what? Creditors ka average balance. How do you find average balance? 71 plus 68 divided by 2. How much is that? 69.5. How much is your annual purchase of raw material? Where have they told? Annual purchase of raw material is how much? 400. 400 represents how many days ka? 365 days ka. How many, what is your average balance of creditor? 69.5. 400 represents 365 days ka balance. 69.5 lakh represents how many days? Prorate that, how much you going to get? 63 days. Meaning on an average, we pay the creditor within 63 days. So we got all our component. So how much is your OC, sir? How do you get OC? R plus W plus F plus D minus C. I think in fact this formula ka logic also I told in the class. Now we will not go into logic and waste time for that. Is it okay? Now we will discuss mostly the exam related things. So if you plug in all the numbers, you will get how much operating cycle? 147 days. What is the indication of this? If you get operating cycle to be 147, what does it mean? Your fund, if today you pay the creditor, you will recover money from your debtor only after 147 days. Meaning if you invest the money today, you will recover this money only after 147 days. Or rather for 147 days, your funds are getting blocked. That's what operating cycle signifies. Yes, people, this is the answer to the first requirement. What else they asked? They also asked one more. What is that? Number of operating cycles in a year. So to run one operating cycle, how many days we need? One operating cycle requires 147 days. In a year, how many days are there? 365. That means in a year, how many cycles can you run? To run one cycle, we need 147 days. In a year, there are 365 days. So how many cycles can you run? Tell me that in formula. How do you get it? 365 divided by operating cycle, or number of days in a year divided by operating cycle. Okay. If you don't want the data if they don't give the data in days, if they give it in months, then instead of number of days in a year, you write number of months in a year. So based on what data you want, that way you do the presentation. So basically 365 divided by 147, if you do, you will get 2.48. So meaning in the current year, you can run the operating cycle 2.48 times. Done, sir? That is the second requirement. Now the third requirement, what did it ask in the third requirement? Amount of working capital. Okay. Sir, do you know how much operating cost every year you're spending? Yes. Annual operating cost is how much? 325 lakh. This is for 1 year or whole year? They said annual. This is the operating cost for whole year. And in a year, how many cycles are you running? 2.48. This also is for 1 year or whole year? Whole year. So whole year your operating cost is 325 and whole year how many cycles can you run? 2.48. That means can I tell this is the 325 lakh is operating cycle for 2.48 cycle. For one cycle, how much is operating cost you need? This 325 is the cost for 2.48 cycle. For one cycle, how much is the cost? 325 divided by 2.48. That gives you how much, sir? 131.04. That means for running one cycle, we need to have how much money with us? 131.04. That is nothing but your working capital. Or you can remember it as formula. Working capital is given by, in these cases, what's the annual operating cost divided by number of operating cycles in a year. If you do that, this is one way of finding out the working capital. There is one more which I'll tell you in a bit. But one quick way to find out working capital through operating cycle is this. Yes, people, this is one kind of question that they can ask. If you want, they can ask this as a 2-marker question also. Here we found R, W, F, D and all we found no. In some problems, they'll directly give it off. R, W and all, they'll directly give it off. That way it will become only 2-marker question. If they want to ask 5 marks and all, they will ask us to compute all this. So how that institute has a choice. This is one kind of problem. Are we comfortable with this? Okay, so this is the first type of problem. I'll come back to the chart. Next, what is that? This is done. Okay. Now, sir, I'll go for this. Another most important topic from this particular chapter is estimation of working capital. Estimation of working capital. So, how do we get working capital basically? To find working capital, we need current assets and we deduct current liability. So, this is in this problem, what do we do is every component of current assets we need to estimate. Every component of current liability we need to estimate. They will not give this. What are the components of current assets? Could be your closing stock of raw material, could be your closing stock of WIP, could be your closing stock of finished goods, could be your debtors, could be some prepaid expense. All this data will not be given to you in the question. They will give some information. Using that, we have to find out all this. That is one. Similarly, what are the components of current liability? Could be your creditors or could be some outstanding expenses. All this we have to estimate. Once you estimate, we estimate all this, then you will be finding out what, sir? Working capital. This is usually comes for around 8 to 10 mark question. Now, in the class, I have done 10 problems on this only, but I have maintained one format. In the same format, I will solve. Maybe in this session, I will take up 2 questions on estimation of working capital. Fine. Now, just to see that, to recap that particular format with you. Okay. Now, I'll just run through this format with you quickly. This is a format I followed for the class. Okay. So, first, sir, you need to find out closing stock of WIP. Now, closing stock of WIP, usually we put it as working note number 1. Work in progress means what, sir? WIP means what? WIP full form is work in progress. Meaning is what? Is it fully complete? No. It is neither raw material, neither it is finished goods. Somewhere it is stuck in between. That means work in progress means, can I say, some raw material cost also you have incurred, some labor cost also you have incurred, some overhead cost also you have incurred. Fully you have not incurred. Because to produce the goods, we need to incur 100% of the cost. To make a finished goods, we need 100% of raw material, we need 100% of labor time, and we need 100% of our other cost, other production cost. If 100% of the cost is incurred, means will it be WIP or it will become finished goods? It will become finished goods. WIP means 100% of the cost is not incurred, somewhere it is stuck in between. Maybe 50% is incurred, 80%, we don't know. That we call it as DOC. DOC means degree of completion. DOC means degree of completion. That they will give it to you in the problem. How much is the degree of completion? Usually they will give it to you in the problem. If they don't give, usually DOC of raw material, no, we take it to be 100%. We take DOC of raw material to be 100%. Because if you want to process the goods means raw material fully, you should first insert, no sir. Without putting in raw material, can the labor work? Or only after raw material is inserted, then the labor and other cost will come. Correct. Yes, no, that's the reason. Normal assumption is we assume that material is complete in how much extent? 100% extent. And watch out now. If the question does not mention degree of completion, then only we take it to be 100%. And if question is silent for labor and overhead, we assume that it is degree of completion is 50%. Assumption, nothing logic as such. This is the convention we adopt for solving the question. Understood? Yes, people. If suppose question says WIP is 100% complete in all aspects. If they use what words? If WIP is 80, or rather WIP is 80% complete in all aspects. That means material ka DOC is also 80%, labor ka DOC is also 80, and overhead ka DOC is also 80%. Only if DOC is not mentioned, then we take for material 100%, for labor and overheads we take it as 50%. So these two also we call it as conversion cost. Okay, that is the term that they use, because to convert raw material into finished goods, we need labor also, we need other overheads also. So these two we call it as conversion cost. For conversion cost, DOC we normally assume it to be 50%, but watch out and accordingly take. Yes, sir. Any problem? Okay, so you have to consider this and find out. Once maybe quickly I'll run through this format. If you're looking at this for the first time, you may not get it, no issues. That's the reason I've taken two questions. So how do you get WAP of relating to raw material is, first to take, they will not directly give you this, we need to estimate. First to take annual raw material consume. First to take out annual raw material consume. Why raw material consume? Why not purchased? Sir, to produce the goods, we need raw material purchased or we need raw material consumed? Because to produce the goods, you have to consume the raw material. Hence, we always take what, sir? Annual raw material consume. Annual raw material consume means this is for 1 day or whole year? Whole year. That means this is for 12 months. Check the data. Sometimes they give the data in 12 months. Sometimes they will give it in days. Sometimes they give it in weeks. If they give the data in months, then you will take it as 12 months. Because this is annual. Look, annual means this is for whole year. So you will take 12 months. If they give it in days, then you will take 365, or some problems may they will ask us to take 360 days, so we will take that. Or if they give the data in weeks, then we will take it as 52. So first you take annual raw material consumed divided by 12, 365 or 52 as the case may be, multiplied by WIP holding period. This will be given to you in the question. 1 month, 20 days, 30 days, 2 months, like this will be given to you in the question. Multiplied by DOC. DOC as in degree of completion. That will be given. If they don't give for material, we will assume it to be 100%. Same drama for labor cost also. First take annual labor cost. Annual labor cost means it is for 1 day or whole year. It's like telling like this part. If you are confused, let's say annually I have consumed raw material of 10 lakh. Annually means this is for 1 day or whole year. That means this is for 365 days. Now they will tell you the problem. On an average, WIP ka process time is 45 days. WIP ka process is 45 days. That means for 365 days, value is how much? 10 lakh. For 45 days, what is the value? Now, how do you calculate this X? Tell me. 10 lakh into 45 divided by 365. That's how you do. Now, tell me the same in formula. What is this 10 lakh? Annual raw material consumed divided by what? 365. Multiplied by 45. What is that 45? WIP ka holding period. Understood? But WIP means, is it necessary it is 100% complete or may not be? May not be. That's the reason we also multiplied by DOC, which will be given to you in the question. Got it? Everybody understood? Same drama. On WIP, you only incur material cost or other cost also? Other cost. Other cost we call it as what? Conversion cost. Conversion cost are of two types usually, labor and overheads. So first do the same thing. Like here, if I tell you annual labor cost is 50 lakh. Annual material is how much? 50 lakhs. That means this is for how? Whole year. Okay, the whole year means how many days? 365 days. I already told you in the problem that they will give you on an average WIP ka process period. How much is the WIP ka process period? 45 days. So for 365 days, if the labor cost is 50 lakh, means for 45 days, how much is the labor cost? Like that we prorate. If you prorate, what will be the formula? 50 lakh into 45 divided by 365. Express this in formula for me. 50 lakh is what? Annual material cost divided by what? 365, 12 or 52 depending on the case. Multiplied by 45. What is this 45? WIP ka holding period or WIP ka process period. Multiplied by DOC, because the WIP means is it 100% complete or may not be? May not be. That's the reason we multiplied by DOC. Same thing you do for overheads. So again, tell me without looking at it, construct overhead ka formula for me. What will you take? Annual overhead cost divided by 365, 52 or 12 depending on the case. Multiplied by WIP process period. Multiplied by DOC. So if you sum up all this, you will get closing stock of WIP. That's how to find out. And one good thing is I've maintained the same format for all the 10 questions we have solved. That works. Fair enough? This is one about this. So this now you get the closing stock of WIP. Next, we also need to estimate debtor. So next working note, number 2, we put up to find out debtors. Debtors, we take the help of cost sheet. Everybody remembers the cost sheet format? What is cost sheet ka format? We don't need full format, but anyways, tell me. First we take what? Material consumed. Then to that we add what? Direct materials. To that we add overheads. I don't want prime cost and all. Directly I'll take this. Okay, so material consumed plus labor plus overhead. If I add all this, I directly get factory cost. I don't want prime cost. I'll start with factory cost. Is that okay with you? Okay, then to factory cost, if I add opening stock of WIP and deduct closing stock of WIP, what will I get? Cost of production. The cost of production, if I add admin expense, and from that, if I add opening stock of finished goods and deduct closing stock of finished goods, what will I get? Cost of the goods, CO, cost of the goods sold, or COGS. To that, if you add a selling expense, what are you going to get? Cost of sales. Correct? Yes, people? Alright. Now, we use this to find out debtors. We use this to find out debtors. Sir, debtors is related to sales. No, sir. Why are you taking cost of sales? Debtor is related to sales. Why are you taking cost of sales? Reason is working capital means, I told you, operating cycle means, if operating cycle is 90 days, what is the meaning of it? For 90 days, your funds are getting blocked. Sir, to sell the goods, first I need to buy the goods. To sell the goods to my debtor, first I need to buy the goods. Let's say I buy the goods at 150 per unit. I purchase the goods at 150 per unit. Later I sell it for 200 rupees per unit. Okay. Now you tell me working capital means how many days, or working capital talks about sale value or cost value? Cost, because we are talking about how many days funds are getting blocked. Now you tell me, did I pay 200 rupees to purchase this product or only 150? 150. That means how much of my funds are getting blocked? If my funds getting blocked for 200, or I invested only 150? I invested only 150. Hence, we don't estimate debtors on a sale basis. We estimate it on cost of sale basis. Okay. Basically, the difference between these two is profit, right? Did I invest in profit or it's a byproduct? Byproduct. By selling the goods, I'm getting profit. Is my fund getting blocked in terms of profit? No. My fund is getting blocked only to the extent of cost. Hence, we don't take sale value. We take what, sir? Cost of sale and work out debtors. Understood? One more thing you need to be careful is, this is cost of sale means this is cost of credit sale or total sales? Total sales. Debtor will arise with respect to total sales or credit sales. That means from this you have to find out one more thing called what's annual cash cost of credit sales. In some problem they will mention 20% is cash sale. That means 80% will become credit sale. In majority of the problem it will not be given. If they don't give, we'll assume that the annual cost of sale and cost of credit sale is same. But if they give the breakup, you need to find out. Done. Now let's assume that this number is 10 lakh rupees. This number is how much? 10 lakh rupees. What is this once again, sir? Annual cash cost of credit sales. Annual cash cost of credit sales. That means this 10 lakh rupees is for one day or for whole year? This 10 lakh is for whole year. Whole year is 365 days. Correct? Now, will you give 365 days credit to your customer? Will your debtor, will you give credit of 365 days? No. Let's assume that we give a credit of 40 days. We give a credit of 40 days. That means for 365 days, the sale value is how much? 10 lakh. For 40 days, what is the value? If you prorate, how do you get X over here? 10 lakh into 40 divided by 365. You will get debtor's value. Okay, now tell me this in formula now. Let's see. How do you get this? 10 lakh is what? Annual cash cost of credit sale divided by 12, 365 or 52 depending on how the data is given. Multiplied by 40. What is that 40? Debtor's ka credit period. That is what I've written is here as formula. Done, people. This is how we estimate the debtors. Okay. But if you just carefully check, I've written the word cash cost. What is cash cost? I've not written total cost. I've written the word cash cost. The reason is we are working capital. Working capital means what? For how many days my funds are getting blocked. When we produce the goods, we'll also incur some depreciation. If you are producing some goods, we'll also incur some depreciation. Depreciation is cash expense or non-cash? Non-cash. So should we include non-cash expenditures also here? We should not. We should not. Because will there be any outflow of cash relating to depreciation? No. That is the reason we always find out what's it. It's not total cost. We take the cash cost. That means in your overheads and all. No, here we have written overheads. It should include depreciation or exclude depreciation. All the depreciation and other non-cash expenditure we should exclude. If in the problem, if they say it is included, what we have to do? Exclude and then recalculate. Done now. This is the format to get the debtors. Any problem, anybody? Any problem, anybody? Or okay? I'm discussing the overall format. Once again, I'll apply the same thing in two problems. Done, done, or done? Okay. Working note number 3, we usually put up for creditor. Same format, same thing. If you will see the next problem. Working note number 3, we'll put up for Creditors. But one second, hang on. Here, what do we have? Material consumed. For finding creditors, we need material consumed or material purchased. Material purchased. But here, what do we have? Material consumed. From material consumed, can you find out annual material purchased? Yes. First of all, how do you find out raw material consumed? Opening stock of raw material. This is raw material consumed. Because will you purchase finished goods from creditor? If you are a manufacturer, will you purchase finished goods from creditor or only raw material? Only raw material. So if they give you raw material consumed, how do you get raw material consumed? Opening stock of raw material plus purchase of raw material minus closing stock of raw material. We do this. Now you tell me, sir, if I give you this data, if I give you this data, can't you find out purchases? Redraft the equation for me. How do you get purchase? Purchase of raw material is equal to raw material consumed plus what? Closing stock, you'll send it to the other side. So it will be plus closing stock of raw material minus opening stock of raw material. That's what I've written here as equation. Check. Annual cost of raw material consumed plus closing stock of raw material minus opening stock of raw material. If you do, you'll get annual cost of raw material purchased. Understood? Suppose this number is 20 lakh. Suppose this number is 20 lakh. This is what? Annual raw material purchased. That means this 20 lakh is for 1 day or whole year? Whole year. Let's maybe work out this in months. Okay. So because they can give the data in days, months, weeks, whatever. So if they give you the data in months, then how will we work? Now this 20 lakh is for whole year. Whole year means how many months? 12 months. Will you get whole year cut 12 months credit from creditors or only few months? Let's say creditors ka credit period is 2 months. Creditors ka credit period will be given to you in the question. Let's assume it to be 2 months. That means for 12 months, if the value is 20 lakh, means for 2 months, how much is the value? How do you find out X here? Tell me. 20 lakh into 2 divided by 12. Now tell me in formula, let's see. How do you get the creditors? First you will take what, sir? Annual purchase of raw material divided by 12, 365 or 52 multiplied by creditors ka credit period. If you do that, you will get the value of creditors. That's all is the format. Done, people. In this format only, we'll get few closing stock. Then lastly, we put up a statement. This statement will have estimation of working capital. All the closing stock of raw material, WIP work in progress, you put it here. Then debtors, basically all the assets you list out here. Then all the current liability you reduce here. Then you will get what, sir? Asset minus liability will give you net working capital. That wala problem this is. Every component of current asset, every component of current liability we need to estimate. Some one or two I've written extra over here that we will take it with the help of problems. Overall, did we get the crux of it? Once quickly, can we summarize this? And then we will apply. Same format, so that way it is good. First working note, we put it up over what, sir? WIP. Okay. For WIP, keep in mind one key component of DOC. Now, how do you get WIP? What and all costs will be incurred towards WIP? Material cost also, labor cost also, overhead cost also. Material is okay. Labor and overhead we use at a conversion cost. So, how do you get material related to WIP? Take what, sir? Annual material consumed divided by 12, 365 or 52 multiplied by WIP holding period into what? DOC as in degree of completion. Similarly, labor, how do you get? Take the annual labor cost divided by 12, 365 or 52 as the case may be multiplied by WIP holding period multiplied by DOC. Similarly, overhead cost relating to WIP, how will you get? Annual overhead cost divided by 365 or 12 or 52 multiplied by WIP holding period multiplied by DOC. If they don't give you DOC in the problem, for material we assume it to be 100%. For conversion cost we assume it to be 50%. No logic, just a convention. If they give it, take that. So that gives you your closing stock of WIP. Then debtors we find out as a cost sheet ka format. Not full-fledged format. This is. First we take annual raw material consumed. To that you add material cost. And then to add overhead cost. Adding all this you will get factory cost. From factory cost add opening stock of WIP, deduct closing stock of WIP. You will get cost of production. The cost of production add administrative expense and also add opening stock of finished goods. Reduce closing stock of finished goods. You will get COGS, cost of goods sold. Then add selling expense. You will get cost of sales. In fact, you will get annual cash cost of sale because we are considering total cost here, only cash cost. Cash cost meaning depreciation and all we are including in this statement or excluding? Excluding. So you will get annual cash cost of sale. We want annual cash cost of sale or annual cash cost of credit sale. First find out annual cash cost of credit sale. From annual cash cost of credit sale, find out the data. Okay, because annual cash cost of credit sale is for 12 months. Will we get 12 months credit from our credit period from our debtors? No. So that means what is the formula to get the debtors? annual cash cost of credit sale divided by 12, 365 or 52 multiplied by the credit period in days or weeks. Yes, people, that way you will get the debtor. Third one is the creditor. How do you get the creditor? For that we need raw material consumed or raw material purchased. Raw material purchase. From consumed, how do you find out annual raw material purchased? Take annual cost of raw material consumed. To that you add closing stock of raw material, deduct opening stock of raw material. You will get annual cost of raw material purchased. Right? From annual cost of raw material purchased, you can find out the creditors. How do you find out that? Annual cost of raw material purchased divided by 12, 365 or 52 multiplied by the credit period given to creditors. If you do, you got this. That's all is the format. Now, plainly, can we apply it in one question? Okay, 1 second. I'll show you the question. We'll take up question number 3. Okay, everyone, listen. On 1st January, the managing director of Naureen Limited wishes to know the amount of working capital that will be required during the year. From the following information, you need to prepare working capital requirement forecast, meaning we need to estimate the working capital. That's a simple requirement. Check. Production during the previous year was 60,000 units. It is planned that this level means 60,000 units would be maintained in current year also. Perfect. How many units are you producing in the current year? 60,000. Okay. The expected ratio of cost to selling prices, raw material is 60%. 60% of what? They said expected ratio of cost to selling price. That means they are saying 60% of selling price constitutes raw material. 10% of selling price constitutes direct wages. 20% of selling price constitutes overheads. And here they have given you selling price. Check somewhere we saw. Selling price is how much? 5. Okay, that means I can write over here. Selling price per unit is selling price per unit is 5. In this 5, what will be the raw material cost per unit? 5 ka 60%, which is 3. Then they said direct wages. Wages will be 5 ka 10%, which will be 0.5. And 5 ka 20% will be overhead, which is 1. Correct? A balance in this profit. If you add all this, you're getting 4.5. But selling price is 5. I mean 0.5 per unit is your profit. For our working capital estimate, is profit required? No. Because we usually prepare our working capital on what basis? Total cost basis or cash cost basis? Cash cost basis. So profit to depreciation and other non-cash expenditures are irrelevant. Okay, people? Done. We got this. Next, check. Raw material are expected to remain in store for an average of 2 months. I mean, this is what, sir? Raw material ka holding period. We need all this to estimate, correct? Raw material on an average we hold it for 2 months before we give it to production. Each unit is expected to be in process. In process means work in progress. For how many months? 1 month. That means WIP ka holding period is 1 month given. The raw material being fed into the pipeline immediately. That means indirectly telling whatever raw material we need, immediately we'll give it. That means indirectly they're telling what, sir? DOC of raw material is what? 100%. Because whatever raw material we need, it's fed into pipeline immediately. Meaning 100% DOC completion for material. Labor and overheads, which we usually call it as conversion cost, accrues evenly during the year. Fine. But have they given DOC? No. If they don't give DOC, what do we take it as? For conversion cost, the convention is we take the DOC to be 50%. Okay. Finished goods will stay in the warehouse before dispatch to the customer approximately how many months? 3 months. That means finished goods ka holding period is 3 months. We can use this data to find out closing stock of finished goods. I'll tell you. Credit allowed by the creditor is 2 months. Great. Towards raw material only, correct? Credit allowed to debtor is 3 months. Selling price is 5 per unit. Fair enough. Wages and overheads are paid on 1st of each month for the previous month. That means previous month ka wages we will pay that month only or next month. That means indirectly can I say 1 month wages and overhead is outstanding because this month ka salary you pay it in the next month. Correct? That means 1 month ka salary, not only salary, even your overheads, both are outstanding. Even outstanding expenses are current liability. So indirectly they're telling here 1 month ka wages and overheads on an average is outstanding. Comfortable now? You need to, and company normally keeps cash in hand to the extent of 20,000. Cash balance they only give. Rest of the current assets and current liability components we need to estimate. Can we do it? Same format, no change. Okay. It's not necessary we have to prepare in the same format, people. Alright. I have maintained the same format, but so that format gets registered in your mind. So we don't have to change. Okay. You can present the answer in any format that you're comfortable with. But I'll stick to the same. Okay, first working note. Tell me, sir, what will you put up? In fact, this we can discuss quickly. You will guide me on this. First working note 1 will be for WIP. In fact, WIP or closing stock of WIP. Closing stock of WIP. So WIP means what and all costs will be incurred. Raw material, labor and overheads. First we'll take up raw material. Okay, direct material. So how many units they said, sir, we'll produce? 60,000. We want what, sir? Visualize. We want annual raw material consumed. How many units have you produced? 60,000. So to produce raw material, we need to consume raw material. No, correct? But have they given the raw material cost per unit? No. So we can, in fact, we found out also. How much is that? 3 per unit, right? You can do it like this, or we can directly do like this also. How much is the annual raw material consumed? 60,000. Okay, what is the cost per unit? You have produced 60,000 units. What is the selling price of each unit? 5 rupees. But if you do 60,000 into 5, will you get material cost or will you get sale value? Sale value. What did they tell in the problem? 60% of it constitutes raw material. Either directly you can do 60,000 multiplied by 3. We got raw material cost to be 3 here, no? Directly you can do 60,000 minus 3 or into 3, or you can do 60,000 into 5 ka 60%. Your choice, the way of presentation. Done now? This is what, sir? This is what? Annual raw material consumed. This for annual means, and how have they given the data here? Days or months? Check. All the data is given in months. So we will present the data also in months. I mean, in the denominator will we take what? 12. So we have annual raw material consumed divided by 12. Multiplied by what do we need? WIP ka holding period. What is WIP ka holding period? They said each unit will be in process for how many months? 1 month. So WIP holding period is 1 month. Multiplied by DOC. What is DOC for material? 100%. So if you do that, you will get 15,000. Done now? This is the only thing, or we have more? More. What is that? This is material. Next is a labor. So how many units have you produced? 60,000 into 5. What is this 5 rupees? Selling price per unit. What percentage of selling price constitutes labor cost? They said 10%. That means into 10% I do. Or instead of 5 into 10%, you can directly multiply 0.5. Like that also you can do. 60,000 units, 60,000 into 0.5 if you do, you will get the total labor cost for the whole year. I mean, this is for how many months? 12 months. Multiplied by WIP holding period. What is WIP holding period? 1 month. Multiplied by DOC. What is DOC for conversion cost? 50%. Given? No. If they don't give, you assume it to be 50%. So multiply 50%, you will get 1 to 5. Similarly, for overheads, how many units did you produce in the current year? 60,000 into 5. But what is this 5? Selling price. What percentage of selling price is overhead cost? 20%. So multiply 20%. Or directly, instead of 5 into 20%, you can directly take 1. So if you do that, you will get total overhead cost for the whole year. Meaning this is for 12 months. But how much is in the process on an average? 1 month. So multiplied by WIP holding period, which is 1 month, multiplied by DOC. DOC is a degree of completion for this. How much is it? 50%. You get this number. Adding all this components, you'll get closing stock of WIP. How much is that? 18,750. One component done. Can we do the next working note? Any change between what we explained or ditto? Just we discussed in words. Now we are discussing in numbers. That's the only distinction. Yes. Okay. Next one is what, sir? Debtors. Debtor we use what format? We found out debtors from sales or cost of sale. To be more precise, we want cost of credit sale. Cash cost of credit sale is what we need. For this, we take the help of cost sheet format. First, we start with what? Material consumed. Now we already have. How many units did we produce? 60,000 multiplied by 5. But what is this 5? Selling price. What percentage of selling price constitutes material? 60%. So if you do this, you'll get annual material consumed. Alright. Next is your annual labor cost. How many units did you produce? 60,000 multiplied by 5. But 5 is your what? Selling price. What percentage constitutes labor cost? 10% of selling price. So multiply 10%. You will get total labor cost for the whole year to be 30,000. Multiplied by adding the overheads. How many units you produce? 60,000. Multiplied by 5. 5 is your selling price. What percentage of selling price constitutes overhead? 20%. So multiply, you will get the total overhead cost to be 60,000. By adding all this, what will we get? Factory cost. That is how much? 2,70,000. From factory cost, what do? Add opening stock of WIP and deduct closing stock of WIP. Now, 1 second, hang on. First, let's find out in fact, we have already found out the WIP. How much is the closing stock of WIP? 18,750. What about opening? Sir, simple. First of all, is this a new company? Is this a new company? Check anywhere. Have they told it's a new company? Sir, if it's a new company, why am I stressing on that? If it's a new company means, will new company or a new project have any opening stock or no opening stock? If it's a new project or a new company, they will not have opening stock of raw material, opening stock of WIP, and also opening stock of finished goods. Anywhere mentioned it is new company? No. That means will you have opening stock? Yes. But to find out opening stock data is related to current year or last year. That means we need last year for all this data. Correct? Now, how did you find out closing stock of WIP? By taking all this data. Correct? Do we know all this data for last year? No. That means one simple assumption is when they give you its existing company, opening stock and closing stock, we assume it to be same. Lack of data, what to do? Yes, hence opening stock and closing stock, we assume it to be same. If closing stock of WIP is 18,750, means opening stock also will be assumed to be same. Same number, 18,750. Got it up. That means one shortcut you can use in exam. What is that? In your cost sheet format, 18,750 you are adding, 18,750 you are reducing. Really required to be done, or you can cut off. Okay, that way the working notes becomes shorter and shorter and shorter. Fine. But since I am discussing the format, I will discuss the whole format with you. Fine. Then afterwards you can use the shortcut. So from factory cost, if you add this, what are you going to get? Cost of production. To this, what do we need to add? Administrative expense. Check. We read the question. Did we find any admin expense separately given? No. I mean, it is what, sir? 0. To this, what we have to do? Add opening stock of finished goods. Deduct closing stock of finished goods. 1 second, hang on. Finished goods means it is 100% complete. Yes, no? That means it is better linkable with cost of production. See, you have incurred cost of production of 2,70,000. Why? To produce finished goods only, you know. This 2,70,000 is a cost of produce. Cost to produce what? Finished goods. This 2,70,000 is a cost to produce 1 unit, or this is the cost of production for a whole year. 2,70,000 is a cost of production for whole year. Meaning 2,70,000 represents the cost of production for whole year, which is how many months? 12 months. Entire 12 months of goods, will you store it as finished goods? Because this 2,70,000 is the value of total closing stock for a whole year. Whole year ka stock are you maintaining? No. What did they say? Check the problem. Finished goods on an average will stay in the warehouse for how many months? 3 months. That means whole year ka stock you are maintaining, or only 3 months ka? This 2,70,000 is 12 months ka stock. How much for? 3 months ka stock. Prorated, how will you get X? 2,70,000 into 3 divided by 12. Tell me this in formula, let's see. Tell me this in formula, let's see. What is this 2,70,000? Annual cost of production divided by 12, 365 or 52. Here we have to using 12 multiplied by what? Finished goods ka holding period. Multiplied by finished goods ka holding period. That's what we have done over here. 2,70,000 is for whole year. For 3 months, how much? 67,500. Understood? This is what? Closing stock of finished goods. Able to understand, everybody? Yes. Sir, it's a new company or existing? Existing. That means will it have opening stock of finished goods? Yes. To find out opening stock of finished goods, we need cost of production of the last year. Given or missing? Missing. So what is a simple approach? Opening stock of finished goods and closing stock of finished goods, we assume it to be same. If this is 67,500, means this also will be how much? 67,500 only. Done now. Adding all this, what will we get? Cost of the goods sold. Check the question. Have they given any selling expense separately here? No. I mean, selling expense is how much? 0. By doing this, what will you get? Annual cost of sales. We don't need annual cost of sale. We need annual cost of credit sales. Check the question. Have they told anywhere cash sale represents 30%, credit sale represents blah, blah, blah? Any reference? No. No reference means what is our assumption? Annual cost of sale and annual cash cost of credit sale is same. Okay. Now, we got this. Correct, people? Now, using this, we will find out what? Debtors. How do you get debtors? Annual cash cost of credit sale, 2,70,000. It's for the whole year, meaning it's for how many months? 12 months. Will we give 12 months credit to our debtors? No. On an average, how much credit we give to our debtors? 3 months. So multiplied by 3. You will get the debtor value to be 67,500. Working note number 2 also over. Need a minute to observe? Or okay? Fine. Alright. Third one is what, sir? We'll find out what? We'll find out creditors. But to find creditors, we need material consumed or material purchased. Material purchased. But here, what do we have? Raw material consumed. From raw material consumed, can you find out raw material purchased? Yes. How do we find that? Just now we discussed. Take annual cost of raw material consumed. To that you add what? Closing stock of raw material and deduct opening stock of raw material. Now, do you know closing stock of raw material? No. Not given up? No. But at least do you know raw material holding period? Yeah, on an average, they told raw material will stay in the premises for how many months? 2 months. Okay. before it is issued to production. Now, 1 second. Raw material, what you will do? Raw material, what you will do? You will consume. How much is the annual raw material consumed? 1,80,000. This 1,80,000 is a raw material consumed for 1 day or whole year? Whole year, 12 months. That means this 1,80,000 is a total stock for how many months? 12 months. On an average, we maintain 12 months stock of closing stock of raw material? No. On an average, how much stock of raw material we maintain? 2 months. 1,80,000 is for 12 months, means for 2 months, how much? So how do you get X here? 1,80,000 into 2 divided by 12. Tell me this in formula, let's see. How do you get closing stock of raw material? Take annual raw material consumed divided by 12, 365 or 52 depending on data. Multiplied by what? Raw material holding period. That's what I've done over here. No need to put up separate working note. Here only you can calculate. This 1,80,000 is annual raw material consumed. Meaning it is for how many months? 12 months. On an average, how much stock of raw material you maintain? 2 months. So for 2 months, how much? If you calculate that, you will get 30,000. This is your closing stock of raw material. We need only closing stock or also opening stock? New company or existing company? Existing company, any data given about opening stock? No. So what do? Closing stock of raw material and opening stock of raw material, we assume it to be same. That means what? Raw material consumed and raw material purchased will be same. Because 30,000 you are adding, same 30,000 you are reducing. So annual purchase cost of raw material will be how much, sir? 1,80,000. Done now. This is the total purchase made for 1 day or whole year. Using this, can we find out creditor? Yes. How do we find out? Tell us. Take annual cost of annual purchase of raw material, which is how much? 1,80,000. This is for 1 day or whole year? Whole year. Meaning this is for how many months? 12 months. How many months credit will we get from our creditors? 2 months. For 2 months, how much? So you need to multiply that. So if you want to tell this in formula, it will be what? If you want to get creditors, you will take annual raw material purchased divided by 12, 365 or 52 multiplied by creditor stock credit period as given in the question. If you do that, you will get creditor stock value. Any problem? It will be lengthy, no doubt, but pretty straightforward. Yes or no, sir? Can I move on to the next? So almost everything we have done. Now we'll have to put up one statement. And what statement is that? Estimation of working capital. All current assets you put it in one side. Current liabilities you put it on the other side. Now first, do you know closing stock of raw material? Here only we found. How much is that? 30,000. That we have put over here. Then do you know closing stock of WIP? Yes, we got it from working note number 1. How much is that? 18,750. Do you know closing stock of finished goods? Yes, we got that from working note number 2. Check where is that? Closing stock of finished goods is 67,500. Then debtors we know. Yes, that also we got it from working note number 2. How much is that? 67,500. Is there any prepaid expense given? Some problem they will give. Here we have prepaid expense or outstanding expense. Outstanding expense. Then cash balance we have to find, or they only gave in the question. They only gave. So adding all this, what will we get? Total current asset. I'm denoting that in the symbol A. Now take all what's current liability. First current liability we already worked out. That is creditor. How much is creditor average balance? 30,000. This is this. Done. Then you have any outstanding expense? Yes. They said what in the question? Wages and overheads are paid on first of each month for the previous month. So on an average, how much is the outstanding wages? 1 month. How much is outstanding overheads? 1 month itself. So can we calculate? Okay. Now no need to read the question. What is this? What is this? This 1,80,000 is a total raw material consumed for the whole year. Yes, that means that for the whole year the value is 1,80,000. Whole year expense, are you keeping it outstanding or only 1 month? 1 month. So that means this 1,80,000 is for whole year. That is, this is for 12 months. How much for 1 month? Prorate. How do you get that? 1,80,000 into 1 by 12. Yes, sir. Where is that? I took material. Sorry, my bad, people. I took water. I think I took the value not as this one. I took it as raw material consumed. How much is what was outstanding? Wages. So how much is labor cost rather, or wages cost? 30,000. This 30,000 is for how many days? This is labor cost for the whole year, meaning this 30,000 is for 12 months. Entire 12 months of our wages are outstanding, or only 1 month? For 1 month, how much is outstanding? So how will you get that? 30,000 into 1 divided by 12. Correct. So that's what I've done over here. You'll get how much, sir? 2,500. In a similar way, you also have to find out what's the overheads. What is the total overhead cost? 60,000. 60,000 is for 1 day or whole year? Meaning 60,000 is for 12 months. How much is outstanding, or how many months overhead cost is outstanding? Only 1 month. So multiply, you will get 5,000. This is your current liability. Adding all this, you will get current liability. Current asset minus current liability, if you do, you will get 166, 250. In some problems, sir, they will say add safety margin because these are all pakka numbers or estimates. Estimates. Are you pakka? Are you sure that all your estimates are 100% right, or it may go here and there? So some problems where they say add a 10% safety margin, 15% provision for contingencies and all, they will tell in the question. If they say, suppose if they say add safety margin or provision for contingencies 10%, what do? You have found out this number, no? To this number, how much is that safety margin? 10%. So multiply 10% to that number. If you add it, how much are you going to get? 16,625. Now add this, then you will get your net working capital. But in this problem, is there any safety margin provision for contingencies given or not given? Not given means this is zero. Some problem they will give it. If they give it, take it. This will be directly given to you in the question. If it is not given, no need to worry. And this finally is your net working capital. This wala problem. So far okay. Can we take up one more question to revise this quickly? I think we have some time. It's okay. Can we try? Or this is good? One more you want to try? Whatever you say, sir. Okay. 1 minute. Let me find that question. We'll take up this question number 23. Okay, sir, you can ask the working capital estimate problem in one more way. Check this. Anija Limited is a newly formed company. Wait. Why? Sir, if it's a newly formed company or if it's a new project means, will they have any opening stock? No. No opening stock of finished goods. No opening stock of WIP. No opening stock of raw material. Nothing will come. Done. But closing stock, will it come? Yes. Okay, keep that in mind. So they have approached some banks, so they need some projections. Projection means we need to estimate working capital. Check this. Estimated level of activity is 1,04,000 completed units. 1,04,000 completed units plus 4,000 units of WIP. In the last problem, they gave 60,000. That means in that 60,000, some part was WIP, some was finished goods. Breakup that not given and we don't need it. But here clearly is given 1,04,000 units are finished goods, 4,000 units are WIP. Like this also they can structure the question and ask. In this case, what to do, we'll see. Based on the above activity, estimated cost per unit is given as follows. Raw material will cost 80 per unit. In the last problem, raw material cost was not directly given. We had to find. Here given 80 per unit. Wages cost is 30 per unit. Overhead cost check exclusive of depreciation. That means including, excluding. Excluding. Should it be included? No. Is it included? No. So any adjustment to be done or no adjustment? Suppose they told it is inclusive of depreciation and depreciation is 10 per unit. What you would have done? Suppose if they told this overhead is inclusive of depreciation of 10 per unit. What you would have done? Will you take 60? No, the 60 includes 10 rupees depreciation means you will take value as how much, sir? 50 per unit. But in this problem, is it inclusive or exclusive only? Exclusive. So any adjustment required or nothing? Nothing. So if you add all this, you will get 170. Selling price is 200. That means indirectly profit is 30 per unit. Is profit relevant for us? No. Leave it. Raw material on an average will stay or you will hold how much, sir? 4 weeks. Here last problem data given in months. Here given in weeks. Work in progress ka where is that? Where is? Okay, work in progress. Assume 50% completion stage in respect of conversion cost. So they have only given conversion cost for DOC is 50%. Material is issued at the start of processing. That means whatever material you need initially only you will give it off. That means material ka DOC is what, sir? 100%. Same like last question. So they have not given raw material ka WIP. We'll see. But they have given the units only. No. If they directly give the units, why do we need the holding period? We already know how much is the WIP ka closing stock on an average. How much is that? 4,000. In the last problem, we didn't know how much WIP ka closing stock in units. So we had to work it out using holding period. Here they have given directly units, closing stock of WIP ka units. How much is that? 4,000. Directly we will take that. That's the reason they are not given average holding period of WIP. Not required. Okay. Finished goods in stock is how much, sir? 8,000 units. On average. Totally how much have you produced finished goods? 1,04,000. On that, closing stock of finished goods is how much? 8,000 units. The rest of the units are sold off. That's okay. Credit allowed by supplier, as in creditor is how many weeks? 4 weeks. To our debtor, we are giving how many weeks credit? 8 weeks. Lag means Outstanding lag means delay. Okay, either they can call it as outstanding, they can call it as a delay, or they can call it as outstanding, whatever. So outstanding in wages is on an average 1.5 weeks. 1.5 weeks of wages payment on an average will be outstanding. Fine. Cash balance, they only given it to be 25,000. Nothing else they have given. They are only take 52 weeks in a year. You need to find out net working capital. Same drama. Will you guide again? What is first working note? WIP. In this problem, is WIP ka holding period required or they gave off units? They only directly give you. How many? What is the WIP ka units? We have a closing stock of WIP of 4,000 units. Now WIP mein what and all cost will come? Will you incur material cost? Yes. Will you incur labor cost? Yes. Overhead cost? Yes. But material will incur full. Problem is same. DOC is 100%. But conversion cost ka DOC is only 50%. Can we calculate? How many units of WIP? 4,000. What is the material cost per unit they gave? 80. 4,000 units of closing stock of we have multiplied by 80 into DOC percentage, which is how much? 100%. Which is how much? 3,20,000. Any problem? Yes, people? Okay. So we are not taking, again, we are not taking here WIP ka holding period. Why? Because we directly have WIP ka units. So units multiplied by unit cost, if you do, you'll automatically get what? Closing stock of WIP ka value. Similarly, how many units of closing stock of WIP we have? 4,000. What is the wages cost? 30. So if you do 4,000 into 30, it will be full. Full labor cost have you incurred, or they said only 50%? For conversion cost, they told that it is 50% complete. If it is 50% complete, means we have incurred labor cost only to the extent of 50%. Multiplied by 50%, you will get labor cost associated with WIP of 60,000. Similarly, overhead, how much WIP units we have? 4,000. What is the overhead cost per unit? 60. 60 is for 100%. Is 100% complete for conversion or only 50%? So multiply 50%. So you will get overhead cost of 1,20,000. Adding all this, what will you get? Will you get total WIP or closing stock of WIP? Closing stock of WIP, how much? 5 lakh rupees. One working note done. Can we get to the other one? What is working note number 2? Guide me. Working note number 2 is to find out debtors. On what approach are we solving this? Total cost basis or cash cost? If you take total cost, you will find debtors using sales. If you take total cost or total value, you will find debtors using sales. Such kind of problem also we have done in regular class, just saying. But if the question is silent, always work out working capital on a cash cost basis. Because working capital means, or operating cycle means what? For how many days my funds are getting blocked? Funds get blocked to the extent of profit or to the extent of cost? To the extent of cost. So the better approach is cash cost approach. If question is silent, I always suggest use a cash cost approach. So again, same format ka run through. First you will take what's raw material consume, but now be careful. You have 1,04,000 units of finished goods and you have 4,000 units of WIP. That means what, sir? 1,04,000 units of finished goods you have produced. On this, how much is the material cost? 80 per unit. Correct now? Now this is the material cost only for what? Finished goods. You have purchased material only for finished goods or also for WIP? Also for WIP. That you don't have to work. Here you already know. How much is the material cost for WIP? 3,20,000. Add it from the previous working note only. You can recalculate or you can directly take it from the previous working note. Manageable. So total material consumed is how much? 86,40,000. Getting the difference between last problem and this? When they give you the breakup, you need to consider for finished goods also, we need to consider for WIP also. In the last problem, we didn't do this. Why? Because they gave WIP ka unit separately, finished goods ka unit separately, or they gave it together. When they give it together, you don't have to do the split up. You can calculate in one go. But when they give separately, you also need to calculate separately. Then how many units of finished goods produced? 1,04,000. What is the wages cost per unit? 30 per unit. This is only for what? Finished goods. How much is the WIP ka material cost? Labor cost? 60,000 units. That we have to calculate or already done? Already done. Add it, you will get how much? 31,80,000. Then overheads. How much is finished goods produced? 1,04,000. How much is the overhead cost per unit? 60. So this is for what? Relating only to the production. Plus relating to WIP how much? 1,20,000. Add it. You will get how much? 63 lakh. 60,000. Adding all this, what will you get? Factory cost. Done now. So this is what you have to do. Opening stock of WIP and closing stock of WIP minus. Opening stock bindas I will write 0. Why? Newly company or newly formed the company. Even if sometimes they will say existing company, but they will say new project. If you are taking a new project will have opening stock. Okay, it's a new project or a new company will not have any opening stock. In this case, it is not a new project, but rather it is a new company, but impact is the same. So how much is the opening stock of WIP? 0. Closing stock of WIP, we got it already how much? 5 lakh. By doing this, what will we get? Cost of production. How much is that? 1 crore 76 lakh 80,000. To this, we have to add administrative expense. Any admin expense given? No. That means this is 0. Then take what? Opening stock of finished goods. That is any which way what? 0. From that deduct what? Closing stock of finished goods. Now we can calculate. Now, have they given closing finished goods ka holding period? No. But it's okay. They have given units. Check. You know the closing stock of finished goods? How much is that? 8,000. Simple. Sir, you will incur cost of production for what? Finished goods. Yes, now to finish the product only, for finished goods only, you will incur the cost of production. Now this 1 crore 76 lakh 80,000 is the cost to produce how many units? 1 unit. Totally how many units did you produce in the current year? 1 lakh 4,000. So it's like telling like this. 1 crore, how much is that? 1 crore 76 lakh 80,000 is the cost to produce 1 lakh 4,000 units. 1 lakh 4,000 units produced finished goods. Are you holding it as closing stock? No. On average, how much finished goods ka closing stock we have, sir? 8,000. So if this is the cost for 1 lakh 4,000 units, means for 8,000 units, how much is the cost? If you prorate, what are you going to get? When you cross multiply, what will be the answer? That's what I've written over here. 1 crore 76 lakh 80,000 is for 1 lakh 4,000 units. For 8,000 units, how much is it? 13 lakh 60,000. Got it off. If you don't want to do like this, there is another way. How many units have you produced? 8,000. How much is the total cost per unit? How much is the total cost per unit they've only given? 170. 8,000 into 170 you do 13 lakh 60,000. Like this also you can arrive. I didn't want to change the format because previously we did like this now. So I'm keeping the same format. So basically it is one way to find out closing stock is through holding period. Another way to find out the closing stock is through units. Some problem is directly they'll give units. Some problem is they will give holding period. So just check whatever data is given. Based on that, you need to figure out your approach. Manageable. Everybody good? Okay, if you do this, what are you going to get? Cost of goods sold. Selling expense, we read the problem, it is not there. So by doing this, what will we get? Annual cost of sale. But we need annual cost of sale. We want annual cash cost of credit sale. Again, we read the problem. Is there any cash sale, credit sale reference? No. That means assumption is what? Total sales and credit sales are same. And now we will use this data to find what? Debtors. Tell me, how will you find out this? What's the formula? Annual cash cost of credit sale divided by 12. How have they given the credit period for debtors? In weeks. That means, tell me, sir, how will you calculate this? 1 crore 63 lakh 20,000 is for what? It's for whole year, meaning it's for 52 weeks. Do you give 52 weeks credit to your debtors? No. On an average, how much credit you give to creditors? 8 weeks. For 52 weeks, if this is the value, means for 8 weeks, what is the value? Prorate, how do you get? Or what is the formula? Annual cash cost of credit sale divided by 52 multiplied by the credit period given to debtors, which is 8. If you work out, you will get 25 lakh 10,769. This is your debtors ka balance. Done. Next, okay, working note number 3 is to find out what? Creditors. How will you find out creditors? For that, we need annual raw material purchased, but they have given annual raw material consumed. How much is annual raw material consumed? 86 lakh 40,000. From this, how do you find out annual raw material purchased? Take raw material consumed, add closing stock of raw material, deduct opening stock of raw material. Opening stock of raw material, bindas I will write 0. New company. How about closing stock of raw material? Do you have units? Do you have units or they have given weeks? Check. They have given raw material, they have given in units or weeks. I mean, this they have given in units of holding period. I mean, here we need to find out the data using holding period. It could be a combination. They can give holding period or they can give units. Your choice. Now again, this raw material consumed. What is this raw material consumed? Annual cost of raw material consumed. Meaning 86 lakh 40,000 is for 1 day or it's for whole year? Whole year, how many weeks? 52 weeks. 52 weeks ka closing stock of raw material you maintain or only 4? As per the problem, they told on an average we maintain raw material stock only for 4 weeks. So 86 lakh 40,000 is for 52 weeks. How much for 4 weeks? If you do that, you will get this particular number. Done now. By doing this plus minus, you will get annual raw material purchased. How much is that? 93 lakh 4,615. This is what again? This 9304 is what? Annual purchase of raw material. That means this 93 lakh is for 1 week, 1 day, or whole year. This 93 lakh 4,650, 615 is for whole year, and here data is given in weeks. Will we get a credit of whole year from our creditors, or how many weeks? The credit given by our supplier is only for 4 weeks. So take this number, divide by 52, multiply by 4. If you do, you'll get the creditor ka value. Any doubt in this, anybody? Now, take all this data and dump it into estimation of working capital wala problem. But we are preparing this on what basis? Cash cost basis. Closing stock of raw material, work in progress, and finished goods, we got it from the respective working note. Debtor also we got it from respective working note. Cash balance was given. Adding all this, you'll get total current asset. Creditor also directly we got. Only one thing we need to find out is what, sir? Some outstanding was there. No? What is our outstanding? Lag in payment of wages. Meaning we have some outstanding wages. Again, should we have to look at the question, or we have data? We have data. How much is the total wages? Check your working note. All the total is there over there. What is the total labor cost? 31 lakh 80,000. This is for 1 day or whole year? 31 lakh 80,000 is for whole year. Meaning it is for 52 weeks. 52 week ka wages is outstanding, or how many weeks ka? 1.5. So multiplied by 1.5, you will get outstanding wages as 91,731. Done now. So you have your current assets, you have your current liability. Current asset minus current liability will give you working capital. But do keep in mind the safety margins. Again, given or missing? Missing. If it is there, means add. Okay, that they will give it to you in the problem. 5%, 10%, whatever, it will be given to you in the mention, or it will be mentioned in the problem clearly. Not mentioned means take it as 0, and this becomes your net working capital ka final value. So another type of question we have finished. Important one. This is usually comes for 8 to 10 mark. Great. Comfortable. Same format. I think in your study material you have around 6 to 8 questions. I have taken some 2-3 extra question in regular class as well. So if you have time, try to solve all the remaining questions in study material also in the same format. Don't worry about the presentation. ICAI will present each question in one way. You use the same presentation and present, you should be able to get the answer. Done, Asaru? Okay, now I'll come back to the chart. We'll take up what? We'll finish this and I'll give you a break. Would that be okay with you? I'll take another 1 hour maybe. Manageable? Roughly. I'm not sure. Maybe a little early also. Okay, Jay. Okay, next type of problem is the cash management. Next type of problem is the cash management. So the usual type of question that comes here is cash budgeting. They'll ask you to prepare a cash budget. Budget means you're forecasting. You're estimating what is going to be your future inflows and future outflows. You can prepare budgets in multiple ways. One we call it as receipts and payment method. Another one balance sheet method. Another one P&L method. Meaning in adjusted income method from P&L we prepare cash budget. Using P&L we prepare cash budget. It's like your cash flow statement. In your BCom or advanced accounting we have studied a cash flow statement. Yes, sir. Or you have not taken group on it all. No problem. Okay, so it's basically using profit we try to get cash budget. In fact, we did that in previous DECA session, NPV. From profit only we got what? Cash flow, no? The same fund over here. We use profit and we get cash wala data. That is your adjusted income method. Another one is adjusted balance sheet. You know, cash balance comes also in balance sheet. Cash also comes in balance sheet. This adjusted balance sheet method says prepare balance sheet, okay, and get cash as a balancing figure. All other components of balance sheet you estimate, like share capital or debt or liability, fixed asset, debtors, everything you find out and get cash as a balancing figure. That is your adjusted balance sheet method. These are not relevant to us. For our examination, they will ask us to prepare cash budget using receipts and payment method. How this works, we will see. It's a very straightforward question. They will ask you to prepare cash budget for a certain duration, maybe 3 months, maybe 6 months, 4 months, or whatever. For that to 4 months, we have to consider all the receipts, we have to consider all the payments and get the closing balance of cash. That's all it is. Okay, just some data will be given to you. Using that, we have to find out cash receipt and cash Payment. Can we look at one problem just to see, understand this better? Come back to a minute, I'll tell you where that problem is. Here, this one. So let's go over this question to understand this. Following information relates to Zeta Limited, a publishing company. Fair enough. Selling price of the book is how much? 50. That is the selling price. Sales are made on credit. That's fine. Variable cost of production per book is, material cost is how much? 5 rupees. Labor cost is 4 rupees. Overhead is 12. Maybe if you add all this, you'll get 11 rupees. Selling price is 15. Maybe 4 rupees is profit. That's okay. Sales manager has forecasted the following volumes. So sales manager, will he give you production volume or sales volume? Sales volume. That means all these are what, sir? Sales, but not in value, but in units. Sales manager is saying from November up till August, these many units we are expected to sell. Forecast means actual number or estimated number. So we are estimating that all these books we may sell in those respective months. Okay, let's see. Customers are expected to pay. Sir, budget means data has already happened or we are projecting future number? Projecting future. So we always take expected number and prepare the budget, because budget is not for current period. Budget is always for the future. Okay. So that's the reason everywhere you will use the word expected, 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 because all these are projections. Things that are about to happen in future, we are projecting now only. Like after examination, after 1 month you will clear examination, I am forecasting. No. All of you will clear your CA inter exam. No, that is fine. We are budgeting now, but the actual result will come later. Okay, Paka, you have confidence you will clear. No. All of you are writing both the groups or one group? One group. Why? Why not both? You are writing both. You have already cleared one group. So only one is pending. So why should we write both, sir? We have already cleared one. They are telling. Makes sense, macha. Okay, fair enough. Okay, and what is the date of examination? I forgot that. 17th of January to 1 day leave, no, still the same format. No, or any paper they gave extra days this time? Nothing like that. Only normal, 1 day is enough, no. Yeah, good enough, I think. And 17th is what? Group 1 ka starting or group 2? Group 2 ka starting. Group 1 is starting on 11th. Okay, and all of you are Paka writing group 2. Correct, no? You are writing both the groups. Okay, what's your name, macha? Our Rishi is going to get a rank this time. Yes, no, macha? Yeah, Paka. Alright. Exam is on his birthday. That means biggest birthday gift is going to give himself is a ranker. No pressure, just saying. Okay. All right. So keep always the confidence high. For a second also, do not say I will not clear. Till you write to the examination, the confidence, the willpower should be such that I have already cleared. Degree, no. ICAI is printing. Your CA intermediate ka marks card, no. CA Institute is printing in there, one shop. That shop ka machinery, no. It is in the under repairs and maintenance. It will get repaired after 2 months. So you will get your CA inter ka marks card after 2 months. But you have already cleared the CA inter examination. Some formality. I say asking you to on one particular day, they are asking you to come to examination hall and put autograph for 3 hours. Some ABCD, some numbers they're asking you to fill, that's all. Formality. But you have already cleared the paper. Have that kind of confidence. Okay? Always it should be like this. I always say this is the difference between a CA and an MBA. CAs are more knowledgeable, but MBAs get a better position and a better package compared to CA. Why? I have nothing against MBA. I have deep respect for them because they put on a lot of efforts to get into those B schools. It's not a joke at all. They're talking about 99 percentiles. They're not talking about 60% here. We're talking about 99 percentile. Sometimes 98.5 will not cut it for your IAMs and all. Okay. So deep respect for them, but doesn't mean that we are no less. We also put in equal efforts. No Deepavali. Okay. No Ramzan. No Eid. No Christmas. So everything gone in exam only. Correct. No. So I mean, so much of sacrifice we also give. From morning to evening. From morning you attend law class. Now you are attending FM class. I mean, it's 12 hours class. So any MBA student will sit. But a CA student will sit. Correct? Or no? Because for them it is college. For us it is our career. For them, their career starts the moment they get into college. I mean, for them that 2 years of MBA is just probably what? Just a learning exercise along with some fun activities. But for us, This is our life. If you don't clear, nobody will give us our certificate and our whole life is on the line. So who's more serious about it in these now? Us. I mean, should we get lesser package or no? But reason why do they get? Confidence. Confidence. They have a lot higher confidence level, command over language, networking skills. These are the three skills where an MBA will has a definite advantage over CA. That is what your generation should change. Communication. Communication means, it doesn't mean Shashi Tharoor language. Easy, simple language minimum we require. Our Britishers ruined our country for many years. Still, we need to learn English because that's the communication language of the world now. So that's something which we need to have a basic communication skill there. Focus on that if you are lacking. Second one is confidence. Now, if I say, did you clear your examination? Full bindas without even taking a minute, you should say, yes, I've cleared or I will clear. I have put in efforts, I will pakka clear. From my LKG first standard till my CA intermediate, I have not failed any examination. So I will not change the trend at all. I will clear CA. That's the kind of confidence you should have. Doesn't matter what happens, okay? That confidence should always be on the higher side. The moment you carry off all this, then you will get the same package, the same respect, the same position as MBA commands. We will start moving. Right now, CAs are getting compliance roles. We are not getting. In fact, even if you ask also, in fact, many CEOs were asked this question. Why CAs are getting paid less? Why MBAs are getting paid more? You know what their definition was? CA is a cost center for me. MBA is a profit center for me. Meaning, if I hire an MBA, he'll get me more sales. He'll get me more sales. I give him the strategy role. But for a CA, I give compliance role. Auditing, tax compliance. So the notion is, I don't want to get tax burden, so I am hiring a CA to make sure that my books are correct. So they are only doing the checking. CAs are not giving me extra revenue, so I will not give you extra cost or extra package. That perception you should change, okay, by having a higher level of confidence and good networking skills. Among your fraternity, let there be a connection. Don't lose out the touch with all your colleagues and all. Keep this in mind. Aram se, things you can progress higher. So just by scoring examination, your life will end. In fact, your life will start. So all these are also required for you to progress in your career. Now, can we progress in this sum? I think we forgot about that altogether. I forgot this is a marathon session. People are scolding, hey, do that time of work. Okay. So they've given some data. We need to prepare a budget. Great. Customers are expected to pay on what basis? 1 month after sale, 40%. 2 months after sale, 60%. Meaning if you sell today, customer will not pay immediately. He'll pay after 1 month. That to full amount or only 40%? Only 40%. 2 months after sale, how much will he pay? 60%. That means he is going to pay us in how many installments? 2 installments. Keep that in mind. Once we'll read off the whole thing. Or maybe I'll finish off this data. Would you be fine with this? So, first, we have to prepare cash budget. Check, sir. We have to prepare cash budget for how many months? 6 months. From what to what? Jan to June. That means from January to June, we need to find out what and all receipts, what and all payments. Meaning what and all inflows, what and all outflows. Now, if you have sold the goods means, will you have to pay or you will receive? Receive. From whom? Debtors, customers. That is what our first working notice. Collections from debtors or money received from debtors. Now, I have taken from November. Why? Because they have given the data from November. But in reality, I need from November or only from January to June. Only from January to June. Since they started the data from November, I also have started from November. So, from November to August, all these units we have copied one by one here. Okay, in fact, why to copy the units? Sir, this is what? This is what? Number of units sold. What is the selling price per unit? Somewhere we saw, no? Selling price per unit is how much? Somewhere, selling price per book is how much? 50. So 1000 units you are selling and price of one book is how much? 15. What is the sale value? 1 or 2 will compute. 1000 into 15 is how much? 15,000. So for the month of November, sale value is 15,000. Correct? Similarly, December, how many units? 1000. What is the selling price per book? 15. So that means this is also how much? 15,000. Next month also 15,000. February, how many units sold? 1250. What is the selling price? 15. 1250 into 15 you do. How much you going to get? 18 something. Like this, you'll have to fill out the other columns. Got it up? Fine. This is what? This is what? Sales value. If you have sold goods worth 15,000 in November, will you receive the money in November only? No. Our customers will pay in 2 installments. first installment will come when? 1 month after sale. That means if you sell in November means 40% of this amount the customer will pay next month. Correct? Now, so calculate 15,000 ka 40%. How much is that? 6,000 rupees. So 6,000 rupees he will pay when? November. Next 60% he will pay in January. So 15,000 ka 60%, how much? 9,000. This how the payment is going to be received. We made a sale of 15,000 in November, 6,000 we received in December, 9,000 we received in January. Like that is the pattern that we have to keep following. Can we do it one more? December mein how much did you sell? 15,000. When will you receive the money? 40% you will receive the next month. So 15,000 ka 40% how much? 6,000. Correct? Huh? That you will receive in January. Balance you will receive in February. Balance is how much? 60%. 15,000 ka 60% is how much? 9,000. That you received in January. Similarly, I'll maybe take this. 18,750 you sold in February. What will you do? Or what will you recover? 40% of 18,750. How much is that? Calculate. 7,500 you will receive in March. The balance 60% you will recover in April. How much is that? 18,750 ka 60% how much? 11,250. Like that you have to calculate for everything. Got the pattern? I'm just quickly revising. Okay, no? Now you are collecting the money in 1 stages or 2 stages. And we need to prepare budget from what month to what month? January to June. So January may totally how much did you collect? 15,000. Like this January to June, what and all you collected, go on adding. Other months I don't need it, so I put it as dash. Amount is there, but do I need it for my budget? No. So hence I have kept it as blank. I need only from January to June. That much only a freedom. So this is what? Payment or receipt? Receipt. Correct everybody? Okay, we'll have to capture this, or maybe I'll show this. Cash budget we have to prepare from January to June. Normal, sir, you are preparing a simple cash account. Instead of preparing cash account as a ledger, we are preparing as a statement. First, you will start with what? Opening balance, which they will give it to you later. We'll see. Now, add from opening balance, add all the receipts, deduct all the payments, and you will get what? Closing balance. First receipt we already got for January. How much is that, sir? 15,000. February also how much? 15,000. March 16,500. That data receipt from debtors I am updating here from the working note number 1 that we just now prepared. Got it up. This is the receipt from debtors. Can I move on to the other data? Okay. Next, let's go for this. Be careful in this. Company produces books 2 months before they are sold. So, be careful. Company produces books 2 months before they are sold. That means here, January May if you have to sell means, January May if you have to sell 1,000 units means, January May you will produce the books or 2 months before? January May if you have to sell means in November only you should produce how much? 1,000. February May if you have to sell 1,250 means when, which month you have to produce this? December only you should produce 1,250. March May if you have to sell 1,500 means 2 months before only. That is January only you should produce how much? 1,500. Why am I writing this? Because cost, material cost, labor cost and all you will incur on the goods sold or goods produced? Goods produced. That's the reason this data. Got it up? Everybody? So that's what is the next. Check this. Okay, the company produces books 2 months before they are sold, and creditors for materials are paid 2 months after production. So in the month of production, are you settling the creditors or 2 months later? 2 months later. We talk about this, or maybe we'll finish off this. First, payment to creditors. We'll prepare a working note. First, again, I'll start the data from November to June. Why? Because they have given the data in that fashion. So I'll start from November to June. Can you tell me November mein how many books did you produce? Don't say this 1,000. November May you did not produce this 1,000. What is November ka production? January May if you have to sell means in November May you should produce 1,000. That means you have to start copying the data from what to what? From here to here. Don't blindly copy the data because this is a sales. You will produce the goods 2 months before they are sold. Correct? Now that means you have to copy the data from 1,000 till here. Correct, sir? So check, have I done that? 1,250. Then what is the number? 1,500. Next number is what? 2,000. In that order, may I have copied. This is not units sold. This is what? Units produced. Comfortable? Because you will incur material cost, labor cost, overhead cost on the goods produced, not on the goods sold. Done? Yes. Now, what is the material cost per unit? Have they given? Yeah. Material cost is how much per unit? 5,000. So 5 per unit. 1,000 is the books and material cost per book is how much? 5. So go on multiplying 5 for this number, you will get 1000 into 5 is how much? 5000. 1250 into 5 is how much? 625. Like that, go on finding. Done now. This is what? This is what? Material cost. Are you settling material cost immediately? No. What did they tell in the question? Read the data again. Creditor for material are paid 2 months after production. So for producing, you have incurred 5000 material cost in November. November only you will settle or 2 months later? November ka creditor ka settlement will happen in January, 2 months later. December ka creditor settlement will happen 2 months later, that is February. And January ka settlement will happen in March. Like that, go on doing the settlement. Done now. And what is this? This is receipt, this is payment. This is payment. Okay. So what is the cash budget format? Opening balance and all the receipts. Deduct all the payments. Did we get the payment to creditor? No. Yes. And we need it only from January to June. So hence I've restricted there. This data should come under which section? Payment section. Check, have I copied that? This is your payments. Payment to creditor from working note number 2. January, how much did we pay? 5000. February, 6250. Like that, I've copied from here to there, giving the working note reference. Any difficulty? These are very lengthy questions, but they are easy. The crux is to solve the question within time. 10 marker question means 20 minutes you have to solve all this. That is the crux. That will come only with the practice. Okay, but pretty straightforward and easy questions. Okay, now let's see the other one. Variable overheads are paid in the month following production. Meaning this month, if you're producing, means settlement will happen this month or next month. For what? Variable overheads. What is variable overhead cost? 2 rupees. So they have said overhead, they have not given breakup. That means 2 rupees. I'll assume it as what? Variable overhead. Okay. And variable overhead you will incur on the goods sold or goods produced? Goods produced. Every month ka goods produced have you already ascertained? Yeah. This is what, sir? Units produced. No. Same data I will copy for variable overheads also. Correct? No. Yes, people. Confusion or okay? Okay. So what is the variable overhead cost per unit? 2 rupees per unit. But have they given any extra information? Check. Variable overheads are paid in the month following production and are expected to increase by 25% in April. Okay, that means up to March, it is 2 rupees. From April onwards, will it be 2 rupees or it will increase? It will increase by how much? 25%. That means this will become 2.5. Up to March, it is 2 rupees. Beyond that, it will become 2.5. Correct? So that's what I've written over here. Up to March, 2 per unit. From April onwards, it will increase by 25% and become 2.5. So from here to March, you will multiply by how much? These are all units produced. You will multiply by what? 2. 1000 into 2 is how much? 2000. 1250 into 2 is 2500. But from April onwards, you will multiply what? 2.5. So 1900 into 2.5 will give you 3800. 2200. In fact, up to March, from April onwards, we should multiply. Correct? From 2200 into 2.5, you do. How much you going to get? 5500. Correct? From April onwards, multiply 2.5 because up to March it is 2 only. Correct? Yes. This is your what? Variable overhead cost. Are you settling the cost in the same month or next month? What did the question say? Say variable overheads are paid in the month following production. This month, if you incur variable cost, you will settle it in the next month. So 2000 November cost, you will settle in December. But is my budget starts from December or January? That means I need the data only from January to June. So December ka cost of 2500, you will settle it in January. January ka cost, you will settle it in February. February ka cost in March. That means all these are receipt or payment, sir? Payment. So all this payment is from January to June. This is the payment related to what? Overheads. I've copied from the previous working note. Done now. Next, what are they saying next? They said one more. What is that? 75% of the wages are paid in the month of production. Whatever cost, labor cost you incur, 75% of that you incur in that month only. 25% you will settle it in which month? Following month. So that means this is settled in 2 installment. 75 that month only, 25% next month. A wage increase of 12.5% will take place on 1st March. That means up to February, wages cost will be how much? For up to February, wages cost will be, how much was that number? Wages cost or labor cost will be 4. From March onwards, will it be 4? No, it will increase by 12.5%. Do it. 4 plus 12.5% is how much? 4.5. From March onwards, for per unit, it will become 4.5. Anyway, all this cost also you will incur on the goods sold or goods produced? Goods produced. Do you know goods produced ka data? Yeah, here it is there. Copy the same data of units produced for labor also. Now, labor cost per unit. Up to February, how much is per unit? 4 per unit. From March onwards, it will become 4.5. So, up to which February? From here to here, you multiply what per unit? 4. So, 1000 into 4 will give you 4000. 1250 into 4 will give you 5000. But from March onwards, you will multiply what? 4.5. 1900 into 4.5 is how much? 8550. 2200 into 4.5 will give you 8000, 9009. All these are what? Labor cost. Labor cost. We are not preparing P&L. We are preparing cash budget. That means we want labor cost or labor cost paid. Paid. And how is the settlement happening? 75% that month. Balance 25% next month. So that means of 4,000, if you incur in November 4,000, 75% you will pay that month only. So 4,000 ka 75% is how much? 3,000. That you will pay that month only. 4,000 ka 25% is how much? 1,000. That you will pay next month, that is December. Done. Similarly, December ka what is the cost? 5,000. 5,000 ka 75% how much? 3750. That you will pay in December only. And 5,000 ka 25% how much? 1250. That you will pay in January. Similarly, January ka cost is 6,000. How much will you pay that month? 75%. 6,000 ka 75% how much? 4,500. Balance 1,500 next month. Okay. And I need this value for whole year or only from January to June. Hence, other columns have, though I can find the total, I've kept it blank because for my budget purpose, I need only from Jan to June. So this is my Jan to June ka labor receipt ka payment. So this is your labor payment, which we have got it from previous working. Balance receipts and payments, they'll give it to you in the question. Can we update that? Okay, check the question. What else is there? Company is going through restructuring and it will sell one property in May for how much? 25,000. Sir, when you sell an asset, it's going to be a payment or a receipt? Every month receipt or only in May? Only in May, 25,000 receipt we need to put. This is your May and this is your freehold property ka sale as coming as a receipt. Done, Asaru? Okay, next. Depreciation. The moment they say depreciation, I'll not even bother reading it. They can give 101 data. I'll ignore. Why? Depreciation is a non-cash expenditure and I am preparing P&L or I am preparing budget. Cash budget. So is there any cash inflow or outflow due to depreciation? No. Consider or ignore. Ignore. They can give whatever data. I'll not even bother reading it. Okay. What was it, ma? One more line is saying, okay. It was planning to buy a printing press in May for 10,000. So in the month of May, again, if you're buying an asset means it will be a receipt of payment. In the month of May, there is another payment for asset purchase of how much? 10,000 rupees. Captured. Done now. Alright, next what is there, sir? Company's tax of 10,000 is due for payment in March. So in the month of March, it is expected that we will pay tax of how much? 10,000. March month is this and it's a payment of 10,000 towards tax. Next, company has a cash balance on 31st December 20x3. Hang on. You need to prepare cash budget of 6 months from what date? From January 20x4. You need to start your budget from 1st January 20x4 and end it on 30th June 20x4. But they have given 31st December 20x3 ka cash balance. Why have they given this? This 31st December is a closing balance of last year, which becomes current year ka opening balance. We start with what? Opening balance. No, opening balance of cash is given to be how much, sir? 1,500. So take opening balance, add all the receipt, deduct all the payments, you'll get what, sir? Closing balance. That's all. Done now. Any problem? No. Easy. That's all is budget all about. Done. Now, sir, one more way budget may they can ask this question. One more ways in some problem may they will say maintain minimum cash balance. Maintain minimum cash balance. Let's maybe for 1 month I will show you how this minimum cash balance works. Okay. Some problems may they will say let's assume that this particular question may they say minimum cash balance you need to maintain as 2,000. Minimum cash balance you need to maintain how much? Or you have to maintain a cash balance of 2,000. You have to maintain a cash balance of 2,000. Take your calculator, all of you. How much is opening balance? Padafat. 1,500. How much is the receipt? 15,000. So only for January we will do. 1,500 plus 15,000 you do. How much is it? 16,500. Did you make any payment? Yeah. All this payment. When you make the payment, cash balance will reduce. So reduce all this three. Reduce all this three. How much you're showing? You have 3250, 3250, correct? But question is saying what we have assumed? We have to maintain a cash balance of 2000. We have how much? 3250. We have 3250, but we need to maintain only 2000 as per the requirement of the question. So that means minus 2000 euro. 1250 extra cash we have. If you have extra cash, we will invest. If you have extra cash, we will invest. So in this problem, we took opening balance, we added all the receipt, we deducted all the payment. We are getting 3250, but we need only 2000. How much extra we have? 1250. That 1250 we will purchase the investment. When you purchase an investment, cash balance will reduce. So if you reduce 1250, that means when you purchase an investment, it's a receipt or a payment. It's when you purchase an investment, cash will go out. So it becomes a payment. So that means what you have to do? The sign should be positive or negative? Negative. Then you will get the closing balance to be 2000. There's another kind of problem they may ask you. Done now, people? Any problem? No? Okay. Sir, next month, if you have shortage, what you will do? Suppose 1 minute. Next month also minimum how much cash balance you need to maintain. February also minimum you need to maintain 2000. Available, let's say, is only 1800. Assumption. Available is only how much? 1800. Assumed. Required is how much? 2000. That means now we have extra, we have shortage. How much shortage? 200. When you have shortage, in the last month you purchased an investment. Now in this month, what you will do? Sell the investment. How much shortage is there? 200. For that shortage amount, you sell the investment. Now, sir, when you have surplus, when you have extra, invest the money, meaning purchase the investment. When you have shortage, sell the investment. This is one kind of problem they can give. Okay, sir. Sir, first month only we got shortage. First month only we got shortage. In that case, you will do the borrowings. Okay. Next month, when you get surplus, you will repay the borrowings. One of the scenario can come. Either investment purchased, investment sold. Or borrowings taken, borrowing repaid. Both the combinations they will not give. Either it will be investment purchased and investment selling or combo, or borrowings taken, borrowings repaid or combo. That also can be inserted in the same question. This question usually they will not insert because this question has already become lengthy. They will reduce the number of adjustments and ask this type of question. That is one more way they can ask the budget. Everyone understood this? Comfortable? Okay, you will do all this investment borrowing only when what? When the question says maintain a minimum balance or maintain a certain closing balance. Otherwise not required to be done. Okay, this is about budget. 2-3 minutes. We have few more cash components. We will quickly run through that. Here. Now, sir. Now our few models are there. Few Mahanubhavas, few of our great scientists or whatever you can call them. They have done some thesis and they have given some outcomes. One is William Baumol-Sir model, and then we have Miller-Orr model. What is Baumol-Sir is trying to say is, now I ask you a simple question: how much cash balance should company maintain? What will you tell? How much cash? Or I'll ask you, you are our students, no? How much cash balance Arivupro should maintain? He's like, hey, whatever you want to maintain. Now you're asking us so. Now, as a finance manager, you tell me how much cash balance will you maintain? You don't have a straightforward answer, right? Baumol sir is trying to find a straightforward answer for that through a formula. Did you understand? So Baumol sir said, I have done some analysis. I will tell you how much cash balance organization should maintain. Because if you maintain too high cash, suppose Arivupro we maintain 1 crore rupees cash in our bank. Good decision or horrible decision? Sir, if you have 1 crore cash, we can open a new branch, or at least we can buy some shares or some debentures and earn extra return. No. Will anybody keep 1 crore cash idle? Or will you keep 1 crore rupees in your bank account for 3%, 4% return? Is it a good decision or bad decision? Bad decision. That means maintaining high levels of cash is wrong. Suppose I maintain only 1000 rupees cash. That is good or bad? So maintaining high level is also bad. Maintaining low level is also bad. So what level should be maintained? That is what Baumol sir is trying to answer. You know what Baumol sir said? You have studied this. You studied EOQ, economic order quantity, in your inventory management. How do you get EOQ? Square root of T, square root of 2 AOC, A for annual demand, O for ordering cost, and C for carrying cost. Same funda here. Instead of AOC, here it is UPS. What is it? UPS. So square root of 2 multiplied by U multiplied by P divided by S. So what is U? There it was annual demand. Here it is annual disbursement. Okay. There it was ordering cost. P here is your transaction cost. S is for opportunity cost. All this data will be given to you in the question. You just need to plug in. Okay. U for what? Annual cash disbursement. P for transaction cost. So what is this transaction cost? So if I have extra cash, what will you do? You will invest. Now when I invest, let's say I buy some company ka debenture or share. I need to buy with the help of broker. Broker will charge some commission. Correct? That commission is your P. P is your transaction cost. To buy or to make an investment, you'll incur some cost. That is what's a P. Done. Now, if you don't invest, if I don't invest, that means will I get that investment return or I will have to sacrifice? That is your S. S is your opportunity cost in terms of percentage. And they will give it to you in the problem. 7%, 10%, 12%, whatever. That's what. If you do square root of 2 UPS, you will get the number. That number, Bomal sir is saying that much cash you need to maintain. Understood? 2 marker MCQ question. If at all they want to ask, they can ask. Done, Azaru. Next is Miller R model or Miller O model, whatever you want to call it. Miller sir said, what nonsense, this bar model will not work. Why? Sir, every organization, can they maintain a same balance? Like if Arivupro maintains 10,000, Reliance also will maintain 10,000. Now the scale is completely different. They are a lot bigger organization. They need a lot higher amount. So maintaining one common balance for every organization through a formula is wrong, because cash needs also will be same every month, or it will change. Change. See, our examination month is there. In examination month, maybe we conducted a lot of classes. That means we have to incur a lot of payment. See, normal class may we incur electricity bill for 5 hours. We use the classroom for 5 hours. But in examination time, we use morning also, we use evening also. That means all this cost will be same or high. High. That means during examination season, we need to maintain high cash because the payment also will be more. So all this factor Bomal sir considers or ignored? Ignored. That's the reason Miller sir said, I will give you another creative model. Miller sir said, I will tell you 3 points. Upper limit, lower limit, return point. Upper limit, lower limit, return point. Upper limit is denoted by the symbol. You know water chemical formula? H2O. Here it is HZO. HZO. It's actually not O, it is actually 0, but remember it as O. It's okay. HZO. H for higher limit, Z for return point, 0 for lower limit. Denoted by symbol just in case they ask us an MCQ. What Miller sir is saying is, every organization has to find their own limits, 3 limits, upper, lower and return. Let's say for one organization, upper limit is 50,000, lower limit is 10,000. Okay, return point is how much? 30,000. What Miller sir is saying is, the moment upper limit is maximum amount of cash a company can hold. Maximum amount of cash company can hold. The moment the cash balance reaches 50,000, that means you are holding highest cash. Holding too much cash is good or bad? Bad. So the moment you reach upper limit, you purchase of investment, because you are holding too much cash. You are losing a return. You purchase of investment. That means from 50,000, again your cash balance will come to how much point? 30,000. Because when you purchase investment, cash balance will reduce. The moment you hit upper limit, you purchase the investment to get the cash back to which limit? Lower limit. The moment cash balance becomes lower limit value, the moment the cash balance reaches lower limit ka balance, then you are holding very high cash or very low cash, but you have some investment. Sell off that investment. When you sell the investment, you will get money. So that you will sell that much investment to get the cash balance to what point? Return. Ideally, you can play within the range. As long as your cash is between this range, you can do whatever you want. But this range should not be crossed. That is what Miller sir is trying to say. And this range, who has to define? Organization. Again, all these are important for exam, may not be. But remember the symbol, they may ask exactly, or they may ask explain Miller model as a 2 marker, or they may ask you the symbols as an MCQ question according to me. Practical problem are difficult to answer. Done, done, or done? Everybody. Cool, cool, cool. Okay. One more question is there on cash management. We will run through that. I'll tell you the question once again. Hang on. Where is that? This one. Sir, following information is with respect to Sai Trading Company. On an average, debtors collected after 45 days. That means the debtors collection period is how much, sir? 45 days. Inventory ka holding period is 75. Creditors ka payment period is 30 days. The moment you see all this, what you can calculate? Operating cycle. Firm spends 120 lakh annually at a constant rate. It earns 10% on its investment. From the above information, you are required to calculate cash cycle, not operating cycle. What cycle? One and the same. One and the same, because operating cycle means what, sir? The days, if operating cycle is 90, what does it mean? The cash is getting blocked for 90 days. You can call it as operating cycle, or you can call it as what? Cash cycle. How do you calculate operating cycle? Or how do you calculate, for that matter, cash cycle? R plus W plus F plus D minus C. But R and W they have not given. Probably, and in fact, it will not be there also. Why? Only manufacturers will have raw material and work in progress. Will traders, what will they do, sir? They will buy finished goods and they will sell finished goods. Will traders have a raw material work in progress? No. That means for traders, raw material and work in progress is zero. In fact, should we have to bring this or cut off? Cut off also you can. What is finished goods ka inventory holding period? 75 days. Debtors ka collection period? 45. Creditor ka 30. Plug into formula, you will get cash cycle to be. Don't call it an operating cycle, call it as cash cycle. Done. No. If this is 90 days, what is the indication? If you invest cash today, you will recover that cash after 90 days. Meaning for 90 days, your funds are getting blocked. And to run one cycle, how many days you need? 90 days. So how many cycles can you run in a year? Here they are asking you to assume 360 days in a year. Okay. To run one cycle, we need 90 days. So in a year, how many cycles can you run? That is given by what formula? Number of days in a year divided by cash cycle. That will give you 4 times. Correct? There we used to call it as number of operating cycles in a year. Here is given as a fancy name as cash turnover. Cash turnover means how many cycles can you run in a year? How much is that? Done. Now can you find out next requirement is how much minimum amount of cash to be maintained. Minimum amount of cash to be maintained is like working capital. Using this data, did you find out working capital previously? Yes. How did you find that? Annual operating cost divided by number of operating cycles in a year. Here construct the formula for me. Let's see. Annual operating cost 120 divided by number of cash cycles. That only we call it as cash turnover. So 120 lakhs is your total operating cycle for a whole year. And in a year, how many cycles can you run? 4. To run 4 cycles, we have to incur a cost of 120 lakh. For one cycle, how much is the amount? 30. This is the minimum cash you need to maintain. That's one. Okay, people. This is the first requirement. Savings, next requirement they're asking, savings by reducing the inventory holding period by 30 days. Currently, how much is inventory holding period? 75. From 75, if you reduce it by 30 days, you will reduce by 30 days. So what will be the revised inventory holding period? It will be 75 minus 30 and it will become 45. Now calculate what will be the cash cycle. This will be 45. Debtors collection period is still 45. Creditors payment period is still 30. Cash cycle will become 60. Cash turnover will become 360 divided by 60. So how many cycles can you run in a year? 6 cycles you can run in a year. Call it as cash turnover. How much cash balance you need to maintain? Total annual operating cost for the whole year is how much? 120. 120 is for the whole year. Whole year, how many cycles can you run? 6 cycles. So for one cycle, how much you need to maintain? 20. Earlier, how much money you had to maintain? How much cash you had to maintain? 30. Now you have to maintain only how much cash? 20 lakh. How much cash balance got released? 10 lakhs. Yes, so you can call this only as savings. But have they given the return on investment? Yeah. How much is that? 10%. Now, how much cash you don't need? 10 lakh. Will anybody keep idle cash or they will invest? By investing, what will you get? Return. How much can you invest? 10 lakh. How much return will you get? So what is the return in amount? That only you call it as savings. If return percentage is given, then you solve this and call 1 lakh as saving. If return percentage is not given, call this 10 lakh itself as savings. Check the data and accordingly solve. There is another cash budgeted or cash related question that can come. Done, people? Okay. Now this problem also done. Next, we have two questions, two types of questions. This chapter is over. It will take another half an hour, maybe. Two problems if you do, that's good enough. Half an hour. Is it okay? We'll finish off and then take a break, one shot. Comfortable, everybody? Manageable? No? This is important. Both the things we are about to do is important. Okay. Actually, one more is there, maybe short one. I'll maybe finish off that. So before I forget, maybe. So next one is creditors management. So far, if you see, we have estimated working capital. We have done cash management. Now we are looking at creditor management. There is also debtor management. That topic we'll finish this and then take up that. In creditor management, no, sir, they'll ask you one type of problem. 2-marker question usually. What they will ask is, they will give you this data. They will give you this data. Like here, they will say 5/15 net of 45 days. They will give you the data like this. What this means is, when they give you any data like this, what it means is this 5 stands for discount percentage. This 5 stands for number of days within which you need to pay to get the discount. Meaning, or maybe I'll read off the whole data. Net of 45 days means credit period is 45 days. Creditor is giving us a credit period of 45 days. Creditor is also giving us one extra option. Creditor is telling us, I will give you 5% discount if you pay me within 15 days. If we pay the creditor within 15 days, we will get a discount of 5%. Otherwise, compulsorily, we have to settle within 45 days. Instead of telling all that in sentence, they will represent like this. That's what this means. Understood? Pakka, everyone? So if I cross check once again, if they give, let's say 2/10 net 50 days, you tell me what it means, what this 2 means. This 2 means discount percentage. Creditor will give us a discount of 2% if paid within 10 days. Otherwise, we have to settle within 50 days. Okay, done? Now, what you as a finance manager should decide is, should we accept this discount option? Should we accept this discount option or should we reject? That's all. It's a simple problem. Done now. This, sir, for this we have to find out something called, this is a benefit for us, right? So we have to find out this benefit not in amount but in percentage. And we have to find this on an annual basis. Annual benefit percentage you have to find out. That is given by the formula D divided by 100 minus D into 365 divided by T into 100. So how? This D divided by 100 minus D into 365 divided by T into 100. We want it in percentage, hence we last may be multiplied by 100. This D is for discount amount. This D is for discount amount. T for the payment or early payment days or prepayment days. Within how many days you need to pay to get the discount. Here, how many days within which you need to pay? 15 days. This 15 becomes your T. Correct? Okay, not necessarily. That varies actually problem to problem, but anyways, no problem. We'll see that. Okay, so far. So T is basically in how many days you need to settle the amount to get the discount. Early payment days. You can call it like this. Fine, I'll take up one question and I'll tell you what is this formula all about. Actually, it's a fancy formula, but it's a simple logic. Anyways, one quick question we will take. I'll find you that question. Hang on. I think question number 35 something, I think. Question number 34. This was, I think, given RTP May 2018 wala question this is. So let's see. A Limited is in the manufacturing business. It acquires raw material from X. That means we have to pay X Limited because they are our creditors. As per the terms of the agreement, payment must be made within 40 days because 40 days is the credit period. However, A Limited has a choice of paying 98.5 per 100. If you have to pay the creditor 100 rupees, creditor is saying don't pay 100, macha give me only 98.5. That means how much is the discount? 1.5. Correct? Or 1.5% can I call it in a way? 100 ka 1.5% is how much? 1.5. It owes it to X Limited on or before the 10th day of purchase. So that means if we want to get the discount from creditor, we have to settle the amount within how many days? 10 days. If you don't want a discount, you have to settle within 40 days. Comfortable? Okay. This now they are saying examine whether the company Some noise came up. Yeah, back up. Okay, I think everything is good. Yeah, still running. Okay. Whether A Limited should accept this discount offer or not. Assume billing is 10 lakh and alternative investment will yield a return of 15%. This 15% is on an annum only. Okay. Now simple. Forget about what they have given. We know the formula. Annual benefit discount percentage is, our annual benefit percentage is given by what formula? D divided by 100 minus D into 365 divided by T into 100. You can take D or any random amount, or you can take the actual answer will not change. Like here, actual invoice value is how much? 10 lakh. Right? But we can also take this. If we have to pay the creditor 100, will we pay 100 or only 98.5? I mean, how much is the discount we are getting? 1.5. You can take total and work out, or any random number you take and work out, also answer will be same. Maybe I'll show you both. How much is D here in first case? 1.5. Okay. Divided by 100 minus D. 100 minus 1.5 is how much? 98.5. Into 365 divided by T. T means what, sir? How many days early you need to pay to get the discount? Check. Sir, normally you pay within how many days? 40 days. But to get the discount, you need to pay within 10 days. So how many days early you need to pay? 30 days. Okay. Normally we pay. You don't take directly 10. No. Normally you are expected to pay within 40 days. But to get the discount, you need to pay within 10 days. So how many days early you need to pay to get this discount offer? 30 days early payment you need to make compared to the total credit period. Correct? So this 30 days becomes what? Your peak. Yes. So do that. You'll get how much, sir? 18.52%. Done now. Any problem? Any problem, anyone, or got it? Now, will we go for a discount? Will we go for discount? Very much yes. Why? Sir, our annual discount benefit percentage is how much? The benefit we are getting on a yearly basis 18%. Sir, suppose I have money. I have money with me. I have two options. Either pay the creditor and get discount benefit, or I can invest this extra money and get investment return. I have two options. Yes, I can use my surplus money to pay the creditor and get discount benefit, or invest money and get return. My discount benefit on an annual basis is how much? 18.52%. If I invest the money, I'll only get how much return? 15%. That side return is only, that side benefit is only 15. But creditors ka benefit is 18. You choose lower benefit or higher benefit. That means what is the decision? Annual discount benefit percentage is greater than the return on investment. So what you should do? Discount offer can be X. Done now. Everybody got it? If you do want this per unit basis, you can work out on total basis also. Alright. Sir, for 100 rupees, if you have to pay the creditor, means will you pay 100 or 98.5? 98.5. But actually you have to pay the creditor 100 or 10 lakh? 10 lakh. For 10 lakh, you have to, if you have to pay, means how much actually you will pay? Calculate X. 10 lakh into 98.5 divided by 100 euro. You will get 9 lakh 85,000. 9 lakh 85,000. That means instead of paying 10 lakh, we will pay the creditor only 9 lakh 85,000. That means what is the total discount we got? 10 lakh minus 9 lakh 85,000, which is how much, sir? 15,000. Yes, take this number and work out if you want. How do you get, what is the formula? D divided by 100 minus D. What is D here? 15,000. Divided by 100. Here you can't take 100, you are taking total. Look, that 100 is for percentage. Instead of 100, you have to take the total amount. What is the total amount you have to pay? 10 lakh. 10 lakh minus 15,000 is how much? 9 lakh 85,000. Into 365 divided by T into 100. You work out, you will get the same answer. That will not change. But I suggest do this only. It's okay. Easy to work out. Comfortable now because this is expressed on a 100 unit basis. This formula. Then what is this formula if you ask me? It's very simple. Sir, how do you get GP percentage? GP divided by sales into 100. GP is a benefit, correct? Same way, even discount is also a benefit. How much discount are you getting? Instead of 100 rupees, you are paying only 98.5. How much discount you are getting? 1.5. How much payment you are making? 98.5. So you are getting a benefit of 1.5 and how much payment you are making? 98.5. Tell me how much is this benefit? If you want this benefit in percentage, how much is this? Tell me. 1.5. I think I've already done this. Okay, no issues. 1.5 divided by 98.5 into 100. How much is that? Tell me in decimal. It's okay. 1.52. 1.52%. Correct. Now, this 1.52 is the benefit percentage for whole year or for making early payment? This benefit I will get if I make an early payment. Early payment of how much? 30 days. But my investment return is for 30 days or whole year? Whole year. Sir, this benefit is only for 30 days. Can I compare this benefit with investment benefit? Are they on the same platform? No. This benefit is for 30 days. Investment return is for the whole year. To compare, both of them have to be on the same platform. So this benefit of 30 days, I'm converting it into whole year. So 1.52% is a benefit for 30 days. How much for whole year? Calculate 1.52 into 365 divided by 30. You do. How much you're going to get? 18.5. That is what this formula is trying to calculate. You don't need the logic, but just that's what it means. Okay. Actually, you are getting the benefit for 30 days. But for comparison purpose, we need a benefit not for 30 days. We want it for whole year. So, but in examination, don't present all this. Present simply in formula. What is that formula? D divided by 100 minus D into 365 divided by T into 100. By doing that, you will get what, sir? Annual discount benefit percentage. Compare this with investment return. If benefit percentage is greater than investment return, means accept. Otherwise, reject. Got it? This is one kind of problem that comes from creditors management. That's it. Can we move on to the next? Next one is debtors management. Next one is debtors management. Now in debtors management, so there are only two types of problems. We have almost like 10 to 12 questions, probably more than 12 questions. But categories are only two types of questions. One is, I'll give you a little background first and start. Currently, let's say to my debtor, I am giving 30 days credit. Currently, to my debtor, I am giving how many days credit? 30 days credit. Now, I as a finance manager, I am thinking to increase this credit period to 50 days. Because the more credit you give, the more sales we will be able to make. Because everybody wants to make the payment sooner or later. So by giving more credit, we will be able to sell the goods more. And if we have more sales, we will get more profit. Now, this is my existing policy. What is my existing policy ka credit period? 30 days. I am proposing what? 50 days credit. Now, this is what they will say. This is what they will give you in the problem. You need to tell whether should we continue with existing policy or should we go for new policy. That's all. This is one type of problem. Is existing policy good or new policy is good? You may have one new policy or they may give you 4 new policies also. That doesn't matter. If they give you 4 policies, means it's like working five times the same component. Okay. Fair enough. That they will, anyway, question to question, it will vary. But understanding, did you get it? So basically, we want to change our credit period. Usually, the change will be on the higher side. Sometimes they may also give you the lower side. Meaning instead of 50, from 30, we can also make it as 10. Problems are rare, but usually the problems are based on the increase in the credit period. All we need to suggest is, should we as a finance manager increase the credit period or not? Done now. This is one kind of question. Can we take it up? For this also, I have made one format. All the 5 or 6 questions that we have in study material will fit into that format only with slight changes here and there. One problem, I'll take you through the format. Can we? Yes. Okay. I don't know where is that. Hang on, give me a minute. I'll find it. Maybe it's there earlier once. This one, sir. It is question number 14 in our class notes. Similar question is also available in study material also, or same question is available in study material as well as one of the, I think, May 24 RTP or MTP also. Similar question had come. Let's understand what we discussed with the help of this question. A company is having currently credit sale of 12 lakh. Existing credit terms are 1/10 net 45. I think you're comfortable with this now. So here This, it's not from creditor. This we are giving to debtors. So 1 bar 10 net 45. What does this mean? We will give 1% discount to our debtor if he pays us within 10 days. Otherwise, he or she has to settle us within, or the company has to settle within 45 days. Currently, the average collection period is 30 days. Current bad debts is how much? 1.5%. In order to accelerate the collection process further and also to increase sale, company is contemplating. Contemplating means thinking, not yet implementing. They are thinking. Liberalization of their existing credit terms to 2/10. Instead of 1% discount, company wants to give 2% discount if paid within 10 days, but net of 45 days. Overall credit is 45 days only. It is expected that the sales are likely to increase by 1/3 of the existing sale. Currently, how much is the sales, sir? 12 lakh. 12 lakh ka 1/3 you do? 4 lakh. That means under our current policy, sales is 12 lakh. But if you go with new policy, will the sales be 12 lakh or it will increase by 4 lakh? They only said, no, it will increase by 1/3. 1/3 of existing, if you calculate, you will get 4 lakh. That means from 12, it will increase by 4 and it will become 16 lakh. Bad debts will increase to 2%. Currently, how much is bad debts? 1.5%. From 1.5, it will become 2. Average collection period will fall to 20 days. From 30, average collection will become 20 days. Contribution to sales ratio is 22%. Now, contribution, if it is 22% of sales, means, can I say variable cost is 78%? Because we know this, no, sales minus variable cost is contribution. If sales is always 100%, if contribution is 22%, means variable cost will be what? 100 minus 22%, which will be 78. Comfortable? We need this data, so I'm putting it up there. Opportunity cost of investment in receivable is 15%, but they are given on what basis? Pre-tax. We already discussed. Opportunity cost, you will take it on pre-tax basis or post-tax? Post-tax. They are given what basis? Pre-tax. And you know this already. If you have pre-tax number, if you want post-tax number, what will you do? Multiply 1 minus tax rate. Do you know tax rate? Yes, tax rate is 30%. You tell me now, let's see, what is opportunity cost post-tax? 15 into 1 minus tax rate. That's what I've done over here. So how much is opportunity cost ka rate on a post-tax basis? 10.5%. Easy. Yes, sir, we have done all this. Yeah, okay. 50% and 80% of the customers in terms of sales revenue are expected to avail cash discount under existing scheme and the liberalization. Liberalization scheme means the new scheme. Should the company change its credit terms, assume 360 days in a year. We currently have a policy of providing 1% discount, a net of 45 days. From 1% discount, we are proposing to give a 2% discount. That means we are giving more benefit to our debtors, no? Should we go ahead with this new policy or not is a question. Simple funda. Let's say my old scheme, no, used to give me a benefit of, let's say 1 lakh. My new scheme is giving me a benefit of 1.5 lakh. You tell me which one will you go for, old or new? Obviously, you'll select what? New. On what basis? Obviously, new one is giving me a higher benefit. That is what we have to do in this problems. Calculate old scheme ka benefit. Calculate new scheme ka benefit. If new scheme ka benefit is more than old scheme ka benefit, go ahead with the new scheme. Otherwise, reject. Can we do it? How do you get benefit? Same drama, but slightly different presentation, because here we have some opportunity cost. The format is this. Every problem, same format. Whatever problem we have in this, every question will kind of fit into this format. We want benefit. They have given directly benefit, or they have given from sales. Sales. Just check the screen, everybody. Currently we have how much credit, sir? What is our average collection period? 30 days. And if you go for new scheme, the collection period will become how much? 20 days. That I have written over here. Sales. Under our current policy, what is the sales? Sales is 12 lakhs. Under new policy, will the sales be 12 lakh or it will increase by 1/3? It will increase by 1/3. 12 lakh or 1/3 is how much? 4 lakh. 4 lakh is not new sales. 4 lakh is the increase amount. So from 12 lakh, it will increase by 4 lakh and it will become how much? 16 lakh. First, we start with this. Point number 1, sales. Then we take variable cost and we take fixed cost. Fixed cost in majority of the question will not be given. Some problems they will give. after sales. Don't change the format. You can present this in multiple ways, but this is easy to remember and easy to proceed with all the question. First, you will take fixed cost, then or rather you will take the variable cost and then the fixed cost. Okay. In this problem, do we have variable cost? Yes. If contribution is 22% of sales, variable cost will become how much? 78% of sales. Find out variable cost. That is nothing but 78% of sales. 12 lakh ka 78%. How much? 9 lakh 36,000. 16 lakh ka 78%. How much? 12 lakh 48,000. Done now. Next, we have to consider fixed cost. Some problem they will give, some they will not give. Here we read the question. Did we find any fixed cost? No. So take it as what, sir? 0. Now, is this the only cost or we have more? We have bad debts also, we have discount also. Leave that out. Find out total cost excluding bad debts. Total cost now, excluding bad debt. Matlab these two ka addition. Add these two. How much you going to get? Same 936. These two ka addition. How much? Same 1248. Why? I will tell you. The format. Okay. Total cost excluding bad debts. Add these two. Done, people. Next, consider the next cost. What is the next cost? This is total cost excluding bad debts. And also, if you want, you can write excluding bad debts and discount. Usually discount will not come in every problem. Anyways, bad debts we have. Yes, under exist. I'll tell you why. For now, just go with the flow. Bad debts is how much rate, sir? 1.5% of what? Sales. 12 lakh ka 1.5% is how much? 18,000. 16 lakh ka, what is the new scheme ka bad debts they told? Under new scheme, bad debts will become 2%. So new scheme ka sale is 16 lakh. 16 lakh ka 2% is how much? 32,000. This is your bad debts. Don't directly deduct. Number them. Then we will tell you why. Then do we have any other cost? Yes, we have one more cost called discount. Correct. No. What did they say? Check here. 50% and 80% of customers in terms of sales revenue are expected to avail cash discount under existing scheme and new scheme. First, we'll work out existing scheme. Under existing scheme, will every debtor go for discount or only 50%? 50%. Sir, check. Under existing scheme, what is my sales? 12 lakh. 100% of my debtor will go for discount or only 50%? Only 50%. Yes, sir. I mean, 12 lakh ka 50% is how much? 6 lakh. 6 lakh is a sale value. Full sales you will give discount. Now, how much is the discount you are giving under existing scheme? Into 1%. Do this. How much is it? 6,000. So 6,000 is the discount under old scheme. Comfortable? Any problem? I've done it as a separate working note over here, but I think we can do it straightforwardly here. Yes, no? Yes, people. Okay. Under new scheme, what is my total sales? 16 lakh. Under new scheme, only 50% of debtors will go for discount or 80% they said? 80% of my debtors will go for discount. And how much discount? If you do this, you will get what, sir? 16 lakh ka 80% is how much? 12 lakh 80,000. That is the sale value. We want sale value or we want discount? How much is the discount percentage in new scheme? 2%. You do this. 25,000 is the discount under new scheme. Correct? Yes, people. Okay. Find out profit before tax for me now. How do you get profit before tax? From sales, you reduce total cost excluding bad debts. Okay. Minus bad debts you do, minus discount you do. Take your calculator, everybody. Take sales. I've already added variable cost and fixed cost. So that only I'm calling it as what? Total cost excluding bad debts. So take this 12 lakh, reduce 9 lakh 36,000, reduce bad debt 18,000, reduce discount of 6,000. How much are you getting? 2 lakh 40,000. That's what I've written here. Comfortable, everybody? Yes. This is what? Profit before tax. I've given the representation for this. Check. 7 is equal to what? 7 is equal to 1 minus 4 minus 5 minus 6. How much is, I'll tell you why am I doing all this. In fact, we could have done it straightforward only, right? Why did I find this? I know there is a question mark there. Let it be. So far, good. 2,40,000 is profit before tax. Do we have any tax in this problem? Yes. How much is the tax rate? 30%. So reduce the tax. After profit after tax, you will get 1,68,000. Stop there. Till here, every number looks good. All okay. Now, listen. If you have forgotten or if you have not attended the class or if you have not done this kind of problem, is there any opportunity cost here? We already did this in investment decision topic. Opportunity cost should be ignored or for decision making, or we should consider. We should consider, right? Here we have any opportunity cost per return? Yes. They gave pre-tax opportunity cost. We already found post-tax. How much is post-tax? 10.5%. What is this opportunity cost over here? Listen. Under current scheme, I sell my goods to my debtor today means debtor will pay me today or after 30 days. If I sell the goods today to my debtor today, he will pay me after 30 days. That means for 30 days my funds are getting blocked. If debtor had paid me today, I could have used that money and I would have invested and I would have got some return. Now am I getting that return or I have a sacrifice? That only we call it as what? Opportunity cost. Got it now? If I had not given 30 days credit, my debtor would have paid me the amount today. I could have used that money and I could have at least invested somewhere and I would have got a return of 10.5%. Now am I getting that return? No. Why? Because my debtor is paying today or after 30 days. That means I'm losing 30 days ka return. I'm losing 30 days ka return. That we need to calculate. Understood? Now, excuse me, my funds are getting blocked. My funds are getting blocked. My funds are getting blocked to the extent of bad debts and discount or to the extent of cost. See, bad debts will come when? After I sell the goods. Did I invest in bad debts? Did I invest in bad debts? Did I invest in discount? No. I invested in what? Goods. That goods only we incur variable cost and fixed cost. That means opportunity cost should not be calculated on every cost. It should be calculated on this. You will calculate the opportunity cost. Just like debtor estimate you did previously. You found out debtors using what? Sale value or cost of sale. Cost of sale. Here also, how much fund is getting blocked for you? 9,36,000 because that is what you invested. Bad debt will come after you sell. Bad debts will come after you sell. Did I invest in bad debts? No. That means my funds are getting blocked only to the extent of cost. And what is cost over here? Is discount my cost? No. Discount will come after sale. Right? Discount will come only after I purchase the goods. No. Because discount will come when I want to sell the goods. But before selling the goods, first I need to purchase. I mean, my funds are getting blocked to what extent? Cost extent. That is the reason here, no, in between this bad debts and discount, I asked you to put one more column called total cost excluding bad debts. Meaning you will calculate opportunity cost on this. By doing this, I can calculate opportunity cost here only. Otherwise, you need to put a separate working note. Got it on? Everybody listen. How much my funds are getting blocked? 9,36,000. What is the return I am sacrificing? Post-tax return is how much? Take your calculator. 9,36,000 is my funds getting blocked. How much return I am losing? 10.5%. Sir, 10.5% is for whole year. My whole year, my funds are getting blocked in current scheme or only 30 days. I mean, what I have to do? This 10.5% is for whole year. For 30 days, how much? 30 divided by 360 or 365. They asked us to take 360 days in a year, given in the question. So, into 30 divided by 360. Do this. How much is that? 8190. That is your opportunity cost. Got it, people? Oh, why did we take after tax? This is what, sir? This is profit after tax. So, even opportunity cost has to be on a after tax basis. Done now. No. This opportunity cost is an inflow or an outflow for me. One return I am not getting. Meaning one income I am not getting means it's an inflow or outflow. I mean, this is the benefit or cost. So my profit is 1,68,000. From that, what I have to do? I have to subtract 8190. Then I will get net benefit. Correct? That's what I've written here. Net benefit as 9 minus 10. Are you able to see this? So these two come minus you. What is my net benefit? Under my existing scheme, my net benefit is 1,59,810. Comfortable. Similar way, we also need to find out net benefit for new scheme. Only one extra fitting. Can we do it once again? Okay, listen everyone. Those of you who are still having some confusion. What is my total cost excluding bad debts in my new scheme? 12,48,000. That 12,48,000 I am getting now or I am getting later. How many days later? 20 days later. That means 12,48,000 is getting blocked for how many days? 20 days. If I had got this 12,48,000 today, I could have invested this 12,48,000 for 20 days and got some return. Now I'm getting that return or sacrifice. That was only what years? Opportunity cost. Now tell me opportunity cost ka formula if you want. Total cost excluding bad debts multiplied by rate divided by 100 into credit period divided by 365 or the 360 or 12 or 52 depending on how they have given credit period. Here credit period is given in days. That's what I've written formula here. Check. Opportunity cost is given by the formula total cost of credit sale. That cost of credit sale is nothing but your total cost excluding bad debts into rate divided by 100 into credit period divided by 365. Comfortable? Calculate the new scheme now. Total cost excluding bad debts is 12 lakh. 48,000. How much return you're losing? 10.5%. For how many days did you lose the return? 20 days. Why 20 days? Because you're given a credit to the debtor for 20 days. Calculate this. How much is it? 7 to 8. So this is your profit after tax. This is your opportunity cost. Net of these two, you'll get net benefit. How much is net benefit? 1,98,800. You can give the answer here only. Net benefit for old scheme is 159. Net benefit for new scheme is 198. Which one will you go for? Lowest or highest? I mean, you will go for old one or new one? New one. So I mean, you can tell the answer that select one. What is the decision making? Except new proposal. Sometimes the question says calculate incremental benefit. Calculate incremental benefit and give the decision based on that. Incremental benefit means we know this. That is extra. Old benefit gave 159 benefit. New one is giving 198 benefit. Compared to the old, new one is giving how much extra? 198 minus 159. If you do, you will get 38. So calculate incremental benefit like this. Then we wrote no. If incremental NPV is positive, except here also same thing. If incremental benefit is positive, except new scheme. If incremental benefit is negative, means reject new scheme. If question doesn't ask incremental, cut this, give the answer here only. If question asks incremental benefit, do one more step and give the answers. To both the ways they've asked the question previously in exam. This is one kind of problem. Okay, people. Okay, like this data, this keeps changing some data here, but this format will work out for majority of the problems. Done. So this is one kind of problem where we should think about changing our existing credit policy or not. One done. One more to go. Can we look at last one for this chapter? Factoring. Factoring. Okay. 1 minute. I'll show you some theory first. Here. Factoring arrangement. Sir, factoring simply means we are selling the debtors to recover some money. Normally from debtors we sell or we wait and collect the money. I sold the goods. What's your name, Acha? Rishi. Okay, Rishi over. Rishi, I will take this person's name. Yuvraj Singh, madam. Okay. Alright. Let us say I've sold goods to our Yuvraj Singh. Okay. On a 30 days credit, sale value is 1 lakh. So what will I normally do? Wait for 30 days. After that, I ask Yuvraj Singh to pay me the money. Correct? That is what normally happens. But in factoring will not do that. Debtors only, we sell it off. Normally, you sell a fixed assets. Yes. Here, what are we selling? Debtors. I'll give you a small one more example. Look at this. Suppose A Limited has debtors worth, let's say 100 lakhs. A Limited has a total debtors worth 100 lakhs. Let us say average collection period is 50 days. Average collection period is 50 days. That means A will recover this 100 lakhs today or after 50 days. After 50 days. But A needs the money now. A needs the money today. But debtor will pay only after 50 days. When this is the case, A can do one arrangement. What arrangement is? This debtors is there, no? Not one debtor. All the debtor is there. All the debtor A Limited can sell it to one agency. That agency we call it as factor. Entire 100 crore of debtor, they can sell it off to one agency called factor. Maybe all debtor or some debtor, that's okay. That is an arrangement or agreement. Leave that. We'll take for simplicity 100% of debtor. 100% of debtor worth 100 lakh, A Limited sold it to factor. You know what will factor do? Factor will pay A Limited immediately. Factor will pay A Limited immediately, not 100 lakhs. Let's say factor paid only 90 lakhs. Factor paid only 90 lakhs. Now, what will happen is factor will wait. Factor is an agency. They will wait. For how many days? What is the collection period? 50 days. For 50 days, factor will wait. Then he will approach debtor and tell the debtor to pay whom? Factor. How much money? 100 lakhs. And A Limited also will instruct the debtors that henceforth don't pay me, pay the factor. That means after 50 days, debtor will pay the factor how much? 100 lakhs. So through this arrangement, what happened? A Limited got the money immediately. Factor paid only 90 lakh. He recovered how much? 100 lakh. That means 10 lakh rupees is factor's commission. Debtor is not impacted. He had to pay after 50 days. He paid after 50 days. So it's a win-win situation for almost all the party concerned. This arrangement we call it as what's a factoring, wherein we sell what? Debtors. Done? Got the meaning? Now factoring arrangements are of two types: with recourse, without recourse. With recourse, without recourse. With recourse means suppose our debtor is he is having Malya. They are like Malya. You know which Malya, right? After 50 days, debtor is telling the factor, now I will not pay you the money. Debtor is telling the factor, I will not pay the money. Now what the factor will do is, he will come back to A Limited and recover the money. Such a factoring arrangement, we call it as with recourse. With recourse means if debtor does not pay the money, factor will come back to A Limited and recover the money. If it is without recourse factoring, if debtor does not pay the factor, factor cannot come back to A Limited and recover the money. That's a type of arrangement. So what type of factoring arrangement will be there? That's an agreement. A Limited and factor can agree for with recourse factoring or without recourse. It is just a negotiation. They can agree to whatever they are comfortable with. Yes, people. Or another way if I have to tell, under with recourse. Recourse means going back. Recourse means changing the direction or going back. In with recourse arrangement, bad debt risk is with the original seller, which is A Limited. Meaning if debtor defaults, A Limited has to give the money back to factor. So who has bad debt risk? A Limited. Under without recourse factoring, who has the bad debt risk? Factor. That is what I've written over here. Now, in all our problems, in all our factoring problems, we will always assume without recourse factoring. If information is missing, we will always assume without recourse factoring. That means who will bear the bad debt risk? Factor. Just an assumption, no logic. Okay. Usually they will mention. If they don't mention, always assume without recourse, meaning who will bear the bad debt risk? Factor. Now, how the question will come? You got the meaning, right? Now, how the question will come is, one finance manager of one company is thinking, should they go for factoring arrangement? Should they go for factoring arrangement? Now, we need to suggest, should the company go for factoring or they should not go? That means what we have to do. When you go for factoring arrangement, there will be some cost also, there will be some benefit also. If net benefit is positive means accept the factoring proposal. Otherwise means reject the law. You'll have to do some extra activity. Okay. If net benefit is positive, straight away you can accept the factoring arrangement. If it is negative, we'll have to do one extra step, which I'll tell you. Understood the whole crux? Okay, so that's what I've written over here. Calculation or evaluation of factoring proposal. For this also I've written this, right? Same format for all the 4-5 questions of factoring that we have. One, I will solve it to you in the class here. Excuse me. First is all the benefit we will show in one place, then all the cost we will show in another place. First, the benefit is savings in bad debts, because we are assuming factoring to be what? Factoring arrangement without recourse. Means once you get into factoring arrangement, who will bear the bad debt risk? Seller or factor? That means bad debt risk we saved. That is one of the benefit. And there will be some savings in administrative cost. Because earlier company had to follow up with the debtor and collect the money. Now company has to do that or factor will do. Factor will do. So some administrative cost we will save. It will be given to you in the question. Done now. Then some opportunity cost will be there. I'll explain it off. Now sir, earlier in my example, debtor used to pay on how many days? 50 days later. But factor is paying the money today. That means I can use this money and invest and get some return. Now this is opportunity cost in the form of outflow or inflow. Since the factor is paying me the amount today, I can invest today for how many days? 50 days and get some extra return. So this is an opportunity cost in the form of an inflow or in the form of a benefit. Hence I put this under benefit category. But in majority of the problem, sir, you will not find out this. Reason is, if you want to invest, you need some return. In majority of the problem, the return percentage will not be given. That means if return percentage is not given, that's what I've written. Check. Do this only if question gives you the return percentage or KO. KO as an overall cost of capital. Because for one entity it is cost, means for another entity it will be a return. So if they give you a return percentage or KO, then only calculate this. Otherwise, no need to calculate. Some problems, very rarely they will give this. If at all they give, take it. Otherwise, don't take. What are all this? These are all your benefits. These are all your total annual benefits. Now factoring will have some cost also. That's what I put over here. One cost is factor will not do this activity at free of cost. He will charge some commission. First cost is factoring ka commission. Commission will be calculated on annual credit sales. Annual credit sales. They will give you credit sales in the problem. Take annual credit sales and multiply by the factoring commission percentage. They will mention 2%, 1% or whatever. That is one cost. Correct. Not only this, factor also usually will charge some interest. Because see, in this arrangement, ideally A Limited had to get the money when? 50 days. But factor is paying the money now only. Correct? That means A Limited is getting the money early, no? That means factor is getting the money now or after 50 days. So some arrangement, factor also will charge some interest. He has given some loan, right? He has given an amount. On that, he will also charge some interest. Usually it will be there. Now how to calculate interest, that I'll take you through the next table. Leave that for the time being. But this is also one cost. Next is any other cost. Sometimes they will say there is some recurring cost due to factoring of 10,000, 15,000, like that. They will give it to you in the problem. If it is given, take it. Otherwise, not necessary. So these three are your cost. So this is your benefit. This is your annual cost. From benefit, if you reduce cost, what are you going to get? Net annual benefit you will get or net annual cost you will get. One and the same. I don't know. That could be A minus B, could be positive or it could be negative. If net annual benefit if you get means, I don't have to think further. If net annual benefit is positive means directly we can go for accepting. If however, if you get net annual cost, meaning benefit is not positive, benefit is negative, we have to do one extra thing and then decide. That I will tell you in a bit. So far good. So what did we do simply over here? Three normal benefit we took, three normal cost we took. What are the three benefits? Savings in bad debts, savings in admin cost, opportunity cost in the form of inflow. You will calculate only if return percentage or KO is given. Then cost are there will be some commission, there will be some interest, any other cost if it is there. So do total benefit minus total cost. If benefit is greater than the cost, you don't have to think further. Directly go ahead with the accepting the factoring proposal. Otherwise, one step extra. Now in these factoring problems, sir, we have to calculate also. Usually for these last one or two attempts, they started asking case study questions. They will ask you how much is the advance given by the factor. How much is the advance given by the factor? That we need to calculate. For that also I have made a normal format which works in almost all the cases. How is this? First we start with annual credit sales. I'll discuss and immediately this we will apply in one question also. But let's at least once we revise, it will be better maybe. First you take annual credit sales. If there is any reserve, reduce that. The reserve means they will tell you in the problem. 10% is held as reserve. That means factor will not give full amount. He is withholding how much? 10%. Withholding amount we call it as reserve. It will be given to you in the question. If it is there, minus. Then factoring commission. Factoring commission will be there, no, that you reduce because factor will not give full money. He will collect what? He will deduct his commission, he will deduct his interest, then only he will give the balance amount to the other party. So hence factoring commission if it is there, you reduce. By doing this, you will get amount available for advance. Okay. Now on this, you shall calculate the interest. On this above number, you will calculate the interest. Take the amount available for in advance and interest rate, they will give it to you in the problem. Multiply by the interest rate. And this is for a factoring period. In my case, how many days early the A Limited is getting the amount? 50 days. Now means factor is getting the payment on a delayed, how many days delay? 50 days. If factor is getting the amount for in 50 days delay means factor will charge the interest also for how many days? 50 days. So this rate will be for whole year. That's the reason you do factoring period divided by 365, 52 or 12 depending on how the factoring period is given. Factoring period you can calculate or you can take collection period, whatever. If it is given in days, you will take 365. If it is given in weeks, 52. If it is given in months, 12. Factor will deduct interest also, then he will get the amount advanced. But one second, here what did you take? The topmost number you check, what did you take? Annual credit sales. So if you take an annual number, this number also will be on what basis? Annual. But one second, factoring means this annual number is based on what? Sales. Sales, will you sell it to the factor or debtors? Sales, total sales, will you sell it to the factor or debtors? Debtors. That means this number is on an annual basis. Debtor will not, the factor will not give you sales amount. He will give you what amount? Debtors amount. How will you calculate debtors from sales? You know this already. You have done already in working capital estimate process. What did you do? Take the cost of credit sales divided by 365 into what? Collection period. Here the same thing. This amount, you know, it's for 365 days. Multiply by the collection period or factoring period you do, you will get the debtor amount. And that debtor amount is what the amount we will sell it to the factor, and that is the amount which factor will give it to us. Done now. Any problem? I know that you might have not got it, especially if you're doing it for the first time. In class, maybe I've done 5 questions on this. Class students, you should not ask anything. Yeah. But anyway, some new faces are there. I don't know whether you have done it or not or whatever. So that's the reason. Anyways, I'll tell you once again. Why are we doing all this drama is, once again, let me see how well you remember. Tell me, what did we do in the second table? We are trying to find out how much advance factor gave to us. Start with what? Annual credit sales. If there is any reserve amount given in the question, reduce. If there is any commission given in the question, factors commission, reduce. You will get amount available. On the amount available, you calculate the interest. If amount available is, let's say, 10 lakh, what you will do? 10 lakh into interest rate. Let's say interest rate is 15%. But this 15% is for whole year. Should factor wait for whole year to get the amount or only collection period? So into collection period, let's say collection period is 50 days. So into 50 divided by 365. This will give you what, sir? Interest amount. From the amount available, if you reduce interest, you will get amount advanced. But your topmost number was what? Was it debtors or sales? And that to what sale? Annual credit sales. That means this amount also will be what, sir? On an annual basis. That means this is based on not debtors. This is based on what? Sales. Are you selling sales to debtors or are you selling sales to factor or debtors? That means this number no is for 365 days, right? How will you find out debtors from sales? Take the sale value divided by 365 into your factoring period you do. You will get the amount advanced by factor. Why we need this is, suppose here you got net annual cost. Again, I'll tell you what number, just say, suppose net annual cost is 1 lakh. You calculated all this and you got net annual cost how much? 1 lakh. Not benefit. Net annual cost of factoring is how much? 1 lakh. Amount advanced by factor, let's say, is 10 lakh. Amount advanced by factor is how much? 10 lakh. Now, what you have to do here in this sort of problem is, listen. So, from factoring, you are not getting benefit. You are getting a cost. From factoring, you are not getting a benefit. You are getting a cost. That means, ideally, you should accept it or reject it. Because you are not getting benefit. You are getting a cost. So, that means you should ideally reject. But now, factoring is one way to raise money. Agreed? Because in factoring, what do? Company sells the debtors and they get the money immediately. That means it is a source of finance. So if you don't want to do this source of finance, you can take a normal bank loan. You can take a normal bank loan. Suppose a bank loan ka interest rate is 13%. Factoring is one way of raising money. Okay. If you don't go for factoring, you can take a bank loan. Bank loan ka interest rate I have assumed to be how much? 13%. Compare this with factoring ka cost. Let's say factoring ka cost is only 12%. Now you tell me what you'll do. You'll go for factoring or you'll go for bank loan? You'll go for factoring. Because factoring has higher cost or lower cost. That is what we are trying to find out here. Done now. Here do we have percentage or we have amount? Amount. But bank loan isn't amount or percentage. That means we also have to find out what, sir? Annual cost of factoring in percentage. Okay. That is the reason we need two components. What are the two components we need for annual cost of factoring? Net annual cost divided by amount advanced by the factor. Because you will calculate the interest on the loan given by the firm. So that's the reason we need these two amounts. Net annual cost divided by amount advanced by the factor. If you do, you will get some percentage. In my example, what was net annual cost? 1 lakh. How much was amount advanced by factor, I assume? 10 lakh. Into 100 you do. How much is this percentage? 10%. That means factoring cost is only how much? 10%. But bank loan is how much? 13%. Will you reject the factoring or will you accept the factoring? That is what I have written here. Check. If annual factoring cost, if it is lesser than the bank interest rate, then you can accept the factoring proposal. So if factoring gives you net benefit, you don't have to do anything. Simply accept. But if factoring gives a cost, then first find out cost percentage. Compare that cost percentage with bank rate. If factoring cost is lower than bank rate, accept. Otherwise, reject. Done now. Now I'll take you through one question where we do all these three things. Can we fast go? Now, one case study question we'll take up. That's the last one for the day, by the way, people, in case you're wondering. So when break, I will give you. After this question, only break. This is the factoring question that came as a case-based question in May 2024 MTP series. Let's understand this with the help of a question. Now, NV Industries is a manufacturing industry which manages its accounts receivable internally by sales and credit department. Currently, company only is following up with their debtors and collecting the amount. It supplies small articles to different industries. Okay. Total sales ledger stands at 200 lakh. 1 second, hang on. For our factoring arrangement evaluation, we want total sales or credit sales? Credit sales. This is total sales. What are they saying? Of this, 80% is credit sales. Calculate 200 ka 80% is 160 lakhs. Correct? Company has a credit policy of 2/40 net 120. What does that mean? Company will give a discount of 2% to our debtor if debtor pays us within 40 days. Otherwise, debtor has to pay within 120 days. Past experience of the company has been that on an average, 50% of the customers will avail the discount. 50% will go for discount, 50% will not go for discount. Balance receivable are collected on an average 120 days. That means, can you tell me, is everybody paying on one day or different dates? Sir, you remember for evaluating factoring proposal, we need average collection period. Here we have one collection period or multiple. Some customers are paying on 120 days. Some customers are paying within 40 days. What will you take? We need average. So first we need to find out is the average collection period. How to do it? So how many customers will pay within 40 days? Everybody or 50%? So 50% of my customers will pay within 40 days. Other 50% of my customer will pay within 120 days. So that means on an average, this customer will pay within 20 days. On an average, that customer will pay within 60 days. So totally, on an average, I will recover my money from my debtor on an 80 days period. So my interest calculation now for factoring will be for this period of 80 days. That's the first step. Everyone got it? Got it? Got it? Got it, people? Sir, if this discount was not there, then I would have directly taken 120. It's not mandatory, it should be there, but here it is there, so we'll have to calculate the average collection period. Got it? Done. Next, the finance controller estimated bad debts to be 1% of credit sale. So if you go for factoring arrangement, we should have to incur this bad debts or we will save? We will save. That means this becomes a cost or a benefit? Benefit. Great. But with escalating cost associated with in-house management of debtors coupled with the need to unburden the management goal is given lever. Currently, the firms, the company CFO is examining the outsourcing this to factoring. That means currently they are thinking instead of following up with the debtors and collecting the money, can we go for a factoring arrangement? Now, if you go for factoring arrangement, currently the firm spends about 2,40,000 to administer the credit sales. The administrative cost per annum is how much? 2.4. Currently, we are doing this, but once we go for factoring, should we have to incur this or we will save? So that means this becomes a cost or a benefit? Benefit. These are avoidable costs as factoring firm is prepared to buy the firm's receivable. So both you can avoid. What are the two things we can avoid? Bad debts and administrative cost. The main elements of proposal are, it will charge 2% commission. Factor will charge 2% commission. So what is this? Benefit or cost? Cost. It will pay advance against receivable at an interest rate of 18%. So this interest is a benefit or cost? Cost. After withholding 10% as reserve. Just now we discussed reserve 1. It will come in working note number 2. Company has an option to take a loan of 15%. Then your factoring arrangement will not give you net benefit. It will give you net annual cost. From net annual cost, you need to find out annual cost, factoring cost and percentage. Compare that factoring percentage with the bank percentage and then probably give a decision. Don't know. That's what it is hinting towards. Correct? We can take a normal bank loan at 15% or we can also take a working capital loan of 14%. We have two loan options, 15%, 14%. So for factoring proposal to accept, the factoring cost should be lesser than what? 14%. Yes, no? Then we will accept factoring. Otherwise, we will reject. You have also presented meeting. Which meeting? I don't know. CFO will ask you to be ready with the following question. Consider 360 days in a year. First question, what is average level of receivable? This is childish question. They're asking you debtor balance. Sir, debtor will come due to total sales or credit sales. What is your total sales? 200 lakh. What is your credit sales of 80%? That means what is your annual credit sales? 200 lakh to 80%, which is how much? 160 lakh. So 160 lakhs is for 1 day or whole year? Here check how the data has been given. Months or days? These are all days. No. Can you have 120 months, sir? No, that means obviously 120 is what? Days. So 160 lakh is for how many days? 365. Allah. 360. Question told to take 360. 160 lakh is for 360 days. On an average, what is my debtor collection period? 80 days. So for 360 days, if the value is 160, means for 80 days, what is the value? This is how you find out debtors. No. Annual credit sales are divided by 360, 365, 52, whatever, multiplied by collection period. How much is this? 35.55 lakhs. So which option has that? B for Bengaluru has that option. Select Madi. Okay, now done. One tomorrow. Now next 2-3 questions I will not even bother reading. Whether they have asked or not, this we are doing for solving the question or for our practice. We will practice both the working note and then we will take the answer. So first working note, you guide, let's see how well you remember. First you will put up what? Total benefit of factoring you will calculate, total cost of factoring you will calculate, and then calculate net benefit or net annual cost. Can we do that? Okay. Give the heading as evaluation of factoring proposal. First benefit. 2 benefits you already know. Tell me, sir. 2 benefits you already know. One is bad debt loss you can save. So how much bad debt will come on total sales or credit sales? Josh may don't take 200 lakhs. Bad debts will only come due to credit sales. So how much is bad debt percentage? Where is that from? Here. Bad debt loss is 1% of credit sales. Calculate. 200 lakh is your total sales. Of that, 80% will be your credit sales multiplied by 1% bad debts. How much is that? 1,60,000 is your savings in bad debts. This is a benefit. Is there any administrative cost you can save? Yes. How much is that? 2,40,000 per annum. Everything we want on annual basis. Why? Because bank interest rate is on annual basis. That means even factoring cost you should calculate on annual basis only. That's the reason every number you will take it on annual basis. So annual savings and admin cost is how much? 2,40,000. Opportunity cost there are. They told return or KO is 10%, 12%. They told interest percentage. That's okay. But investment return given, or at least KO given, no. That means will interest come or opportunity cost come in benefit? No. If it is given, take it. Otherwise, don't take it. So total benefit is how much here? 4 lakh rupees. Now cost. What are the 2 costs here we have? Factoring commission. How do you calculate factoring commission? Annual credit sales multiplied by factoring commission ka percentage. What is annual credit sale? 200 lakh ka 80% will give you annual credit sale. What is factoring ka commission? 2%. So calculate 2% of this. 3,20,000 is factoring ka commission. That's all, or we have interest. But interest will come from next working note. I will give a reference. Is there any other cost? Have they told there is some repetitive cost or recurring cost of 20, 30 like that? No. Other cost is not there. So yes, people, now I can't finish this table because I also need what? Interest. Can we calculate interest? For that also I told you the format. First you will take what? Annual credit sales. How much is annual credit sales? 160 lakhs. From that deduct any reserve amount. Is there any reserve here? Yes, they told how much reserve? 10%. So 160 lakh ka 10% you calculate. How much it will be? 16 lakh is the reserve. Reserve means is factor paying or withholding. He's not giving. So that's the reason we are reducing. Then is there any factoring commission? Yeah, we already calculated. How much is that? 3,20,000. Obviously no, sir. Factor will pay full money or he will deduct. He will deduct his commission, he will deduct his interest and then only give the money. So hence factoring commission also you need to reduce. If you reduce this, how much is the money available? 1 crore 40 lakh 80,000. This much amount factoring can give it as advance. But hang on, is this only commission or there is also interest? Interest. So calculate. How much is the amount? 1 crore 40 lakh 80,000. What is the interest rate they gave in the question? 18%. But that 18% is for whole year. Is factor has to wait for whole year or 80 days? Average collection period is 80 days. 18% is for whole year. For 80 days, how much is it? Calculate. How much you going to get? 5,63,200. That is the interest. Factor will reduce this 5,63,000 from this number. So how much is this number? 1 crore 35,16,800. Hang on. Will the factor give this much money? No. This is based on what? What is your topmost number? Sales. And that to which sales? Annual credit sales. annual credit sale, are you selling to the factor or debtor? Debtor. So that means this number is not based on debtor. This number is based on what? Sales. We want what? Amount paid by the factor. Factor will not pay sales amount. He will pay the debtors amount because we are selling to the factor, not sales. We are selling to the factor debtors. So 1 crore 35 lakh 16,800 is for the whole year, meaning for how many days? 360 days. What is our average collection period we worked out? 80 days. So what is it for 80 days? Calculate. 30 lakh 3,733. This is the amount the factor will give it to us as amount. Got it? Any problem? Did we get interest? Did we get interest? Yes. Is interest a benefit or cost? Cost. So plug this number. 5 lakh 63,200. This is your total benefit, which is how much? 4 lakh. This is your total cost. Now we got interest also. Add the total cost. 8 lakh 83,200. Total benefit is 4 lakh. Total cost is 8 lakh 83,200. Which is more? Cost is only more. So you'll get net annual benefit or net annual cost. Net annual cost. How much is that? 4 lakh 83,200. You can call it as A minus B. When you say cost, you don't have to put any signs. You can show positive also, not a big deal. But reject the factoring proposal or we have to evaluate further. Evaluate further because they have given a bank loan ka interest rate and they have given bank loan ka cost in percentage. But this is in amount. That means we need to find out what? Factoring ka annual percentage. How do you get that? Sir, this is the cost for this much loan. This is the cost for this much loan. What is the cost percentage? It's like this, sir. This is the interest amount. This is the loan amount. How do you calculate? Tell me, sir. If I give you loan amount, if I give you interest rate, can you calculate interest amount for me? How do you calculate? Loan ka interest rate. If you multiply, you will get the interest amount. If I give you interest amount, if I give you loan amount, can't you find out interest rate? How do you find out interest rate? Interest amount divided by loan amount. Correct? Here, factor is charging only interest or there are other costs. So substitute interest cost with what? Net annual cost divided by loan amount. How much is the amount advanced by the factor? Instead of loan amount, call it as what, sir? Amount advanced by the factor. That is the formula. That's what I've written here. Net annual cost divided by amount advanced by the factor. Since we want it in percentage, we multiply by 100. So basically 4 lakh 83,200 divided by 30 lakh 3,733. If you do, you're getting 16.09. But bank is ready to offer 15% one loan, another 14. So looks like decision here is accept or reject. But first I have to ask that question. No, we have solved whatever we want. But let's see the question what they've asked. You got comfort around how to solve this question? No? Same format will work for every factoring question with slight tweaks here and there based on the question. Now, check the second question. How much advance factor will pay against the receivable? That we already know. How much advance factor will pay? 30 lakh 3,733. So, see for Chennai, right answer. What is the annual cost of factoring? Annual net cost. Allah. Annual cost. Annual cost. Not net cost, mind you. Annual cost means there are 3 costs we are incurring here. Generally, we incur. What is that? Commission, interest, any other cost. Here other cost is not there. But do we have the total cost with us? Yes, that's what I've written here. Annual cost of factoring is how much? These 3 addition. 8 lakh 83,200. That is the option. They did not ask net, sir. They ask you net annual cost. From cost, you will reduce the benefit. They did not ask net annual cost. They only asked you annual cost. Look at the next option. What is the net cost to the company? Net cost, what is to the company? Net annual cost is how much? 4 lakh 83,200. D for Delhi is the right option there. Done. Then they ask what is the effective cost of factoring? Percentage. What percentage we got? 16 point something we got. No, what is that? 16.09. Which option has 16.09? A for alpha. They did not ask the decision. Decision here is accept or reject. Reject, but they did not ask. So not required. This is your factoring ka question and that is your working capital management ka revision. Thank you. Yes, people. So let's get started with our marathon session. So the next topic that we'll be looking at is the dividend decisions. Now this topic essence is the whole aspect is can the company control their share price through their dividend decisions? Can company control the equity share ka price with the help of their dividend decision. That's all is the overall essence of this particular topic. But before we dive into that aspect, one quick way is first, again, some theory topics may come, I don't know, types of dividend. One is normal. So normally dividend is paid out in what form? Cash. When we say cash, it means not necessarily cash in hand or through bank transfer. That we call it as cash dividend. Okay. Another one is stock dividend. Stock dividend means issuing the bonus shares, meaning bonus shares as in some extra shares are given to existing equity shareholders at free of cost. Using profits only we give off extra shares. That we call it as bonus shares. That is also one form of dividend. If you do any share repurchase, when you repurchase the shares, you need money, and that money usually will come if company is having some profits. So hence that is also one kind of dividend. Again, all these are some theory questions if at all they ask. Not that popular, but just saying. Okay, now I think we will go into the main exam related pointers relating to this aspect. Broadly, if I have to say, there are 3 types of, or maybe 4 types of problems that usually gets asked from this particular topic. If you are comfortable with those 4, I think we are done with this topic altogether. Now, just like our capital structure, maybe we had some theories, relevance and irrelevance. Even in dividend, we have some theories. One is a relevance theory, another one is a irrelevance theory. So, irrelevance theory ka argument is whether you give dividend or whether company does not give dividend, share price or the value of the firm will be same. Whether company pays a dividend or whether company does not pay a dividend, value of the firm and value of equity shares in the company will be same. And under irrelevance theory, you know who comes first. Under irrelevance theory, you remember sir. Okay, so sir ka hypothesis under irrelevance theory is you pay or you don't pay dividend, value will be same. First, we will look at this. Okay. Now, as per sir, P0. P0 means current market price is given by P1 plus D1 divided by 1 plus cost of equity. P1 plus D1. You will have to remember 3 formulas for approach. P0 is equal to P1 plus D1 divided by 1 plus cost of equity. It's very straightforward. Sir, suppose company feels they are expected to pay a dividend of 10 rupees in the current year. This is dividend paid or dividend expected? This is dividend paid or dividend expected, I said. Expected dividend. Expected dividend is denoted with a symbol D0 or D1? D1. And company feels the share price of this particular company ka share price at the end of the year will be 110. 110. So this is expected price means it is P0 or P1? P1. Any doubt in this? Just some assumed numbers are given. Company feels they are expected to give a dividend of 10 rupees and share price at the end of first year will be 110. Any doubt? Okay. Now you tell me, sir, if you add up these two, how much you're going to get? 110. This 110 is the current value or future value? This 110 or rather this is 120, no? Yeah, this 120 is current value or it's a present value or future value? It's the future value. But we want to find out its present value. That is nothing but your P0. That is nothing but your P0. If you find out the present value of this 120, you will get the present value means current market price. So if you find the present value of 120, you will get what's our P0. And how do you get present value? Tell me. You will do what? 120 multiplied by discount factor. How do you get discount factor? 120 into 1 plus I whole power n. N is how many years here? 1. That means as good as saying was what, sir? 120 into 1 divided by 1 plus I? Yes, no. That is all is your approach ka formula. Now resubstitute. Check. Now what is this 120? How did you get this 120? By the way, doing this, what will you get, sir? By doing this, what will you get? You will get current market price, which is what? P0. Substitute this now, sir. How did you get this P0? You took expected dividend, which is D1. You took expected price, which is P1. Both are on present value terms or future value terms? Future value terms. If you want the current price means we have to find out the present value of this. For finding the present value, you do 1 divided by 1 plus I, no. Instead of 1 plus I, we do 1 plus cost of equity. I becomes your cost of equity. That's all this is formula. Basically, we are trying to find out the present value of future return. If you do that, you will get the current market price. Done now. You can mug up the formula or you can know like this. Done now. What is it again? P0 is equal to expected price, which is P1, expected dividend, which is D1. Both are on what platform? Future value platform. Find out the present value of that. To find out present value, we do 1 divided by 1 plus I whole power n. N is anyway first year here. So instead of 1 plus I, we do 1 plus cost of equity. Cost of equity is a discount factor we use here. That's all. Done up. By doing that, you get P not any problem. Comfortable. Then three things you have to remember as far as approach is concerned. Another one is the shortage of funds. Shortage of funds is denoted by the symbol, or you can call it as new shares. New shares, we'll call it, is denoted by the symbol delta N. Delta N means change or new shares issue. That is given by the formula shortage divided by P1. Shortage divided by P1. I'll take up one problem also, don't worry. First, we will quickly run through. So delta N is given by shortage of funds divided by P1. What is the shortage of funds? Let's assume that the company has an earnings of 1 lakh rupees, people. Company currently has a profit after tax or each of how much? 1 lakh. Now company wants to give a dividend of 20,000. So how much money remains? 80,000. Now company has some expansion plans in the future. In the future, they want to do some expansion. For expansion, they want 3 lakh rupees. They want how much money? Available is how much? 80,000. Required is how much? 3 lakh. That means, do we have any shortage of funds? How much is that? 2 lakh 20,000. So if you have any shortage of funds, what will you do? You will issue an instrument. You will issue some instrument to raise the finance. Yes or no? Here, what will we raise? Equity shares. Equity shares. Let's say equity shares ka one price is 20 rupees. Tell me how many shares will you raise? You totally need how much? 2,20,000. The share price, one share is issued at 22 rupees, let's assume. How many shares will you issue? 10,000 shares. Correct or no? 10,000 old shares or 10,000 new shares? That 10,000 new shares only we call it as delta. Comfortable. Now express this in formula for me. How did you get this delta N? You took 220 and you divided by 22. What is that 220? Shortage of funds. What is this 22? Current price or future price? No, future price, because you are getting the shortage not now. You are getting the shortage in future. That means the delta N is given by the formula what's shortage divided by P1. Divided by P1. And how do you get shortage? From earnings reduce dividend. You will get the amount available. Compare it with amount required. You will get the shortage. Shortage divided by P1 if you do, you will get the delta. Easy now. Comfortable now. Alright. So as per approach, you need to find out the value of the firm. They'll ask you to find out the value of the firm. So I have 10,000 equity shares and my value of one equity shares is 20. So what is my value? I have 10,000 equity shares and one share ka value, market value is 20. How much is this? 2 lakh. Now we have only one kind of shares or two shares? I already have some shares. Now I have issued new shares. That means I have only one kind or two kinds of shares. One is N. N means existing share. Plus delta N is the new shares. Hence market value of the firm is given by N plus delta N into P1. Into P1. Okay. So if you do that, you will get value. In that value, some money you lose for your investment. So minus I. Some you already have from your earnings. Hence plus E. But all this are represented on now platform or future value platform. This P1 and all is now or in future. But we want the value of the firm in future value terms or present value terms. Hence, use the discount factor. That is 1 divided by cost of equity. By doing that, you get the current value of the firm. So, value of the firm is given by the formula N plus delta N into P1 minus investment plus earnings. Since we are using all these are what? So, delta N is current share or you will issue in future. Future. That means by doing this, you will not get current value. You will get the future value. But we want the value of the firm now. Hence, we use the discount factor and find out the present value. That is nothing but 1 plus cost of equity. These three formulas, if you know, means next question number. Okay, now, once again, quickly we'll tell. This is what approach? Approach. And approach is a relevance theory or irrelevance theory? Irrelevance theory. Irrelevance theory ka argument is whether the company pays a dividend or they don't pay the dividend, value of the firm will be same. Value of equity shares also will be same. So three formulas we discussed is 1, P0 is equal to P1 plus D1 divided by 1 plus cost of equity. Then we need to find shortage of funds. In fact, we need to find delta N. Delta N is given by shortage of funds divided by P1. And how do you get the shortage of funds? From the earnings, reduce the dividend, and then you'll get amount available. Compare the amount available with amount required. You'll get the shortage. The value of the firm is given by N plus delta N into P1. In that, something will go for investment, so minus I. Some earnings you already have, so plus E. But all these are represented on future value terms. You get present value 1 plus cost of equity. Can we apply this? Ditto. Come to one question. Question number 1 itself. It's a study material question only, but that's good enough. AB Engineering Limited belongs to a risk class where capitalization rate is 10%. Capitalization rate here refers to your cost of equity. It has currently 10,000 shares outstanding. It already has 10,000. That means this is delta N or N. Existing shares we call it as N. Yeah. Okay. And selling it at 100. That means what is the current value of the share? 100. That means current value means P naught. No. That's what we find out. But here they have given. Okay, we'll see. The firm is contemplating, meaning thinking, the declaration of dividend of 5 per share. Dividend already paid or we are thinking to give? We are thinking to give means this is current dividend or expected dividend. Expected dividend is D0 or D1. That means this 5 rupees becomes your D1. It expects to have a net income of 1 lakh. So our each net income here refers to, when we say net income, it becomes each basically. How much is our net income? 1 lakh. And it has a proposal for making new investment of 2 lakh. How much money you need for new investment? 2 lakh. You need to find out the value of the firm under 2 scenarios. One, when the dividends are paid, when they are not paid. We know it's an irrelevance theory. So whether you pay the dividend or you don't pay the dividend, value should be same. If you're getting different numbers, somewhere you have done something wrong. That's a checkpoint. Can we solve this? Same 3 formulas. First, we will chop. First, working note. Okay. What is the first formula, sir? P0 is equal to P1 plus the D1 divided by 1 plus cost of equity. They asked to solve under 2 scenarios. No. What is the first scenario? Dividends are not paid. So first let's solve dividends are not paid. If dividend is not paid means D1 will be 0. Because name itself is saying dividends are not paid. So D1 becomes 0. So P0 is given in the question. How much is that? 100. D1 is equal to 0 because dividends are not expected to be paid. P1 we don't know. Actually, we use this formula not to find P0. We use this formula to find P1. In all our problems, P1 will be missing. That is the reason we use this formula. Okay, Zaro? So, current price is 100. P1 not given. D1 dividends are not paid, so it is 0. Divided by 1 plus cost of equity. How much is cost of equity? 10%. So, 1 plus 0.1. By solving, you will get P1 to be how much? 110. So, you use this as a formula to find out what? P1. Second, we have to find out what's delta N. For that, first we need shortage. How do you get shortage? Earnings. How much is the earnings, sir? 1 second. Where is it now? How much is the net income of each? 1 lakh. Okay. From earnings, reduce the dividend. Which scenario? Dividends are not paid. That means how much is the dividend amount? 0. So how much amount is available? 1 lakh. But how much you need for investment? You have 1 lakh, but you need 2 lakhs. So that means, is there any shortage? Yes. So we are expecting a shortage of 1 lakh. Yes, people. And moreover, they are saying this expects to have a net income. Expected net income means current income or future net. Future. These are all future value. Okay. So that means in future may we are expecting how much shortage? 1 lakh. In future may if you are getting a shortage means what will you do? You will raise the money and to cover up the shortage. Are you raising the shares now or in future? Future. In future, what is the share price expected? 110. So totally you need 1 lakh rupees money. You will raise this by issuing new equity shares and new issue price is expected to be how much per share? 110. So if you do 1 lakh divided by 110, you will get the new shares issue. That you are getting in decimals. 909.09. Always round up the number of shares to the. Don't use the mathematical round up because in mathematical, what do we say? Anything greater than 0.5, next number. Anything lower than 0.5, previous number. Here we need funds. Okay. Don't take 909. Always take 90.09 means take the next number, which is 910. Because if you take 909, from 1 share 909, what is the price of 1 share? 110. If you multiply 909 into 110, how much are you getting? Fatapat tell. No? 99,090. 99990. But we don't need 99990. We want 1 lakh. That's the reason we always round it off to the next number, not the previous number. Any decimal, round it off to the next number. Okay, people? Alright. So the number of new shares will be issued is how much? 910. But in these sort of problems, don't round off this. Keep it in fraction only. Keep it in fraction. If the question says find out the number of new equity shares, then do this 910 wala calculation. Otherwise, keep it in fraction only. Why I will tell you in the next working note. So far good. That means I'll keep the delta n as what? 1 lakh divided by 110. I'll not take the whole number. Let it be in fraction. So far good. First step we have applied, delta n we have applied. Next is value of the firm. Tell me how do you get value of the firm? N plus delta n into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N, how many shares we currently have? 10,000. Okay, 1 second. N is 10,000 plus a delta n, just now we got it. How much? 1 lakh divided by 110 into P1. How much is P1 expected? 110. So multiplied by 110 minus investment. How much is investment expected? 2 lakh plus earnings. How much is earnings? 1 lakh divided by 1 plus cost of equity. Why I ask you to keep decimal is this denominator 110 you have to multiply anyway 110. Both will get knocked off. So that's the reason no need to work in decimals. We can keep the fraction as it is. Done now. So cross multiply. 10,000 into 110 will give you 11 lakh. This 110 will get knocked off when you multiply. So the number will be 1 lakh. Minus 2 lakh plus 1 lakh divided by 110. So when you solve, you will get the value of the firm to be 10 lakhs. Easy. Now this is the value of the firm under which case? When the dividends are not paid. You have to solve only this or dividend or also paid scenario. You also need to calculate the value of the firm under dividends are paid. First, same. Again start first. P naught is equal to P1 plus D1 divided by 1 plus cost of equity. P naught is a current price. It's already given in the question. As how much? 100. P1 we don't know. We are about to find. D1 is how much? How much dividend company is expecting to pay? 5. Which scenario are we solving? Dividends are paid. That means the D1 will become 5. Cost of equity same. So when you solve, P1 will become 105. Done. Next the same funda. We have to find out delta n. For delta n first we start with what? Earnings. We need shortage. First we start with earnings, which is how much? 1 lakh. Minus dividend. How much a dividend company is planning to give? 5 per share. How many shares currently we have? 10,000. On 1 share, 5 rupees. On 10,000 shares, how much dividend? 50,000. In 1 lakh, 50,000 gone for dividend. How much remains? 50. 50 we have, but how much for investment? How much we need? 2 lakh. 2 lakh we need, but we have only 50. So how much is the shortage? 1 lakh 50,000 is the shortage. So how do you get delta n? Shortage divided by P1. Shortage is 1 lakh 50,000. P1 is how much? 105. Should you have to get it in decimals or keep fraction? Keep the fraction. If the question says find out new shares, then solve it and write 1429 shares. Sometimes they will say, they will not ask value of the firm. They will directly say find out the new shares issued. In that case, we solve it fully and write what? 1429 shares. Here they did not ask number of new shares. They asked value of the firm. For that, no need to take any decimals. We'll keep the fraction as it is. Okay. Then find out value of the firm given by n plus delta n into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N is 10,000 existing shares. Delta n is 1,50,000 divided by 105 into P1. How much is P1 expected? 105 minus investment 2 lakh plus earnings. How much is our earnings? 1 lakh rupees divided by 1 plus cost of equity. Solve and you'll still get the value of the firm to be 10 lakh. Here also 10 lakh, here also 10 lakh. It should be 10 lakh because it is an irrelevance theory. MM approach done. One kind of problem done. Okay, Saru? Any problem? Now, one more way this question can be asked. Sometimes instead of value of the firm, they will ask you value of equity shares. Instead of value of the firm, they will ask you to find out value of firm. Shares alone. Okay. In that case, if you want only share value, what you will do? N plus delta n into P1. Only do this section. Okay. You don't want the value of the firm. If they ask you this, then only do this section. In the value of the firm, you have this formula, no? N plus delta n minus investment plus earnings. Cut off that. And you only do this. N plus delta n into P1. Okay. Because they are only asking the market value of the shares, not the present value. So just do this. Check the question, what they've asked, and accordingly do it. Comfortable, sir? These are the two kinds of problems which usually comes from MM approach. That's first type of, problems we have covered. Move forward. Okay. Next we have some relevance theory. Under relevance theory, we have two people who have given their thoughts. One is Walter sir, another one is Gordon sir. Now, relevance theory का argument is by having a dividend policy, share price can be increased. Meaning, share market value of the share will increase based on dividend policy. If you pay more dividend or if you pay less dividend, share price can be altered. We'll see that. That is what relevance theory argument is. Exactly opposite of irrelevance. So Walter Circa formula is, you have taken, remember this, they will not give you a formula. P naught is equal to D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. This is the formula for Walter Circa. Okay na? Paka na? Sir, it's simple actually again. Sir, if I give you investment amount, if I give you the rate of return, will you find out the return amount? If I give you investment amount, if I give you the rate of return on investment, can you find out the return amount? Yes. Now, if investor, think from equity shareholders perspective, if investor has to get a return means he has to buy the shares today. That means investment is what? P naught. Because he has to buy the shares today means he will buy it at today's market price. Today's market price only we call it as what? P naught. Okay. The return he will become here the cost of equity. Because for him it's a return. For us it's a cost. One and the same that way. Multiplied with the return amount or is equal to return amount. Now you tell me what and all is a return for equity shareholders. One is the dividend. So which I took. Correct. Plus another one is, suppose earnings of the company is 10 rupees. A company has earned EPS is 10 rupees. Is it necessary if company earns EPS 10, entire 10 they have to give it as dividend or their choice? Company, let's say, paid a dividend per share of only 7 rupees. Company paid a dividend of only 7 rupees. That means how much money company has retained? This only we call it as retained earnings or retention ratio. How much is that? 3 rupees. What will company do with this 3 rupees? They will reinvest this money into their business. When they reinvest, they will get a return. They will get a return. Hence, we do E minus D. E minus D is nothing but 10 minus 7, which is what, sir? 3. On this 3 rupees, company will reinvest, and when they reinvest, they will get a return. Yes, this return also belongs to whom? Equity shareholder only. Because this is what, sir? Retained earnings. Retained earnings belongs to whom? Equity shareholders. So, hence, this 3 rupees ka return which company earned will also belong to equity shareholders. Let's say on this 3 rupees, company is expecting to earn a return of 10%. Company is expecting to earn a return of 10%. So how much is this? 0.3. Okay, now this 0.3 return also belongs to whom? Equity shareholders. So this fund will only happen once or throughout. So only once company will retain or every year they will do this. That means for how many years will it go? Infinity. So to capture that cost of equity. That's the way to remember the formula. Understanding. Everybody good. Everybody okay now. So this is the return amount. What is it again? Once again, maybe I'll tell you. Investment amount becomes your P naught. Rate of return becomes your cost of equity. Investor will get 2 returns. What is that? One is the dividend. Plus, company has, is it necessary company has to pay entire earnings as dividend or some they can retain? Some they can retain. How do you get retained? E minus D. When the company retains the money, they will reinvest that money in business. When they reinvest, they will get a return. Hence, we take R into E minus D. This R into E minus D ka process happens only once or infinity. Hence, to capture that divided by cost of equity. This becomes your return amount. Okay. Now, I have to find out P naught means what you will do. This cost of equity will send it to the other side. So, that means P naught will be rephrased as what, sir? D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. As simple as that. Done now. The way you remember is your call, but you have to compulsorily remember. Basically, both are returns. Basically, these both are returns. Done. Work is. Let's find out or let's apply this in one problem. Maybe one more component I'll tell, and then we'll go for the question. Sir, Gordon, sir, and Walter say both say the same thing. What is that same thing? Anyway, I've written. Maybe I'll go through this. There is something called optimum dividend payout ratio, and this is common for Gordon, sir, as well as Walter, sir. What their study or hypothesis says is, and this is pretty much common sense only, if R is greater than the cost of equity, if return is greater than cost of equity, optimum dividend payout ratio is 0%, meaning company should pay dividend or it should not. If R is greater than cost of equity, dividend rate which the company has to give is 0%. If R is lesser than cost of equity, then ideal, optimum, optimum means ideal dividend payout ratio is 100%, meaning whatever you are earning, entire earnings is distributed as dividend. If R is exactly equal to cost of equity, there is no optimum payout ratio, or whatever you pay, that itself is optimum dividend payout ratio. Common sense really. Sir, company is utilizing the money and they are investing that money into a project. That project is giving a return of 15%. Okay. But to do this project, company has raised funds. How? Through equity. The cost of equity is, let's say, only 10%. Now you tell me, they are doing a project. For that project, they've taken a finance. Finance cost is how much? 10%. But project is getting how much return? 15%. Now you tell me, company is making loss-making project or profitability project? Profit. If company is making a profitability project, means should they give dividend or whatever money they have reinvest in business? The more and more they reinvest the money into business, the return for equity shareholders will increase. How? If company makes more and more profit, means share price will increase. Hence, the optimum dividend payout ratio is 0. You're doing a profitable project, so why are you wasting money by giving away to shareholders? How much ever money you have, again reinvest into the business so that you can earn more and generate higher return for shareholders. Hence, optimum dividend payout ratio is what? 0%. If it's ulta scenario, return is only 8%, cost is 10%. Okay, that means this is a profitable project or loss-making project. Is there any point in again doing a loss-making project? No. Hence, Walter sir and Dividend sir, Gordon sir is saying that 100% of your earnings give away as dividend payout ratio. And this is ideal, sir. This is a recommended number. Company instead of 100% can pay 80% also, 90% also. Their choice. As per Walter and Gordon, sir, this is the optimum. Optimum means ideal. Okay. As per this, in this case, the optimum dividend payout ratio is how much? 100%. If R is exactly equal to cost of equity, then neither you are doing a profitable project nor you are doing a loss-making project. In this case, there is no optimum dividend payout ratio. Company can pay 0 dividend, company can pay 10%, 100%, 90%, whatever percentage, share price will not change. That's the reason we say there is no optimum dividend payout ratio, or whatever you pay itself is optimum dividend payout ratio. They'll ask this question. This is popular scenario from this question. That's the reason calling it out. Understood, everybody? One, you have to remember the formula. Another one is the optimum dividend payout ratio. Again, tell me, as per Walters, how do you get price of the share? Current market price P naught? D, return basically. It's a return divided by cost of equity. What are the returns? D plus R into E minus B divided by cost of equity. Whole thing again divided by cost of equity. That is one. Then optimum dividend payout ratio is done with a comparison of R and cost of equity. If return is greater than cost of equity, optimum dividend payout ratio is 0. If return is less than cost of equity, optimum dividend payout ratio is 100%. If R is exactly cost of equity, you can pay anything because there is no optimum dividend payout ratio, or whatever you pay itself is optimum. Let's take up one question. We did Walter says, right? Maybe we'll take up this question. Okay, check this question, everybody. From the following information supplied to you, total earnings is 2 lakhs. Okay, not EPS. They've given you total earnings. In all our formula, maybe I'll tell me the formula once again. Let's see. Cost, price of the share is given by D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. D here stands for dividend per share. D here stands for dividend per share. E here stands for earnings per share. So we don't want total, we want per share basis. Now here they have given EPS or total. Total earnings is 2 lakh, and how many equity shares we have? 20,000. That means what is EPS? 2 lakh is the total earnings and total number of shares is 20,000. So EPS will be 10. Okay. Dividend paid is 1,50,000. We want total dividend or dividend per share? 1,50,000 is a total dividend for how many shares? 20,000. On one share, how much is the dividend? 1,50,000 divided by 20, which is 7.5. Okay. All right. Then price earning ratio, that is P multiple. How much is P multiple? 12.5. And I think if you remember our regular class, I told you there is a inverse relationship between P multiple and cost of equity. P multiple is nothing but 1 divided by cost of equity. Or you can find out cost of equity as 1 divided by P multiple. How much is P multiple? 12.5. So therefore cost of equity will be 1 divided by 12.5, which is how much, sir? 0.08. We wanted in percentage, so we can take it as 8%. Why is this? How do you get P multiple? NPS divided by EPS. You know, we had an earnings price approach in cost of equity we discussed. How do you get cost of equity under earnings price approach? EPS divided by NPS. Compare. This is NPS by EPS. This is EPS by NPS. Hence, we say cost of equity and P multiple have ulta relationship. So therefore, cost of equity is nothing but 1 divided by P multiple. So if you do that, you will get cost of equity to be 8%. Yes, sir. Yes, we need that. No, cost of equity we need for our Walter, sir. That's the reason. It was not given. We found out like this. Any problem? No. Okay, now imagine, sir. What and all data we need for Walter, sir? D. Did we get D? Yes. R. R is a rate of return on investment. Have they given the rate of return on investment? John, no. Cost of equity we got yes. EPS did we get? Yes. DPS did we get? Yes. The only figure missing is what, sir? R. Rate of return on investment. We know this. It is there. You have to tell me. R here is nothing but your return on equity. How do you get return on equity? Return on equity. Each divided by equity. Yes, no. Each divided by equity. How much is the earnings here we have, sir? 2 lakh rupees. Divided by equity. Equity is equity share capital plus retained earnings. We don't know that. We have how many number of shares we have? 20,000. What is the share capital of company? 100. That means what is the equity share capital? 20 lakhs. So 2 lakh divided by 20 lakh into 100 euro. How much is that? 10%. So R is basically 10%. R is also given. Not directly, we need to infer it. Okay, people. So you got all the numbers. Plug in the numbers and ask, substitute into the formula. Correct. But first, let's read the question. What are they asked? Analyze whether the company is following. They did not ask price. They asked analyze whether company is following optimum dividend policy. For finding optimum, we need two components. We need cost of equity. We need R. R is how much, sir? 10%. Maybe I'll write it over here. Or I think I've solved. Why to worry? That's R is how much, sir? 10%. Cost of equity, how much did we get? 8%. Tell me, R is greater than cost of equity. If R is greater than cost of equity, you are running a loss-making project or profit-making? Profit-making projects, will you pay dividend or zero dividend? Therefore, optimum dividend payout ratio is what? 0. Meaning, company should pay dividend or it should not. But in the present case, has the company paid the dividend? Yes. That means, are they ideally, as per Walter, sir, you should not pay dividend. But is the company paying? Yes. So are they following optimum dividend policy? No. That is what you need to conclude. But company is paying dividend. Hence, company is not following optimum dividend payout ratio as per Walter model. They did not ask price. They just ask you for comments. Can I move on to the next requirement? Okay, second one. Compute P ratio, okay, at which dividend policy will have no effect on value of the shares. Compute P ratio or P multiple when the dividend policy will have no effect on value of shares. When will dividend policy have no effect on value of shares? Under one scenario. Which one scenario we discuss? When R is equal to cost of equity, there is no optimum payout because whatever you pay, share price will be same. So that means which scenario should play out here? When R is equal to cost of equity. R is an already applicable. See, cost of equity is an expected number, but R is an achieved number. So which one will you freeze? R. What is R in this problem? We already found out. R is equal to how much? 10%. So if R is 10%, means the cost of equity also should be 10%. Did they ask you cost of equity or they asked you P multiple? How do you get P multiple? 1 divided by cost of equity. How much is cost of equity? 10% or 0.1. That means this will be how much, sir? 10. So if P multiple is 10 means whatever dividend you pay, it will have no impact on the value of the firm. Okay, whether you pay 0%, 1%, 10%, 100%, share price will be same. Understood? That's what they asked. Comfortable? I think I've proved it to you. If you want, I can just prove it to you here also. Okay. For your reference. This will play out when, sir? When R is equal to cost of equity, there is no optimum dividend payout ratio. Every payout is what? Optimum only. Because price of the share will change or it will not change. It will not change. I've worked it out again. If R is 10% means K also should be 10% and P multiple should be 10. Let's do a thing. Let's use this data and work out the price of the share. Because what is the theory saying? Whatever you pay, share price will be same. Let's assume some random numbers. Let's say we have paid a dividend of 70%. Let's say dividend payout ratio is 70%. Dividend payout ratio is always calculated on earnings. Meaning, if dividend payout ratio is 70%, means 70% of earnings company is distributing as dividend. So how did you get 70%? Assumption. Just to prove this point, I assume. If you don't want 70%, you take 7%. You take 1%, you take 0%, answer will not change. So let's calculate. How do you get P naught as per the Walter Search model? D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. How much is earnings per share, sir? We have already calculated. How much is EPS? 10. So EPS is 10. How much dividend you are giving on earnings? 70%. Earnings is 10. Of earnings, 70% you will pay out. So that means what will be the dividend? 7. Plus R. R and cost of equity will be same. How much is that? 10% or 0.1 into E minus D. What is earnings per share? 10 minus the dividend per share. How much? 7. Whole thing divided by cost of equity. How much you getting the price? 100. Okay now. Yes, people. Now let's change. Instead of 70%, let's take any other number. Let's make it as 100%. You can take any other number. Doesn't really matter. Let's assume now dividend payout ratio is 100%. So how much is earnings? 10. So dividend payout ratio is 100%. That means whatever you earn, 100% you distribute as dividend. So dividend also will be how much? 10. Work out this number. Let's see. D, which is 10, plus R divided by cost of equity, which is 0.1, into E minus D. E is 100, E is 10, dividend is also 10. So divided by cost of equity, if you do, price is still how much? 100. Here also it was how much? 100. That means you moved from 70 to 100. Did the price change or it did not change? That is what they asked the question. What dividend policy you should adopt so that the share price will not change? Share price will not change only under one circumstance. Which circumstance is that? R should be equal to cost of equity. They did not ask you to prove this, okay? I just proved it for your reference. Don't do this in exam. This is just for your reference here. Done now. Second requirement, done now. Beta starter. Okay, moving on. Third requirement. Will your decision change if P ratio is 8? Kindly, what is P ratio? 12.5. Instead of 12.5, if you make it as 8, will your decision change is what they ask. We need to rework the number. If P multiple is 8, means how do you get cost of equity? 1 divided by P multiple. So 1 divided by 8 will get you how much? 12.5. But R is an achieved number. How much is R? 10%. Now your decision is same or change? Completely change. Sir, R is 10%. Cost of equity is 12.5%. So which scenario is this? Profitable or loss making? R is lesser than cost of equity, means what is optimum dividend payout ratio? 100%. And I worked out the price, optimum price at that particular level. So obviously the answer is what? Dividend, answer will not change or it will change? It will change. So I've just worked out, considering optimum dividend payout ratio is how much, sir? 100%. I've reworked the number. How much is EPS? 10. So how much will be DPS? 100% of EPS, which will be 10. Work out the number. Dividend is how much? 10. Cost plus R. R is how much? 10%. Divided by cost of equity, how much? 0.125. Into E minus D. E is 10, D is also 10. Whole thing divided by cost of equity. If you work out, the answer you will get it is how much? 8. Obviously, answer will change. I've just worked out the price. If you want, you can work it out, or otherwise, you can just answer in words. Understood the question now? Your application of the numbers, that's all. So, this is about Walter Search model. Problem number 2, dumber. 2 over, 2 more to go. Can we take up the third one? Okay, third one is actually entirely homework. Gordon sir. This is Walter sir. Next we are discussing Gordon sir. Actually, Gordon sir is everything you already know. This is not a new thing. You have already done this. Have you applied Gordon sir's formula already? Yes. How did you get cost of equity, sir? Growth model correct only, but what is that formula? D0 into 1 plus growth rate divided by P naught. Flotation cost will not be there, so leave that. Plus the growth rate. This you will use if they give D naught in the problem. If they give you D1, then it will be what, sir? Cost of equity will be where I have written. P naught will also be equal to D1 divided by, or 1 second, hang on. Yeah, I'll write it once again over here. If they give you D1, it will be D1 divided by P naught plus the growth rate. We'll either use this formula or this formula, correct now? Now here, we are not finding cost of equity. We are finding P naught. We are finding P naught. That means we can substitute in this only, or you can reconstruct the formula. So what you can do? P naught is equal to what here, sir? P naught is equal to what? If you work it out, maybe we'll work from this angle. If you work from this angle, how do you get P naught? You will get it as what, sir? D naught into 1 plus growth rate. P, you send it to this side. You have to work whole step, or this is okay? Or maybe we'll work out the whole step. Tell me, sir, how do you get P naught from here? P naught is equal to, or maybe I'll call this, send the G to the other side. So it will become K minus G divided by P naught into D naught 1 by growth rate divided by P naught. Therefore, P naught will be what? D0 into 1 plus growth rate divided by cost of equity minus growth rate. That is what we have written here. Okay, now just a pure substitution of formula. D0 into 1 plus growth rate divided by K minus G. Suppose they give you D1 means, then what, sir? P0 will be, instead of D0 into 1 plus growth rate, you will take what? D1 divided by cost of equity minus growth rate. That's another formula. Depending on, you'll use which formula. If they give you D0, you'll use D0 ka. If they give you D1, you'll use D1 ka. Then one more formula you can do to substitute. What is that? Instead of writing D1, can I write this as E1 into 1 minus B? Instead of D1, can I say the numerator as E1 into 1 minus C? 1 minus B. What is E1? Expected earnings per share. B is what? Retention ratio. Sir, suppose the retention ratio is 0.4. If retention ratio is 0.4 means what is dividend payout ratio? 40% if you are retaining means 60% you are paying. So if you do 1 minus B, what are you going to get? 1 minus 0.4, you will get what, sir? 0.6. What is 0.6? Dividend payout ratio. If you take expected earnings and multiply dividend payout ratio, what will you get? Expected dividend. Expected dividend only is denoted by the symbol what? D. So again, this is a substitute. Instead of D1, we can write E1 into 1 minus B divided by cost of equity. Instead of G, G is equal to B multiplied by R. Instead of G, we can write substitute with BR. That is another substitution wala formula. Okay. Sir, if they give you growth rate directly, use one of these two formulas. If they give you retention ratio or dividend payout ratio, use E1 ka formula. Depending on what data they have given, use one of the formulas. That's it. Okay, now just to be on the safer side, let's sum up here everything, all the formulas. Tell me. First, if you want P naught, there are three ways to get it. One, D naught into 1 plus growth rate divided by cost of equity minus growth rate. Or P naught is given by D1 divided by cost of equity minus growth rate. Or P naught is equal to, instead of D1 we will write, take E1. E1 is expected EPS into 1 minus B divided by cost of equity. Instead of G, substitute with D. One of the three formulas we will apply it in the question depending on what data given. Can we go ahead and apply this now? Question number 4. The following figures are collected from the annual report of XYZ Limited. Fine. Net profit. So net profit means profit after tax. That only we call it as net profit. How much is net profit? 30 lakhs. Outstanding 12% preference shares 100 lakhs. We have 100 lakh of preference shares. What is 12% denoting? Preference dividend. Preference share capital is 100 lakh. Dividend, preference dividend is how much? 100 lakh or 12%, which is 12 lakh. Why am I doing this? Because as per God, no, we want, if you just check here, they are given cost of equity and they are given return on investment. Return on investment is nothing but R. That means we will use that growth rate formula or BR formula. BR formula. For BR formula, we need E. E as in EPS. Okay. How do you calculate EPS? E should divide by number of equity shares. They are not given each, they are given PAT. How do you get each? PAT minus preference dividend. That's the reason how I am calculating preference dividend. Okay now. So first the step is to find out EPS. How do you get EPS? PAT, net profit PAT is 30 lakh. From that reduce preference dividend. 100 lakh per 12%. How much is that? 12 lakh. From PAT, if you reduce preference dividend, you will get net income of each. How much is the number of equity shares? Number of equity shares is given to be 3 lakhs. So how do you get EPS? Each divided by number of equity shares, which is how much? 6. You got one component. Done now. Next, they are given return on investment. Return on investment is nothing but your R. How much is that? 20%. Cost of equity, they are given it to be 16%. Okay. calculate the price of the share using Gordon's model. If dividend payout ratio, you have to solve this question under three circumstances. First scenario, when dividend payout ratio is 25%. Dividend payout is 25% means how much ever your earnings. Sir, payout ratio is always calculated on what? EPS. So if 25% of earnings, if you are distributing as dividend means, how much are you retaining? 75%. That means can I say B is equal to 75% of 0.75? Because for our formula we need B. Correct? No. So if dividend payout ratio is 25% means retention ratio will be 75%, which is nothing but 0.7. Now you got all your number. Tell me, sir, how do you get P naught as per Gordon's formula? E1 into 1 minus B divided by cost of equity minus BR. Work it out. Expected earnings, just how we worked out. How much is EPS? 6. EPS is 6. Into 1 minus B. How much is B? 0.75. Divided by cost of equity. How much is cost of equity? 16% or 0.16. Minus BR. B is 0.75. R is how much? 20% in full decimal it will be 0.2. Solve this question. Let's see what we'll get. Fatapat 10. Numerator is how much? 1.5. So this will be 0.16 minus this is how much? Final number. Final number is how much, sir? P naught? 150. Maybe I'll cross check here. P naught is 150. Correct? Clear? Okay. This is under one scenario. Which scenario is that? When dividend payout ratio is 25%. Next, same thing you have to calculate when dividend payout ratio is 50%. If dividend payout is 50% means how much are you retaining? 50%. So B is 0.5. Work out under second scenario. When you work out, you're going to get 50 with pure substitute. Next, when the dividend payout ratio is 100%. So 100% of earnings if you're distributing means how much are you retaining? 0. That means B is 0. Substitute B with 0, you will get the price to be 37.5. Why am I covering all the case? Simple. Which scenario is this? Though they have not asked, just for your reference. R is 20%. Cost of equity is 16%. Which scenario? R is greater than cost of equity. When R is greater than cost of equity, Walter sir and Gordon sir have the same optimum dividend payout ratio. What is it? When R is greater than cost of equity, optimum dividend payout ratio should be
0.
Optimum payout ratio should be 0. So company should pay dividend or it should not. Check what has happened. First the company paid. Check this. First the company paid 25% dividend. Share price was 150. Now they increased the dividend from 25, they made it to 50. Share price from 150 became 50. Then from dividend payout ratio of 50, they made it 100%. Share price from 50, it fell off to 37. The more and more dividend you give, share price will go on falling. If you want optimum or the maximum value of the share, optimum dividend payout ratio should be 0. Not asked, just for your reference. Done. Work. Third scenario also. Now, we have one more. Before one more, we have one or two small ones. Quickly, we'll cover that as a simple case study, small examples. Giam and Dodd model. Giam and Dodd model. I don't see this in new study material. They've removed it. Okay, but in MCQ question, somehow they brought it. Concept, everything they removed. But in MCQ question, they brought it. So I don't know whether it is there in the syllabus or not there in the syllabus. Even I'm not sure. But still, AHA will cover it off. So as per Giam and Dodd model, another person, price of the share is given by MDE3. M is in multiplier. D as in dividend per share, E for EPS divided by 3. 3 as in multiple 3. Okay. This is your multiplier. What is multiplier will be given to you in the question. Purely you substitute, just a pure memory technique. That's it. M into D plus E divided by 3. If you do that, you will get it to be price. Because this is purely their hypothesis. Because this is their multiplier. They will get the multiplier. So we don't know what is that multiplier. So it will be given to you in the question. So just plug in the numbers. By plugging in, you will get the price of the share. To be on the safer side, go through in case they want to ask 2 marker MCQs, they can. Next one is Lintner's model. Now Lintner's model was based on a study. Later said that he interviewed a lot of finance managers. What outcome he came across is finance managers are not comfortable increasing the dividend percentage. They are not comfortable increasing the dividend percentage. Like last year, if they have paid 10 rupees dividend, if last year the company has paid a dividend of 10 rupees per share, means current year also finance manager don't mind paying 10 rupees, but they are not comfortable increasing the dividend. That is what Lintner ka study with the finance manager revealed. They are okay to give the same dividend, but they are not okay to increase the dividend. So with this studies and all this data, Lintner sir said there is a way to calculate D1. So Lintner's formula does not give you the current market price. It only gives you the expected dividend. Expected dividend, we call it as what, sir? D1. Okay. So as per Lintner's model, D1 is equal to D0 plus EPS into target payout ratio minus D0 multiplied by adjustment factor or speed of adjustment. This is the formula. So should we remember? Every damn formula you need to remember. Okay. So again, D1 is equal to D0 plus EPS into target payout ratio minus D0 into adjustment factor. Actually, it is a very simple, but they are just trying to complex the things. What is the whole mudda as? Maybe I'll just tell you this. Check this. Suppose company has already paid dividend of 10 rupees. That is what dividend already paid is D1 or D0? D0. Okay. Take this number. Listen everybody. Okay. In the future, my company is expecting an EPS of 20. I've assumed all these numbers. In the future, my company is expecting how much EPS? 20. And the company wants to give a payout ratio of 60%. Payout ratio is always calculated on what? EPS. How much is EPS expected? 20. How much is dividend payout ratio? 60. Calculate 20 or 60%. How much is that? 12 rupees. Correct? That means if you take expected earnings and multiply dividend payout ratio, you get existing dividend or future dividend. You get existing dividend or future dividend. Future dividend. Future dividend. Expected dividend only we call it as D1. How much is D1, sir? 12. But how much was last year dividend? 10. That means compared to last year, how much is dividend expected to increase? 2 rupees. Lintner sir said that you calculate the increase in dividend, multiply by the adjustment factor. Adjustment factor is probability percentage. There is a 40% probability that the dividend will increase by 2 rupees in the next year. That's what this formula is trying to calculate. In fact, we could have given in simple words. Increase in the dividend multiplied by probability factor. Because if you take EPS into target payout ratio, you will get D1. From D1, if you minus D0, what are you going to get? Increase in dividend. Increase in dividend will not happen 100%. There is only a probability of adjustment factor. That could be 40%, 80%, 90%, 10% or whatever. That is what Lintner sir is trying to say as a fancy formula. Okay, so that means the D1 again is given by what? D0 plus EPS into target payout. When you do EPS into target payout ratio, you will get D1. But we don't want D1, we want increase. How do we get increase? Minus D0 you do. By doing that, we will get increase. Will this increase happen 100% or there is a probability? So multiply probability percentage. That we call it as adjustment factor. Sometimes it is also known as speed of adjustment. By doing this, we will get the expected dividend, which is D1. Okay, Saru. All this example or numbers, what I assume to know, they will give it to you in the question. You need to substitute and get the answer. So no, I'll not take any questions in this regard. This itself becomes a question. Okay, Saru. Okay. Next, last thing, of late we are seeing a lot of questions on this concept in our RTPs and MTPs. Maybe for 1 or 2 attempts, this could be important. The last concept for dividend payout ratio, that is dividend discount model. Dividend discount model. Basically, you can find out the value of the share using one model. That model we call it as a dividend discount model. And the price what you get, in fact, they will tell you in the problem. Okay. Find out the intrinsic value of the share. When they say intrinsic value of the share, indirectly they are asking you to refer dividend discount model. Now, how do you get this? There is a fancy formula. This is the formula. This is the formula. Very simple, but just formula looks crazy. Formula is the D1 divided by 1 plus cost of equity plus D2 divided by 1 plus of cost of equity whole square plus D3 divided by 1 plus cost of equity whole cube plus D4 divided by 1 plus cost of equity whole power 4 plus D5 divided by cost of equity minus growth rate into 1 divided by 1 plus cost of equity whole power 4. This is the formula. Know them. Just fanciness. You don't need to know this formula at all. Without formula, you can solve the answer. That is what we will solve in one question. Okay, now, and tell you what this formula means also. You have a choice. I don't prefer the formula. I will tell you normal way. You can solve normal way or formula way. Answer will be same. Okay, can we do it? So basically, what are we trying to find out here? We are trying to find out the value of shares. Okay. Let's see, let's read the data, then I'll give you some point. I'll discuss what to be done. 1 minute. This one. Question number 20. I think again this is a study material question only. This question you'll find it in a lot of RTPs and MTPs also. Similar concept one, not the same question. Okay, listen. A&R is a company, is a large multinational company listed in Bombay Stock Exchange in India with a face value of 100. Company is expected to grow at 15% for the next 4 years. Okay. So company is expected to grow at what rate? 15%. For how many years? 4 years. Then it will grow at 5% for an indefinite period. Indefinite period means infinity. For the first 4 years, 15%, and thereafterwards 5% up till infinity. Shareholders expect a 20% return. For shareholders, it is a return. For a company, it is a cost. So shareholders' expectation here refers to equity shareholders' expectation. That only we call it as what? Cost of equity. Company paid 120 as dividend. Stop. If company has already paid a dividend, it is D1 or D0? D0. So this 120 is D0. For financial year 2021, great. The shares of the company are traded at an average price of 3122. Sir, share price already given? No. Yeah, this is the market price of the shares in the Bombay Stock Exchange. They will not ask you market price. We have to find out the intrinsic value of the share. Okay, that value will not be seen. You have to find intrinsic value and comment whether the share is overpriced or underpriced. So intrinsic value you have to compare with share market value and accordingly find out whether the share is overpriced or underpriced. Can we do it? I will not use formula. I will use a normal one. It's very simple. You have to find out the price of the share. No? Shareholders will get some return. What is the return for shareholders? Dividend. Another one is price. Another one is price. Now, they told the dividend will go constant up to how many years? 4 years. Then afterwards, it will go on for infinity. So, infinity calculations can be do? No. You can have to freeze the calculation up to which period now? 4 years. Because there afterwards, it's infinity. For how long we don't know. So, well, let's calculate only for 4 years. It's very simple. Can you calculate next year dividend? Yes. How do you calculate that? Sir, dividend already paid is how much? 120. Next year also will it be 120 or there is a growth rate? How much is the growth rate for first 4 years? 15%. So 120 into 15% you do. How much is that? 138. I'll tell you. D2 can you calculate? We will calculate D1, D2, D3, D4. Why up to D4? Because up to 4 years growth rate is constant at what rate? 15%. So D2 will be how much? 138 ka 15%. Add and tell me. 158.7. D3 will be 158.7 plus 15%. How much? 182.50. D4 will be 209.8. Okay. Comfortable? Now, this is what, sir? This is present dividend or future dividend. You want the share price in future or present value? Just find out the present value of this. Just find out the present value. To find out present value, we have to take discount factor. What is the discount factor? Cost of equity of 20%. That is what formula ka first point is trying to give you. What is that formula? I'll show you here once again. D1 divided by 1 plus cost of equity means you are taking first year dividend multiplying first year discount factor. D2 divided by 1 plus cost of equity whole square means you are taking second year dividend and multiplying second year discount factor. Like that you have to do for 4 years. Why 4 years? Growth rate is constant only up till 4 years. By doing this, what will you get? Present value of expected dividend. That is what this part of formula is trying to capture. Understood? Okay. Is the return for equity shareholders only dividend or also price? Also price. Okay. Now we have to find out price. How to find out? This is the formula to get the price. D5 divided by cost of equity minus growth rate. So how, sir? You know this, sir. How do you get P1? How do you get P0? D1 divided by cost of equity minus growth rate. If you want the P0 is what? Current market price. If you want current market price, you will take D1 divided by cost of equity minus growth rate. If you want P1 means what you will do? If this is P0 means this is D1. If this is P1 means this is D2 divided by P minus growth rate. If you want P2 means D3 divided by cost of equity. We want which price? Up to which rate the dividend is growth rate is constant? 4th year. That means we want the price at the end of 4th year. So P4 will be what? D5 divided by cost of equity minus growth rate. Check. That's what I've written here. By doing this, what will you get? Price of the share at the end of 4th year. This is the price of the share now or after 4 years? You are finding intrinsic value after 4 years or now? But this is the price of the share after 4 years. So multiply by what? Discount factor. Which year ka discount factor? 4th year ka. That is nothing but 1 divided by cost of equity whole power 4th year ka discount factor. Fancy formula. Anything is there? No. Simply you are finding present value of expected dividend and present value of share price. Add the two, you will get intrinsic value. Compare that with market price and comment whether it is increased or decreased. Can we quickly review this question? Everyone understood the formula? So I have solved it this way. If you want, you can take up this. Where it went, I think here. First, I put one working note to find out, or not written. Working note number 1 to find out what's expected present value of what's dividend. First, we will do working note only to find out present value of dividend. For how many years is the dividend constant? 4 years. That means in the year column, I'll put 1, 2, 3, 4. Dividend paid already is how much? We already calculated that also here. Where it went? Here, 1 second. Hey, come down. It's not coming only. Thought I wanted to move it a little closer. It's not happening. Okay. Done. So how much of the D1 we got? 138. How much have I taken? Check. 138. So D2 will be 138 plus 15%, which is 158. D3 will be 158. Plus 15%, 182. D4 will be 209. All these are what? Future value. We want what? Present value. From future value, how do you get present value? Multiply discount factor. Discount factor at what rate? Cost of equity. How much is cost of equity? 20%. So discounted at 20%. So how do you do? How do you get discount factor? 1 divided by 1 plus I whole power n. What is first year discount factor at 20%? 1 divided by 1.2 if you do 0.883. Press equals to button. You'll go on getting 4 years discount factor. Take the future value, multiply discount factor, you will get what? Present value. Adding all this, you will get what, sir? Present value of a dividend, which is how much? 432.01. This is one return for the shareholder. Is this the only return or one more? Which is what? Price. Which is the price. And up to what rate growth rate is fixed? 4 years. Beyond that, infinity. So that means we will find out what's present value of the share. Before we find present value, first we need the price. We need a price at the end of which year? 4th year. How do you get this? D5 divided by cost of equity minus growth rate. Yes, sir. D4 was how much? 209.87. So D5 will be, don't add up 15%. After 4 years, they told the growth rate will not be 15%, it will be 5%. So D5 will be what? 209.87 plus 5%. Divided by cost of equity is still 20%. Now, the growth rate is not 15%, it is 5%. Okay, calculate this, you will get price how much? 146 or 69.09. This price is the price of the share now or after 4 years? I mean, this is what value? Future value. We need what? Present value. So how do you get present value? Take the price multiplied by the discount factor. This is the price of the share when? After 4 years. So which year ka discount factor will you take? Fourth year. You already calculated that. How much is that? 0.4822 multiply. You will get what? Price of the share to be 708.395. This is one return. Dividend is another return. How much is the dividend return? 432. How much is the price return? 708.395. Add the two, you will get intrinsic value of the share. Okay, now any problem? So this is as per the dividend discount model. But currently the share is trading in the market at what value? 3122. As per our model, value should be, price of one share should be 1140. But in the market, it is 3122. Instead of 1140, it is 3122. I mean, share is undervalued or overvalued. That is what you need to call it. Share is overpriced by the difference between these two. How much is that? 1981.595. I prefer this method than formula. The reason is, if you open one of the MTPs, I don't know, in this year only 2024, they gave the same question, but as a case study, and they asked 4 questions. They did not ask intrinsic value. They asked 4 questions. You know what those 4 questions are? One, they asked how much is present value of dividend. Question number 1. Next, they ask you what is the price of the share after 4 years. Question number 2. Then they ask present value of the share. Question number 3. Then they ask you intrinsic value of the share. When you use the formula, you will be able to figure out all of them? No. Because when you use formula, you can, but you should be a bit careful. When you do this part of the formula, this part of the formula will give you present value of expected dividend. This part of the formula will give you P4. This is your discount factor. When you multiply these two, you will get present value of the shares. If you are able to figure out that much, use formula. Otherwise, solve like the way I have shown, based on your comforts. Done now. Okay. I think, yes, people. So with this, even the dividend discount model fully we have completed. With this, our marathon session is also officially completed. Thank you. So, can I finish off this? Just a few more points I would like to share, exam related things. Is that okay with you? We'll take it up later. A few pointers I would like to share it with you people. 1. I know FM, for a 50-mark paper, FM ka syllabus is quite voluminous. I take roughly around 125 to 130 hours to complete this paper now. For marathon, I don't know how many hours I took, maybe 15, 16, I don't know. Alright. But I've tried my level best to incorporate almost all the concepts and I've covered. Okay. So now the ball is in your court. Maximum possible from my side. I'm not saying I am the best faculty, great to be eternal. Whatever best was possible from my end, I've tried it and I put it across. So now you take it forward and go on in full swing. This time period, no excuses. Excuses nahi chalega. Sir, I will only study for 1 hour. I will only study for 4 hours. I have my girlfriend or boyfriend, or I can't give up on them. Nothing doing. The only thing that matters for the next 1 month is you, your studies, your exams, your CA books. That is your priority. Everything else, sideline. Stop giving excuses. Excuses will not work going forward. You have to operate at the highest level possible. Now it's not the time for you to say, I will only study this much. Now it's time for you to exceed your expectations. If you plan to study 10 hours, you should execute 11. And when the day is over, you should pat on your back and say, Shabash Macha, I did a great job. That has to happen consistently for you to crack your examination. Don't freak out about the things you've already done. I see many students who say that, sir, I've not completed the syllabus, what to do? Sir, ideally, according to me, if you ask, a simple mantra which I followed for my CA examination, which I usually suggest in every class of mine also is, if you want to crack the examination, simple thing is, once you should study the syllabus once, and one revision is required. study once and a revision once is more than enough for you to crack the examination. If you're looking for a rank, revision has to be multiplied. Maybe instead of one revision, you can do 2 or 3 revisions to look for a rank. That's all a rank holder does. Nothing extra. Trust me, he also goes through ICAI material only, RTP only, MTP only. 2-3 attempts ka RTP, MTP only, everybody will go through. But what makes the difference is the number of revisions. It is proved psychologically that as per a survey that today we live in an information overdose age. If I suddenly ask you, today 11 o'clock, what did you do? You'll have to think for a minute, correct or no? Instead of 3 o'clock, what did you do? Full information, will you get it? No, you may have to think. That is the information overdose age we are living in. Suddenly, somebody asks me, what did you have for breakfast also? No, I'll have to think. Though it was just a few hours back, I'll not be able to recollect because we are exposed to so much of information. Our mobile continuously beeps. We'll get 100 of notifications so that our memory, has become too clogged. So we constantly lose the memory. And as per a psychology report, it says that around 20% of information, whatever you gather in a day, you will lose. Whatever information you have gathered, if you have gathered 100% information, 20% of the information will be lost that day only. So if you want the information to recollect, the one way to do that is revision. Here also, whatever we have done, if you want to recollect all those formulas for a longer period of time, the maximum number of times you need to revise. The more and more you revise, the more and more will be your retention power. So keep that in mind. So stop giving the excuses. That is first advice I would probably give it to you. Okay. Another one is don't worry about what time has passed. Ideally, as I said, you should have studied the syllabus once, revised the syllabus once. But no matter what we say, still many students will tell. Last 1 month is the time we actually open our books honestly and sincerely. Before that, full chill pill only. The class chillo, outside also full chillo. But last 1 month, literally pushpa on fire. Now, literally, they study like crazy. That too, last 2-3 weeks, though, some of them don't even sleep. 3 hours, 4 hours sleep, whole day studies. Why so much of drama? I don't understand. Aram se you could have started 3-4 months earlier and finished the syllabus easily. Aram se you could have cracked. But still, invariably, we end up in that scenario. If unfortunately, if you are in that category, don't freak out. Still, whatever time you have, give it your best. If you have 1 month, no problem. Next 1 month, everything for CA. In the name of CA, next 1 month, totally you are sacrificing. Your priority should be studies. How much ever is possible within 1 month, try to cover. If few things are getting left out, like one concept of a particular chapter, you are not able to revise. Yes. Or one chapter itself you are not able to revise. If you are in that scenario, it is all right. Doesn't matter where you are, still always have the confidence that you will crack the examination. Never let that, never let that confidence come down. CA exam is all about confidence game. And trust me, maybe 1 or 2 points I will say, whenever you are writing a paper, go ahead with the expectation. It's a 100-mark paper, right? Go ahead with the expectation that around 25 to 30 marks in every paper will be bouncer. Meaning it will be a difficult question, tricky question, or a new question. Every attempt, that is a normal trend. Okay, so don't freak out by looking at this number. If 25-30 is bouncer, means there will be another WACC. 65-70 marks, which will be more or less straightforward from your ICAI materials. Study material, RTPs, MTP. So it will be from here only. Cut paste most cases. What you need to do is, in this section, you need to score heavily. In this 70, you should aim to score 50 to 60. Pinpoint precision. No silly mistakes. People do a lot of silly mistakes. One way to identify that is writing mock paper. Your creativity is highest. You itself, you don't know how much creativity you have. So you will get to know that when you write some mock papers. So write that, and in this section, try to score as much as possible. In fact, more than this also you can cover. If you cover good marks here, in this section, even if you get 4 to 5 marks, good. From 60, it will become 65. And answer this section first, so that our confidence level increases. If your confidence level is up, you'll be able to manage this little better. Maybe some working note will click. Some pointer will click. Instead of 5 marks, you may end up getting 8 to 10 marks. From 65, you may land up with 70 also. At the end of the day, everything is about confidence. When you're nervous, even simple things also will start forgetting. That's the reason, whatever first you are comfortable, solve that. Anyway, you get the paper 15 minutes before only. If before the time starts 15 minutes, they'll give you reading time. At that point of time, go through the question, figure out what are the questions you want to solve first, in what order, and start solving, and let your writing speed be very fast, people. Many students find it difficult to complete CA paper. The reason, one of the major culprit is writing speed is not up to the mark. You need to increase your writing speed as much as possible. So now whatever time you have, write some mock papers and time them. How much time you are taking for mock paper? Just don't blindly write. Just put a timer and see how much time you took in that 3 hours, how many hours paper or how many marks paper you are able to complete it. Go through that. So that way you will be able to improve it. Okay. So this, as I said, just don't freak out. So go with the expectation that some part of the question will be bouncer. So when you see a new question, it will not freak you out because you are already prepared for this. Okay. You just need to manage this. Okay. In every attempt, this is not only true for you. It is true for us also. You believe that I've cleared my exam. You believe that, you believe no. That means we also did the same thing. Alright. We scored heavily here. We kind of somehow managed this. Because people at the end of the day know, you have taken up an exam which is one of the most reputable exams in the country. So imagine if any student, normal student, he studies 1 week and clears off the exam. Will CA have the value? No. That means the institute has one responsibility. What responsibility? To set a certain level of paper so that only those students who have put in the necessary efforts, only they will pass the examination. In all other courses, there may be that caste system, merit to that to this and all. In CA system, nothing else work. Whether you are a Hindu, Muslim, whatever, SC, ST, whatever you are, if you get 40 in aggregate, if 40 in individual paper, 50 in aggregate means pass. Otherwise, CA for you is not chartered accountancy, it is for come again for exam. As simple as that. So that is one good thing about our course. There is no partiality. Everyone is looked at in the same manner. Okay. And what institute looks for is the efforts. Because once you qualify CA examination, you will put autograph on financial statements, you will put signature. Sir, one signature of CA, millions of people will trust. They don't even know you. But just one signature that one CA has certified, blind belief people will say that CA is certified means everything is proper. That is the amount of respect we get in the society. That is the reason institute never in their last 50 years have reduced the toughness of this course. Last 50 years where they have maintained, this is the reason, because of the respect we get in the society. That is the reason they expect the CA students also to go through this grueling stuff. Okay. So even for small mistakes, institute is very critical because one small mistake if you commit after CA, it will bring down the whole profession. Like Satyam case. One auditor did a mistake. There are lakhs and lakhs of chartered accountants. One auditor did a mistake, but the whole fraternity, people in the market said the whole CA is waste people. The whole CA community took a blame because of one auditor. So that is the reason institute is very precise. They were like absolutely no compromise. Paper will be like this only. You have to get used to it. Okay. So go ahead with this mentality and it is easy. Don't freak out. Aram say we all have cleared, no, right? If I can clear it, then so can you. Right? Lakhs and lakhs of people, if they've already cleared the examination, means so can you. All you have to do is keep the self-belief. The best thing that you can do for yourself is believe in yourself. Don't think like I am dumb, my friend is smart, he did not clear CA in the first attempt, how will I clear? Sir, comparison on all, no, you should not do it in examination. Okay. See, if it's like this, if an elephant compares with kangaroo, if an elephant compares itself with the kangaroo and say, I will jump like kangaroo, the elephant will lose its legs. Correct? Same way, you should comparison as a disease. Don't compare. Okay, you are a unique human being. You have your own capabilities, own advantages, own disadvantages. So always think that what I have to do for my examination, I will do. What my friend has to do. Friendship and all is good. But for you to get CA degree, your friend cannot write your examination. Who should write? Only you. So always confidence level up high. Done. And few other things is write the paper. I've seen many students, they'll write first paper going up. They will write something. They will think that I will only get 15, 20. Then they will stop attempting other paper only. Don't be like that. Evaluation is not your job. Your job is what? Studying and writing the paper. Once you have signed up for a particular course, write the full group. If you have signed up for both the groups, write all the papers. If you have signed up for one group, write all the 3 papers in that group. Do not take a chance, because valuation doesn't work like the way you think. I've seen so many students, they tell I get 25, 30, but they end up getting 45, 50. Equally opposite is also true. Someone will say I get 75, not even 30. Creativity. They don't know their creativity. Only when they take their paper, now you can call back your paper and see, that way they'll get to know this mistake and all I did. Like that you will realize. Okay. So always attempt it fully, because once you have registered, it is counted as an attempt, at least for an experience. Okay. Just go and write. It doesn't matter how your preparation is. As much as possible, prepare. Try your best. Because in my view, if you ask me, if you have given your best, you are a winner. Because after all, a human being can do what, sir? Give his or her best, right? After that, we can't do anything. So let's try our best, put in the best foot forward. Okay. Result, we will leave it on Allah, Shiva, Jesus, whomever you believe in. Okay. That is not your job. Let it be. And also, I know that some of you are staying in PGs and all. Be very careful about the food you're eating. I've had, in fact, in our batch, only a couple of students who did not write the examination. Brilliant students. We were actually expecting rank, because in the class they were that brilliant. I asked him what happened. He said diarrhea, didn't write exam. Is that a reason to miss an examination? Right? If you are not prepared and if you skip an attempt, acceptable. But not feeling well and skipping an examination, how hurtful that person should have felt. So be careful about what you eat. Okay? It is okay. You can hog properly after your examination. Full biryani, kebab, batting and all you can do after exam. Till now, almost eat healthy food, avoid the junk food, because so many people, usually it is common that they will miss out due to all this fever giver reasons and all. Let's not get into that particular scenario. Okay, sir. So having said that, so give your best shot. I'm pretty sure that all of you will come out with flying colors. All of you have shown a wonderful support through online mode. You've been giving great support that is inspiring us to do a lot of things. So thank you for your wonderful support. So I'll try my level best to keep up or to improve. So wish you all the very best, guys. Take care. Stay safe. See you.